Good morning, one and all. My name is M.V. Ramchandra Rao. I am a practicing chartered accountant. I am going to take the classes for income tax. Friends, first of all, I would like to start the chapter that is Introduction to Income Tax. Friends, this is the first chapter, B category topic. Out of this topic, we can expect 1 or 2 marks question. Friends, this is conceptually important chapter. First, I would like to start with the section number 1, that is nothing but introduction. Friends, in India, income tax is governed by one act is called as Income Tax Act 1961. It applicable to each and every state of India, including Jammu and Kashmir. Next one, section number 2 always deals about definitions. Generally, section number 2 deals about definitions. Here also there are so many definitions. Okay, chalo. And next one is section number 3, that is a previous year definition, which I am going to discuss in couple of minutes. And the next one, the most important section number 4, that is charging section. Charging section tell you how the income is taxable and under which head the income is taxable and what are the special provisions related to that particular income that will be explained by the particular charging sections. So the overall charging section for the entire act is nothing but section number 4. This is also known as general rule. Friends, first of all, what is the meaning of tax? Friends, tax means that fee or amount or sum collected by the government from the public on their income, on their products, on their services. Friends, this is nothing but amount collected by the government. It is collected from the public on public income as well as on public money as well as on public services. Friends, on public income, whatever the tax collected is called as direct tax. On public products and services, whatever the tax is collected is called as indirect tax. Friends, the direct tax is none other than income tax, whereas indirect taxes are none other than, as of now, that is GST, goods and services tax. Friends, I would like to start the topic that is income tax. I repeat, income tax. Now, what is income tax? Income tax is a tax which is levied or imposed on income of a person. So every person who has specified level of income is liable to pay income tax to our Indian government. Next one, friends, if you want to understand the income tax, compulsory you have to cover one act that is called as Income Tax Act. In Income Tax Act there are so many components. There are total 5 components. First one is called as Income Tax Act 1961. Second one is called as Income Tax Rules. Next one is called as Budget. I repeat, budget. Budget in the sense that is called as Finance Act. Next one is called as Circulars and Notifications. And last but not least is called as Case Laws. That is Judicial Pronouncement, Judgments. If you want to understand the subject, you have to cover all the 5 elements, then only you will get thorough knowledge about the subject. Friends, anyhow, this is none of our syllabus. After all, our syllabus is only few sections, that too that is restricted to Income Tax Act, and we have only few rules. Anyhow, first I would like to start with the section number 4, that is nothing but charging section. Friends, every person whose total income of the previous year exceeds maximum income not chargeable to tax, in this case the person is liable to pay tax at the rates prescribed in the Finance Act for the relevant assessment year. Sir, first of all I would like to tell you one word. There are 2 years. One is called as previous year, second one is called as assessment year. Sir, everyone who will earn the income in the previous year, whatever the income we earned in the previous year, we are going to pay the taxes in the assessment year. So take it for granted, previous year income is taxable in the assessment year. So we will earn in the previous year, but we will pay the tax in the assessment year. So therefore, every person whose total income, I never told you gross total income, I told you only total income, whose total income exceeds basic exemption limit or exceeds threshold limit or exceeds maximum amount which is not chargeable to tax. So conclusion, friends, whose total income exceeds well, that person is liable to pay the tax as per the rate specified in the budget or as per the rate specified in the Finance Act. Okay, chalo. So friends, this is the charging section number 4. Charging section number 4 is clearly saying that every person who has income over and above basic exemption limit is liable to pay the tax in the assessment year itself. Income of the previous year is taxable in the assessment year. Total income of the previous year is taxable in the assessment year. Okay, chalo. Next one. First of all, how to calculate total income, how to calculate tax liability. Friends, please follow. If any person come to your CA office tomorrow, first you have to ask, what is the assessment year, what is the previous year? First you should ask that question. Because based on the assessment year and based on the previous year, income tax provisions will change. Every year, Government of India introduce one budget. Therefore, every year, the subject is subject to amendments. Our income tax subject is always subject amendments. Our subject is not at all static subject. Our subject is a dynamic subject. Keep on changing, keep on changing. Therefore, please check the assessment year and previous year. After that, determine the residential status. Sir, are you resident? Are you non-resident? You should ask that question. After that, we have to calculate income from 5 heads. Friends, there are total 5 heads. First one is called as salary, income from that salaries. Income from the head house property, income from the head business or provision, PGPB, that means profits and gains from business or provision. Next one, income from the head capital gain. Last one, income from the head other sources. Once again I am repeating, income from the head salary, section number 15 to section number 17. Whereas income from the head house property, section number 22 to section number 27. Whereas income from the head business or provision, section number 28 to 44 dB. Whereas income from the head capital gain, section number 45 to 55A. Whereas income from the head other sources, that is section 56 to 59. Once it is completed, all 5 heads income completed, then we have to apply the clubbing provisions. I repeat, clubbing provisions you have to apply. After that, we have to deduct set off and carry forward of losses if any. I repeat, clubbing provisions means income of someone else will be clubbed in the hands of SSC. Same way, losses also there. In that case, we need to deduct the losses. After that, friends, after calculating 5 heads income plus clubbing provisions minus set off and carry forward of losses, you will get gross total income. Out of gross total income, we need to give deductions under chapter 6A, or else we need to give deduction under section 80C to 80U. Then only we will get total income, or we will get net income, or else we will get taxable income. Take it for granted that taxable income is only taxable. The net income is only taxable. The what you call that income is total income is only taxable. So total income is taxable not in this current year, that will be taxable in the assessment year. That's all. But how to calculate the tax? First one, please remember, generally total income may consisting of different incomes which are subject to different tax rates. Friends, certain incomes are subject to special tax rates, but certain incomes are subject to normal tax rates. First, calculate those incomes which are subject to special tax rates. That income related tax rates we need to apply. We need to calculate first special tax provisions. After that, we have to calculate normal tax provisions. After that, we need to calculate total tax. On the total tax, we need to add a surcharge if any, or else we need to deduct rebate if any. After that, we need to add health and education cess. After that, we will get total tax liability. Out of that, we need to deduct advance tax or TDS or TCS or what you call MAT credit or AMT credit if any we need to deduct. Then I will get the net figure, that is called as net tax payable. I repeat, net tax payable I will get. That's all. This is the way we need to do computation of total income and tax liability. Friends, now definitions part. What is the meaning of previous year? What is the meaning of assessment year? What is the meaning of financial year? These points we wanted to cover right now. Friends, financial year means the year commencing from 1st April and end with 31st March of next year, and it consisting of anyhow 12 months time. So financial year generally common for that is previous year and as well as assessment year. That means previous year also will start April to and ends with March, and assessment year also start with April and ends with March. So friends, take it for granted, financial year as well as previous year as well as assessment year, in all the cases it will start with the April as well as it will end with the March. Okay, chalo, start with the April and end with the March. This is the financial year, this is the previous year as well as this is the assessment year. Okay, chalo. So but friends, now financial year means the year for which we will maintain books of accounts. Generally we will maintain books of accounts. This is a one parameter for computation of income or for the maintenance of books of accounts. This is one parameter, that is financial year. But here previous year is nothing but starting from April and ending with the March. In this year we will compute the income. I repeat, we will calculate the income. But here financial year and previous year both are almost all one and the same in this contest. Next one friends, assessment year means the year which is next to the previous year. The year which is next to the previous year, the year in which we will pay the tax, that is called as assessment year. So simple logic ma, in assessment year we need to do computation. That is the reason it is called as assessment year. Assessment means computation year. So the year in which we need to do computation is called as assessment year. Further, one year is in advance, that is called as previous year. Previous year. Okay, in previous year we will earn the income. In assessment year we will we will calculate the tax and pay the tax to the government. Okay, chalo. Next one friends, what are the tax rates? First I would like to cover normal tax rates. Friends, see the point. First one, Roman number 1 friends. In case of Roman number 1, take it for granted it is applicable for individuals, HUF, AOP, BOI, AJP, all the persons are covered. Up to 2,50,000 total income 0, 2,50,000 above up to 5,00,000 5%, 5,00,000 rupees to 10,00,000 20%, above 10,00,000 that is 30%. Slab wise we need to calculate. Whereas in case of resident senior citizens, I repeat, resident the two senior citizens, the two age 60 years or above, in that case take it for granted 3,00,000 is the basic exemption limit, as well as up to 3,00,000 0, 3,00,000 to 5,00,000 5%, 5,00,000 to 10,00,000 20%, above 10,00,000 30%. Last one friends, resident only, but that is nothing but super senior citizens, where the person's age is 80 years or more. In this case take it for granted friends, up to 5,00,000 0, up to 5,00,000 0, whereas 5,00,000 above up to 10,00,000 that is 20%, and above 10,00,000 that is 30%. There is no 5% slab rate for the super senior citizens. Next one friends, in case of companies and partnership firm and as well as in case of LLB, tax rates would be different. There is no basic exemption limits, so straight away it is taxable. For example, in case of domestic company whose total turnover or gross receipts in the previous year 19-20 does not exceed 400 crores, that is a fixed rate, that is 25%, whereas other domestic companies that is 30%. Whereas foreign company tax rate is 40%, whereas local authority, partnership firm and LLP that is 30%. In case of local authority as well as in case of partnership firm, whereas in case of LLP the answer is generally that is 30%. Okay, in case of local authority, whereas in case of cooperative society answer would be different. There is no basic exemption limit, but there are so many slab rates. Up to 10,000 that is 10%, 10,000 above up to 20,000 that is 20%, and above 20,000 that is 30%. This is applicable for cooperative society. Okay, next one friends, in case of resident individual means who are 60 years or above aged people, whereas super senior citizen means 80 years or above aged people. Okay, next one, we need to check if the person attained the age on 1st April of the previous year, then we can consider them as a senior citizens or super senior citizen, as the case may be. Okay, chalo. Next one friends, surcharge. Friends, surcharge is nothing but tax on tax. I repeat, tax on tax. Once upon a time there is a battle between India and Pakistan. At that time all of a sudden India needs some more money for the purpose of that battle. Immediately at the time Finance Minister S1 Simha, if I am not wrong, he only introduced the concept called as surcharge. Because of that reason, they wanted to levy extra tax from the rich people. So that is called as surcharge, tax on tax. Here, if your total income up to 50 lakh in case of individuals, there is no surcharge. Above 50 lakh up to 1 crore, 10% is the surcharge. Whereas above 1 crore up to 2 crore, 15%. Above 2 crore up to 5 crore, that is 25%. Above 5 crores, that is 37%. These are the surcharge rates. Okay, chalo. And next one, in case of companies and others, only one answer. In case of firm, LLP, local authority and cooperative society, up to 1 crore, no surcharge. Above 1 crore, directly 12%. I repeat, directly 12%, that's all. Whereas in case of domestic company, up to 1 crore, there is no surcharge. 1 crore to 10 crore, that is 7%. After 10 crore, that is 12%. Whereas in case of foreign company, up to 1 crore, there is no surcharge. Up to 1 crore, no surcharge for all these persons, okay, not for individuals. Individuals up to 50 lakh, no surcharge. Above 50 lakh, surcharge is applicable. Whereas in case of foreign companies, up to 1 crore, no surcharge. 1 crore to 10 crore, that is 2%. Above 10 crores, that is obviously 5%. But here one important point, interlevel most important, 25% and 37% as well as surcharge rates are not applicable for capital gains covered under section 311A, that means short term capital gain. Same way covered under section, that is 112A, that is long term capital gain, whereas it is also not applicable for a dividend income. So 25% and 37% surcharge rates are not applicable for long term capital gain and not applicable for short term capital gain, which are covered under special provisions, as well as not applicable for dividend incomes also. Next one, friends, these above surcharge rates are also applicable even though you opted concessional tax rates. I repeat, if SSC want to follow alternative tax rates, that is 115 BSE, then also same surcharge rates are applicable. Babu, in case of cooperative societies and in case of domestic company, concessional rates are applicable as for 115 BAD and 115 BAB as well as BAA respectively. Their surcharge rates are 10%. Friends, these are the special tax rates provisions. These may not be applicable for your interlevel, but maybe bits point of view it may be relevant. Otherwise, it is not relevant. Okay, chalo. Next one, friends, health and education cess, that is universal across the India, that is 4% will be levied. Next one, it is calculated on the sum of tax plus surcharge. I repeat, tax plus surcharge, or else tax minus rebate on the entire amount it will be levied. Next one, friends, there are special tax rates, that is optional tax rates, are also called as alternative tax rate. First one is section 115 BAC. In case of individual and HUF, all of you please follow 115 BAC is applicable up to 2,50,000 0. 2,50,000 to 5 lakh, 5 lakh to 7.5, 7.5 to 10, 10 lakh to 12.5, 12.5 to 15, above 15. If you observe carefully, everywhere we need to increase 2.5, 2.5, 2.5 like that. And the slab rates are also as follows. Tax rates up to 2.50, 2.5 to 5%, 10%, 15%, 20%, 25%, 30% respectively. So income also we need to increase 2.5, 2.5, 2.5, 2.5 like this, and the tax rate also we need to increase 5, 5, 5, 5 like that. Okay, chalo. And surcharge rates anyhow same, health and education is also same. Okay, chalo. Next point, 115 BAB, this is applicable for company, the company which is set up on or after 110/19 and that is engaged in manufacturing activities. In this case, tax rate not 30%, off rate only, that is 15%. Surcharge also not 12%, not 7%, directly 10%, and cess anyhow 4%. Next one, 115 BIA, that is domestic company, any company whether manufacturer or not. In this case, tax rate 22%, such as 10%, health and education as 4%. 115 BAD, that is resident cooperative society, surcharge rate 22%, sorry 10%, and tax rate 22%, health and education cess, that is 4%. Babu, marginal relief anyhow applicable for individual and HUF who opts concessional rate also. but not available for 115 BAB, 115 BIA as well as 115 BAD, not applicable with respect to marginal relief is concerned. And the above optional rates are not applicable for special incomes also. Okay. Next one, special incomes are always subject to special tax rate. In case of individual and HF who opted 115 BSc, not liable to follow AMT. AMT not applicable to those individual and HF who want to follow 115 BSc. Next one, the following deductions and exemptions not applicable if you want to opt 115 BSc. Somehow important. Headwise, I want to tell you with respect to salary chapter, certain things not allowed as deduction. If you want to follow alternative tax regime under section 115 BSc, number 1, deductions not allowed. So section number 16, deductions not allowed. If you want to follow 115 BSc, section number 16, deduction not allowed. Number 1, that is standard deductions not allowed, entertainment allowance not allowed, and next one is proportional tax also not allowed. Next one, leave travel concession also not allowed, exemption, HRA exemption not allowed, specified allowances also not allowed, but DTC allowed, that is daily allowances and transport allowances and conveyance. These three are only allowed. Rest of the exemptions are not at all allowed. I repeat, number 1, deduction under section 16 not allowed, and next one is called as proportional tax not allowed, LTC not allowed, HRA exemption not allowed, specified allowances are also not allowed. Next one, with respect to house property, interest not allowed. With respect to self-occupied property, no doubt, with respect to let out property it may be allowed, and the same way with respect to house property, set off and carry forward of losses, if any, cannot be adjusted against any other head income. Next one, PGPB, depreciation anyhow allowed, but additional depreciation not allowed, and 35 AD deduction not allowed, and specified deduction for donations made with respect to scientific research not allowed. With respect to IFOS is concerned, family pension deduction not allowed. And with respect to clubbing provision, section 1032 deduction not allowed, set off and carry forward, already I told you, house property interhead adjustment not allowed. Whereas chapter 68 deductions not allowed, only 2 deductions will be allowed, 80 JJAA and 80 CCD subsection 2. 80 JJAA means that is nothing but additional employment provided, at the time deduction will be allowed. 80 CCD subsection 2 means employer contribution to NPS or employer contribution to central government pension scheme, that is also not allowed. Sorry, these 2 are allowed, rest of the deductions not allowed. Exemptions, now section 10 subsection 17, that is MPs and MLAs exemption, that is not allowed, and section 10A deduction also not at all allowed. Okay, chalo. So this is the topic, friends. Next one, the above concessional rate 115 BAB BAA are applicable only SSC if they do not claim any exemptions and deductions, but they can claim 80 JJAA and 32, that is depreciation topic, that is allowed, and 80M, that deduction also will be allowed. That's all. These are the special tax provisions. Next one, special tax rates, very important topic. Out of that, first one is called as 112, that is long term capital gain. With respect to long term capital gain, take it for granted 20% tax rate applicable. Whenever 20% tax rate, take it for granted, no BEL, I repeat, no basic exemption limit, and no deductions, I repeat, no deduction, straight away 20% is the tax rate. Next one, 112A, that is long term capital gain in case of listed securities, etc. In this case, up to 1 lakh, that is not taxable, up to 1 lakh not taxable, we have over and above 1 lakh, 10% is the tax rate applicable. Okay, and no basic exemption limit and no deductions are also applicable. Next one, 111A, this is short term capital gain, up to no exemption level at all. Now directly that is 15% tax rate, that too there is no BEL, no deductions. And 115BB, that is memory code bad boys, I repeat, BB for bad boys. Some bad boys, what they will do, card games, etc., that is 30%, no, that is 30% tax rate, because it is a sin money, casual income. So lotteries, card games, casual income, 30% is the tax rate. Next one, 115BBA, memory code bad explanation, I repeat, bad explanation, unexplained money, unexplained bullion, unexplained jewelry, etc. These are subject to tax rate at the rate of 60%. They would have 60% tax rate, and such as 25%. Health and education anyhow 4%. Babu, these rates are applicable even if you follow the alternative tax provisions also. Okay, chalo. Next one, friends. In those days, Congress party introduced one concept, that is rebate under section 87A. You know what is rebate? Rebate means up to that amount, no need to pay income tax. So see the word, it is applicable for residents only, that too applicable for individuals, that too applicable whose total income not exceeding 5 lakh rupees. In this case, the whatever the rebate, least of the following. How much? 12,500, or else income tax whichever is lower. I repeat, 12,500 or income tax whichever is lower. It will be allowed before adding health and education. I repeat, after calculating basic income tax, then only we need to deduct this figure rebate subject to all these conditions. Then only net amount is only subject to health and education. Therefore, it must be applied before adding health and education. Next one, friends, rounding off the total income and tax liability. Take it for granted, total income as well as tax liability always must be rounded off to multiples of nearest 10 rupees. Last digit must be 0. Okay, see the last number. If the last number is above 5, automatically we need to go to upper 10 limit. If it is 5, also above upper 10 limit we have to go. If it is below 5, we have to come to, that is a lower 10 circuit we have to come. Okay, for example 7, take it for 10. Next one 4, take it for the ground level. Okay, chalo, like that we need to do the rounded off. Compulsory you have to do rounded off in exam hall. Please take care. Next one, average tax rate. Very simple ma, tax divided by total income into 100. In some cases we will use average tax rate, not here. In CA final we will use, leave it. Next one is called as MMR, that is maximum marginal rate. That means highest rate applicable to AOP and BY. I repeat, highest rate applicable to AOP and BY, that too, that is including surcharge and health and education. That is as of now 42.744%, because highest rate that is 30, surcharge highest also 37%, health and education anyhow 4%. Okay, this is MMR. And the last topic, friends, that is called as marginal relief. Sir, one simple logic, my income is 50 lakh. Whenever my total income 50 lakh, surcharge anyhow not applicable. Let us say my tax liability, let us say 10 lakh, not correct, example sake. Whereas my total income is 50 lakh 10,000. Obviously, my tax liability may be 11 lakh. I repeat, my tax liability may be 11 lakh. Do you know why? Unnecessarily surcharge is applicable. Whenever surcharge is applicable, no problem. As for the provisions, you have to pay surcharge. But only the point is, my income is increased by 10,000, whereas my tax liability increased by 1 lakh. It is not fair. That is the reason lawmaker wanted to give this differential amount as a marginal relief. That's all. This is only the logic beyond this. So for that, steps point of view, step number 1, compute tax on total income including surcharge. After that, step 2, that is compute tax on 50 lakh, 1 crore, 2 crore, 5 crore, 10 crore with respect to surcharge is applicable. Step 3, margin relief is equal 1 minus 2. Okay. Next one, step 4, tax liability is equal step 1 minus step 3. On that, we have to add health and education cess. Okay, chalo, this is the way we need to do the marginal relief. Anyhow, I told you the logic beyond this. Take care. Next one, friends, another topic, that is theoretical questions. SSE definition, very important definition. SSE section 2 subsection 7. Okay, what is that SSE definition? SSE means, first of all, you must be a person who is liable to pay any sum. I repeat, person who is liable to pay any sum, that person is called as SC, and also includes representative SC. That means who is representing someone else. For example, in case of minor, that legal guardian, or else in case of mentally retarded, legal guardian. In case of non-resident, their agent. So that like that, representatives SSC is also covered. And one more thing, defaulted at SSE in default also covered. The SSE who has not paid tax properly, the SSE who failed to pay tax, that fellow is also called as defaulted SE. For example, L&T Metro Rail. So once upon a time 30,000 labor is working in L&T. Under construction stage 30,000 employees are working. But for your information, L&T does not have any income. No income, no tax, that is clear. But L&T is paying salaries to these fellows. Each person's salary is obviously 3 lakh, 4 lakh like this. Whenever salary payment more than 2 lakh 50,000, generally L&T is required to deduct tax at source. Required to deduct tax at source. Hey, L&T, if you have not deducted, you are called as SSE in default. Okay, because you only defaulted in payment of tax. That is the reason even SSE in default also considered as SSE. So SSE means who is liable to pay the tax, and also who are not liable to pay the tax but come under other categories, they are also covered under SSE's definition. Okay, chalo. Next step, this is concepts related to income. This is only theoretical topic, not important anyhow. Income can be in the form of cash or kind. Kind also fine, but you have to pay tax to the government in the form of cash only, no need to pay in kind. Next one, number 2, income includes notional income in certain cases like 50 capital C, these kind of cases notional income also taxable. Next one, income includes losses also. Okay, wherever I say income, maybe losses also possible. Every income need not be taxable. Some agriculture income not taxable, gift not taxable generally. Next one, illegal income is equally taxable. Even smuggling or kidnap or anything, if you get the income, that is also taxable. Some person cannot tax it twice. Generally person taxed one time only. If double time is taxed, generally exemption will be given generally. Okay, persons will not be taxed twice, but no doubt in some cases under Income Tax Act, yeah, persons are taxed twice also. Purely that is intention of the lawmaker. Lawmaker will decide, you and me have to follow. Next one is all of you, some income cannot be taxed twice, and income means regular periodic monetary returns. Every time regular monetary returns. Okay, regularly it has to come, like rent, like salary, etc. But in some cases not like that, one time only we will get, like capital gains as well as winning from lotteries, etc. Next one, receipts are two types. One is revenue receipt, one is capital receipt. Revenue receipt means which is in recurring nature, recurring nature, which is in periodic nature, that is pakka taxable. So income earning by utilizing the source of income is called as revenue receipts. Suppose building rent or else salary, these are recurring in nature, pakka taxable unless otherwise provided. Emi chapakabote, unless otherwise provided, pakka taxable. Whereas capital receipts not like that. Receipts by way of sale of source itself, like capital gain, sale of house property or sale of building, etc. In this case we will get one time payment, that too lump sum, that too capital receipt, that is unless otherwise provided, not at all taxable. That's all. And friends, that last another part friends is as follows. Important concept, explanation. Generally lawmaker will give explanation to certain concepts, that is more elaborated purpose we need to follow. Next one, proviso. Proviso means it will give exception to the provision contained in the respective section. Some exceptions purpose they will provide. Next one, circulars. CBDT will issue the circular from time to time. It is a guidance note to the officers as well as SSG, but it is not binding on SC. SC like it they can follow, otherwise no need to follow. Next one friends, notification issued by central government friends. CBDT is also empowered to issue notification. Government may issue or else central government may issue, or else CBDT also may issue notification binding on SC as well as assessing officer generally. Okay, exemptions. Exemptions means not taxable, which is not included in the tax, which is not included in the income computation. Next one, deduction. Deductions means that is it is included in the income, but at the end after gross total income we will give deduction. Okay, the best example, royalty income under section 80 QQB or RRB, etc. Next one, assessment. Friends, assessment means honestly speaking computation. That is actually CA final topic. Assessment means computation. First SSC will do self-assessment and file the return. After that income tax department only will do final assessment, like best judgment assessment or else scrutiny assessment or else escaping assessment, like that. But none of our syllabus, it is only our syllabus is up to tax calculation as well as tax computation and filing of returns only, our CA inter or CMA inter syllabus. Okay, chalo friends, with this we're done with the topic called as chapter number 1. Thank you very much. Happy learning. Friends, in today's lecture we are going to start the chapter that is a residential status of individual. Very important chapter, A category topic. Out of this topic we can expect minimum 3 marks question. Friends, please follow. Generally, persons will be classified into two things. Number one, resident. Second one is non-resident. Friends, if you are a resident, take it for granted Indian income is also taxable as well as foreign income is also taxable. Ultimately, in the hands of residents, global income is taxable. But if you are a non-resident, no, only Indian income is taxable, foreign income not at all taxable. So friends, if you want to determine total income of any SSE, first of all we should know the residential status of the SSE. For determination of total income and tax liability, the important element is residential status. Therefore, residential status we need to determine each and every previous year. I repeat, for every previous year separately. In this chapter, residential status chapter, there are major 3 elements. One is residential status of individuals. Second part is residential status of HUF, AOP, BOI, AJP, partnership firm as well as LLP. And the third one is nothing but residential status of company. Friends, first I would like to start with the important topic, that is residential status of individuals. Friends, you know, individuals are nothing but natural human beings. Therefore, residential status of individuals shall be determined based on one factor, that is nothing but period of stay. How many days you stayed in India, that is only the matter. So friends, let's start the topic residential status of individuals. For that purpose, first of all, individuals can be classified into two things. One is resident, one is non-resident. Friends, one person can be a resident if he satisfied any one of the basic conditions. Actually, there are two basic conditions which are specified under section 6 subsection 1. There are two basic conditions, A and B. If he satisfied any one, either first one or second one or both, superb. If you satisfied both also, or else at least one or second one, out of two basic condition, if you satisfied at least one of the basic condition, then you will be classified as a resident. Friends, by chance, if you are not satisfied any one of the basic condition, then you are called as non-resident. That means if any person satisfied none of the basic conditions, then the person is a non-resident. Okay, chalo. So if any person satisfied any one of the basic condition, then the person is a resident. And another separate concept also there, that is called as deemed resident. Deemed resident is a special provision which is specified under section 6 subsection 1A, which will be discussed after a couple of minutes. Let's start the topic basic conditions. As I told you earlier, there are two basic conditions. If you satisfied any one of the basic condition, you are a resident. Once you classified as a resident, again the SSE will be classified into two other ways. One is RBOR, resident but ordinary resident. Second one is called as resident but not ordinary resident. If you satisfied both of the additional conditions, there are two additional conditions, separate conditions called as additional conditions, which are specified under section 6 subsection 6. If you satisfied both of the additional conditions, then you are called as RB or resident but ordinary resident. And the other part, if you satisfied any one or none of additional conditions, then you are called as RBN or resident but not ordinary resident. Okay, chalo. So if you are individuals, first we need to check the basic conditions applicability. Once any one of the basic conditions satisfied, again we need to check the applicability of additional conditions also. Okay, if you satisfied any one of the basic condition, then you are a resident. Again the resident is further divided into RBOR and RBNOR. If you satisfied both of additional conditions, then you are called as RBOR. If you satisfied any one or none of the additional conditions, you will be called as a RBNOR, resident but not ordinary resident. Okay, chalo friends. Now let's start the topic. First basic condition. Friends, if any person stayed in India for a period of 182 days or more in the relevant previous year, I repeat, 182 days or more in the relevant previous year, then take it for granted that first basic condition satisfied. For example, Mr. Sachin Tendulkar, he stayed in India for 300 days. Yeah, resident, because 300 days is more than 182 days, right? Chalo, next one. Sachin Tendulkar stayed exactly 182 days, then also he is a resident. Last one, Sachin Tendulkar, he stayed in India for only 140 days, only 140 days. Then friends, he failed to satisfy the first one, first basic condition. Then we need to check the second basic condition also. Be careful, second basic condition is like that. Number one, he stayed in India for a period of 60 days or more, 60 days or more in the relevant previous year, and 365 days or more during the period of 4 years immediately preceding to the relevant previous year. Current year you must stay for minimum period of 60 days or more, and last 4 years immediately preceding to the relevant previous year, you should stay minimum period of 365 days, minimum 365 days or more than that also. Then second basic condition satisfied. Okay, chalo. In my illustration, Sachin Tendulkar stayed for 140 days. 140 days means less than 182 days. So therefore first one failed. Then second basic condition we need to check. 140 days is more than 60 days. So okay. And last 4 years Sachin Tendulkar stayed, for example, for 400 days altogether. Yes. So in the current year more than 60 days, and the last 4 years more than 365 days. Therefore second basic condition satisfied by Sachin Tendulkar. Therefore Sachin Tendulkar is a resident. Chalo. If you satisfied either first one or second one or both of the basic condition, you will be called as resident of India. Okay, chalo. Now here I would like to tell you one word. This second basic condition is not applicable. I repeat, not applicable for 3 category persons. Not at all applicable. That means for them only first basic condition only we need to check. If first basic condition satisfied, they are residents. If first basic condition not satisfied, then no need to check the second basic condition. No need to check at all. The reason, second basic condition is exempted for them. The second basic condition is relaxed for them. Okay, for 3 category persons. Therefore I am going to teach you 3 category persons to whom second basic conditions not applicable. Number 1, individual, the 2 Indian citizen, the 2 the person who is leaving India for employment outside India. Sir, someone got the job in abroad, that is the reason is leaving right now. When any person leaving India for employment outside India, take it for granted, for him the second basic condition is not applicable. For example, your own brother, he completed his BTech. After that, he got the job in Canada. So he is moving to Canada right now. In India, he stayed for only for 190 days. Now tell me, what is the residential status? Number one, 190 days is more than 182 days. Therefore, is a resident. Second one, other example, your own brother, for example, he stayed in India for 150 days in the current year. After that, he traveled to abroad. Now tell me, friends, what is the answer? 150 days, less than 182 days. So first one failed. Leave it. Second one, not applicable because your brother is a individual, the two Indian citizen, the two leaving India because he got the job outside India, employment outside India. In this case, second basic condition not applicable. I am not telling you not satisfied. I am telling you not at all applicable. Okay, chalo. And other person, friends, Indian citizen, the two individual who is leaving India for employment in a vessel as a member of crew is leaving India. For example, in Kerala or else in Vizag, some persons are working as a crew members, some persons are working in a vessel, in a ship. So they keep on moving from one place to another place, one country to another country. They are keep on moving in the waters of India. So moral of the story, if you are a individual, the two Indian citizen, the two you are leaving India as a member of crew, in that case, first basic condition only we need to check. Second basic condition, first of all, not applicable. Okay, chalo. So here 2 points I told you so far. First one, individual Indian citizen. The two, the person leaving India for employment outside India. Second point is individual Indian citizen. The two, the person leaving India as a member of crew. That's all. Third one, friends. Very, very, very important point, friends. Please follow. Indian citizen or else Indian origin. First time I added one more word here. Indian origin. In Telugu it is called as Bharata Santati. Okay, chalo. Indian citizen or else Indian origin visiting India. Visiting India. In that case, what is the situation? I will take one best example. Indian citizen means you and me. We are Indian citizens, no doubt. For example, Indian origin means either parents or grandparents. I repeat, parents or grandparents. Either of parents, whether father or mother, or father side parents or mother side parents, must born in undivided India. Undivided India means the India which is there before 1947. You know, before 1947 means prior to independence. That means India plus Pakistan plus Bangladesh all together, that is called as undivided India in those days. Your parents or your grandparents at least born in undivided India, then you are called as Indian origin. Okay, chalo. If you check the cricket teams of abroad, England cricket team or else South Africa cricket team, many players are Indian origins. They are not Indians. Their ancestors are from India, but they settled in foreign countries. Nowadays, they are representing foreign cricket team. That is different story. Now here the point is, any Indian citizen or Indian origin visiting India, in that case, take it for granted if their Indian income, I repeat, Indian income alone is 15 lakh or less than 15 lakh, equal or less than 15 lakh, take it for granted, second basic condition not applicable. For example, their Indian income alone is more than 15 lakh, take it for granted, second basic condition applicable, but modified second basic condition is applicable. Modified, what is that? So you must stay at least in India for a period of 120 days or more. 120 days. I never told you 60 days. I told you 120 days or more in the current year, and 365 days or more during the period of 4 years immediately preceding to the relevant previous year. So I would like to tell you one word. Second basic condition not applicable to 3 category persons. I told you first person is the individual Indian citizen who are leaving India for employment outside India. Second point, who are leaving India as a member of crew. Third point, the person Indian citizen or Indian origin visiting India. In that case, if their Indian income alone is 15 lakh or less than 15 lakh, in this case second basic condition not at all applicable. But if any person, individual Indian citizen, that to Indian origin, whose Indian income is more than 15 lakh, in that case modified second basic condition applicable. That means 182 days are more in the current year and 365 days are more during the period of 4 years. Okay, chalo. For example, Sunita Williams, you know, she is a Indian origin. Actually she is American but Indian origin. Nowadays she been to space also, astronaut. One day what happened, because of love and affection towards India, she came back to India for visiting purpose. You know, her Indian income zero, because she is a foreigner. Actually Indian income zero, therefore take it for granted for her second basic condition not applicable. But other example, suppose one Indian citizen is settled in abroad, but for summer holidays or for Pongal purpose or some reasons he came back to India for visiting purpose. At that time he earned amount more than 15 lakh. Then yes, second basic condition is applicable for them. Okay, chalo, that's all. Friends, now we can check the additional conditions. Friends, there are two additional conditions as specified under section 6 subsection 6. First one, he has been resident for a period of 2 years out of 10 preceding previous years. That is the first additional condition. That means out of last 10 years you must be a resident at least for a minimum period of 2 years. And other one is as follows: the assessee must stay in India for a period of 730 days or more during the period of 7 years immediately preceding to the relevant previous year. I repeat, during last 7 years he must stay in India for a minimum period of 730 days or more. Okay, these are the two additional conditions. First additional condition, last 10 years you must be a resident at least for minimum period of 2 years. And the second additional condition, last 7 years you must stay in India for a minimum period of 730 days or more. These are the two additional conditions. If two additional conditions are satisfied, then you are called as RBOR, resident but ordinary resident. If you have satisfied any one or none of additional condition, then you will be classified as a RBNOR, resident but not ordinary resident. Okay, chalo. So friends, with this we done with the topic, that is basic conditions as well as additional conditions. There are no relaxations for additional conditions itself. That's all. Now I would like to cover one topic, that is deemed resident. Very important topic. Please follow, friends. This amendment as introduced in the Finance Act 2020. What is the deemed resident? Please follow. Number one, you must be a individual. I repeat, individual. The two Indian citizen. The two is Indian income. I repeat, is Indian income must exceeds 15 lakh rupees in a year. I repeat, Indian income alone must exceed 15 lakh rupees in a year. The two is not a resident of other country. That means you no need to pay tax in any other country. In that case, that fellow will be considered as a deemed resident as per the section 6 subsection 1A. I would like to take one live example, real example. One of my friend Rajesh, he got the job in Tanzania. His salary 25 lakhs per annum. For your information, in Tanzania there is no income tax at the time. Therefore, you no need to pay any amount of tax in Tanzania. But you know, he has so many properties in India. He has fixed deposits also in India. He is getting Indian income. I repeat, he is getting Indian income also. You know what? Indian income alone is getting 18 lakh rupees. Now tell me, my friend Rajesh is an individual. The two is an Indian citizen. The two is Indian income alone more than 15 lakh. The two on his foreign income or else on his any income, you no need to pay tax in any other foreign country. So when you are not liable to pay tax in abroad, lawmaker wanted to collect tax in India. That is the reason they voluntarily introduced one topic called as deemed resident concept. Okay, chalo. So friends, with this we done with the topic called as residential status of individual. See the material ones, see the line diagram. First one is general cases. Number one, first basic condition 182 days or more, or second basic condition 60 days or more in the relevant previous year, and 365 days or more during the period of 4 years immediately preceding to the relevant previous year. If satisfied, yes, you are a resident. Not satisfied, then you are a non-resident. Okay, chalo. After that, once you are a resident, again you have to check the additional condition. First additional condition, out of last 10 years you must be a resident for minimum period of 2 years, and second additional condition, last 7 years you must stay for 730 days or more. If you satisfied both, then you are called as RBOR. If you satisfied any one or none, then you are called as RBNOR, resident but not ordinary resident. Enough. Next one, friends, for the second basic condition, there are some exceptions. I told you 3 exceptions. Number one, individual Indian citizen who are leaving India for employment outside India, and the second point, who are leaving India as a member of crew, and third point, that Indian citizen or Indian origin who are visiting India, and the two, their Indian income alone is 15 lakh or less than 15 lakh. In this case, the second basic condition not applicable. For example, if their Indian income alone is more than 15 lakh, take it for granted, ma'am. So modified second basic condition applicable. In the current year, you must stay for 120 days or more in the relevant previous year, and 365 days or more during the period of 4 years immediately preceding to relevant previous year. If you satisfied no, then you will be classified as a RBNOR. No need to check additional conditions. Directly we need to consider as a RBNOR. Okay, in this case only. In which case, you know, if any person, individual or Indian citizen who are visiting India, the two, their Indian income alone more than 15 lakh, in this case, if they stay in India for a period of 120 days or more in the current year, and the last 4 years 365 days or more, take it for granted that person will be considered as a resident but not ordinary resident. Enough. Suppose, friends, now additional conditions in other cases anyhow applicable. After that, deemed resident concept also we covered. Deemed resident concept applicable only in the case individual, the two, Indian citizen, the two, the person who is Indian income alone is more than 15 lakh and who are not liable to pay the tax in any other country. The two, friends, these persons will be treated as a RBNOR directly. RBNOR, deeming provision, no. So that concept is treated as deeming provision as for section 6 subsection 1a. Directly they will be classified as RBNOR if they satisfied these conditions. Enough. After that, another topic, residential status of HUF. Friends, in case of HUF, generally the residential status shall be determined based on control and management. Not only for HUF, for AOP, BOI and other AJP, as well as in all the cases, take it for granted, control and management fully or partly in India, then they are called as resident. If control and management fully outside India, wholly outside India, then they are called as non-resident. Very simple. Only 2 lines. Control and management fully or partly in India, then they are resident. Control and management fully outside India, then they are non-resident. Control and management means the key decision making power. That's all. But here I would like to tell you one word. If HUF control and management fully or partly in India, then it will be treated as resident. If HUF is a resident, take it for granted, HF is again classified as a RBOR and RBNOR. Resident but ordinary resident, resident but not ordinary resident. Friends, you know, to determine RBOR and RBNOR, additional conditions are applicable. But honestly speaking, HF is a not natural human being, right? That is the reason additional conditions we need to apply to Karta. If Karta satisfied both of additional conditions, then the HUF is treated as RBOR. If Karta satisfied one or none of additional conditions, then take it for granted that HUF is treated as what? RBNOR. That's all, ma. So take it for granted, friends. Only individuals and HUF is only further classified into RBOR, RBNOR. Enough. Last topic, friends, that is residential status of company. take it for granted, if you are a company, corporate SC, all Indian companies are residents. At your childhood you did the pledge, no? So all Indians are my brothers and sisters, like that, right? So here also all Indian companies are residents. Okay. All foreign companies not non-residents, ma. In case of other than Indian companies, we need to check what? Poem means what? Place of effective management. If poem is in India, place of effective management in India, then that other than Indian company is treated as resident. If the poem is outside India, then that is called as non-resident. Once again, all Indian companies are residents irrespective of poem. Poem not applicable to Indian companies. All Indian companies are residents. If it is other than Indian company, take it for granted, we need to check the poem. If poem is fully or partly in India, then that is called as resident. If the poem is outside India, then that is called as non-resident. Okay, chalo. This is the topic, friends. So next one is called as scope of total income. Very, very, very important point, very important concept for exam point of view. Out of that we can expect one practical question. Okay, chalo. So friends, here income two types, you know, that is called as Indian income as well as foreign income. And friends, here persons classified into three, right? One is RBOR, one is RBNOR, one is non-resident. I would like to tell you one word. All Indian incomes are taxable. Blindly I am telling you, Indian income taxable, taxable, taxable. See this one, the first three are Indian income. So answer taxable, 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 taxable. Every case all Indian incomes are taxable. If it is Indian income, it is pakka taxable. What is Indian income? If any income received in India, I repeat, any income received in India, then that is Indian income. Any income accrued in India, earned in India, that is also Indian income. If both are in India, Indian income. Anyone is in India, Indian income. So remember, ma, received in India, received in India, Indian income. Oh, Indian income taxable, taxable, taxable. In the hands of RBOR taxable, RBNOR taxable, NR also taxable. Sir, income received outside India but earned in India. Oh, earned in India, that is also Indian income. So answer taxable, taxable, taxable. Sir, both are in India. Oh, super, that is also Indian income. Taxable, taxable, taxable. That's all. See the word. Income received or deemed to be received in India. Oh, in India, received in India. So Indian income. No need to check about taxable or not taxable. Check about whether it is Indian income or foreign income. Sir, how do we know? Simple. If received in India, if you heard like that, that is Indian income. Answer taxable, taxable, taxable. Reverse. Sir, received outside India but accrued or arised or deemed to accrue or deemed to arise in India, earned in India, then answer taxable, taxable, taxable. Okay. Because if you received in India, that is Indian income. If you earned in India, it is Indian income. Next one, income received or accrued outside India. Sir, outside India, both are outside India. In this case, that is foreign income. Whenever it is a foreign income, take it for granted, it is taxable in the hands of resident only. It is not taxable in the hands of RBNOR, not taxable in the hands of non-resident. For example, friends, if both are outside India, both means received as well as accrue, both are outside India, then that is called as foreign income. When it is a foreign income in the hands of RBOR, that is pakka taxable. RBNOR not taxable. NR not taxable. Okay, see the word, friends. Fourth point first you can check. After that I will explain third one. Income received, accrued outside India. Sir, both are outside India. Oh, both are outside India, therefore foreign income. That too from a business or profession controlled from outside India. So ultimately foreign income. Foreign income taxable, not taxable, not taxable. That's all. No doubt at all. I told you beginning of this chapter, if you are a resident, Indian income as well as foreign income both are taxable. I told you global income taxable. See the word. If you heard the word RBOR, fully taxable. resident but ordinary resident fully taxable. If you are a RB, NOR or non-resident, Indian income is only taxable, foreign income generally not taxable, okay. Chalo, but see the third point ma, income received and accrue both are outside India. Sir, when both are outside India, take it for granted that is foreign income. So income received and accrued outside India from a business or profession controlled from India. Sir, here only one relation. You know what is the relation? No, that business or profession controlled from India. Best example I will tell you. Some audit firms in abroad, what they will do, you know, they will have branches across the world. Same way, in India, some big four organizations are there. Best example, in India, one company is there, X Limited. They have branches in abroad also. And what they will do, you know, they will control the business, abroad business from India only. That means the particular business they carrying in abroad, they earning in abroad, they received money also in abroad, everything in abroad, but only they are controlling from India. They set up the business in abroad only, but they are controlling from India. Whenever you are controlling the business from India, then it is a foreign income, no doubt, because received in abroad and accrued also in abroad, therefore it is a foreign income, but that is taxable in the hands of resident but ordinary resident, and not taxable in the hands of non-resident. But warning, it is taxable in the hands of RB, NOR. That is the special point. Okay, chalo. And last one ma, income earned and received outside India. Both are outside India, but later on it is remitted to India. Sir, listen. Some persons, what they will do, they will earn money in abroad. They will earn money in abroad, receive the money in abroad. So everything in abroad. So that is foreign income at all. But after 10 years or 15 years, what happened? They wanted to come back to India. So when they are coming back to India, they will bring that money to India. At that time, not at all taxable. Take it for granted. Past year incomes are not taxable. Income means this year income. I repeat, only this year income, not past year income. Therefore, whenever income received and accrue outside India in earlier years, but later on remitted to India, not taxable, not taxable, not taxable. Next one, friends, these are other points. Income earned and received outside India during the current year, but later on remitted to India. Friends, income earned in this year, no, that too, that is foreign income, because both are in abroad. So foreign income, but related to this year. Oh, this year means it is an income. Therefore, in the hands of RB or pakka taxable, in the hands of RB, NOR and NR not taxable, because that is a foreign income, right? Sir, take it for granted, any income is taxable. If it is a income of this year, it is taxable in the hands of RB or. If it is a income of earlier years and later on remitted, that is not a income, sir. Not at all taxable in anybody's. Leave it. Next point, foreign income is not taxable in the hands of non-resident. And foreign income not taxable in the hands of RB, NOR also. But one foreign income only taxable. You know what? The business or profession controlled from India, but income received outside India, that accrue outside India, that is a foreign income, but it is taxable in the hands of RB, NOR also, because only one relation is there. The relation is nothing but the business or provision controlled from India, that is the relation. Okay, chalo. So next one, past untaxed profits, that is not taxable. Past year amounts are not at all incomes of this year, not taxable. Next one, exempted income anyhow not taxable. Common sense, exempted income always not at all taxable. Okay na friends, with this we completed this chapter, that is residential status part 1. I revised this topic also, so take care, very important topic. Thank you very much. Friends, in today's lecture I am going to start the topic, that is residential status part 2. Out of this topic, section 9, very important topic for exam point of view. compulsory we can expect one question out of this chapter. Please follow. First I would like to start the topic that diversion as well as application of income. Friends, suppose tomorrow you got the job and you got the salary of 12 lakh per annum. Out of 12 lakh, you only voluntarily given 5 lakh rupees to your mother and 3 lakh rupees to your sister, and balance amount you only spend for your personal purpose. Now my point is, how much is taxable in your hands? Answer, full amount is taxable. I repeat, as per the provisions of Income Tax Act, we need to do computation. After that, we need to collect the tax. We need to calculate as well as pay the tax to the government. Government will collect the tax from you. That's all. That is that simple technique. Whatever the purpose you spend the money, that is called as application of income. Take it for granted. Application of income is nothing but spending the money or else using the money for your personal needs or any other obligations purpose. No doubt it is fully taxable. Okay. Suppose you got the salary 12 lakh, you have given to your mother or father or whatever it may be, it is pakka taxable. That's all. Application of income is none of our business, that is fully taxable. Voluntarily you only given the payments to your relatives or friends or someone else. Therefore, it is not at all relevant to the department. It is pakka taxable. It will be included in the income portion of the SSC. That's all. What is diversion of income? I would like to take one example. Mr. Dasaratha is in ICU. He called his son Rama and he said like this, Rama, take that building. The building rent also you can take it, but only one condition. Out of that building rent 10 lakh, compulsory you have to give 3 lakh rupees to your mother Kaushalya. Every year you have to give 3 lakh rupees to Kaushalya. This is the compulsion. Now my point is, Rama will receive the amount of 10 lakh, but compulsorily, not voluntarily, compulsorily he has to give 3 lakh rupees to his mother as per the will written by the father. This is called as diversion of income. I repeat, diversion of income. Income received by Rama, afterwards it is diverted to someone else. That is called as diversion of income. Whereas in application of income, not like that. Income received by the person, but voluntarily he has given, spending the money, that is called as application, but compulsorily you have to give the money to someone else, that is called as diversion. See the point? Diversion of income as well as application of income. Diversion of income is nothing but overriding the title over the source, whereas application is nothing but voluntary payment. Application is nothing but voluntarily spending the money. There is no question of overriding the title. Second one, in case of diversion, obligation is on the source, whereas here in case of application, obligation on the recipient of the money, income. Next one, here all of you, in diversion, due to obligation, the income is diverted at source before it reaches to the SSC. Sometimes what happen, the house property rent 3 lakh received by Kausalya, 7 lakh will be received by Rama. The income will be diverted like that from the source itself. Okay, chalo, next point. The discharge of obligation takes place after income reaches to the SSC, whereas in case of application, they will receive and they will give to someone else voluntarily. Last point, in case of diversion, the income is not included in. Diversion is always not taxable because that is not his income. In my example, out of 10 lakh, 3 lakh is given to Kaushalya, right? The 3 lakh is not the income of Rama. But whereas in case of application, the entire income is taxable in the hands of the person. Balance amount, whatever you have given to someone else, is called as application. That is not at all relevant. Okay, chalo. Next one, friends, another section, section number 7. In the residential status part 1, we covered the topic called as section number, all of you, 6, as well as section number 5. Now it is time for section number 7, that is nothing but income deemed to be received, not received, deemed to be received. All of you friends, all the SSCs are liable to pay the tax in respect of income received or deemed to be received by them, during the relevant previous year irrespective of their residential status as well as place of its accrual. Already I told you friends, the moment when you receive the money, the moment when you earn the money, it is pakka taxable. I told you, right? Here also, if you receive the money in India, it is pakka Indian income. Whenever it is an Indian income, it is fully taxable irrespective of residential status. Even though you are a RBOR, RBNOR and NR, the income if you receive, it is pakka taxable. That's all. The following income shall be deemed to be received. Okay, one by one. Employer contribution to RPF in excess of 12% of salary. In salary chapter, we are going to cover this point. Employer contribution to RPF over and above 12% of salary is treated as income, but it is deemed to be received. That is the assumption. On the assumption that income is taxable. Next one, interest credited to RPF over and above 9.5%, that is also taxable. So we will assume that the amount is received. The taxable transferred balance from URPF, unrecognized provident fund balance amount at the time of what you call resign or else leaving the job at the time, whatever the balance withdrawn from URPF is pakka taxable, that is also deemed to be received. Next one, deemed income under section 68 to 69C, that is nothing but undisclosed income, undisclosed bullion, undisclosed expenditure, like that, that is also deemed to be income, that is also taxable. Next one, deemed profits under section 41 as well as 59. Section 41 deemed business profits, whereas section 59 similar kind of provision in case of other sources, that is deemed income. Next one, the contribution made by the employer to a pension fund under 80CCD. 80CCD topic, that is NPS, National Pension Fund, or else Central Government Pension Fund. Their employer also will contribute, that amount also pakka taxable, that is also deemed to be income. That's all. Next one friends, very important topic, compulsory question for exam point of view, that is nothing but section number 9. I request you all, please follow this topic. Income deemed to accrue or arise in India. Friends, very important topic. Okay, please follow. Section number 9, subsection 1, class 2. First I wanted to cover class 2. Please follow. Friends, salary earned for services rendered in India. Suppose if any foreigner rendered services in India, that is also treated as all of you income deemed to accrue arise in India. So Indian income pakka taxable even in the hands of foreigner or in the hands of Indian or in the hands of any person. If services rendered in India, take it for granted, if you receive any salary for that services which are rendered in India, it is Indian income taxable. Next one, salary payable by the Indian government to Indian citizen who are rendering services outside India. Best example friends, our Indian embassy employees who are working in abroad. You know what, in America also our Indian embassy is there. In Indian embassy our employees are working. Okay, so our central government will pay the salary to Indian employees who are working in abroad, right? So salary payable by Indian government to Indian citizen for services rendered outside India. Actually they will stay in abroad and they will take salary in abroad from our government only. Okay, so even though they are staying there, even though they received there itself, none of our business, that is deemed to be accrue arise in India, pakka taxable. Next one, dividend from Indian company. Best example, Facebook company MD, owner, promoter, he only purchased some shares of Byju's. Really, is the one of the angel investor for Byju's. Now my point is, he may receive dividend from that company shares. So wherever he is sitting, that is none of our business. If you got the dividend from our Indian company shares, that is pakka Indian income, pakka taxable. Okay, chalo. Next one, another important point, section 9 subsection 1 class 5, class 6, class 7, that is nothing but interest, royalty as well as fees for technical service. I repeat, interest, royalty as well as fees for technical service, very important topic. I would like to take one example here because that is very important. Please follow friends. Now one company called as Reliance Industry will take the loan from foreign bank called as HSBC. Okay, HSBC fellow is a non-resident. or else sometimes they will take the loan from the foreign companies also. Anyhow friends, now our Reliance Industry has taken the loan. When they have taken the loan, on the loan compulsory they have to pay interest. Okay, now my question is whether the interest amount is taxable in the hands of HSBC or not. That is the question. I request you all follow. Number one, in case of interest as well as in case of royalty. For example, in case of loan, that is the interest, no, but in case of usage of any asset or formula, that is royalty. Or else last one is called as FTS, fees for technical services. Sometimes Reliance Industry may take services from foreigners, Americans or someone else. For that they will pay fees for technical services. In all the three cases, that is same answer applicable. You know what? Whatever the money received by this fellow is taxable. I repeat, taxable. Interest received by these fellows are taxable. Royalty received by these fellows taxable, and fees for technical services also taxable. Take it for granted. One time it is not taxable. Only one time. Try to remember that point. I request you all follow this point. Interest, royalty and fees for technical services received by non-resident. I repeat, received by non-resident with respect to business or profession carried outside India. I repeat, business or profession carried outside India. Outside India. In that case only, in their hands not taxable. I repeat, in this case in their hands it is not taxable. Don't confuse, very simple, follow. Reliance Industry has taken the loan for carrying business or profession in Brazil. For that purpose, they took the loan and they are paying interest to HSBC 100 crores. Whether it is taxable or not taxable? Answer, not at all taxable, because ultimately the loan used for the business in Brazil. Therefore, so they rendered business in abroad. Therefore, interest paid for the loan taken for business in abroad. Therefore, in the hands of non-resident, it is not taxable. That's all. Remember only this point. Same way, royalty also. Follow. Reliance Industry has taken one formula from this non-resident HSBC, for example, and for that they are paying royalty. When royalty paid by one Indian person to foreigner for carrying business in abroad, not taxable. Same answer for fees for technical services also. Our Indian company is making the payment called as fees for technical services for business carrying in abroad. That is also not at all taxable. That's all. If I change even single word, it is pakka taxable. Suppose they are paying interest, they are paying royalty, they are paying fees for technical services for carrying business or profession in abroad. In abroad, not taxable. Suppose if they use the amount or formula or else services in India, then in this case, in the hands of HSBC, it is pakka taxable. So please try to remember only one point. Interest, royalty, fees for technical services received by non-resident for carrying business or profession in India, it is taxable. Outside India, not at all taxable. Okay, chalo. With this, we done with the topic called as 9 subsection 1, class 5, class 6, class 7. I would like to show some examples here. Please follow. Now see the examples. Payment of interest, royalty and fees for technical services, that is not at all taxable in the following cases. That is first one, payment of interest, royalty, fees for technical services by resident to non-resident. So here receiver is non-resident for carrying business or profession outside India, then it is not taxable. Same way payment of interest as well as royalty as well as fees for technical services by non-resident to non-resident for carrying business or portion outside India, obviously that is also not taxable. I will give one complete chart here. Please follow. All of you follow this one. Interest, royalty and fees for technical services paid by government to resident as well as non-resident. Obviously same answer, taxable, because paid by government, pakka taxable, because received by resident anyhow taxable. In the hands of residents always taxable, no doubt at all. But if it is received by non-resident, then also taxable because it is paid by the government. Leave it. Second one, paid by resident, I repeat, paid by resident to resident. No need to discuss my time waste. Whenever received by resident, received by resident, pakka taxable. Next one, paid by resident to non-resident for carrying business in India taxable, for carrying business outside India not taxable. Okay, chalo. Next one, paid by non-resident, to resident, no need to discuss, time waste, pakka taxable. And last one, paid by non-resident to non-resident in India pakka taxable. If it is paid by non-resident to non-resident for carrying business or portion outside India, I repeat, outside India, that is not at all taxable. Okay, these are the concept. Section 9 subsection 1 class 5 class 6 class 7, interest, royalty and fees for technical services. Okay, chalo. So this is one topic, friends. Now I would like to start first one, that is section 9 subsection 1 class 1. Friends, see the table ma. Here first one, section 9 subsection 1 class 1. Here all of you, income accrue or arising from or through the following things. Number one is the business connection. What is business connection? I let you know within couple of minutes. Second one, property or assets are source of income from India. If any property in India, obviously if you get the income from such property, obviously that is Indian income, pakka taxable. I will take one example. For example, Microsoft company, they bought some land in Hyderabad Nanakram Guda, and they started their corporate office there. Pakka taxable, because that is the property. If they get any rental income or any income, pakka taxable, no doubt at all. Suppose they transfer such capital asset which is located in India, even though they are non-resident, if you get any capital gain by transfer of such asset, then also it is taxable. Okay, here last concept, that is called as business connection. Now I am going to explain business connection in detail right now. Please follow. Friends, business connection means certain relation created by way of following things. I would like to take one simple example. Dell. I want to buy Dell laptop. So I went to that corporate offices, that shopping malls and all, for the purchase of Dell. For your information, Dell company never manufactured any laptop in India as of now. For that purpose, what happened now, Dell company located in USA, that Dell company will supply the laptops to someone else in India called as Mr. Agent. The agent only will sell laptops in India. Now the question is, what is the relation between these two fellows? That is nothing but business connection. I repeat, business connection. Here the business connection is defined like this. Business connection includes certain things. The technique I would like to tell you, memory code purpose, cause. If any person acting on behalf of non-resident like agent for concluding the contract. Suppose non-resident is in Canada, that on behalf of that non-resident, one fellow called as Mr. X is concluding contracts in India. Oh, this fellow is taking the contracts and giving to his parent company, or else is a principal there in Canada. That is the reason concluding contracts is a relation called as business connection. So any income earned out of that business connection, it is pakka taxable. Next one, yes, for maintain the stock which he regularly delivers on behalf of non-resident. Friends, Dell example I told you just now. If any person delivers goods on behalf of non-resident and maintain the finished goods or maintain the stock, then also that is called as, that relation called as business connection, pakka taxable. Next one, friends, another O, cause, COSS kada, that is O for securing the orders on behalf of non-resident. So non-resident in abroad, so on behalf of that non-resident, someone else will go and secure the orders, that is also taxable. And the last one, COSS for significant economic presence in India on behalf of non-resident, then that is also pakka called as business connection. So in all the cases, COS cases, COSS, C for conclude the contracts, O for secure the orders, S for that is maintain the stock, S for significance economic presence. In all the four cases, take it for granted there is a relation called as business connection, so it is pakka taxable. But take it for granted the following things are not a business connection. Number one, collection of news and views. I repeat, collection of news and views. I will take one best example. BBC channel that is belonging to British, that is England. So that channel, what they will do, they will collect the news and views from various places in the world. For example, in India also they will collect the news. Now my point is, collection of news and views in India for that is a transmission outside India purpose, they will collect the news and views. Yes, that is also pakka business connection. Actually yes, but lawmaker wanted to say no, only news and views collection purpose. If anybody is working, that is not a business connection, therefore that is not taxable. Suppose BBC broadcast some news from Hyderabad, that is not a business connection, therefore that news relation activities is not a business connection, therefore if any income they earned in abroad, that is not at all taxable. Okay na? Chalo, next one, purchase of goods for export purpose out of India. Some people, what they will do, they will appoint their agents in India. The agents will procure raw material, only raw material, and they will export to abroad. So government want to encourage these kind of exports, so they don't want to say it as a business connection. Whenever there is no business connection, nothing is taxable. Next one, shooting of films in India. I hope some foreigners will come to India, will shoot. For example, so many Hollywood movies, they covered certain places in India. I hope certain movies are shot in India. So one Jackie Chan movie also directed in India itself, some of the part of the cinema. So after all, film shooting in India is not taxable, because that is not a business connection. But one thing for sure, if they release movie in India and they get the income, that is no doubt pakka taxable. After all, film shooting is not taxable. Okay na? Chalo, next, last but one, that is foreign company. I repeat, only foreign company engaged in the business of diamonds exhibition, display of uncut diamonds, then that is also not a business connection. This rule applicable only for foreign companies who are engaged in the business of just exhibition of uncut crude diamonds in India for exhibition purpose. That is not a business connection. Last one, friends, presence of eligible fund manager in India. Some funds, mutual funds that located across the world, across the globe. Therefore that kind of funds manager, if even though he located in India, take it for granted, that is not a business connection, that is also not taxable. Next one, liaison office. Liaison office also not taxable. Liaison office means some kind of office they will start for the maintenance of rapport with the local media and local people and officers. That is liaison office for rapport purpose. That is also not a business connection. They will do nothing. After all, they will have PROs there, so public relation officers. Last one, person acting independently. That is also not at all taxable. Okay, chalo, if any person acting independently, then where is the question of business connection? No gada. Chalo, now see the word, friends. Salary earned for services rendered in India, or salary payable by the Indian government to Indian citizen for rendering services outside India. Next one, dividend paid by Indian company. Next one, any income earned by way of business connection or else property in India, or else transfer of capital asset. All these are covered. And another point, income arising outside India, being any sum of money paid without consideration by resident Indian to non-corporate or non-resident or foreign company, where aggregate sum is exceeding 50,000. Friends, if anybody remitted or transferred them any kind of thing without consideration more than 50,000 outside India, gift kind of thing, it is also pakka taxable. And interest and royalty fees for technical services, I already told you, very very important, please follow. That is also taxable or not taxable? One time not taxable, indirectly two times. Paid by someone else to non-resident for business or profession outside India, then all is non-taxable. In rest of the cases, it is pakka taxable. Last one, business connection. Also I told you, business connection means some person act on behalf of non-resident for cause purpose. C for conclude the contract, O for secure the orders, S for that is called as a maintain the stock, and the last one S for significant economic presence. But certain things are not covered. I told you purchase of goods for export, collection of news and views, and as well as a business with respect to self what you call independent cases, and shooting of cinematographic films, and activities conform to only diamonds, that too only foreign company, that too exhibition of uncut diamonds or rough diamonds in special notified zones, that is also not taxable. Okay friends, with this we done with the part number 2 of residential status. Out of that, section number 9 is most important for exam point of view. Okay, so take care. Thank you very much. Friends, in this lecture I am going to start the topic that is exemptions. I repeat, exemptions. Income which do not form part of income. These incomes are does not form part of taxable income. These are exempted incomes. Okay, chalo. Friends, generally exemptions are covered under section 10, 11, 12, 13. Section 13 exemptions are applicable for political parties as well as electoral trust. Whereas section 12 is applicable, as well as section 11 is also applicable for charitable trust and charitable institutions. But our right cup of tea is section number 10. There are so many subsections here. This is a very important topic for exam point of view. Out of this topic, we can expect 2 or 3 marks questions. First one, what is the difference between exemptions and deductions? Number 1, exemptions are nothing but section 10, 11, 12, 13. Whereas deductions generally covered under chapter 6A, like 80C to 80U. In case of exemptions, that income is not at all taxable. I repeat, not taxable. The income shall be exempted means the income shall not form part of gross total income, shall not form part of computation. Okay, chalo. But in case of deductions, not like that. Income first we need to add it to the gross total income. After gross total income only we need to give the deductions. Then only we will get net income or taxable income or total income. So exemptions shall not form part of computation, whereas deductions will be allowed after gross total income. Number next. In case of exemptions, take it for granted, maximum exemption is nothing but income. Suppose my agriculture income 10 lakh means exempted also 10 lakh or else 5 lakh, something for example. But in case of deductions, not like that. Certain times weighted deduction also may possible. Suppose once upon a time in section 35 AD, if we spend 100 crores, 150% allowed as deduction. Once upon a time, not now. But anyhow, in case of deductions, weighted deductions also possible. And last but not least, in case of exemptions, all of you, that exemptions are applicable only for income, whereas deductions are applicable for income or else may be applicable for expenditure or applicable for special nature also. Examples I will take. 80C is expenditure based, whereas 80 IA, IB, IC, these are income based. 80U, that is special category, physically handicapped or mentally retarded. So these are the fundamental differences between exemptions and deductions. Now it is time for section 10 exemptions. There are many sections. Out of that, some are more important, some are less important, some are least important. But anyhow, I am going to cover these topics. Please follow. Section number 10. Out of that, first one, section 10 subsection 1, agricultural income. Take it for granted, agricultural income is exempted in India. The two, that is not at all taxable. But foreign agricultural income is pakka taxable. That too, it is taxable under that IFOS. But Indian agriculture income is pakka exempted. Okay, chalo. But for your information, here practical point of view, one important topic is there. That is nothing but grossing up. What is gross income? I would like to tell you. Sachin Tendulkar, live example, he has non-agricultural income. I repeat, non-agricultural income. That is, let us say 30 crores. Whereas he has agricultural income also. For your information, Sachin Tendulkar has so much of land, agricultural land. Even he has agricultural land in Andhra Pradesh also. But he will give on tenancy basis that agricultural income, let us say 5 crores. Okay. If any person has agriculture income as well as non-agriculture income, in that case, grossing up provisions are applicable. These grossing up provisions are applicable only for individual as well as HUF as well as AOP as well as BY. For these category persons are only it is applicable. What is grossing up? Your agriculture income is more than 5,000 rupees as well 5,000 rupees. Okay, fine. And non-agriculture income exceeds bell. In this case, grossing up concept applicable. What is grossing up? For that, step number 1, you have to take all of you your non-agricultural income plus your agriculture income. So step number 1, we have to add back your agricultural income. When we need to add back, when your agricultural income is more than 5,000, non-agricultural income is more than bell, that to your individual HF, AOP, BY and AJP. In this case, grossing up applicable. Step number 1, calculate non-agriculture income plus agriculture income. Step number 2, calculate tax on step number 1. Calculate tax on that. Okay. Step number 3, calculate agriculture income plus basic exemption limit. I repeat, agriculture income plus basic exemption limit. Step number 4, all of you calculate tax on step number 3. Then friends, net tax liability step number 5 is equal to step number 2 minus step number 4. Okay, chalo. After that, we have to add surcharge if any, or you have to add health and education, and you have to consider the rebate under section 87 also if any. That's all. This is the concept called as grossing up. The lawmaker intention very simple. If any person has both the incomes, indirectly he wanted to add back. But as I told you earlier, agriculture income is exempted. Therefore, he wanted to give the rebate on this one. So adding again deducting. So because of that reason, indirectly, slightly, the tax liability may increase. This is the logic behind the grossing up concept. Anyhow, please follow. That is section 10 subsection 1. Okay, chalo friends. Next topic that is section 10 subsection 2. Share income from HUF is exempted in the hands of co-partners. Friends, take it for granted, HUF is a separate tax person. Whenever it is a separate tax person, HUF has to pay the tax. When HUF paid the tax, automatically the tax will be collected from HUF. Rest of the amount HUF will distribute to co-partners. There is no double taxation. Therefore, in the hands of co-partner, that is exempted. Next one, section 10 subsection 2a, that is share income from partnership firm is exempted. I repeat, share of profit from partnership firm is exempted. So partnership firm is a separate taxable person, so that it will pay the tax. After that, the amount will be distributed, rest of the amount will be distributed to the partners, that is exempted. Next one, section 10 subsection 4 class 2, that is nothing but NRE account. Very, very important. NRE account, interest on NRE account is exempted. Some people will open foreign accounts, that is NRE, non-resident external account, that income also exempted. Next one, section 10 subsection 6. All of you friends, foreign embassy, I repeat, foreign embassy employees incomes are also exempted. See the word, remuneration received by the foreign embassies employees, that is exempted. A remuneration received for services rendered in India as an employee of foreign enterprise, that is also exempted. Salary received by non-resident non-citizen for services rendered in connection with foreign ship, that is also exempted. Remuneration received by the foreign government employees during their stay in India for specified training, that is also exempted. So these are mainly focused for the foreigners as well as foreign embassy employees. Okay. Now next one, section 10 subsection 7. Please remember, Indian government paid the salary to Indian citizen for rendering services outside India. I repeat, Indian government paid the salary to Indian citizen for rendering services outside India. For example, in USA, our Indian embassy is there, and in our Indian embassy, our employees are working. So our Indian government will pay salary allowances perquisite to our Indian employees who are working in abroad. Okay, chalo. The salary pakka taxable as per section 9. That is already we covered in residential status part 2 video also. But for your info, allowances and perquisites, whatever paid is only exempted. Salary is pakka taxable. Don't confuse. I will take one example. Follow. Our Indian government is paying salary, is paying allowances, is paying perquisites to Indian citizen who are working in abroad. Sir, they are representing us. They are pride of India. Therefore, the salary amount anyhow pakka taxable as per section 9. But allowances and perquisites are exempted under section 10 subsection 7. Sir, they are working far away places. That too, they are representing our nation. So allowances and perquisites are exempted. This is called as a section 10 subsection 7. Memory code purpose I am telling you. Sapta Samudras. I repeat, Sapta Samudras. వాళ్ళు సప్త సముద్రాస్ అవతల వర్క్ చేస్తున్నారు. ఎగ్జాంపుల్ యా. సో మెమరీ కోడ్ యూ షుడ్ రిమెంబర్ ద సెక్షన్. నో, that is the reason lawmaker wanted to give the benefit. Allowance and perquisites are pakka exempted. Okay, chalo. Next point, friends, another topic is as follows. Section 10 subsection 10 BC. Friends, here BC means memory code bad climate. Please remember, at the time of calamities, tsunami or fire accident or any natural calamities, cyclone, etc., generally government will give some compensation. So that kind of compensations are not taxable, exempted. See the word compensation received on account of disaster from central or state government or local authority, that is exempted. Next one, very important one. Seventh one is very important. Please follow. Section 10 subsection 10 CC. Friends, non-monetary perquisites, on that certain cases employer only will pay the tax. So tax paid by the employer on behalf of employee on non-monetary perquisites, that is exempted in the hands of employees. I would like to take one example. Some bus facility or something else, or some non-monetary perquisites provided by the employer to the employee. For taxation purpose, employer only voluntarily paid the tax. Voluntarily employer only paid the tax. Take it for granted. That is another benefit to employee. Still, it is lawmaker don't want to collect the tax. Therefore, it is exempted. Section 10 subsection 10 CC. Next, another important topic, very important, that is section 10 subsection 10D. D for death, that is nothing but insurance compensation. So LIC or any other insurer compensation at the time of death, that is anyhow exempted. We will discuss in detail in section 80 capital C. 80 capital C, very important topic. There we will discuss. Anyhow, section 10 subsection 10D, that is nothing but any compensation or any insurance sum received from insurance companies, that is exempted. Section 10 subsection 11A, A for Ammayi. I repeat, A for Ammayi. That is nothing but Sukanya Samriddhi scheme. So we can open SSS, Sukanya Samriddhi scheme account for baby girl whose age is less than 10 years. So any income earned out of that Sukanya Samriddhi scheme is exempted under section 10 subsection 11A. Next one, section 10 subsection 12A, that is nothing but, friends, payment from NPS, National Pension Scheme, partial withdrawal. I repeat, one is partial withdrawal, one is a total withdrawal. Now see the point 1. Section 10 subsection 12A is the total withdrawal, opting out that from NPS, whereas section 10 subsection 12B is nothing but partial withdrawal. Take it for granted, if anybody wanted to he wanted to close his NPS account and he want to come outside, in this case, out of the total amount 60% exempted. Suppose in case of partial withdrawal, so 25% is exempted. Okay, chalo. Next one, section 10 subsection 16, 16 vayasu. In this case, you will get scholarship generally. Okay, scholarship received for education purpose, now that is also exempted. Next one, section 10 subsection 17, MPs and MLAs allowances, daily allowances received by MPs and MLAs exempted. Section 17, 1017A, A for award or reward. Any award or reward received from state government or central government or local authority, that award or reward also exempted. Next one, section 10 subsection 18 as well as section 10 subsection 19. 18 is nothing but gallantry award winners. I repeat, gallantry award winners. Paramavir Chakra, Mahavir Chakra, Sauri Chakra, like that. So any armed forces, if they are the gallantry award winners and they got the pension, or at the time of their death, their family members may get the pension. That is family pension. So pension or family pension received by the armed forces who are the gallantry award winners, that is exempted under section 10 subsection 18. Whereas section 10 subsection 26 AAA, that is Sikkimese, I repeat Sikkimese. Once upon a time, Sikkim was the separate country, not separate state, separate country. Afterwards, they voluntarily merged with India. At the time, our government has given one bumper offer. Nothing is taxable in their hands. Salary, house property, PGPB, capital gain, other sources, all their incomes from Sikkim state, only from Sikkim state exempted, or interest income from any other states of India also exempted. Only in the hands of Sikkimese. This is not for others, only for localites Sikkimese. Okay, that too, if any woman married, non-Sikkim woman married any Sikkim man, there is no change. But any non-Sikkim man married Sikkim woman on or after 1/4/2008, take it for granted, no benefit is applicable to that couples also. Okay, so any Sikkim woman married non-Sikkim man on or after 1/4/2008, then there is no benefit at all. Okay, chalo, that's all. With this, we completed exemptions topic there, and last topic, very important topic, section 10 subsection 10AA. I repeat, section 10 subsection AA. That is nothing but special economic zone. Friends, take it for granted. SEZ means that is foreign country for taxation point of view. Lawmaker started this topic by adopting this concept from China. China is well developed once upon a time. Because of this concept, that is SEZ, India also borrowed that concept. In the year 2005, they introduced one act called as SEZ Act. Okay, therefore this section also applicable from 2005 onwards. What is that? Section 10AA, deduction. I repeat, deduction applicable for SEZ units. What is this? Government wanted to develop, that is undeveloped areas they want to develop. For that purpose, they introduced this concept. They wanted to manufacture or produce any goods or articles in a SEZ area, or else they wanted to develop the software, and so called the manufactured products or developed software they will export to abroad, and in return they will get foreign currency. That too, the foreign currency will remitted to India within stipulated time. The stipulated time is nothing but 6 months from the end of the financial year. I repeat, 6 months from the end of the financial year. If it is the case, first 15 years deduction will be allowed. First 5 years, take it for granted, 100% of export profits. I repeat, compulsory you have to do export. 100% of export profit is allowed as deduction. Next 5 years, 50% of export profit allowed. Last 5 years, I repeat, 50% of export profit or amount transferred to SEZ reserves, whichever is lower, will be allowed as deduction. Okay, so friends, if anybody started SEZ unit, 15 years deduction will be allowed. First 5 years, 100% of profits. Next 5 years, 50% of profits. Last 5 years, 50% of profits or amount transferred to SEZ reserves, whichever is lower. Indirectly, lawmaker intention is very simple. Why don't you manufacture goods in undeveloped area, so-called SEZ area, which is notified by the government, and the manufactured product, why don't you export to abroad? Why don't you bring the foreign currency within 6 months time? If it is the case, only export profits, I repeat, only export profits will be allowed as deduction. Export profit formula: total profit into export turnover divided by total turnover. Babu, here export turnover means the turnover remittances must be made to India within 6 months time. If you have not remitted within 6 months, take it for granted that export turnover will not be considered. Okay, chalo. And take it for granted, friends, whatever the amount you transfer to SEZ reserves in last 5 years, total 15 years now, out of that, in last 5 years, we have to transfer the amount to SEZ reserves. That amount you have to withdraw, and that amount must be utilized for SEZ purpose. Or you have to purchase plant and machinery for SEZ purpose. If you have not done the same, in the next year, it is pakka taxable. In the year of misutilization, it is pakka taxable. Some people will do non-utilization. In case of non-utilization, automatically after expiry of 3 years, in the fourth year, that amount is pakka taxable. And one more thing, friends, your export turnover includes only those remittances which are made in convertible foreign exchange to India, that too within stipulated time. But out of that, no, some expenses will be allowed. Freight, telecommunication charges, insurance which are paid outside India, that will be allowed as deduction. And last part, friends, total turnover. Total turnover includes everything. I repeat, it includes everything. That's all, ma. This is the topic called as section 10 AA. I would like to take one example. Follow. In Hyderabad, there is one SEZ. So in other area they have their businesses. Other areas are called as DTA. DTA means domestic tariff area. SEZ means special economic zone. So other than SEZ, everything is called as DTA. One company called as X Limited, they have one unit in SEZ, another unit in DTA. Take it for granted, for DTA, no benefits, normally tax rates are applicable. Whereas for SEZ, tax benefits are applicable, that is section 10AA. First 5 years, 100% of their export profit is allowed as deduction. Next 5 years, 50% of their export profits are allowed as deduction. Next 5 years, 50% of their export profits are allowed as deduction, provided they have to transfer some amount to SEZ reserves. But that amount must utilize it for purchase of any plant and machinery or for development of SEZ unit purpose they have to use. If they have not used properly in the year of non-utilization, in the year of misutilization, it is pakka taxable. But some people will create the reserves and take the benefit, but they will not use the same for said purpose within 3 years. Then automatically after expiry of 3 years, in the 4th year, it is pakka taxable. That's all. Next one, friends, and last concept, that is called as what is agriculture income. Friends, agriculture income means sale of agriculture produce. Anyhow, everybody know. And the next one is called as tenancy, also covered. You know, tenancy means kaulu. So we will give on tenancy basis, that is also covered. And next one, friends, income from let out of farmhouse let out for agriculture purpose, that is also covered. And nursery also covered, okay. And sale of agriculture produce, anyhow covered. These are only agricultural income, okay, chalo. But friends, some persons, what they will do, they will have agriculture income as well as non-agricultural income. When any person has both agree and non-agree, then proper segregation is required. For that purpose, Government of India introduced some rules, that is called as rule number 7A, rule number 7B, rule number 8. I would like to tell you one topic here. Remember RCT, my name, Ramchandra tax, okay, Ramachandra tax. R for memory code rubber, C for coffee, T for tea. Rule number 7A, rule number 7B, rule number 8, RCT. See the word, rule number 7A, income from grown and manufacture of rubber. One fellow is doing both activities. If you go to Kerala, so many farmers has rubber estate. the same rubber they will take away and they will sell it. So growing means agriculture and manufacture means business. In this case 65% of that income is agriculture income and 35% of that income is business income. Okay, chalo. Next one, 7b. If anybody is carrying business as well as agriculture of coffee, in this case number one, they are doing only grown and cured, then 75% and 25%. If anybody is doing grown, cured, roasted and grounded, I repeat, grown, cured, roasted and grounded, then 60-40. 60 is the agriculture, 40 is the business. And the last one, rule number 8, growing and manufacture of tea, chai. Okay, so if any person is doing agree as well as non-agree of tea related business, that is cultivation of tea plants and the tea, the leaves they are taking and making the tea powder and selling the in business, then they are doing both the activities, then 60-40%. 60 is agriculture, 40 is the business. That is the assumption. Okay, chalo. So with this we done with the topic called as agriculture and income related topics also. And section 14a, expenditure incurred in relation to exempted income. So for your information friends, in some cases exempt expenditure will not be allowed with respect to exempted income. The same is given here. No deduction shall be allowed in respect of expenditure incurred by the SSE with respect to exempted income. Suppose in relation to agriculture, if you spend any amount, take it for granted that expenditure anyhow not allowed, because it is neither taxable nor allowed as deduction. Okay, so any expenses related to exempted source of incomes are not at all allowed. That's all ma. With this we completed this chapter, that is exemptions chapter. Okay, fine. Thank you very much. Friends, in today's lecture I am going to start the topic that is income from the head salaries. A category topic, very important chapter. Out of this chapter we can expect minimum 6 marks practical question. Friends, income from the head salaries. There are total 3 sections, section number 15, section number 17 as well as section number 18. Section number 15 is the charging section. Section number 16 is the deductions topic. Section number 17 is related to certain definitions. And section number 10, anyhow exemptions are also applicable in this chapter. We are going to cover in detail about each and every topic. Just follow. Point number 1, section number 15, charging section. Friends, the person who is paying the money is called as payer. To whom we have paid the amount is called as payee. Sir, take it for granted, if the relationship between payer and payee is employer and employee, take it for granted whatever the amount paid by the payer to the payee is taxable under their salary. Sir, compulsory the relation must be employer and employee. I repeat, employer and employee. If the relationship between payer and payee is employer and employee, whatever the amount paid on account of that employment is covered under the head salary. Okay, see the provision friends. Any benefits either in monetary or else non-monetary received by the employee from his employer is taxable under their salary. And next one friends, compulsory the relation between payer and payee is employer and employee relation. Okay, next one friends, other point, the employer may be a past employer or else present employer or else future employer. Suppose now you are my ex-employer, you only given amount now, that is also covered. You are my present employer, now also you paid some amount, that is also covered. Or else you are my prospective future employer, that means I got the job in your organization, so you only given some advance money, advance salary to me, that is also covered. So moral of the story friends, your employer means not only past employer, even present employer covered and future employer also covered. Sir, the relationship between payer and payee must be employer and employee. Whenever employer-employee relationship is there, automatically the payment is taxable under their salary. And next one, basis of chargeability friends, here due or received, whichever is earlier. Even though you received or not received, that is immaterial. On due basis or receipt basis, out of these two, whichever is earlier is only considered for taxation of salary income. Friends, here whenever there is no relationship of employer and employee, take it for granted that amount is not covered under the head salary. I would like to take some example, please follow. Friends, principal and agent. Sometimes principal will pay a commission to their agents. Take it for granted the principal and agent are not employer and employees. Therefore, whatever the commission paid by the principal to agent is not covered under the head salary. It is covered under the head PGPB. Suppose if it is a insurance commission, then answer would be different. It is taxable under that IFOS. Next one, friends, last one, remuneration received by the partners from partnership firm. Sir, whenever remuneration received by the partners from partnership firm, then there is no question of salary topic. The reason is very simple. The relationship between partnership firm and partners are not employer and employee. For your information, partner is not a employee of organization. Therefore, it is not covered under the head salary. It is covered under the head PGBP. Next one, friends, pension received by the family members. Friends, when you heard the word family pension, that means the employee is no more. The employee died. Then only his relatives will take the pension from that organization. That is called as family pension. Friends, in case of family pension, there is no relationship of employer and employee. Therefore, it is not taxable under that salary. It is taxable under that IFOS. Next one, friends, director sitting fees. Take it for granted, directors are two types. One is executive director, second one is non-executive director. Friends, executive director means the person who will take care of day-to-day operations of the organization. So executive director as well as companies are in the relationship of employer and employee, whereas non-executive director, other directors are not employees of the organization. Therefore, whatever the commission, whatever the sitting fees received by the directors is not covered under the head salary, is covered under the head IFOS. Next one, friends, MPs and MLAs. Take it for granted, MPs and MLAs are not the employees of the government. After all, they are representatives of the public. Therefore, whatever the salary received by MPs and MLAs is not covered under the head salary. It is covered under the head IFOS. Okay na? Chalo. Next one, friends, contract of service, contract for service. Friends, contract of service means that is nothing but salary related one. How? Suppose in my organization TCS, you are employee, so we have one contract that is called as contract of service. Whenever there is a contract of service, the relationship between these two persons is nothing but employer and employee. Therefore, that is taxable under their salary. Whereas contract for service, not like that. There is no employer and employee relationship. For example, friends, contract for service example I would like to take. This is my building. For my building, I wanted to get painted this building. For this purpose, I called one contractor, or I called one worker. I asked the person to paint this entire premises. For that purpose, I want to give 1 lakh rupees. For that, we enter into contract that is called as contract for service. Take it for granted, in case of contract for service, the person will act independently. The person will take his own decisions and do painting. So that is the reason that is not covered under the head salary, because he is not my employee. That is covered under the head PGPB, because he is also professional, or he is also one worker, independent worker, that is his business. So I am also separate person, he is also separate person. So take it for granted, in case of contract for service, that is covered under the head salary or PGPB, that is covered under the head PGPB. Whereas contract of service means that is pakka covered under the head salary. Okay na, friends? Chalo. Next one, friends, other important points, please follow. Number next, that is salary in lieu of notice period. For example, suppose I am employee of one company called as Infosys. Now I got the job in TCS. So you know, notice period generally 3 months. 3 months means prior to my resign or prior to leaving the job, 3 months before, I need to communicate to my employer. So now I wanted to resign from my company Infosys. That is the reason I communicated, sir, after 3 months I am leaving the organization. So that is called as notice period. Sir, in case of notice period also we will get some salary, that is called as salary in lieu of notice period. Sir, that is also taxable under that salary, because the relationship between the payer and payee is obviously employer and employee relationship. Okay, chalo. Next one, friends, place of accrual of salary. Listen, what is the meaning of place of accrual of salary? Accrue of salary means the place where you earn the money, the place where you generated the revenue. That is the question. Only one word answer. The place where your services are rendered. I repeat, the place where your services are rendered. For example, myself, I am working in Tamil Nadu. Yes, my place of generating revenue is nothing but Tamil Nadu, because I rendered my services in Tamil Nadu itself. Or else I've been to abroad, I am rendering services in America. In that case, place of accrual of salary is nothing but America. Okay, chalo. But friends, here one exception is there. Already we covered this point earlier. Section 10 subsection 7. You know what? Salary or allowance or perquisites paid by the what? Central government to Indian citizen for rendering of services outside India. In that case, this condition not applicable. I would like to take one example. Please follow. So our Indian government as well as Indian citizen, ma Indian citizen working in USA, in Indian embassy she is working in America. For that purpose, our Indian government paying salary to that Indian citizen who are rendering services in America. So honestly speaking, that is a foreign income, correct? Because she is rendering services in America. But friends, this is the exception. Even though she rendered services in America, we are assuming that the income deemed to accrue arise in India. So as for section number 9, I repeat, as for section number 9 subsection 1, we will assume that she or the person, Indian citizen, who are receiving salary from the Indian government for rendering services outside India, that we are assuming that the services are rendered in India only, the income earned in India only, therefore it is pakka taxable. But no doubt, as for section 10 subsection 7, only two things are exempted: allowance and perquisites paid by Indian government to Indian citizen for rendering of services outside India, that is only exempted. Okay, chalo. With this, we done with the other important point. Next one, friends, other topic is also there, that is annuity as well as advance salary as well as advance against salary. Friends, see the first topic, that is annuity. Friends, annuity is nothing but periodic payment made by the employer to the employee. So take it for granted, whatever the amount received, periodic payment received by the employee from the employer in the form of annuity, if employer is a present employer, take it for granted, that is taxable on that salary. Next one, in case of past employer, if you receive any kind of annuity, that is taxable under that salary only, but it is taxable as a profit in lieu of salary. Okay, chalo. Last one, if you have taken the same from any person other than employer, I repeat, from third party or some other reason you have received, in that case it is not taxable under that salary, it is taxable under that IFOS. Okay, chalo. Next one, advance salary, and another word is called as advance against salary. Very simple, friends, please follow. Advance salary means every month my salary, let us say 1 lakh rupees. Now what happened, because of my sister's marriage, I asked my employer like this: sir, give me next to 2 months salary now itself. Next to 2 months salary give me in advance. That is called as advance salary. Take it for granted, advance salary is also pakka taxable. The reason very simple, in case of advance salary, you only received salary in advance. I already told you, salary is taxable on due or receipt whichever is earlier basis. Obviously, in case of advance salary, I only received salary in advance, therefore it is also taxable. Okay, chalo. Next one, advance against salary. What is that? Please follow. I am anyhow getting salary from my boss. Okay, follow. One day what happened, I wanted to buy some land, but for that I need money. That is the reason I asked my boss: boss, I am working with you for so many years. Okay, so please give me some loan. I repeat, give me some loan. For that I won't give any surety, because I am your employee. I am working for long time. I am working here since very long time. So please do one thing. Give me some advance money to me. That means that is nothing but loan amount. Loan amount. Whereas advance salary is not a loan amount. Advance salary is nothing but salary given advance. Okay. Whereas advance against salary means I am the employee. Therefore, they will give some advance money to me. With that advance, I will purchase land or something. Next, every month I may deduct some nominal amount, or else I will not deduct any amount. Once one fine day, I will accumulate some amount of my savings. I will give it back to my employer. So advance against salary is nothing but loan amount. That is not at all taxable. Take it for granted. Loan amount generally not taxable. Okay na? Because it is not a income. Loan amount always repayable. That is the reason advance against salary is not taxable. Chalo. Next, how to calculate taxable salary, or else how to calculate income from that salary? That is the question. Very simple ma. First one, take basic salary plus all allowances. You can take it inner column less exempted allowances. You know, out of allowances some are exempted, so taxable allowances outer column. Same way, take perquisites. Out of that exempted perquisites, you can write inner column, taxable perquisites outer column. So therefore basic salary as well as allowances as well as perquisites. Next one friends, taxable value of welfare contributions. For your info, sometimes employer will make contribution for the purpose of welfare of the employee, like RPF, recognized provident fund, or SPF, like that, these payments. Next one, taxable value of retirement benefits. We will get leave salary, or else we will get pension, or we will get annuity, or else we will get what you call gratuity, etc. All are taxable. So if you make total, then you will get gross salary. Out of gross salary, we need to give deductions under section 16. Deductions are 3 in kind here. Number 1, standard deduction. Number 2, entertainment allowance. Number 3, proportional tax. After that, you will get the figure called as net salary. Okay, so once again, basic salary, allowances. Which allowances? Taxable allowances, taxable perquisites, taxable retirement benefits, and taxable employer contribution to employee welfare funds. After that, gross salary minus deductions. After that, you will get net salary, or else income from the head salary. Okay na? Chalo. With this, done with the topic called as computation of salary. Friends, it is not a standard format. Generally, we will do this one. Okay, chalo. Next one, friends, one by one topic I would like to cover. First one, I want to start with perquisites. Perquisites means generally kind, or maybe in the form of cash also. But take it for granted, perquisites are attached to the person or position. Perquisites are attached to the position, but not attached to the person. Student will have the doubt, sir, what is the meaning? Very simple. Suppose I am the manager of the organization. What happened? No, they will give car facility to me. I can go anywhere in a car. I can come anywhere in a car because I am a manager of that company. Therefore, I have given one car. Okay, chalo. Suppose I involved in some frauds. That is the reason what happened. I demoted from that organization. I am in the organization only, but I am no more a manager. I am ordinary employee like others. In this case, car facility will not given to me. Car will not be provided to me. Very simple reason, car facility not given to Mr. Ram. Car facility is given to only to the manager of the company. Correct? Chalo, one more example. Suppose in my company, afternoon time, lunch will be provided to my staff members. One day what happened? One of our students, Sai, she resigned from our organization. She joined other building, other organization, exactly opposite building. What she is doing now? She is doing job there, but exactly 3 o'clock or 2 o'clock, she wanted to come to my company and wanted to have lunch. Sorry, lunch here it is not provided to outsiders, only for my staff members, not for outsiders. It is not a mess. It is not a Andhra mess, for your information. Therefore, take it for granted that lunch facility is provided only to the staff members, not to the outsiders. Therefore, take it for granted it is attached to not Sai, it is attached to the position of the organization or position of the employee. Okay, chalo, see the word perquisites means extra benefits provided by the employer to the employees in addition to normal salary in the course of employment. Okay, chalo, next one. Perquisites may be either in cash or kind, sometimes in cash also. Perquisites may be either free of cost or concessional rate. Sometimes they will provide it free of cost, sometimes they will provide it concessional rate. Best example I will tell you, lunch. So when I did audit in Blue Star, they will charge 8 rupees from the staff members, really 8 rupees, and they will provide lunch. My point, how lunch is cost 8 rupees? After all, they will provide the lunch at subsidized rates, that is called as concessional rates. I know another company, L&T, what they will do, you know, they will give lunch at free of cost to the staff members. That is called as free of cost. Okay, so maybe free of cost or maybe concessional rate. Next one, taxability of perquisites. Number one, some are taxable, some are exempted, some are what you call partly exempted, partly taxable. And one more thing, some are only taxable in the hands of specified employees. Next one, some perquisites are exempted, some perquisites are taxable, some are partly taxable, partly exempted. That we are going to cover. Sir, what is the meaning of specified employees? Please follow. Here, three category persons are known as specified employees. Number one, all of you follow. Number one, employee who is working as a director come employee. Sir, employee come director. So that is known as director employee. Best example, executive director. They are director as well as employee of the organization. Possible, yes, is called as specified employee. Next one, employee having substantial interest in the company. That means the employee is a shareholder who has not less than 20% of voting power. 20% of voting power. Next one, the aggregate salary of employee from one or more employers is exceeding 50,000 per annum. So those person whose aggregate salary from organizations exceeds 50,000 per annum. Common sense nowadays, many persons salary is obviously more than 50,000 per annum. Obviously they are covered under specified employee category. Anyhow, notes, salary does not include the following: non-monetary benefits not to be covered, employers contribution to RPF not to be covered, and monetary benefits to the extent of exemption not covered, and reduce section number 16 deductions, that is also to be considered. And substantial interest means, already I told you friends, 20% or more than 20% voting power you must have. If a person is a director come employee, he will be taken as a specified employee only for that company purpose only. If employee is working with more than one employer, then aggregate salary exceeds 50,000 means he is a what you call specified employee for all the organizations. Suppose I am working with A Limited and B Limited, so here my salary, let us say 30,000, here let us say 40, total that is 70. Whenever 70 is more than 50, automatically I am called as specified employee for A as well as specified employee for B. Okay, chalo. So this is the topic called as specified employee. Why we need to discuss specified employee? No, in certain cases salary will be taxable only in the hands of specified employees. That is the reason. Okay, chalo. Next, other topic, accommodation. What is that accommodation? No, rent free accommodation. Follow. If you got the job in some corporates, compulsory they will provide the quarters. I repeat, quarters, residential buildings. Some people will provide with furniture also. Some people will not provide the furniture at all. So anyhow, here accommodation two types. One is furnished accommodation. Second one is unfurnished accommodation. First come to furnished accommodation. How to calculate furnished accommodation value? Very simple. Furnished accommodation value is equal to value of unfurnished accommodation plus value of furniture. I repeat, value of furniture we need to add. Furniture again two types. One is own furniture, one is hide furniture. If it is own furniture, take it for granted 10% of original cost we have to take. I repeat, boss own furniture provided in my office, in my home, in that case 10% of original cost we have to take it. Suppose my employer not having any own furniture, he only taken hire basis and he only provided to me, then we need to add higher charges. Then you will get value of furnished accommodation. I repeat, value of furnished accommodation is equal value of unfurnished accommodation plus value of furniture. If it is own furniture, 10% of original cost. If it is hired furniture, higher charges we need to add. That's all. Now it is time for value of unfurnished accommodation. How to calculate? Number one, are you government employees or non-government employees? That is the question. If you are a government employee, only one word, only one answer. License fees is taxable. License fees already fixed by the government. That fee is only taxable. That's all. Whereas you are a other than government employees, that too boss provided accommodation in his own building. So accommodation given by the employer in his own premises, that means the accommodation owned by the employer. In this case we need to check the city population. If the city population is less than or equal to, less than or equal to 10 lakh, then take it for granted 7.5% of salary is taxable. Suppose if the city population is more than 10 lakh but less than 25 lakh, in this case 10% of employee salary is only taxable. Whereas if the city population is greater than 25 lakh, take it for granted 15% of employee salary is taxable. I repeat once again. Suppose you got the job in company Reliance. Reliance wanted to give the quarters. So they have given quarters in Guntur. Guntur population is 8 lakh. Oh, 8 lakh. Then first category 10 lakh below, right? Therefore 7.5% of salary is taxable. Suppose Guntur population is less than 10 lakh. Okay, suppose accommodation given in Vijayawada, whereas Vijayawada population is in between 10 to 25 lakh, let us say 15 lakh. Therefore 10% of employee salary is only taxable. Next and last, suppose accommodation given in Hyderabad, whereas Hyderabad population 90 lakhs, therefore 15% of salary is taxable. That's all. And one more thing friends, sometimes director means your company owner does not have any own building. He only taken one building on hire basis and that company hire building only provided to you. So whenever hired accommodation provided, no, then answer least of the following is taxable in the hands of employee. How much rent paid, that means higher charges, how much boss paid, or 15% of salary of employee, whichever is lower only taxable. That is the topic called as hired premises provided by the employer to the employee. That means employer only taken on hire basis, afterwards he only provided the same to the employee. In this case actual rent, that means higher charges, or else whatever the 15% of employee salary, whichever is less only taxable. This is called as value of unfurnished accommodation. And some special points here. Number one, if accommodation provided in hotel, generally hotel charges will be more, no, therefore least of the following is taxable. 24% of salary as well as higher charges, whichever is lower is only taxable. For example, if accommodation provided only for the purpose of transfer of the employee, that to accommodation provided for a period not exceeding 15 days, up to 15 days, then nothing is taxable. For example, you are working in one place called as Hyderabad. Now today you transfer to Lucknow, so you don't know what is that place at all. For that purpose, temporarily boss will give accommodation in a hotel. So therefore hotel accommodation provided at the time of transfer of the employee, that to maximum up to 15 days, nothing is taxable with respect to hotel accommodation. If it is more than 15 days, obviously 24% of salary are higher charges, that means hotel charges, whichever is less only taxable. Next one friends, more than one accommodation. Sir, first 90 days only one accommodation which has lower value is taxable. After 90 days both the accommodations shall be taxable. Suppose if boss provided two accommodations, in this case first 90 days one accommodation only taxable, whereas second 90 days onwards, that means after 90 days onwards, so both the accommodations double value is taxable. First 90 days, suppose two accommodations provided by the employer in special cases. In this case, accommodation 1, accommodation 2, whose value is less, that is only taxable. Whereas after expiry of first 90 days, next period onwards, up to the year, throughout the year, balance no, at the time, whatever the both the accommodation values are taxable. Next one, friends, exempt accommodation. In the following cases, rent-free accommodation not at all taxable. Number one, accommodation given to Supreme Court, High Court judges, not taxable. So quarters given to judges, not taxable. Accommodation given to parliament officials, not taxable. Accommodation given to union ministers, not taxable. Accommodation provided to opposition leader, not taxable. Accommodation provided to chairman or members of UPSC, central government organization, not taxable. Next one, friends, whenever accommodation provided at mining sites, or else onshore exploration of oil or petroleum, or else offshore sites, or else project execution, or else dam sites, or else power generation projects, or else remote area. In this case also, whatever the job you are doing immaterial, nothing is taxable with respect to accommodation itself. For example, you are working at the Polavaram project, so for your info, there no hotels, nothing. They voluntarily given the accommodation, nothing is taxable, because they're compulsory, they must provide this accommodation, otherwise the labor will not stay there, the work also will not be done properly. That is the reason. Same way offshore area, same way in case of projects, or else in case of power generation plants, in all the cases whatever the accommodation given at free of cost, that is nothing is taxable. Okay, chalo. So friends, this is the topic called as rent free accommodation, or else accommodation given at free of cost. Next one, friends, very important, friends. Number one, what is the meaning of salary? Friends, here salary definition consisting of many parts. Therefore, in exam hall, please keep in mind, when you want to solve the salary problem, the two rent free accommodation problem, in the salary problem, this rent free accommodation topic you have to do at the last resort. The reason as simple as that, it consisting of many parts, therefore you have to do at the last minute of that particular problem time, you have to do this one, because it consisting of many things. That is the reason. Follow. Here salary includes DA, which is so provided for computation of future retirement benefits. That to employer contribution, it includes, which is so provided for retirement benefits, but it does not include which is not so provided. That too, it does not include employer contribution to RPF. It does not include exempted allowances. It does not include perquisites. Okay, it does not include what you call interest on provident fund contribution, that means interest on employer contribution. Next one, it does not include voluntary payments received from that organization. That to retirement benefits, whatever received from the organization, that is also not covered. All other things are covered. Example, basic salary covered. Next one, DA so provided covered. Next one, friends, taxable salary, taxable allowances covered. Next one, taxable perquisites also covered. Okay, chalo, these are covered. Next one, bonus covered. Next one, commission also covered. That's all. What is not covered? No, these are not covered. Example, DA not so provided. Next one, employer contribution to provident fund. That to interest on such employer contribution to provident fund. That to exempted allowances and exempted perquisites and retirement benefits and non-monetary benefits. Non-monetary benefits also not covered. Okay, chalo. That too, friends, in case of rent-free accommodation, salary must be taken. I repeat, salary must be taken only on what basis? That is the question. Now see the points, ma. Here in the cases, the word used is provided perquisite is taxable only if it is used by the SSC. So only perquisite is taxable, but non-monetary benefits are not taxable. Here salary is taken only for the period for which accommodation is occupied by the SSC. whether it is actually received or not. So take it for granted. In case of rent-free accommodation, we have to take only salary on due basis. Generally due or receipt, whichever is earlier, no, but no, only due basis only we have to consider. This is only for rent-free accommodation purpose. For example, now my year number of months, no, that is 12 months, but what happened, no, I have taken 12 months salary plus next to 2 months, next year 2 months salary also I have received as a advance basis. Take it for granted, total 14 months salary I have received. No way. Answer, 12 months salary is only taxable. Remaining 2 months salary is taxable, no doubt at all, in this year only. But the remaining 2 months salary I should not consider for computation of rent-free accommodation salary. Okay na? Chalo. Next one, friends. Other topic, domestic servant, sweeper, gardener, etc., cook, watchman, whatever the things provided. Follow, friends. If it is provided by the employer, I repeat, provided by the employer and salary paid by the employer, in this case it is taxable in the hands of specified employees. Suppose if it is appointed by the employee but salary paid by the employer, in this case it is taxable in the hands of all employees. Okay, that means specified and non-specified. So take it for granted, if appointed by, I repeat, that person appointed by employer and the salary also paid by employer, both are by employer, in this case only specified employees. Whereas it is appointed by the employee and paid by employer, then it is taxable in the hands of all the category employees. Next one, here taxable value of perquisite is equal to how much is the amount paid by the boss. That's all. Next one, domestic servant allowance fully taxable, that is allowance topic, and if any amount recovered from the employee, it shall be reduced from the benefit. For example, in my house, one servant appointed by employer only appointed one servant. That too, my servant salary, let us say 2 lakh rupees paid by my employer only, but 50,000 is taking from myself. So from the employee is taking 50,000, my employer taking 50,000 and is paying 2 lakh salary to my servant. In this case, my net benefit is 2 lakh minus 50,000, that is nothing but 1.5. That's all. 1.5 is only taxable. Next one, gas, electricity, water facilities provided by the employer. In this case, the connection is in the name of employer and paid by the employer only, then it is taxable in the hands of only specified employees. Whereas the connection is in the name of employee but paid by the employer, in this case it is taxable in the hands of all the employees. Next one, here taxable value of perquisite, how much is taxable? Suppose if it is provided from the own source, that means my boss business itself manufacturing of what you call some gas cylinders, or else what you call supply of water, or else my boss business itself generation of electricity, in this case take it for granted, manufacturing cost only taxable. So example, for generation of that cylinder, let us say the amount is incurring, the manufacturing cost is incurring, let us say 10,000, but in the market is selling for 15. Answer, 15 is not taxable, in my hands 10k only, 10,000 only taxable. That's all. Suppose boss is not doing any kind of these businesses, gas, water, electricity, he only procuring from outsiders and he only providing to me. In this case, take it for granted, purchase value is only taxable. For example, my boss is purchasing from outside market for 15,000 and later on providing to me, take it for granted that 15,000 is only taxable. Okay, chalo. Next one, friends, educational facility it is, so not allowance, perquisite. Educational facility provided by the employer, then what is the answer? Educational facility provided by the employer to the children of the employee. Okay, chalo. Number one, facility arranged by the employee but fees paid by the employer. In this case, it is taxable in the hands of all employees. Okay, next one, the taxable value is nothing but how much is the paid by the employer, that is only taxable. That's all. Next one, facility provided by the employer and that money also incurred by the employer. In this case, it is taxable only in the hands of specified employees. That too, if taxable value is nothing but for children of the employee. I repeat, for the children of the employee, if you provide the education, take it for granted. If the cost of education for each child is less than or equal to 1000 per month, not taxable. Suppose if the cost of education is more than 1000, in this case it is fully taxable. Okay, chalo, that's all, fully taxable. So don't take other alternative, take alternative one only, because there is a high court judgment for this. Okay, anyhow, case laws are not applicable at CA inter level, but generally in CA final also we will teach this one only, because one court decision is there, DPS, Delhi Public School High Court decision, Delhi High Court decision. But anyhow, follow this alternative one, don't follow alternative 2. In your institutive material and masterminds material also, both the alternatives are given. But in exam hall, you cannot write alternative 1, alternative 2, alternative 3. We don't have that much of time. Directly write the answer. It is fully taxable. Next one, friends. Suppose educational facility provided to the children of relatives. In this case, fully taxable. How much is the cost? That entire cost is fully taxable. That's all, friends. This is the topic in relation to educational facilities. Here important point is, in the case of own institution education provided, up to 1000 per child per month is not taxable. If it is more than 1000, fully taxable. That too, there is no restriction on number of children. Okay, chalo. Next one, if employer providing free education and training to the employee including accommodation, it is not at all taxable. If employer only provided free education to the staff members, nothing is taxable. If amount recovered from the person, no, that anyhow should be reduced from taxable value. Education allowance, in case of children education allowance, no, 100 per month per child is exempted in case of maximum 2 child. That too, hostel allowance, 300 per month per child is exempted for maximum of 2 child. That's all. Okay, if you have more than 2 child, no, exemption is restricted only for 2 child. That's all. With this, completed the topic educational facilities. Next important topic, medical facilities. Medical facilities provided in India. In India, take it for granted, almost all everything is exempted except private clinic. Okay, anyhow, please follow. Educational facilities completed. No, this is medical facilities provided in India. In this case, provided all of you in own hospital, owned by employer, exempt. Second one, government hospital, that is also exempt. Third one, hospital which is approved by Chief Commissioner of Income Tax for specified diseases, approved organization for specified diseases, exempted. Last one, medical insurance premium paid, that is also exempt. So own hospital exempt, government also exempt, approved by the Chief Commissioner of Income Tax, that is also approved. No, that is also exempt only for specified diseases. Last one, premium paid, that is also exempt. Take it for granted, in India all are exempt except one thing. What? That is private clinic treatment. So reimbursement of expenditure done by the employer for the medical treatment of employee, in this case, that is fully taxable. Once upon a time, up to 15,000 exempt concept was there, that was amended, so fully taxable. Next one, outside India. Expenditure incurred for medical treatment outside India, that facility provided by the employer only. In this case, what is the answer? Number one, for expenses for medical treatment purpose, exempted, fully exempted, subject to approval of RBI. So that means expenditure incurred or RBI approval, whichever is lower, is only exempt. Next one, stay expenses, that is also exempt, subject to approval of RBI. Next one, last one, travel expenses. In case of travel expenses, we need to check the employee's gross total income. If employee gross total income is less than 2 lakh, in this case, all of you, that is exempt. Less than 2 lakh, it is exempt. Suppose if it is more than 2 lakh, then fully taxable. Suppose less than 2 lakh means gross total income less than 2 lakh is a very low salaried income employee. That is the reason government don't want to collect the tax. Suppose if the gross total income more than 2 lakh, it is pakka taxable. That's all. This is the concept called as medical facility. So medical facility is different, medical allowance are different. Medical allowances are pakka fully taxable. Employee should attach with income tax return a certificate from the hospital. Anyhow, here gross total income include taxable value of medical treatment as well as stay expenses also, but excluding this travel expenses. So his gross total income excluding travel expenses is less than 2 lakh, then his travel expenses benefit whatever provided by the employer is not taxable, otherwise it is taxable. Here family includes spouse or children and dependent parents, dependent brother and sister. Okay, chalo. With this, done with the topic, that is educational facility as well as medical facility. Now another topic, car provided by the employer to the employee. In this case, car owned by the employer. Boss only provided the car. That too, expenses also incurred by the employer. Both are employer. In this case, generally taxable provided if you use for your personal purpose. Common sense, if you use the car for office purpose, nothing is taxable. So employer and employer. Follow. Car owned by employer, hired by the employer for official purpose. Answer, nothing is taxable. For personal purpose, fully taxable. How much incurred by the boss? That is taxable, plus car also given no depreciation, like 10% of original cost is only taxable. That's all. Next one, both purpose, partly official, partly personal. In this case, we have to check the car capacity, engine capacity. If it is less than or equal to 1.6 liters or else less than or equal to 1600 cc, in this case 1800 per month is taxable. Suppose if it is a big car means more than 1600 cc or more than 1.6 liters, then 2400 per month plus 900 rupees per driver. If driver also provided extra 900, 1800 plus 900, here 2400 plus 900 is only taxable. That's all. I repeat, if car owned by the employer, expenses also met by the employer. If it is official purpose, not taxable. If it is personal purpose, that expenses plus 10% of cost is taxable. If it is partly official, partly personal, in this case engine capacity we need to check. If it is a small car less than or equal to 1.6 liters, then answer 1800 plus 900. 900 will come only if driver also provided by the employer. In case of big car in the sense more than 1600 cc, obviously 2400 per month plus driver if any 900 is also taxable. Next, another question friends, car owned by the employer. Okay, after that expenses met by the employee. Okay, chalo friends, it is owned by the employer, expenses met by the employee, then the car is used for official purpose, not taxable. If you heard the word official, not taxable, leave it. Personal purpose, not taxable. What? Not expenses, because your expenses anyhow own expenses by employee, not taxable. Then what is taxable now? Car value. How much? 10% of original cost is only taxable. Last one friends, partly official, partly personal. Then you have to check the same engine capacity. If it is a small car, means less than or equal to 1.6 liters, then 600 per month plus if driver also there 900 per month. If it is a big car more than 1.6 liters, 900 per month for car plus driver also if any provided by the employer another 900 is taxable. Next one friends, car owned by the employee, expenses also met by the employee, both are employee, nothing is taxable. Official, personal, partly, nothing is taxable. Why? What is the benefit given by your employer? Beginning of this chapter I told you the relationship between payer and payee is employer and employee, then only it is taxable. But I told you everything employee, car owned by employee, expenses met by the employee, then how it is taxable? Nothing is taxable. Last one, car owned by the employee but expenses met by the employer. Possible? Yes. Your boss only is telling like this. Your boss is telling that, hey employee, come in your car, I only will make the expenses. Then answer, official purpose, nothing is taxable. Personal purpose, taxable. What? Not depreciation value, only expenses met by the employer only taxable. Last one, partly official, partly personal. Whenever there is a word partly, then you have to check the engine capacity. If the engine capacity is less than 1600, no, in this case you have to write like this, whatever the expenses minus 1800 per month plus minus 900 per month if driver also provided, balance amount only taxable. Suppose if the car bigger one more than 1600 cc, in this case that expenses minus the 2400 per month minus 900 per month if driver also provided, that means total expenses minus 1800 plus 900 if any. Same way, if it is a big car, expenses incurred by the employer minus 2400 again minus 900 if driver also provided, the balance amount is only taxable. Okay, chalo friends, as far as car is concerned, other information. Number one, car where two or more cars are provided, in this case what is the answer? One car selected by the employee is treated as the car is owned by the employer and expenses also met by the employer and used for both the purposes. That is only one car treatment is this one. So in this case, expenses minus 1800 per month minus 900 if driver also there. In case of big car, expenses minus 2400 per month minus 900 per month, balance amount is only taxable. Suppose if more than one car provided, no, this is the first car treatment, whereas remaining car treated as the car is owned by the employer and used for personal purpose. Whenever it is personal purpose, take it for granted. Answer, actual expenditure incurred by the employer plus 10% of the car cost is only taxable. Okay, so include, the point is very simple. If two cars, more than one car provided, we will assume that one is used for both the purposes, second car used for personal purpose. That is our assumption. Where car owned by the employer and expenses met by the employer, in this case what is the answer? It is used for official purpose, nothing is taxable. Suppose if it is used for both the purposes, then expenses met by the employer minus official purpose, that is 900 normal way, as well as driver if any provided, another 900, balance amount is only taxable. Last one, car facility is not taxable in the following cases. In the following cases, nothing is taxable. Number one, in between office to home, home to office, nothing is taxable. Car facility only for office to home, home to office, nothing is taxable. Same way, car facility provided to High Court and Supreme Court judges also not taxable. Last one, car facility provided to UPSC chairman, that is also not taxable. Okay, chalo. So in the following cases, it is not taxable. Car important topic for exam. And medical facility also important. Rent free accommodation also important. Okay, chalo. Next, interest free loan. Very, very, very important. Interest free loan. Interest free loan provided by the employer to the employee. What is the answer? Common sense, that loan facility provided only because of your job, right? Therefore, what is the loan outstanding? I repeat, what is the loan outstanding? That too, you have to check the loan outstanding on monthly basis. Month end, how much is the loan outstanding? That is step number one. Step number two, what would be the SBI rate? I repeat, what would be the SBI rate? Number 3, what would be the employer rate? How much employer is charging? Step number 4, the difference between SBI rate interest and employer rate interest balance is only taxable. Example, if you are an employee of Reliance Industries, your boss has given 5 lakh rupees at 4% interest. For your personal obligations purpose, you have taken 5 lakh rupees loan from your boss at the rate of 4% interest. For your info, same personal loan if you want to take from SBI, you have to pay, let us say, 10%. That means indirectly you are getting 6% benefit. The 6% into 5 lakh, that is only taxable. That's all. See the points. Number 1, all of you, Babu, here taxable. How much is taxable? Rate specified by the SBI as on the first day of the previous year. That means 1/4/2023-24 as the case may be, minus rate charged by the employer. The differential amount is taxable. That's all. But compulsory you have to calculate month ending balance. See the word, interest shall be calculated on maximum outstanding monthly balance. Oh, month ending, how much is the balance? The MOMB, month outstanding monthly balance. No, that is maximum outstanding monthly balance, means outstanding balance as on the last day of the month. This perquisite is taxable in the hands of all employees, every employee, specified, non-specified, government, non-government, all. If it is a closely held company, in this case, for your info friends, section 2 subsection 22 class E, deemed dividend concept will applicable. This topic anyhow we are going to discuss in detail in the topic called as IFOS, provided that employee must have minimum 10% of voting power. Next one friends, notional interest on interest-free security deposit given by the employer cannot be treated. Sir, notional interest shall not be taken with respect to those deposits made for the rent-free accommodation and all. That should not be considered. And next one friends, exceptions. In the following cases, nothing is taxable. Petty loan, petty, small amount. How much? Not exceeding 20,000 per annum. Small amount, sir. You have taken amount of 10,000 from your boss, then nothing is taxable. 15,000, nothing is taxable. Aggregate amount I am talking. 18, no. 19, no. 20, no. 21, yes, taxable. That's all. 10, entire computation you have to do. Next one, loan taken for medical treatment of relative or employee. Suppose employee father suffering from cancer. That is the reason employee has taken 40 lakh loan from the boss. Yes, that is also not taxable, because on humanitarian grounds, whatever the loan taken for the purpose of healthcare or what you call medical treatment, you can take any amount. Whatever the interest, we will not charge, we will not calculate like this. Nothing is taxable. Okay, chalo. With this, done with the topic. Next one, mobile assets. In case of mobile assets, if you give for usage purpose at free of cost, if you give laptop or computer at free of cost, nothing is taxable, because if you give laptop or any computer, it is useful for the organization, not to the employee. If you give any other asset which is owned by the employer, in this case 10% of original cost is only taxable. If any asset provided by the employer which is hid by the employer, take it for granted, higher charges only taxable. That's all. Next one, transfer of mobile asset. I repeat, transfer of mobile asset. Sometimes what happen, no, boss will transfer car or else computers, or else in second sale they will sell it. No, in this case, what is the answer? Number 1, electricals. In case of electricals, first to take purchase price, at what rate boss purchased in those days, minus depreciation for completed years of usage of the asset. Only completed years, how many years they used the asset. Suppose 4 years 2 months, ignore 2 months, you have to take only 4 years. That too, in case of electricals, depreciation will be more, no. That is the reason we have to calculate depreciation at the rate of 50%. I repeat, at the rate of 50%. Okay, chalo. Of WDV. Next one, balance amount you will get. Out of that, you have to deduct how much is the selling price. At what rate employer sold the asset to the employee, that you have to deduct. Balance amount only taxable. For example, I only purchased computer for 10 lakh or computer etc. I used it for 3 or 2 years. First year 50%, 5 lakh, balance 5. Next year on WDV value 50%, 2.5. So net amount 2.5. Today WDV 2.5, but I sold the asset to my one of the staff member for 2 lakh. Tell me, 2.5 asset you sold for 2 lakh. So balance 50,000 is taxable. That's all. Next one, car. Some student doubts, are car already completed? No. That is a usage of car, but this is a transfer of car. Employer wanted to sell the car to the employee. In this case, answer very simple. What is the purchase price minus depreciation for every completed year of usage, that is at the rate of 20% of WDV. Then you will get WDV balance minus selling price, you will get taxable value. Last, other assets. In case of other assets, take same way, purchase price minus depreciation for completed years of usage. I repeat, depreciation for completed years of usage. A small mistake, that is 10% of SLM, not WDV. Now balance WDV minus sale value, then you will get taxable value of perquisites. That's all. Friends, here electricals means only those assets which are used in offices. No doubt all these assets are used in offices, but which are used for office purpose, like computers. And the next one, data storage and handling devices, computers, digital diaries, printer, scanner, fax machine, these are only covered. But household appliances which are used in offices, that is not covered under category called as electricals, that is come under category called as other assets, like machines, or else what you call mixie, microwaves, AC, refrigerator, etc. Okay, chalo. This is the topic called as usage of mobile asset and transfer of mobile asset. In case of transfer of mobile asset, please remember one word. In case of transfer of 10 years old asset, nothing is taxable. Suppose if the furniture purchased 14 years back and transferred by the employer to the employee, nothing is taxable. Okay. Next one, gift. Money, fully taxable. Whatever the money given by employer to the employee, fully taxable. Next, kind. In kind, boss only provided. If aggregate value of gift is up to 5,000, nothing is taxable. If exceeds 5,000, take it for granted, fully taxable. Don't take alternative 1, take alternative 2 here. Direct answer, gift fully taxable. Suppose you got the gift value of rupees 5,500, fully taxable. 5,500, no, fully taxable, that's all. Okay, chalo. This perquisite is taxable in the hands of all employees. Gift allowances anyhow fully taxable. That's all. Next one, food, tea, snacks, coffee, etc. provided by the employer to the employee. Number 1, tea, coffee, non-alcoholic beverages provided at any time. Answer, nothing is taxable. Tea, coffee not taxable, sir. Leave it. Next one, food. Food provided by the employer. Answer, these are provided during working hours. I repeat, during working hours, or else when you are working, what you call working on remote area, or else on-site, offshore units you are working, in this case also not taxable. Suppose they are provided during working hours, that too the meal value is up to 50 rupees, nothing is taxable. If the meal value is more than 50 rupees, extra amount only taxable. For example, late hours I am working, nothing is taxable, because when I am working lately for my organization purpose, it is a minimum courtesy to my boss to provide the lunch, not taxable. Suppose I am working on site, nothing is taxable. I am working In remote area, nothing is taxable. I am working during office hours only. Boss provide the lunch up to 50 rupees per meal, not taxable. Above 50 rupees per meal, fully taxable. Means extra only taxable. For example, meal value 55 rupees. Up to 50 rupees not taxable. 5 rupee into number of meals. How many meals you had during the year? That amount only taxable. This perquisite taxable in the hands of all employees, and this exemption would not be available in case of employees who opts 115 BSc. If you want to go for 115 BSc, this exemption 50 rupees exemption not applicable. Next important topic, sweat equity shares. Whenever employer provided to the employee for a consideration other than money, employee has some IPR, intellectual property right, or employee is doing excellent services. In this case, employer will provide some sweat equity shares at free of cost or at concessional rate. In order to retain these employees, we will give some extra benefit. That extra benefit is nothing but sweat equity shares. In case of sweat equity shares, answer very simple. Number one, these sweat equity shares are taxable, pakka taxable. How much is taxable? That is the question. Answer. Number one, what is that company? Whether listed or unlisted? Listed. Whenever it is a listed company, the two, the day when you are taking the share, the day market is open. In this case, average price you have to take. Market is generally open. Morning 9:15, the shares will be quoted, right? Evening up to 3:30, right? So opening price plus closing price divided by 2. So average price must be taken. Suppose I am working with Infosys. Infosys wanted to allocate or allot 20,000 shares. So 20,000 shares given at free of cost, no? Then 20,000 into average price you have to take. Next one. If share is listed more than one stock exchange, maybe BSE and NSE, in this case, same answer. Take average price which records highest volume of trading. Generally, in NSE, shares volumes will be high in some cases. In some cases, maybe BSE. So, where the volumes of particular shares are high, that we have to take it. That highest volumes market average price you have to take for the share. Next one. It is not listed at all. I repeat, no trading listed, but no trading on the stock exchange. No trading on the stock exchange means the day market is off. That means the day market holiday. For example, Saturday. Saturday market won't be there. Stock exchange won't be there. Therefore, you have to take, all of you, closing rate. I repeat, closing rate on last working day. Last working day. Suppose Saturday, my boss called me and said, hey, take 20,000 shares at free of cost because I like you. I liked your services. Take this 20,000 shares at free of cost, he said. So Saturday market is off, right? So I need to take the closing price of the Friday. That's all. Next one, friends. Not listed share, unlisted share. Suppose my company is a private company where I am working. My boss called me and given 20,000 shares at free of cost. In that case, the fair market value as determined by the merchant banker. Generally, for the giving the loans and all, they will calculate a value of share, right? So that value is only taxable. That's all. This is the topic called as sweat equity shares. Important for exam point of view. Okay, chalo. Next one, friends. Traveling and touring other than LTC, not LTC, not leave travel concession, other than leave travel concession. Number one, perquisites in respect of traveling, touring, accommodation. This facility provided from outside source. Suppose I went to Araku. In Araku, employer only given rooms to me. In this case, expenditure incurred by the employer is taxable. Suppose employer only has own source, out of own source provided. In this case, the value at which market prevails, that is only taxable. For example, for outsiders 40,000 rupees. For me also 40,000 taxable. That's all. Other points, where employee is on official tour and expenses for is household accommodation, in this case whatever the expenses incurred, that is taxable. Where official tour is not taxable, only official tour not taxable, other than official tour pakka taxable. Okay, chalo. Next one, all of you, free transportation. What is the free transportation? Transportation provided to the employees working in railways and airways, not taxable. I am railway employee, not taxable. I am airways employees, not taxable if they provided free transportation. Whereas accommodation provided other transport, that is road. I am working in case 9 travels, they only given free transportation. In this case, the value of that accommodation cost, the value of the transportation cost is only taxable. If third party want to travel, in that case 9 it travels, how much is the cost, that is only taxable. Very simple. Club facility. In software sector, no, boss generally will provide club facility to the employees. If that is provided for official purpose, organization purpose, nothing is taxable. If it is provided for personal purpose of the employee, entertainment purpose, pakka taxable. See the word exempt in following cases. Number 1, health club, sports club facilities provided for all employees, generally not taxable. Initial fees are deposit, that is also not taxable. But which are taxable? No, membership fees, annual fees, any other expenditure in the club, that is pakka taxable. So generally health club and sports club not taxable, and initial any deposits not taxable. Deposits amount not taxable, other amounts are pakka taxable. Other amounts means annual membership fees, all are taxable. Okay, chalo. Next one, if it is provided by the employer to the employee for official purpose, then only taxable. Personal purpose not taxable. Sorry, reverse. Official purpose not taxable, personal purpose pakka taxable. Next one, credit card. Credit card provided for official purpose. The credit card used by the employee for official purpose, nothing is taxable. Suppose the credit card used for personal purpose of the employee, in this case membership fees, annual fees, any other expenditure, pakka taxable. Okay, chalo. With this, done with the topic called as perquisites. With this, we completed format for computation of salary, and we completed perquisites. Now in next video we are going to start the topic called as retirement benefits. Friends, now we are going to start the second part of salary topic. Now out of this, first I would like to start the retirement benefits. Please follow. There are so many retirement benefits. Out of that, the first one is gratuity. Friends, generally gratuity will be given at the time of retirement. Generally at the time of retirement. Suppose if your employer wanted to give the gratuity during the period of service, during the period of employment, take it for granted that gratuity portion is pakka taxable. That means fully taxable. Suppose if the gratuity received at the time of retirement, in this case, what is the taxability? That is the question. Suppose if it is received by the government employees, I repeat government employees, then take it for granted it is fully exempted. If gratuity is received by other than government employees, that too if the employee is covered by the payment of gratuity act, I repeat covered by the payment of gratuity act, in this case least of the following is exempted. Small a, maximum limit 20 lakhs. Small b, actual amount received. Anyhow your employee will say the figure. Small c, whatever the 15 days salary based on last drawn salary for every completed year of service. I repeat 15 days salary based on last drawn salary for every completed year of service. Friends, last drawn salary means your last month retirement time, what is your salary? Last drawn salary into 15 days divided by 26 days excluding Sundays. 15 divided by 26 into, you have to take completed years of service, number of years of service. So 15 days salary based on last drawn salary for every completed year of service or part thereof in excess of 6 months. If the number of years of service we have to check, for example, that is 11 years 2 months, then ignore the 2. Suppose 11 years 7 months, then the 7 is more than 6, no, then take it as a 12. Suppose if the last number of months is above 6, then take it as a fully completed year. Okay, chalo, that's all. Your salary definition: basic salary plus any DA. Last topic, friends. If employees are not covered by the Payment of Gratuity Act, in this case, least of the following is exempted. Small a, maximum 20 lakh. Small b, actual amount received. Small c, half month average salary for every completed year of service. Half month average salary means 1/2 into average salary into completed years of service. Suppose 14 years, then take 14 only. 12 years, take 12 only. 12.9, ignore 9, only take 12 years, that's all. But whereas covered by the Payment of Gratuity Act, if the period is more than 6 months, then we have to take as a completed year. Okay, chalo, see the word. Here salary definition: basic salary plus DA, which form an part of retirement benefit salary, plus commission as a fixed percentage on turnover. Your average salary means salary drawn during the period of 10 months divided by total 10 months you have to check. Next one, friends, these gratuity exemption is available only if you are a government employee is fully exempted. If you are other than government employees, then answer would be different, whether you are covered by the Payment of Gratuity Act or whether you are not covered by the Payment of Gratuity Act matters. Suppose if you receive the gratuity during the period of employment, that is pakka taxable. And one more thing, friends, whatever the 20 lakh exemption, okay, the exemption is applicable for life, So throughout your life, the gratuity exemption does not exceed 20 lakh at any point of time. Okay, chalo. Next one, friends, here government employees receives the gratuity, that is pakka exempted. Even if government employees died, their legal heirs received, that is also exempted. Okay, chalo. So I told you, friends, if you are covered by the Payment of Gratuity Act, if your period of service is completed years, we have to take it. If it is more than 6 months, then we have to take it as a completed year. If you are not covered by the Payment of Gratuity Act, then you have to take only completed years only. The fraction, whatever the number of months, even 11 months, 11 days also we need to ignore. Okay, chalo. Next one, friends, another topic, pension. Pension, two types ma. One is a monthly pension. I repeat, monthly pension. Otherwise, it is also called as periodic pension. Periodic pension. Otherwise, it is also called as uncommuted pension. Uncommuted pension. Take it for granted, pakka taxable. Either government or non-government or immaterial, pakka taxable. Next, commuted pension. Commuted pension also known as a lump sum pension. In case of commuted pension or lump sum pension, if you are a government employee, is pakka exempted. If you are other than government employees, if employee is not receiving gratuity, they have not received gratuity, means they don't have any exemption there. In this case, 1/2 of commuted pension is exempted. Whereas if employee received gratuity, in this case already exempted claimed in gratuity case, right? Therefore least, somehow less amount, 1/3 of commuted pension, full value of commuted pension is only exempted. Here pension received from UNO, anyhow fully exempted. Whereas pension received by family members, in this case that is called as family pension, because employee died, then only family members will come into picture, then that is covered under the head IFOS. Pension received by the family members of armed forces, that is may be exempted under section 1018 or else may be exempted under section 1019 as the case may be. If the armed forces of gallantry award winners, then that is exempted under section 1018, or else if the employee died while discharge of services, in that case that is exempted under section 10 subsection 19. Next one, commuted value. Full value of commuted pension is equal to what is the amount received for commutation divided by percentage of commutation. That's all. With this, done with the topic called as pension. Next topic is called as leave salary, leave encashment. Leave salary covered under section 10 subsection 10A. Leave salary received during the service, during the job, that is pakka taxable. Leave salary received after retirement, that too if you are a government employee is fully exempted. First of all, what is leave salary? Generally there are some leaves which are compulsory leaves, which are optional leaves. Compulsory leave means that day holiday, at any cost it is a holiday. Example, May Day, that is international holiday, we should not open the office that day. But some days some organizations will be there, they will give optional leaves. Example, Sri Ram Navami is a optional holiday. They will give holiday that day. If you want, you can take it, or else you can come to office and do the work. If you come to the office and do the work, then they will pay extra salary, that is called as leave salary. In case of leave salary, if you receive at the time of job every year, means every month or every year, as the case may be, periodically if you receive, pakka taxable. If you receive at the time of retirement, in this case if you are a government employee, pakka exempted. If you are a non-government employee, least of the following exempt, that is statutory limit, maximum limit 3 lakh, actual amount anyhow received. Next one, 10 months into average salary. Next one, cash value of, that is cash equivalent value of leaves which is credited to his leave account. Okay, so that you have to take it. So cash equivalent value of leaves which are credited to his leave account, that you have to take. Out of these four, whichever is lower. Here salary definition, friends, same. Basic salary plus basic salary plus DSO provided for computation of future retirement benefit plus commission on fixed percentage on turnover. Friends, here only completed years of service only we have to take it. Completed years of service. Average salary formula, salary last 10 months salary preceding to date of retirement divided by 10 months. Okay, so last 10 months salary preceding to date of retirement divided by 10 months we have to take. That's all. Next one, how to calculate cash equivalent value of leaves at the time of retirement. Friends, for this purpose, first we have to do this computation. Leaves as per the organization, as well as leaves as per income tax rules. Friends, leaves as per income tax rules does not exceed maximum 30 days per annum. I repeat, maximum 30 days per annum. Whichever is lower only permissible. Minus how many leaves you utilized. Then you will get unutilized leaves. So that unutilized leaves you have to convert into number of months of leaves outstanding into average salary. Number of months of leaves outstanding is nothing but already you got unutilized leaves, no, that you have to convert into number of months into average salary you have to take it. That's all. So friends, if you are a person who are non-government employee, that too you received the amount at the time of retirement, then least of the following is exempt. Maximum limit 3 lakh, actual amount received 10 months into average salary. Next one, number of months of leaves outstanding into average salary. Okay, chalo. Next one, friends, compensation. Friends, there are so many compensation here, mainly retrenchment compensation. Whenever there is a change in the terms of employment, boss will give some extra compensation. That is called as retrenchment compensation. In that case, least of the following is exempted. statutory limit, that means maximum limit 5 lakh, actual amount received, or else amount calculated as per Industrial Dispute Act. Industrial Dispute Act, whichever is lower. Another topic, friends, VRS compensation. VRS compensation, voluntary retirement case also, least of the following is exempted. The maximum limit is 5 lakh. Actual VRS compensation received. But here third point, higher of the following. What is that? Completed years of service into 3 into last drawn salary, or number of months of leaves outstanding into last drawn salary. Out of these two, whichever is higher, that figure we have to take outer column. All together, whichever is lower. I repeat once again. Maximum exemption 5 lakhs. Actual amount received, or else higher of the third point is nothing but internally higher of the following. Completed years of service into 3 into last drawn salary, or else number of months of leaves outstanding into salary. That's all. Friends, here salary definition is as follows. Basic salary plus DA so provided plus commission as fixed percentage on turnover. And one more thing, friends, here completed year of service only we have to take it. Okay, chalo. So this is the topic, friends. But here I would like to tell you what is the government employees means. Friends, government employees definition I am going to tell you. For leave salary, only central and state. For gratuity, central, state as well as local authority. Whereas for pension, central, state, local authority and statutory corporation. Once again, for first one, what is that? First one is leave salary, only central and state. Second one, gratuity, no, central, state, local authority. Third one, pension, no, central, state, local authority and statutory corporation. This is the employees definition. Government employees means. Very, very, very important topic, provident fund. Friends, there are 4 provident funds. One is statutory provident fund, one is recognized provident fund, one is unrecognized provident fund, one is public provident fund. Honestly speaking, public provident fund is applicable to all citizens, anyone, not only employees. Employer, beggar, farmer, students, rich, poor, everybody is covered. Whereas statutory, recognized, unrecognized, these are only applicable for employees. First, let me start with recognized provident fund. For recognized provident fund, both employee as well as employer will contribute. Employee contribution, 80C deduction allowed. Employer contribution, up to 12% of his salary not taxable, over and about 12% of salary is taxable. Whatever the interest created on that, up to 9.5% is not taxable, above 9.5% is taxable. Any lump sum amount received, no, that lump sum amount also not taxable, provided employee has to render services for a period of 5 years. For a continuous period of 5 years, he has to do work. But one and only exception, in case of medical issues, doctor suggested him not to work, or else in case of unavoidable reasons, at the time he can leave the organization, no way. But otherwise he has to continue services for a minimum period of 5 years. Then only whatever the amount received from RPF, recognized provident fund, is exempted. If you work only for 3 years and if you resign from that organization, pakka it is taxable. Next one, unrecognized provident fund, friends, which is not recognized by the Commissioner of Income Tax. If employee contribute, 80C deduction not allowed and nothing is taxable. Interest also not taxable. But wait, whatever the lump sum amount you received at the time of retirement or at the time of resign, that lump sum amount anyhow pakka taxable. See the word. In case of unrecognized provident fund, that balance may consisting of 4 items. First one is called as employee contribution, second one is called as interest on employee contribution, next one is called as employer contribution, last one is called as interest on employer contribution. First one, employee contribution anyhow not taxable because you only employee, you only paid, not taxable. Next one is interest on employee contribution. It is taxable under the IFOS because there is no employer and employee relationship for that interest, because employee only contributed, on that contribution only got the interest, so not salary, only other sources. Next one, whereas employer contribution and interest on employer contribution both are covered under the head salary, but as a profit in lieu of salary. Okay, chalo. Next one friends, SPF, very simple one. Employee contribution exempted, deduction allowed 80C. Employer's contribution not taxable, fully exempted. Interest also fully exempted. Whatever the lump sum amount received also fully exempted. Next one, public provident fund. Any citizen will contribute. 80C deduction anyhow allowed. Employer contribution also not applicable. First of all, I don't say not taxable, I say not applicable because anybody voluntarily can contribute for themselves. Next one, interest any created exempt, and lump sum amount received after 15 years, because lock-in period in case of PPF 15 years, that is also exempt. That's all. With this, done with the topic called as PF. In case of recognized provident fund, if they rendered services for a continuous period of 5 years, exempt. If not rendered for a period of 5 years, then pakka taxable, but exceptions, health issues, or else discontinuance of business or any other reason. That's all. I told you already, unrecognized provident fund. Next one, new provisions. These are amendments. Please follow. Aggregate employer's contribution to any of the following accounts is in excess of 7.5 lakhs, then that is considered as perquisite. See the word RPF and NPS covered under section 80 CCD subsection 1 and approved superannuation fund. Friends, for example, if any person contributes some amount, the total amount, let us say 4 lakh here, 5 lakh here, 1 lakh, total 10 lakh. Sir, 10 lakh is more than 7.5 lakh. Therefore, the aggregate contribution to any of the following accounts in excess of 7.5 lakh, that is considered as a perquisite, that is pakka taxable. Okay, chalo. See the next point. If any employer contribution to a fund becomes perquisite in the hands of employee, then annual accretion on such amount by way of interest, dividend, or any other amount of similar nature during the previous year shall be considered as perquisite. On that, whatever the dividend or interest or whatever it may be, that is also pakka taxable. Okay, chalo. Next one friends, superannuation fund. Whatever the employer contribution, if it is more than 1,50,000, taxable. Whereas employee contribution, that is not a income at all, that is 80C deduction allowed. And whatever the interest amount received on that contribution, that is pakka exempted. Okay, so if it is received by the legal heirs, or if it is received at the time of retirement because of his health issues or age factor, or at the time of death, that is not at all taxable, that is pakka exempted. Superannuation fund amount received is exempted. That's all. Friends, last concept, that is called as allowances. Take it for granted, some allowances are fully taxable, some allowances are partly taxable, some allowances are fully exempt. Okay, chalo, one by one we are going to cover. Please follow. Number one, DA, dearness allowance. In Telugu it is known as Karuvu Bhatyam. If prices are going to increase, then boss will give some extra money, that is called as dearness allowance. Next one, city compensatory allowance. When you are moving from one city to another city at the time of retirement, when you are transferring from second grade city to metro city or cosmopolitan city, obviously cost of living is high in that cities. Therefore, boss will give some extra money, is called as city compensatory allowance, that is pakka taxable. Next one, domestic servant allowance. Boss will ask you to appoint one maid servant. For that, boss will give some extra salary for you, that is called as domestic servant allowance. It is actually personal in nature, pakka taxable. Telephone allowance, fully taxable. Telephone facility not taxable, but telephone allowance taxable. Medical allowances fully taxable, whereas medical facilities may be exempted to some extent. Entertainment allowance pakka taxable, overtime allowance fully taxable, food allowance, lunch, dinner allowance taxable, warden allowance for your children warden purpose some allowance reserved fully taxable, night duty allowance some people will work night shift, for that extra money will be given exempt, are taxable, pakka taxable, specified allowance that is also taxable. Okay, next one friends, another topic, some are official purpose that is exempt. Conveyance means whatever the amount reserved for transportation from one office to another office, another office to another office. Suppose myself, I want to go to income tax office, after income tax office to GST office, GST office to bank for company purpose, so exempt. Whatever the car facility or whatever the money given for that, exempt. Helper allowance for office work purpose, they appointed one helper, exempt. Cost of travel and tour or transfer, at the time of transfer they have given, exempt. Next one, uniform allowance for traffic police or police, some departments will have uniform, for that boss will give some amount, exempt. Daily allowance, day to day operations purpose, exempt. Academic research and training and educational allowances for employees for academic growth purpose, exempt. Okay, chalo. And next one friends, some are specified amounts are exempted. In children education allowance, take it for granted, 100 rupees per child per month it is exempted, maximum of 2 child. Hostel allowance, same answer, 300 per month per child is exempted, maximum of 2 children. Transport allowance pakka taxable, I repeat pakka taxable, but in only in case of physically handicapped, in that case 3200 per month for a handicapped person is only exempted. Next one, fixed amount, that is. Next one, running allowance, 70% of amount received or 10,000 per month is exempt. Running allowance means those employees who are working in a transport businesses, like suppose I am a driver in a Volvo bus, obviously keep on moving from one place to another place, that is the reason whatever the amount I received into 70% or 10,000, whichever is less, exempt. Mining and underground allowance, 800 per month is exempt if I am working in mining area, and tribal allowance 200 per month is exempt, and hill compensatory allowances 300 per month or else 7,000 per month depend upon the place, that is based on the altitude the answer will differ, not important. Next one, inland duty allowance 3,250 per month, and height altitude allowance, the more height you will go, oxygen levels will be come down automatically, temperature is also very less, so we need to wear separate equipments and separate dresses, that is the reason some amount 1060 per month to 1600 per month exempt depend upon the altitude. And special compensatory height allowance, high active field allowance, Kargil etc., 4200 per month exempt, and field area allowances 2600 per month, modified field area allowance 1000 per month, border and remote and disturbed, that is areas, that is 200 per month to 1300 per month exempt depend upon the place, and counter insurgency allowances 3900 per month exempt. And very important topic, whatever I told you so far, this may not be important, but HRA house rent allowance, very important topic, least of the following is exempt. Rent paid minus 10% of salary, or in case of metro cities 50% of salary, in case of other than metro cities 40% of salary. Last one, actual HRA received, whichever is less is exempted. Here salary definition, salary is called basic salary plus DSO provided plus commission on fixed percentage on turnover. Next one, it is only consider on due basis, I repeat, only on due basis. Last one friends, fully exempted allowances, High Court judges, Supreme Court judges. Next one, allowances paid to ENO employees. Next one, any allowances received by the judges, whereas allowances given by government of India to any Indian citizens who are working outside India, then allowances are exempted under section 10 subsection 7. Okay, so simply judges, ENO employees, World Bank employees exempt, and those employees who are working outside India for government of India purpose, when government of India given any allowance, perquisites also exempt. Friends, another topic, deductions under section 16. Very important topic. There are three deductions ma. First one, friends, that is a standard deduction, that no amount, whatever the salary, I repeat, whatever the gross salary or 50,000, whichever is less, allowed as deduction. Entertainment allowance, it is also taxable first. Again, it is allowed as deduction only for government employees. First, it is included in the gross salary. Again, deduction allowed for government employees. Answer, maximum 5,000 or 1/5 of salary. That means 20% of salary, and the actual amount received, whichever is less. Last one, provisional allowance, provisional fees paid. Answer, it is also allowed as deduction on payment basis. Payment basis, if you pay, then only it is allowed as deduction. If it is paid by your boss, that means obligation of employee met by the employer, therefore it will be added in the salary. Again, deduction will be allowed. Suppose if it is paid by the employee alone, employee only paid out of his pocket, then it is not taxable. Normal do computation of salary minus this deduction will be allowed. I repeat once again, if paid by the employer on behalf of employee, first include as a income, minus deduction will be allowed. If it is paid by employee himself, then directly deduction will be allowed. Okay, chalo. Next one, government employees definition. Already I told you, but anyhow follow. Rent free accommodation, here central state anyhow covered. If you observe carefully, central and state always covered, and statutory corporation covered only in one case, that is called as pension. Already I told you this point. Whereas local authority, that is covered only for gratuity as well as a pension. Okay, for these two only covered. In all other cases, employees of government means only central and state. Next one here, family includes medical facility purpose spouse, dependent or independent children, or dependent brothers and sisters. Whereas LTC purpose family means spouse, any children, dependent, independent parents. Parents may be dependent and independent LTC purpose, and dependent brothers and sisters. Whereas other cases, any other cases, family means spouse covered and children covered, dependent, independent parents, as well as servants and other dependents also covered. Servants as well as other dependents also covered. Okay, chalo, keep in mind. And the following benefits are not available if any SSC opt the provisions of section 115 BAC. Number 1, leave travel concession not available. That exemption not available if you want to follow 115 BAC tax provisions. HRA exemption not allowed, and special allowances exemptions not allowed, but 3 are allowed. One is transport allowance, conveyance allowance, and travel allowance, daily allowance. Okay, remember DCT. D for all of you. You can remember DTC, direct tax code. You can remember like this: daily allowance, transport or transfer allowance, and the last one, conveyance. These 3 are only allowed. All other exemptions not allowed. Next one, allowances to MPs and MLAs, that is also not covered. And deductions, all deduction under section 16 also not covered. And exemption of perquisites with respect to food and beverages provided by the employer to employee, that is also not at all allowed. Okay, chalo. So friends, anything provided in this, no, that is not at all allowed. Number 1, leave travel concession, HRA, and all specified allowances and allowances given to MPs and MLAs. And last one is deductions also not allowed, and other exemptions of perquisites that related to food also not allowed. Friends, with this, done with the chapter called as salary. Very important chapter. Thank you very much. Friends, in today's lecture we are going to start the topic, that is income from the head house property. Friends, very important topic for exam point of view. Out of this topic we can expect minimum 1 5 marks question, that too practical question. Friends, section number 22 to section number 27, these sections are dealing about the provisions of income from the head house property. The first section as usual, charging section, that is section 22. Next one is section number 23, that is nothing but computation of GAV. Next one, section number 24, that talks about deductions. Whereas section number 25, that is nothing but treatment of recovery of arrears of rent as well as unrealized rent. Whereas section 26 talks about co-ownership and 27 talks about deemed owner. This is the provision. Now I would like to start with the first topic, that is charging section, section number 22. See the word, friends. The annual value of property consisting of land or building appurtenant thereto, of which SSC is the owner and not used for carrying business or profession. Friends, here exactly there are three conditions. Condition number one, there must be one property. You know what? Which property? That is house property. What is house property? You know, there must be land as well as building. Both must be appurtenant thereto, appurtenant, adjacent to each other. Number two, SSC must be the owner. Number three, the property should not be occupied by the SSC for carrying his own business or profession. In these cases, the income from such property is taxable under the head IH Pro, income from the head house property. Sir, every case you have to check these three conditions. Condition number one, there must be property, that is house property. Compulsory there must be one house property. That too, the house property is not built on ship. The house property not built on trees. The house property should not be built in the space. The house property should be built on the land. Land or building appurtenant thereto. That is the first one. Second one, SSC must be the owner. I repeat, SSC is not the tenant. SSC must be the owner. He must be the owner of the property. He may be a legal owner or else he may be a beneficial owner. Number three, that house property SSC should not use it for carrying his own business or profession. I repeat, SSC should not use such property for carrying his own business or profession. If all the three conditions are satisfied, take it for granted the annual value of the property is taxable under the head house property only. Here some points we are going to discuss. Number one, building. What is the building? Friends, that may be a residential building or that may be a commercial property also. Any kind of property will do, but only the thing is it must be a house property. Construction must be completed. I repeat, construction must be completed. That may be a smaller one or larger one, or that may be a palace or anything else, but it must be a house property. That too may be residential or may be commercial. That too, friends, that residential property should complete or else commercial property should complete. Okay, chalo. Next one, friends, land attached with the building. Friends, land attached with the building means there must be a property. That too, the property is house property which consisting of land as well as building. And friends, vacant land is not at all covered. Some cases you will find only open space area. There is no building at all, only vacant land. Sir, if anybody let out vacant land, take it for granted it is covered under the head other sources but not under the head house property, because the charging section stipulates that there must be a house property. Next, SSC must be the owner. I repeat, what is the meaning of owner? I only purchased that property. That means I only paid consideration for that property. The property registered in my name. Whenever it is registered in my name, I am the legal owner of the property, right? Yes. Sometimes what happen, not only legal owner, beneficial owner also covered. Beneficial owner means the person who is getting the benefit out of that property. That means deemed owner is also covered. I repeat, so in order to protect that income tax, in order to protect the tax revenue to the government, they only amended the provision. There must be a owner, correct? But the owner may be a legal owner or else the owner may be a deemed owner also. What is deemed owner? Listen, I am doing job. My salary, let us say 2,50,000 rupees per annum, for example. Okay, chalo. I have one property in Guntur. One day what I did, I voluntarily transfer that property to my wife. You know why? Now, if I transfer property to my wife, that house property income is covered under house property that is taxable in the hands of my wife. So, what I did, my salary already 2,50,000, which is not more than bill. If I add a house property income also in my hands, unnecessarily it may exceed BEL, basic exemption limit. Unnecessarily I need to pay the tax. Why this headache? That is the reason. Simply I transfer the property to my wife. Now my wife is the owner. That is that is my intention. So government understood these kind of binami transactions. Immediately what government did, you know? They introduced one concept called as deemed owner. You know what deemed owner? Now I am the transferor in this example because I only transfer to my wife. So I am the transferor, my wife is the transferee. In these cases, take it for granted, the income from such property will be clubbed in the hands of transferor. Transferor will be treated as deemed owner even though he transferred the property to his wife. Okay na? So friends, owner means not only registered owner, owner means deemed owner also covered. Next point friends, that house property should not be occupied for carrying his own business or profession. That means SSE should not use the property for carrying his own business or profession. SSE should use the property to let out to someone else. I repeat, he can use for his self-residence. So SSE can stay in the property with his family, or else SSE can give the property to someone else on rental basis. But warning, SSE should not use for carrying his own business or profession. Common sense. If you are using the property for carrying your own business or profession, take it for granted that is covered under the head, come on, PGPB, but not under the head house property. So here the condition, the property should not be used for carrying your own business or profession. Okay, chalo. So that is the point. Next one friends, here ownership. First, another point, ownership. What is the meaning of ownership? As I told you earlier, ownership includes legal owner as well as deemed owner. Next one, here person who owns the building need not be the owner of the land. So land can be belonging to someone else, whereas the building can be belonging to someone else. Next one, need not be the owner in the assessment year. I repeat, need not be the owner in the assessment year. You may be a owner of the property in the previous year. If you get the rental income enough, that rental income of that property is taxable in the hands of owner even though subsequently transfer the property. Next one friends, if the title of ownership is under dispute, in this case also it is taxable. Okay, even disputed property also taxable. That's all ma. These are the points related to ownership. Now I would like to cover the topic called as deemed owner. What is the meaning of deemed owner and what are the circumstances covered here we are going to cover. Okay, chalo, one after one. First one, transfer of property by individual to spouse or minor child. I repeat, if any individual transfer the property to what, spouse or else minor child, the individual is called as transferor, wife is called as transferee. Take it for granted, the annual value of the property is taxable in the hands of transferor. I repeat, is taxable in the hands of transferor. So I will take one example. Number one, Abhishek Bachchan transferred the property to Aishwarya Rai. Yes, in this case Aishwarya Rai is the owner as per the legal documents, but for income taxation purpose we will consider Abhishek Bachchan is only the owner of the property. In our example, Abhishek Bachchan voluntarily transferred the property to Aishwarya Rai. In this case, Abhishek Bachchan is only the transferor. Now, if anybody transfer the property to wife without adequate monetary consideration, in this case, take it for granted, the transferor will be treated as deemed owner. Same way, Aishwarya Rai, wife, okay? Chalo. Suppose Abhishek Bachchan transferred to minor child. In this case also, these provisions are applicable. The income will be taxable in the hands of transferor only because Abhishek Bachchan will be treated as deemed owner. Okay, so conclusion ma, if any individual transfer the property to wife or else minor child, take it for granted, in this case the transferor will be treated as deemed owner. Next one friends, all of you, transfer of house property by individual to minor child without without consideration or inadequate consideration, in this case transferor will be treated as deemed owner. Transferor. Okay, already I told you. Next number, transfer of property under section 53A of Transfer of Property Act. What is that? Very simple. Follow. I am a teacher. What happened now? Government, they constructed teachers colony. There one property they allotted to me. For that I paid advance amount, or else I paid down payment 10 lakh. Actually the property value 30 lakh. Out of that I paid 10 lakh. Remaining 20 lakh I will pay every month. Like a monthly installment I will pay the amount. But I will take the possession of the property and I will stay with my wife and my children in that property only I will stay. So moral of the story, it is nothing but kind of hire purchase. But honestly speaking, hire purchase concept applicable for mobile asset. But this is immobile asset, no? Therefore, in this case, there is a concept called as section 53A of Transfer of Property Act. You know conditions. Number 1. There must be agreement. Yes, agreement is there. I entered into agreement. And amount paid. Some amount must be paid. Yes, I paid. No, I paid some amount there. Next, taken possession of the property. Yes, I am staying with my family in the building. Every month I am paying some amount. So all the conditions are satisfied. Take it for granted. I am the owner of the property as per the section number 27. I am the deemed owner. I am a teacher, no. I am staying in that building, no. I am the deemed owner as per these provisions, because as per section 53 of Transfer of Property Act, if you have agreement and part of the consideration paid, and last one is possession of the property as taken. In this case, take it for granted, indirectly the person who has taken the possession of the property will be treated as deemed owner. Next. Fourth one, allotment of house property by cooperative society to its members. Babu, if any cooperative society allotted to its members, honestly speaking, the building is registered in the name of society, not in the name of members. So owner is, cooperative society itself, but they only constructed the buildings and they only give the same to members. But for section 27 purpose, we will assume that the members are the deemed owners. Next, holder of impartible estate. Sometimes, joint properties will be there. Joint property. In this case, we will assume that the person who is holding the possession of the property will be the deemed owner. I repeat, possession holder. Last one, person having right in the property for a period not less than 12 years. I hope you know lease. Some persons will take lease for 90 years, 99 years, like that. If anybody has taken the property for a period not less than 12 years, take it for granted, who has taken the property on lease basis, the person will be treated as deemed owner for income tax purpose. Example, this land belonging to X, but this land taken over by this building, not land, this building taken over by Ramoji Rao for his business purpose. How many years? 99 years. Now tell me friends, when anyone has taken for lease for 99 years, here really Mr. X is the owner. But for section 27 purpose, we will assume that Ramoji Rao is the deemed owner, because he has taken on lease for a period more than 12 years. Okay, chalo. This is the deemed owner concept. Number 1, friends, house property rental income literally taxable under that house property. Clear? But sometimes it is taxable under that house property. Sometimes it is taxable under that PGBP or IFOS. Now I would like to cover which are covered under PGBP, which are covered under house property. These points we are going to cover right now. Number 1, if any building used for own business or profession, I repeat, if any building used for own business or profession, take it for granted, it is taxable under that PGBP. Own business or profession. Suppose this is my own building. In my own building, I started my CA practice. Yeah, covered under the head PGPP. Number 2. If main objective of the business is, I repeat, main objective of the business is rental activity. In this case, take it for granted, it is also covered under the head PGPP. Main objective of the business means lodge, hotels. You know what? Hotels, OYO rooms are hotels, right? So my business is let out and take the rent. Let out and take the rent. In this case, it is covered under the head PGBP, not under the head house property. Last one. Let out is incidental to main business. Sometimes let out also incidental to main business. For example, food industry. Ground floor we will offer food, serve the food, and first floor rooms will be there. Yes, that is incidental to our main business. It is also covered. Okay, chalo. So in the following cases, it is covered under the head PGPP. But friends, in some cases, that income not at all taxable. In some cases, number 1, farmhouse. Already we covered agricultural income topic. There already I told you, farmhouse if let out for agriculture purpose, the income is exempted. I repeat, farmhouse used for agriculture purpose, that is covered under agricultural activity. What is farmhouse? That building which is located in agricultural area for the purpose of agriculture. So that is farmhouse, that is exempted if you give on rental basis, provided you must give for agricultural purpose. Next, ex-ruler. You know Mysore Maharajas, Nizam Maharajas. These persons, what they will do, they will have properties, they have some palaces. One palace will be allowed as exemption. Next, local authority. You know, in Hyderabad, Maitri Vanam, that is municipal corporation building, Hyderabad Urban Development Authority building. So municipal complex, or else local authority buildings, or else panchayati buildings, or else municipality buildings which are let out, no, that is also exempted. Go to any place, even Guntur, Vijayawada, Warangal, Karimnagar, anywhere you will find municipal complex. There so many rooms will be there, that will be let out, that is also not taxable exempt. Next, income from house property of an scientific research association. Scientific research association has any buildings and get the rental income or something, exempt. Next one, universities. You know, educational institutions, universities may have buildings, that buildings rental income or any income is exempt. Next one, trade union, registered trade union. So you can find a Krishna district lorry owners association, they have so many marriage halls, they have so many buildings, their rental incomes also exempt. Trade union, the two registered trade unions properties rental income exempt. Next one, charitable and religious purpose exempt. If you have any building which is used for charitable and religious purpose, and their rental income is also exempt, subject to conditions. Political party, rental income of buildings owned by political parties exempt. Political parties will not do businesses, therefore they have buildings, right? Their buildings will give on rental basis to someone else, that rental income exempt. Next one, property used for own business or profession. If anybody use the property for own business or profession, first of all it is not covered under the head house property, it covered under the head PGBP. Honestly speaking, not taxable. Next one, in case of individuals and HUF, 2 house properties will be allowed as self-occupied. 2 house properties. That means nowadays you are staying with your parents in one particular building, that building is allowed as exempt. In some other cases, you are staying in one building, your parents are staying in another building which is owned by you. So anyhow, 2 properties will be allowed as exempt. Okay, chalo. So this is the topic called as a taxation of house property incomes. In some cases PGBP, in some cases house property, in some cases exempt. I told you already, if you heard the word house property rental income, that is house property. If you heard own business or profession purpose, if you heard main activity is a rental activity, if you heard rental activity is incidental to main objective of the business. In these cases, it may not be covered under the head house property. It is covered under the head PGPB. Okay, chalo. But anyhow, local authorities and charitable trusts and political parties, registered trade unions, buildings, rental incomes are anyhow exempt. Next topic is called as computation of income from the head house property. I repeat, computation. All of you please follow. First you have to calculate GAV, gross annual value. Out of GAV, we need to deduct municipal taxes paid. I repeat, municipal taxes paid. After that we will get NAV, net annual value. After that we need to give deductions under section 24. After that we need to deduct standard deduction at the rate of 30% of NAV. And same way we need to deduct interest on housing loan if any. After that we will get income from the head house property. So pro forma GAV minus municipal taxes paid, NAV less deduction under section 24. One is standard deduction, one is interest on housing loan. Then you will get income from the head house property. Now first we would like to cover section number 23, that is nothing but computation of GAV. I repeat, computation of GAV, gross annual value. In case of let out property, how to calculate GAV? For that purpose, first you have to calculate RER, reasonable expected rent. Second one, AR, actual rent. Third one, comparison. You have to compare, comparison. These things you have to do. First one is reasonable expected rent, RER. Next one, actual rent, received or receivable. Third one, comparison. For RER computation purpose, you have to do first one A, B, C, D. A, municipal value, fair value, standard rent. These three things you have to take. I repeat, municipal value, fair value. Municipal value and fair value, whichever is higher, is treated as expected rent. Expected rent and standard rent, whichever is lower, is treated as RER. That's all. So step number 1, you have to calculate RER, reasonable expected rent. See the word municipal value, fair value, whichever is higher we have to calculate. The higher amount or standard rent, whichever is lower, we have to calculate. That's all. That is called as RER, reasonable expected rent. After that we have to compare the same with AR. AR means actual rent. I repeat, actual rent. See the word RER as well as actual rent we have to compare. Out of these two, whichever is higher we have to consider. RER or AR, whichever is higher we have to consider. Whichever is higher is called as GAV. GAV is equal to, all of you, RER or AR, whichever is higher. See the word, if AR is greater than RER, that means GAV is equal to AR. That's all enough. Suppose if AR is lower than the ER, in this case we have to check the reason. What is the reason for that? If the reason is because of vacancy, then that is valid reason. Chalo, hello. For that purpose, GAV is equal actual rent, we can take it. Suppose if AR is lower than ER because of any other reason, then GAV is equal, sorry, not actual rent, GAV is equal to RER only. So 3 steps ma. Number 1, RER, reasonable expected rent. Number 2, AR, actual rent. Number 3, comparison. How to calculate RER? RER we have to calculate like this. First one, municipal value or fair value, whichever is higher. After that, higher amount called as ER, or else standard rent whichever is lower. That is called as RER, reasonable expected rent. After that, we have to compare with AR, actual rent into 12 months, that you have to take it. Now RER or AR, whichever is higher, we have to take it. Suppose for example, AR is higher, happy, very happy, GAV is called AR. For example, RER is higher, then you have to check the reason. Why RER is higher than the AR? If it is because of vacancy, okay, chalo, GAV is called AR only. If it is not because of vacancy, then obviously GAV is called RER. That is the computation of what you call GAV. Okay, chalo. So next one, friends, all of you. Out of that GAV, we need to deduct municipal taxes paid. After that NAV. After that deductions under section 24. After that standard deduction as well as interest on loan. Then you will get income from the head house property. Chalo. Next one, friends, recovery of unrealized rent. Friends, generally unrealized rent will be allowed as deduction. Unrealized rent will be allowed as deduction subject to fulfillment of 3 conditions. Condition number 1, the tenancy agreement must be bona fide. For example, I have given this building to some people. Why? For preparation of drugs, heroin, drugs purpose. Is it genuine agreement? No. So tenancy must be bona fide. Number 2, when the fellows are not paying the rent, ask them to vacate the premises. The tenant should vacate the premises. And the tenant should not occupy any of other my premises. I repeat, they should vacate. They should not occupy my other premises. Number next, legal proceedings must be initiated. I need to just approach the lawyer. I need to send the lawyer notice. If all the conditions are satisfied, unrealized rent will be allowed as deduction that can be deducted out of actual rent only. See the word, I told you here 3 steps, no? One is RER, second one is AR. Out of AR, we need to deduct unrealized rent also. After that only we need to compare these two. Whichever is higher, we have to take it. That anyhow I told you. Leave it. Next topic, friends, unrealized rent will be allowed as deduction upon fulfillment of certain conditions. Generally in exam, no, we will assume all the conditions are satisfied and we will take the deduction of unrealized rent out of actual rent. Next one, friends, municipal taxes anyhow will be allowed as deduction. I repeat, municipal taxes, whatever corporation tax, municipal taxes allowed as deduction. So 2 condition, it must be paid by the SSC only. I repeat, paid by the SSC only. That too, it is allowed as deduction on payment basis. If you pay, then only it is allowed. Next one, the municipal taxes will be allowed as deduction on payment basis. Maybe last year amount or this year amount or next year amount, anything is allowed. Next one, if municipal taxes paid is greater than GAV, then NAV could be negative. Suppose if you pay more amount, then automatically NAV could be negative. For example, my GAV 10 lakh, but you only paid 12 lakh, then that NAV is negative. Possible? Yes. Next one, municipal taxes related to property situated outside India is also allowed. Foreign house property, yes, in the hands of RB or resident but ordinary resident, foreign house property is obviously taxable. So while computing foreign house property income, computation is same way. GAV minus municipal taxes paid in abroad, that is also allowed as deduction. Nothing wrong in that. Okay. Next one, standard deduction. Friends, generally house property means we have so many expenses like repairs, maintenance, water charges. Sorry, all are not allowed. Apart from this or on behalf of all, simply one standard fixed deduction will be allowed. That is 30% of NAV allowed. Next one, interest on loan borrowed, interest on capital, yes, allowed. That interest is allowed as deduction on due basis. I repeat, due basis, it is allowed. If it is a let out property, I repeat, let out property or deemed to be let out property, fully allowed. Unlimited amount, 100 crores also allowed if you have. that too on due basis. Okay, chalo. But whereas in case of self occupied property or unoccupied property, sorry to say, 100% not allowed. Maximum 30,000 or else 2 lakh, as the case may be. I repeat, some cases 2 lakhs, some cases 30,000, as the case may be, it is allowed. When 2 lakh, if loan taken on or after 1498, that too the property must complete within 5 years. 5 years. In this case 2 lakh it is allowed, or else 2 lakh is not allowed. More than 2 lakh only not allowed. Maximum 30,000 only allowed. If all the two conditions satisfied, then it is allowed 2 lakh rupees, otherwise maximum 30,000. This 2 lakh or 30,000 limit applicable only for self-occupied property or else unoccupied property, but not for let out property. Next one, pre-construction period. Friends, you know, building will not be completed overnight. It is not Bahubali or cinema set, right? That is the reason it is not possible to complete within one day. It will take years together. Therefore, pre-construction period interest is allowed. What is pre-construction period? Pre-construction period means a period commencing from date of borrowing and ending on date of repayment, or else 31st March prior to, I repeat, 31st March prior to date of completion of construction of property. I repeat, 31st March, which is prior to date of completion of construction of property. Out of these two, whichever is earlier. In between this period, whatever the interest we will calculate, that interest will be allowed as deduction over a period of 5 years. I repeat, over a period of 5 years. That too, the interest will be allowed as deduction commencing from the year in which the construction completed. That is the reason in exam, while solving this problem, we will take proportionate pre-construction period interest. That is 1/5 of the amount we will take it. Okay, chalo. Next one. In case of self-occupied property, as I told you earlier, 2 lakh allowed, or else 30,000 allowed. When it is 2 lakh, loan must be taken for construction of the property. That too, you have to take the loan on or after 1/4/1999, not 98, 1/4/1999. That too, the property construction must complete within the period of 5 years. In this case, it will be allowed as deduction over a period of, it is allowed as deduction. Okay, maximum 2 lakh allowed. If any one of these condition not satisfied, take it for granted, 2 lakh not allowed, maximum 30,000 itself allowed. Next one, here it is allowed on due basis, not on payment basis. Due basis means even though you have not paid, the interest portion allowed. Next one, you have to take the loan for construction or else purchase or else major repairs purpose. Next one, if you have taken fresh loan for repayment of old loan, that is also allowed. Interest on fresh loan taken for repayment of old loan, that is also allowed. Next one, interest on interest, that is not at all allowed. Sometimes no, if you make delay payment, you have to pay interest. Sorry, not allowed. Next one, deduction is allowed subject to conditions, like subject to section 25 conditions, that is recovery of unrealized rent or arrears of rent, like this. And no deduction allowed for hidden charges like brokerage and all. If you want to take the loan, sometimes you have to pay some commission and all. Sorry, not allowed. Next one, interest includes commitment charges also. Okay, and whatever the charges related to interest, that is only allowed. Next one, for principal repayment of loan, it is not allowed under house property topic. It is allowed under the head 80 capital C. I repeat, allowed under deductions topic, that too under section 80 capital C. Next one, deduction of interest in respect of self-occupied property not at all allowed if SSC opted alternative tax provision under section 115 BAC. If anybody wanted to go for section 115 BAC, then special tax rates are applicable. Therefore, lawmaker don't want to give deduction with respect to interest on self-occupied property. In exam hall, please remember, while solving the house property problem, if examiner specifies that if SSC opted 115 BAC provisions, take it for granted, in case of self-occupied property, the 2 lakh or 30,000 interest also not at all allowed. Next one, loss from the house property cannot be set off against other heads income if SSC opted 115 BAC. If SSC want to go for 115 BAC, one house property loss cannot be adjusted against other house property heads. Okay, other heads. House property against house property allowed, but house property loss cannot be adjusted against other heads income like salary income, not at all allowed. Inter-head adjustment not allowed with respect to house property loss only if SSC opted section 115 BAC. Next one, inadmissible expenditure, inadmissible deduction under section 25. As I told you earlier, if tax not deducted with respect to interest which is payable outside India, the tax interest portion not at all allowed. For example, I have taken the loan from one foreign bank for housing purpose and I am paying interest. On that interest, no, compulsory we have to deduct TDS. If no TDS, take it for granted, no interest will be allowed as deduction. Okay, chalo. Next one, section 25A, that is nothing but recovery of unrealized rent or recovery of arrears of rent. Same answer. In case of recovery of unrealized rent or recovery of arrears of rent, take it for granted, it is taxable in the year in which it is received. Okay, that too, 30% of such arrears of rent or unrealized rent will be allowed as deduction. The two, it is taxable in the hands of recipient. The two, it is taxable irrespective of fact that SSC is a owner or not a owner in the particular year of receipt. That is not relevant. So once he received the amount, irrespective of the ownership of the house property in the current year, that particular arrears of rent or unrealized rent is taxable in the hands of SSC. Okay, chalo. So this is one topic. Next one, co-ownership. Co-ownership. What is co-ownership? In case of co-ownership, generally we will do computation. I repeat, we will do computation in general way. After that, we will allocate the income between all the co-owners. If it is self-occupied property, see the word, each and every co-owner share is defined. In that case, what is the answer? Or else, if everybody co-owner share is not defined, then what is the answer? See the word, the annual value for such each co-owner shall be nil and shall be entitled to claim deduction of 30,000, 2 lakhs separately. If co-owner share is different, no, in this case, each co-owner can claim 20,000 or 2 lakh as the case may be as a deduction. Next one, in case of let out property, no, income shall be computed as if the property is owned by one person. After that, segregate among the co-owners. I repeat, segregate among the co-owners. I told you, no, first do the computation. After that, the income shall be apportioned between all the co-owners. That's all, ma. This is the co-ownership property. Next one, composite rent. Friends, composite rent means apart from the building, we let out the furniture as well as plant and machinery. Best example, cinema hall, or else best example, furnished accommodation. If anybody let out building plus other amenities, the rent is called as composite rent. In case of composite rent, you have to check these points. Number one, whether the rent is separable or not separable. Separable means you know how much for house, how much for other. You know or don't know? I know. How much for building? I know. How much for other amenities? I know. If you know, house property rent is covered under the head house property. Other amenities rent is covered under the head PGPB or IFOS. If you don't know, if you cannot separate, if rent is not separable, I don't know how much for building, how much for other amenities, I don't know. I know entire figure. In this case, entire income is taxable under the head IFOS or PGPB, but not covered under the head house property. Next, all of you, another topic, foreign house property. Sir, I can say only one word with respect to foreign house property. Assume the house property located in India. I repeat, assume the house property located in India and do the problem accordingly. The two, foreign house property is taxable in the hands of resident but ordinary resident. Okay na? Chalo. So SSC must be a RB OR. If SSC residential status RB NOR or NR, in that case the income is not taxable. If you are a resident but ordinary resident, in this case the foreign house property income is only taxable. Suppose if you are a non-resident or else RB NOR, in that case foreign house property income not taxable. But if you receive that rental income in India, in that case, no doubt, in the hands of non-resident and RB NOR also that income is taxable. That too, how to do computation? Only one word. Assume the house property located in India, and do the problem accordingly. Okay, chalo. The foreign currency will be given, right? The currency you have to convert into Indian currency. Every transaction you have to convert by using the convertible foreign exchange rate. Next one. Here different model questions. Number 1, self-occupied property or unoccupied property. Take it for granted. 2 house properties will be allowed as self-occupied in the hands of individuals or HUF. Only 2 houses maximum. In case of self-occupied property, take it for granted, GAV 0. Municipal taxes anyhow not allowed. So NAV also 0. By default NAV 0. Standard deduction anyhow small 0. Only worst case, interest on loan taken for house property only allowed. How much? Maximum 30,000 or else 2 lakh. Remember when it is 2 lakh. If the loan taken for construction or purchase of house property, that too on or after 1/4/1999, that too the property construction completed within 5 years, in that case maximum 2 lakh will be allowed as deduction, or else 30,000 only will be allowed as deduction. Suppose if SSC opted 115 BAC, then this 2,30,000 also not at all allowed. Enough. This is the topic, self-occupied property. In case of self-occupied property, take it for granted, ultimate answer may be 0 or else negative. In case of self-occupied property, the answer should not be a positive. Okay. Next, let out. In case of let out, all the computations are applicable. GAV less municipal taxes, it is also allowed as deduction on payment basis. NAV anyhow positive figure generally, minus standard deduction 30% of NAV allowed, minus interest on loan taken. That too 2 types interest, that is current year interest and proportionate pre-construction period interest. Your interest is allowed as deduction without any limit. I repeat, without any limit it is allowed. That's all. Next one, deemed to be let out property. If any SSC opted more than 2 properties, if any SSC opted more than 2 properties as self-occupied, as I told you earlier, for every individual or HUF, generally family point of view, they will allow 2 house properties as self-occupied, maximum 2 houses, 1 or 2, that's all. Some people may claim 4, 5 or 3 like that. If anybody wanted to claim more than 2 house properties as self-occupied, take it for granted, out of that only 2 are allowed as self-occupied, rest of the things will be allowed as DLO, deemed to be let out property. DL, deemed to be let out property. In this case, what is the computation DLO case? In case of DLO property, GAV computation purpose, as I told you 3 steps, no? Step number 1, RER. Step number 2, AR. Step number 3, what? That is comparison. But honestly speaking, RER possible, AR won't be there. Because in case of DLO, deemed to be let out property, AR will not be there. Actual rent won't be there. Therefore, you can take it 0. Whenever actual rent is 0, comparison also not possible. So in case of DLO, GAV is equal RER. Anyhow, municipal taxes will be allowed. Anyhow, standard deduction allowed. Interest also allowed without any limit. Same as DLO. Same as let out. Only the difference is GAV computation time we have to take only RER. That's all. And another model question. Part of the house self-occupied, remaining part of the house let out. Part of the house part of the house let out. Then how to do the question? Simple. Do the question by assuming the house property on proportionate basis you can do. Suppose 75% self-occupied, 25% let out. Then take every figure 75 is to 25. Suppose 50-50, then take every figure 50-50, every figure except actual rent. So suppose 50-50, this unit 1 self-occupied, unit 2 let out. For unit 1 self-occupied, GAV 0, less municipal taxes not allowed 0, standard deduction 0. Next, interest on housing loan allowed, maximum 2 lakh or 30,000 as the case may be, or 50% of interest whichever is lower only allowed, because here 50-50 no assumption. Here let out case, in case of let out GAV, municipal value, standard deduction, all the figures you have to take 50% only, because 50-50 assumption. Actual rent you have to take fully, because the actual rent belonging to only that let out area. And municipal taxes 50% only allowed. Standard deduction allowed, fully allowed. Interest 50% only allowed. That's all. So if part of the house let out, part of the house self-occupied, this is the answer. Next one, friends. Part of the year let out, part of the year self-occupied. I repeat, part of the year let out, part of the year self-occupied. That means out of 12 months, certain period let out, certain period self-occupied. Then how to do the problem? Simple. If certain period let out, certain period self-occupied, assume the house property let out throughout the year. That's all. Only one word I would like to tell you. Only one word. Assume the house property let out throughout the year. And do the problem accordingly. GAV, same. RER, calculate full year. AR, only is the small change. AR, don't take for 12 months. AR, you have to take only for let out period. That is only the thing you have to do. So RER and AR you have to compare whichever is higher. On that you can take it as a GAV, and municipal taxes anyhow allowed, because our assumption this property is let out throughout the year. And standard deduction allowed. Next one, interest on loan taken allowed. Last one, every figure it is allowed. Interest on loan taken also allowed without any monetary limit, because my assumption the property is let out throughout the year. Very important model problem. Next one, special cases, stock in trade. Some people will construct the buildings for sale purpose, that is called as stock in trade. Example, Jayberry Real Estate, Mr. Murali Mohan, he constructed so many buildings for sale purpose, that is called as stock in trade. In case of stock in trade, you will sell in the market. Sometimes we cannot sell. I repeat, sometimes we cannot sell. Then what happen? We will give on rental basis. I hope you know, as of now in Hyderabad, nobody willing to buy apartments because of market crisis. Tell me now. When buildings are unable to sell, then the owner of the buildings cannot wait. He wanted to give on rental basis at least. If you give house properties on rental basis, that too the house properties are held as stock in trade. In this case, that rental income is covered under the head house property, but not under the head PGPB. Warning. So many people will remember, oh, it is taxable under the head what? PGPB. Wrong. It is covered under the head house property only. If you sell it, the property profit, no, the business profit, that is taxed under that PGPB. If you sell it, I am talking about rental income of buildings which are held as stock in trade is not covered under the head PGPB, is covered under the head house property. That's all. If any house property is held as stock in trade, take it for granted the rental income, if any, generated out of that stock in trade is covered under the head only house property. Next, another point I would like to tell you. Sometimes I unable to let out also. In that case, lawmaker will wait for 2 years. After expiry of 2 years, the house property which are held as stock in trade will be treated as let out properties and will collect the tax on that. See the word house property held as stock in trade, if it is remains vacant for a period more than 2 years, up to 2 years, the GAV is called 0. After expiry of 2 years, I will assume that the property is let out and the GAV is taxable. So simple word, if you have buildings which are stock in trade, if you sell the building, sale of buildings covered under the head PGPB, enough, because that is your business. Next, I have buildings as a stock in trade, unable to sold, unsold, unsold, unable to sell, unsold. In this case, first to 2 years, lawmaker will keep quiet. Your GAV not taxable, 0. After expiry of 2 years, take it for granted, GAV pakka taxable. That's all. Lawmaker is giving 2 years cushion. If you have stock in trade buildings, you have to sell it, or else otherwise you have to let out. If you kept quiet up to 2 years, nothing is taxable. After expiry of 2 years, it is taxable. Be careful. Next, properties which are used for agriculture purpose, take it for granted, if properties are used for agriculture purpose, that is treated as agricultural income, not at all taxable, exempted under section 10 subsection 1. But if you use the agriculture properties for non-agriculture purpose, it is taxable. Example, my farmhouse I let out for film shooting purpose, pakka taxable. Next, disputed ownership. In case of disputed ownership, suppose elder and younger brothers both are claiming that this is my own property, so they went to court of law after death of their parents. In this case, that is covered under disputed property. In this case, the person who is having the possession of the property, see the word, the person who enjoys the possession of the property is liable to pay the tax on temporary basis. Next one, property owned by the firm. Where immovable property which is owned by the firm, it is accessible in the hands of the firm only, but not accessible in the hands of the partners. If any property owned by the firm income is taxable in the hands of the firm only, but not in the hands of partners. Friends, with this, done with the chapter called as income from the head house property. Just a small revision. Section 22 charging section. The annual value of the property consisting of land or building appurtenant thereto which are owned by the SSC and not used for own business or portion covered under the head house property. As I told you, condition, there must be land or building appurtenant thereto, SSC is the owner, not used for own business, then taxable under the head house property. Next one, friends, here owner two types, legal owner, deemed owner, both are covered. Legal owner means whose name is appeared in the legal document, that is legal owner. Deemed owner means we are only assuming for section 27 purpose, that too for house property purpose. If any property transferred to wife, then deemed owner applicable. If any person transferred the property to minor child, deemed owner also applicable. Holder of impartable estate, member of cooperative society, 53A of transfer of property act, I told you kind of hire purchase, but hire purchase applicable for mobile asset, 53A of transfer of property act applicable for other than mobile asset. Holder of power of attorney. Next one, ownership in disputed property and property taken on lease for a period not less than 12 years. In these cases, that is covered under the topic called as deemed owner. And next one, exactly here 11 model problems. 11 model problems are there. First model problem, property vacant throughout the year, nothing is occupied, then not taxable, leave it. Number 2, property used for own business or portion, sorry, not at all taxable, covered under the head PGBP, they are also not taxable, honestly speaking. If you use your own building for your own business or portion, not at all taxable under the head house property. Covered under the head PGPB. Under the head PGPB also not taxable. Leave it. Self-occupied property. For individual and HF, only maximum 2 houses will be allowed as self-occupied. In case of self-occupied property, NAV 0, GAV 0, municipal taxes 0, standard deduction 0. All are 0. Only one figure allowed. That is interest on loan taken for house property. That is also allowed. That too maximum 30,000 or 2 lakh. See the heading, see the board. If loan taken for minor repairs or else other cases 30,000. Loan taken for major repairs or construction purpose or purchase purpose. The two loan taken before 1/4/1999 maximum 30,000. Other loan taken on or after 1/4/1999 then construction completed within 5 years అయితే maximum 2 lakh or actual interest whichever is less. Not within 5 years అయితే 30,000 only allowed. Let out property. You know any properties will be allowed as let out. In case of let out, GAV taxable, municipal taxes allowed on payment basis, standard deduction allowed, interest also allowed. Okay, no limit at all. All the figures will be allowed. GAV computation. Step 1 RER, step 2 actual rent minus unrealized rent, step 3 comparison. How to calculate RER? Municipal value, fair value, whichever is higher is called as expected rent. Expected rent or standard rent, whichever is lower is called as RER. Next one, AR into 12 months minus unrealized rent. Unrealized rent allowed as deduction subject to 4 condition. I already told you, not important. But anyhow, comparison, RER and AR you have to compare, whichever is higher you have to take, minus loss due to vacancy, then you will get GAV. That's all. And the next one, municipal taxes paid by the owner allowed, tenant not at all allowed, only owner, that too due basis not allowed, only payment basis. Standard deduction 30%, standard fixed deduction allowed. Next one, interest allowed, loan taken for house property purpose it is allowed. Unlimited amount allowed in case of let out property, limited amount only allowed in case of self-occupied property. The 2,30,000 limit only for self-occupied. Next point, pre-construction period interest in self-occupied also allowed, let out also allowed. Okay, chalo. Next model question, part of the house let out, part of the house self-occupied. Remember only one word, pro rata basis it is allowed, proportionate basis. Triple bedroom flat let out, double bedroom flat self-occupied. Area wise you can take it. Examiner will give the percentages. Next one, part of the year let out, part of the year self-occupied. Then assume the property let out throughout the year. Next one, another model question, foreign house property. Assume the house property located in India and do the problem. As it is, do the problem. Next one, all of you, another topic, co-ownership. If it is defined, do the computation separately. Not defined, do the computation as it is a AOP, association of person. Next one, stock in trade. In case of stock in trade, if you let out house property, if not let out and unable to sell, and if you kept quiet first 2 years, nothing is taxable. After expiry of 2 years, it is taxable. Unrealized rent, recovery of unrealized rent and recovery of arrears of rent anyhow taxable. Same answer, it is taxable in the hands of recipient and taxable in the year of receipt, and 30% of amount is allowed as deduction. And next one, arrears of rent also same, it is taxable in the hands of recipient in the year of receipt, standard deduction also 30% of the rent is also allowed as deduction. Next, more than one house property used for self-occupied. In this case, only 2 house properties will be allowed as self-occupied, remaining houses will be allowed as DLO. In case of deemed to be let out property, GAV is equal to RER. But SSE can choose the best option in which the tax liability is lower. Okay, chalo. With this, we're done with the chapter called as income from the head house property. Thank you very much. Friends, in today's lecture, we are going to start the topic that is PGPB, profits and gains from business or profession. Very important chapter for exam point of view. Out of this chapter, we can expect minimum 8 marks question. Friends, it is A category chapter, compulsory question for exam point of view. Section number 28 to section number 44 DB, these provisions are dealing about the provisions of profits and gains from business or profession. As usual friends, first section, section 28 is the charging section, whereas section number 30 to 38, these are related to deductions, that means expenditure, whereas section number 40 is nothing but disallowances, whereas section 41 is called as deemed profits, whereas section 44 deals about the special provisions, like 44AA is maintenance of books of accounts, 44AB is a tax audit, whereas 44AD, ADA and AE are related to presumptive taxation. Friends, now we are going to start one by one topic. This is a very important chapter, that too high scoring subject. Okay, fine, follow. Number one, first I would like to start with the method of accounting, section number 145 subsection 1. Friends, in fact there are two methods of accounting. First one is called as mercantile method. I repeat, mercantile method. Second one is called as cash method. Friends, mercantile method or cash method, these are the two methods of accounting. In case of mercantile method of accounting, books will be maintained or else expenditure will be recorded on due basis, and income also recorded on accrual basis. Whereas in case of cash method of accounting, income and expenditure will be recorded on actual basis. That means if actual payment is there, then only we will record the expenditure. If actual receipt is there, then only we will record the incomes. So take it for granted friends, in case of boys, that means PGPB as well as other sources, for these two heads purpose, computation of income under the head PGPB as well as other sources, whether we can follow mercantile method or we can follow cash method, any method we can follow regularly. But whereas in case of other heads like salary, house property and capital gain, for that purpose we don't have any option. Compulsory we need to follow the provisions of the Income Tax Act. Now for salary, house property, capital gain, there is no option at all. Compulsory we have to follow the provisions of Income Tax Act. Whereas for computation of income under the head business or profession as well as computation of income under the head other sources, we can follow either mercantile basis or else we can follow cash basis also. Okay, any one method we can follow at the option of the SSC, but compulsory we have to follow regular basis. Now see the word friends, cash system of accounting or mercantile system of accounting, any one we can follow. This is purely optional to the SSC, but it must be followed regularly. Next one friends, definitions. Please follow. Business or profession, I told you. First, what is the meaning of business? Friends, business includes trade. Trade means dealing with the goods. Purchase the goods at lower price and sell the same at higher price is called as good. And next one is called as commerce. Friends, commerce is nothing but if you do trade in large scale, then that is called as commerce. Okay, next one is called as manufacture. Conversion of raw materials into finished goods, that is nothing but manufacture. And the same way, any adventure or any concern in the nature of trade or commerce or adventure. Friends, similar kind of activities which may include some kind of adventure or else which may similar to the trade or commerce or manufacturing, that is also covered. So this is the business definition. Simply dealing with the goods and buying the goods at lower price and sell the same at higher price, or else take the raw material and convert them into finished goods and sell it. This is called as business. Whereas a profession means this is nothing but occupation requires some degree of learning. For example, CA practice, that is a profession. For that purpose, some skill is required, some knowledge is required. Lawyer, some information is required. So in case of profession, always it requires some degree of learning. So we can do business if you have money, but profession is not like that. You should have not money first, you should have some information, some knowledge, some skill or some talent. So the term profession includes vocation also. Friends, you know, vocation refers to any activity on which a person spends majority time in order to earn for his livelihood purpose. That is nothing but astrologer or else a priest or beggars, etc. Friends, their life living activity as well as their profession both are one and the same. For example, beggar, so continuously he will do the same, and the same way is called as astrologer. Wherever he go, so he will apply his knowledge and he will say the certain things and he will collect the money. That vocation, that is called as vocation. Friends, for your information, profession includes vocation also. So I'm telling you, in case of business generally we will deal with the goods, whereas in case of profession we will deal with the services. Next one, very important one, that is nothing but section number 28, charging section. Friends, take it for granted the following incomes are taxable under the head PGBB. Under that first one, friends, any profit or gain arising from business activity, that is except dividend or winning from lotteries, etc., etc. Friends, any activity if you are doing in the nature of business or profession, that income is taxable under that PGBP. But one thing for sure, dividend income always taxable under that IFOS, no doubt at all. Suppose shares I held as a stock in trade, I repeat, shares I held as a stock in trade, in that case also take it for granted that shares dividend is taxable under that IFOS, but not under the head PGBP. The reason very simple, the charging section 28 specifically said that all profits from business or profession is covered here, but charging section 56, that is other sources charging section, clearly said that so any dividend income is taxable under that IFOS. Same way, friends, profession includes vocation also. Next one, friends, any winning from lotteries, I repeat, winning from lotteries, card games, etc., that is not covered under the head PGBB. That is not a profession at all, that is covered under the head other sources. Next one, business or profession need not in continuation for taxability of income under the head PGBB. Friends, whether you continued or not immaterial, even single activity, isolated activity also sometimes is taxable under the head PGBP. Okay, chalo. Next one, friends, another topic, compensation or any other payment due to or received by a person in connection with termination, I repeat, in connection with termination or else closure of any contract, I repeat, any contract or any agency, in that case also it is covered under the head PGBP. For example, friends, I have one contract with Reliance Industry. For your information, Reliance Industry petrol bunks allotted to me. Okay, so my name is Mr. Ram, they are allotted to me. Now what happened? All of a sudden Mukesh Ambani took the decision that he wanted to discontinue that petrol bunks because of non-profitability. Everybody in the class. So terms of agreement has changed by the Mr. Mukesh Ambani. That is the reason he wanted to give compensation. This compensation is covered under the head PGBP. See the heading, any compensation or any other payment due to or received by a person in connection with termination or modification of contract related to management of all or substantial all of activities of Indian company or affairs in India for any other company. Sir, one company and another company, whatever the agreements they have, the agreements has been changed. For that purpose, if compensation paid, that is covered under the head PGBP. Next one, contract relating to agency for business activity in India, if changed, then also if any compensation paid, covered under the head PGBP. Next one, friends, terms and conditions for any contract related to business changed, that is also covered under the head PGBP. Next one, B point, vesting the management of any business or property in favor of government or any corporation owned by the government under any law in force. So sometimes what happen, government companies or else any other companies where government has majority share, these kind of companies will have some agreements. Because of that agreement, if management or anything has changed or terms of agreement has changed, in this case whatever the compensation paid, that compensation is taxable under that PGBP. Okay, chalo. Next one, friends, any income received by trade association or professional association from its members, that is taxable under that PGBP. For example, tomorrow once you qualified, compulsory you have to pay membership fees to CA Institute. If you are a CMA graduate, you have to pay what you call membership fees to CMA Institute. Same way CS Institute also. That means some fees received by the professional bodies from their members only for specific services, that is pakka taxable under the head PGBP in the hands of professional bodies. For example, CA Institute is collecting some fees from the members who qualified earlier, that amount is taxable under the head PGBP. Next one, export incentives. If any company or any government entities or any organization do exports, then our government will get the foreign currencies. For that purpose, foreign reserves purpose, our government of India wanted to encourage the exports. For this purpose, they requested all the people, all business tycoons, why don't you do exports? For that, I will give export incentives. Take it for granted, whatever the export incentives given by the government, taxable under that PGPB. Export incentives like this: profit on sale of import license. Sometimes they will give import license at cheaper rate or free of cost. If you sell it, you may get profit. So that is taxable under the head PGPB only. Here they asked you to do export. For encouragement purpose, they will give import license. If you sell the import license to someone else, that is whatever the profit you got, that is taxable under that PGPB. Next one, cash assistance. If you achieve this much of target, export targets, they will give cash rewards. That is also covered under the head PGPB. Next one, excise and customs duty repaid, duty drawback. I hope you know, whenever you imported, you have to pay customs duty to the government. Again, the same goods used in manufactured in India and you do re-export. For that purpose, whatever the tax you paid earlier, government wanted to give refund to you. That is called as duty drawback. See the heading, duty drawback. Yes, duty drawback is a export incentives. For encouragement purpose, they wanted to encourage you to do exports. For that purpose, they are giving duty drawback. That is also taxable under the head PGBP. These are covered under the category of export incentives. Next one, friends, the value of any activities, the value of any benefits or any perquisites which are received from business or profession. Sir, if any employee received perquisites, the perquisites are covered under the head salary. If any perquisites or benefits received because of your business or profession, yes, that is not covered under the head salary, that is covered under the head PGPP. If perquisites are received by a business person from his business or profession, that is taxable under that PGPP, not under the head salary. Next one, any interest, salary, bonus, commission, remuneration received by the partner from partnership firm. I repeat, any salary or interest or remuneration or what you call commission received by the partner from partnership firm is taxable under the head PGPP, because partner will get the remuneration or salary, whatever it may be, from the partnership firm. That is also taxable under the head PGPP. Okay, chalo. Next one, friends, any sum received in cash or kind. I repeat, in cash or kind for not carrying any activities, that is non-compete fees. Non-compete fees, or else not sharing any technical know-how, trademark, license, etc. In this case, whatever the amount paid, that amount is taxable, that compensation is taxable under that PGPP. I would like to take one example. Hero plus Honda, Hero Honda, they developed one bike called as Splendor. Nowadays, they splitted with each other. Nowadays, Hero separately doing business, Honda also separately doing business. Nowadays, the Splendor bike, that rights and everything taken over by the Hero company only. For that purpose, the company Hero paid some compensation to Honda for that purpose. So Honda is not supposed to share the know-how or else the formula or else the secret or the information, the knowledge related to manufacture of Splendor. Therefore, they received some compensation from the Hero company. That compensation is taxable under the head PGPP only. Okay, chalo. So next one, friends, any sum received under Keyman insurance policy. Friends, if Keyman insurance policy received by the organization, received by the person who is in the employment service, employment, in this case, that is covered under the head salary. Who are not in employment, who received in the professional capacity, that is covered under the head PGPP. Or else, if legal heirs only received, yes, that is covered under the head IFOS. See the word Keyman insurance policy. If Keyman insurance premium paid, anyhow, that is expenditure deduction allowed under section 37. Whereas if it is received by the person who are in employment, that is covered under the head salary. If it is received by the person or company, then it is covered under the head PGBP. If it is received by the legal heirs of the persons, that is taxable under the head IFOS. Okay, chalo. Next one, friends, fair market value of inventory as on the date of conversion or treatment as a capital asset, then in this case it is taxable as a business income. Friends, for your information, stock in trade, I repeat, stock in trade is converted into capital goods. Once upon a time that is stock in trade, nowadays they converted into capital goods. At that time, if you do this kind of conversion, whatever the fair market value of stock in trade as on the date of conversion, that is taxable under that PGPB. Best example, I started one real estate venture. Okay, so I took the flats, I wanted to sell it, but one fine day what happened? No sales. I don't want to continue anymore. Immediately I wanted to use it as a business land. I wanted to use it as a my personal land. That means once upon a time it is meant for resale, stock in trade, but nowadays I converted as a capital gain. Once you converted like this, the day when you are doing conversion, the day whatever the fair market value of the stock in trade is taxable under that PGPP. Next one, friends, any sum received or receivable in respect of capital asset which has been discarded or demolished or destroyed or transferred, for which deduction covered under section 35 AD. Sir, in case of section 35 AD, that is specified business, if any capital asset destroyed, that capital asset is also taxable under the head PGBP. Okay, chalo friends, these are the incomes which are taxable under that PGBP. No doubt, very lengthy topic, but very important topic also. Honestly speaking, out of all 5 heads, this is the largest head and very important head. Okay, chalo. So far I covered section number 28. The topics are as follows. Number 1, first one is all of you, any profits or gains from business or portion is covered under the head PGBP, or any compensation received for termination of agency or modification of terms of agency covered under the head PGBP, or else scheme and insurance policy received by the company or business or portion PGBP, and any perquisites received is also covered under the head PGBP on account of business or profession. Salary or interest commission, anything received by the partner from partnership from PGBP. Fair market value of the stock in trade on the date of conversion, that is also PGBP. And destruction of capital asset under section 35 AD, that is also covered under the head PGBP. Export incentives covered under the head PGBP. Non-compete fees also covered under the head PGBP. Friends, all these are covered under the head business or profession head. Okay, chalo. Next one, friends, section number 29, that is a computation section. Not important, just they are saying that if you want to computation of business or profession income, you have to follow section number, all of you, 32, last section, section number 44 dB. Okay, now friends, you know the section number 28, section number 29, 30, like that. There are so many sections up to 44 dB. What section number 28 is dealing? No, that is charging section. What 29, you know, computation. Section 29 is saying, Babu, you have to follow other sections like this. Other sections means whatever the sections commencing from 30 to 44 dB, these sections must be considered for computation of income. Anyhow, that is common point, leave it. Next one, friends, another topic, section 30 to 38. Friends, I would like to tell you one word. Whenever you heard 30 series, 30, take it for granted expenditure. 30 expenditure, that's all. When you heard the word 30, 30, 31, 32, whatever it may be, expenditure, that means deduction allowed. Now, first I would like to start with section number 30. Friends, what is that, you know? Deduction with respect to expenditure related to building. I repeat, deduction with respect to expenditure related to building. If you want to do any business, first we must have building. Therefore, section 30, that is expenditure related to building, provided the building must be used for business or profession purpose. Friends, here buildings are two types. One is a rented building, one is a owned building. Rented building means we have taken on rental basis. Friends, here one word I would like to take it, Ramarao, ill or murder. So remember the word. So Ramarao, RR, ill, 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 or M, murder. So one memory code, R for rent, first R for rent, second R for current repairs, next one I for insurance, L for land revenue, L for local rates, M for municipal taxes. All of you please follow. These are the expenses are only allowed with respect to building. If it is rented building, whatever rent paid allowed, whatever current repairs allowed, whatever insurance also allowed, whatever local rates also allowed, whatever land revenue also allowed, whatever municipal taxes also allowed. Next point is called as owned building. In case of owned building, rent anyhow not allowed, rent not allowed, but other things, repairs and what you call insurance, local rates and land revenue, municipal taxes allowed. Friends, in case of owned building, rent is not there. Whatever the rent you only paid from one pocket to another pocket, that is not covered. Only actual rent paid, that is only allowed as deduction, but whatever the rent you only paid to yourself, that is not at all allowed. Okay, chalo, see the word friends. Number one, if the building is used for business or profession, the two owned building, that is expenses are allowed. What? Repairs, current repairs, not capital repairs, only current repairs. Next one, insurance also allowed. Next one, local rates, land revenue, municipal taxes also allowed. Friends, land revenue, local taxes, municipal taxes, all are payable to government. Same way, in case of rented building also, rent, whatever rent due, that it's due or paid, it is also allowed. Repairs, insurance, local rates, municipal taxes, everything allowed. Take it for granted, this LLM, I repeat LLM, that is allowed as deduction on payment basis. If you pay, then only it is allowed as deduction. I repeat, LLM, L for local rates, L for land revenue, M for municipal taxes, that is allowed as deduction only on payment basis. That is the reason section 43B is covered. Okay, 43B means certain expenses are allowed on payment basis, no? So local rates, land revenue, municipal taxes will be allowed as deduction purely on payment basis. All of you please follow. Allowable expenditure related to building, that to business or portion, used as a owner, then depreciation under section 32 allowed, not under 30, leave it. Next one, repairs, revenue repairs only allowed, insurance premium allowed. Next one, land revenue, local taxes, municipal taxes allowed. But whereas a tenant, extra one more figure is allowed, rent allowed and revenue repairs allowed, insurance premium, land revenue, local taxes are allowed. And one more thing friends, capital repairs shall not be allowed as deduction, will not be allowed capital repairs. That too, maybe depreciation will be allowed under section 32, that is separate concept. Next one, in case of sole proprietary concern, notional rent will not be allowed. If I pay rent to myself, not allowed. Next one, in case of partnership firm, rent paid to partners will be allowed. Friends, whatever rent paid by the partnership firm to partners for usage of their building, anyhow that is allowed, because there our intention is the building owner is separate and the building occupant tenant is separate. So as a tenant, partnership firm is paying to building owner. Fortunately or unfortunately, our partner is only the building owner, so whatever the rent paid to partner, that is allowed. Next one, where SSC has sublet the part of the premises and the rent paid by the SSC, that is also allowed as deduction. But the rent paid by the SC minus rent recovered from the subtenant, the net amount only allowed, net expenditure only allowed. Where the premises are used partly for business and partly for what you call personal, only business proportionate expenditure only allowed. Some people will use the building partly for business, partly for their residence, and only the part which is related to business only allowed. Okay, chalo. Next one friends, section number 31. Friends, in case of building 30, whereas 31 is nothing but plant and machinery and furniture and features. Here two expenses are only allowed. Very simple. Number one, first one is called as current repairs, second one is called as insurance. Only two expenses are only allowed. Current repairs one thing and insurance allowed, that's all. See the word, that is used as a owner. Depreciation, that is anyhow 32, not here, leave it. And revenue expenditure allowed, and revenue expenditure being repairs, and insurance premium also allowed. As a tenant also, answer, revenue expenses allowed, insurance premium allowed, rent here not at all allowed here, rent not allowed here, so strike it off. Rent is allowed under section 37. Okay, leave it. Next one, capital repair shall not be allowed as deduction, but depreciation of such repairs will be allowed as deduction under section 32. Babu, capital repairs not allowed, but depreciation anyhow allowed. If machinery, plant and furniture, etc. Are taken on hire, rental charges will be allowed under section 31. I repeat, hire charges will be allowed under section 31. I told you, no, rent will be allowed under section 31. But even if an asset is used for part of the previous year, the assessee entitled to deduct full amount of expenses on repairs and all. Babu, when you used part of the year, if assessee used for part of the year, then that amount is allowed as deduction. The full amount whatever paid it is allowed. And the term repairs will include renewal or renovation, etc., etc., but not replacement or reconstruction. Simple word, repairs, current repairs are allowed, capital repairs are not at all allowed. Okay, chalo. And next one, section 32, depreciation. Very important point, please follow. Babu, it is mandatory to claim depreciation. Claiming of depreciation mandatory. Compulsory, even though you like it or not, compulsory you have to claim depreciation. And the next one, depreciation shall be calculated on block wise. Block wise means not individual assets, group of assets. Okay. And method of depreciation only WDV. Only in case of power sector undertaking you can follow SLM also. Okay. And next one, here sir, there are so many types of depreciation. One is a normal depreciation, one is a reduced depreciation, one is a additional depreciation. So these are the ways. Number one, block of assets means the assets which are having same rate of depreciation and falling under same block. I repeat, same block means a simple word, same class of assets, and having same rate of depreciation. For example, friends, building is different class, leave it, that is separate block. But in building also, residential building, that is after all 5%, whereas building other than residential means commercial building are 10%. So take it for granted, friends, here building only, but residential building come under one block and commercial building come under another block, because residential building 5% depreciation, whereas commercial building 10% is the depreciation. So here block of assets means assets belonging to same class of assets having same rate of depreciation. Okay, same class and same rate, both must be there. Okay, chalo. Next one, here conditions for claiming what you call depreciation. Babu, twin condition, two condition. Number one, SSC must be the owner. Number two, asset must be used for business or profession. I repeat, owner, user. Owner, used. Owner and used for business or profession. See the word, SSC must be the owner of the asset. Owner. And yeah, such asset shall be used for SSC is business or profession. So you must be the owner and you must be the user, and both condition must be satisfied, then only it is allowed. Exceptions. I repeat, exceptions. Number one, even though you are a owner of the asset, in these following cases some exceptions are there. Number one, I am a tenant. I only taken the land on rental basis. On the land, I only constructed the building. I repeat once again, I am not the owner. After all, I am the tenant. I have taken your land. On your land, I only constructed the building. Friends, in this case, take it for granted. Whatever your land I have taken and whatever the building I constructed, this is capital expenditure for me. So on this capital expenditure, I can claim depreciation even though I am not the owner of entire premises. I am not the owner of entire building, I know, but I can claim depreciation. Next one, asset acquired by the SSC under hire purchase. In case of hire purchase, hire purchaser can claim depreciation. For example, I bought the lorry for my business purpose under hire purchase. Even though full payment is not done, even though the lorry is not registered in my name, still I only can claim depreciation because I am the hire purchaser. Next one, purchaser covered under section 53A of Transfer of Property Act. Already I covered this similar topic in house property chapter. If anybody covered in in 53 of Transfer of Property Act, that person also can claim depreciation because their substance over form, possession has taken, agreement is also there, and property already possession taken, and part of the consideration already paid, all the three conditions satisfied, take it for granted, SSC can claim depreciation even though he is not the real owner of the property as of now. Next one, joint ownership and co-ownership. In case of joint ownership and co-ownership, so the persons also can claim depreciation because even though there is no 100% right in the property, they also can claim depreciation. Okay, chalo. Next one, uses. Usage means actively used. I repeat, it must be actively used. Actively means, it must be really used for business or profession. But for your information, sometimes, some cases, passive usage also okay. Example, fire extinguisher. Fire extinguisher. Sir, I bought the fire extinguisher. I kept in my room. Whenever there is a fire accident, then only I will use it now. Or else gun. In jewelry showroom, the security guard will have gun. The gun we will apply whenever there is a theft or something. That is not a Diwali gun or something. I cannot say dishum like that. Whenever there is a theft or riots, then only I may use it. So that is ready for use but not used at all. Still depreciation is allowed. See the word passive use, kept ready for usage but not used actively. Still it is allowed. Examples, assets remain idle during lockdown or strike and breakdown time. So that is also allowed. Next one, assets installed but not actually used. I told you fire extinguishers, gun, generators. So I bought the generator but sorry, there is no power cut. Happy. Still depreciation is not allowed. Okay, chalo. Next one, classification of assets for claiming depreciation. Assets are two types. One is tangible, one is intangible. Tangible, again three types. That is a building, and the next one furniture, next one plant and machinery. That's all. Whereas in case of intangibles, I hope you know, intangibles means know-how, trademark, patent, license, franchisee, copyright, etc. Once upon a time, goodwill also allowed. Once upon a time, but amendment, goodwill is no more depreciable asset. You can no need to discuss, time waste. Goodwill, non-depreciable asset. I am not talking about your accounts. In your accounts, answer is different. In tax, answer is different. As far as the subject is concerned, as far as direct tax is concerned, take it for granted, the depreciation is not allowed in case of goodwill, whether it is purchased goodwill or self-generated goodwill. Here another point, building. Building includes roads, bridges, wells, culverts, etc. Whereas furniture, there is no proper definition for furniture which we will use for sitting for uses in the business, that is furniture. Plant and machinery. Plant and machinery means it consisting of so many things. Plant consisting of so many things, that is books, vehicles, and scientific equipments, etc. That is also covered, but does not include trees, does not include tea bushes, does not include livestock. Plant does not include tea bushes, etc. It includes books also, and vehicles also, and as well as computers also, and scientific equipments also covered. And next one, depreciation rates. So many people are in the wrong impression that depreciation rates are covered under section 32. Answer wrong. That is not covered under section 32. Depreciation topic is covered under section 32, but depreciation rates are specified by the rules. I repeat, specified by the rules. Number one, building. Babu, residential building 5%. All other buildings, that is 10%. But temporary wooden structure 40%. I repeat, temporary wooden structure 40%, residential building 5%, and normal all other factory building, etc., etc., that is 10%. See the word mainly for residential purpose 5, and building which are not used for residential, maybe commercial 10%, and whereas the building acquired on or after 1/9/2012 for installation of plant and machinery and forming part of water supply, etc., that is 40%, and temporary wooden structure also 40%. Next one, furniture and fittings, that is also 10%. Only one word, 10%. Next one, motor vehicles. Follow friends, motor vehicles always 15%. Motor cars 15%. Whereas motor cars purchased for higher business then 30%. I repeat, higher business 30%, or else other motor vehicles, that is 15%. Next one, other point, motor buses or motor lorries or taxis used in higher business anyhow 30%. Okay, chalo. But there is another time period, if you use in between what you call 23rd August 2019 to 31st March 2020, answer would be different. Anyhow, that is different point, leave it. Next one friends, aeroplane or else aero engines, that is 40%. And molds used in rubber and plastic goods factories, that is 30%. Okay, and next one, that is life saving equipment 40%, and computers and computer software also 40%, and pollution equipments 40%, energy saving devices, books used in library or any books 40%, ships and vessels, that is 20%, aeroplane, that is anyhow 40%, and other plant and machinery 15%, oil wells 40%, and windmills which are installed on or after 1/4/2014, that is 40%. Okay, so these are the depreciation rates, and intangible assets always 25%. So friends, these are the depreciation rates. Friends, next topic, computation of depreciation. Please follow friends. Here depreciation will be allowed in case of WDV format. First one, you have to take the opening WDV. On that we have to add purchase price of the assets if you make any purchases during the year. That means if you do any additions, you have to take the actual cost to be added. After that, less if any money received in respect of goods sold or demolished, that money received or receivable must be deducted. After that, you will get the balance amount. On the balance amount, we need to calculate depreciation, and we need to deduct depreciation out of that. Okay, chalo. After that, we will get the closing WDV. As usual, you know friends, closing WDV of this year will be treated as opening WDV for the next year. Next one friends, the WDV shall be taken as nil if money receivable or received is more than the balance amount. For example, if that ultimately the balance amount is 0, there is no question of depreciation. Same way, there must be some number of assets in the block. If there are no number of assets in the block, automatically there is no depreciation. So conclusion friends, the block must have positive value as well as the block must have some number of assets. If two conditions are satisfied, then only depreciation will be allowed. Suppose any one of the condition not satisfied, take it for granted, depreciation won't be allowed. Okay, chalo. So this is the topic in relation to calculation of depreciation as well as WDV. Next one friends, what is the cost to be added? So what is the actual cost? That is the question friends. If it is purchased by the SSC, whatever the expenses incurred to bring the asset to present condition and present location must be added back. Same way, whatever the income to bring the asset to present condition and present location must not be added back, must be deducted. See the word friends, cost of such asset you have to take, add taxes if any, you have to add loading unloading charges, and same way transportation charges and installation charges, and any subsidies we have to deduct, and same way interest on loan borrowed, that also must be added. So all the things expenses must be added, like trial run expenses must be added, foreign exchange losses must be added. Same way, certain incomes must be deducted, like grants, subsidies must be deducted, discount if any must be deducted. Same way, foreign exchange gain must be deducted if any. And same way friends, another figure, that is a trial run income. Suppose if you do trial run, if you get any products, if you sell it, no, then you may revenue generated, right? That revenue must be deducted, then you will get actual cost. So this is the way we need to calculate actual cost. The actual cost must be added back to the asset. Okay, chalo. Next one, special points friends. These are the special cases given in the explanation to section 43 subsection 1. Please follow. Asset used in business after it ceases to be used for scientific research. Babu, if any asset used in what you call R&D purpose first in this case what happened, used for R&D, after that we introduced it into business. In this case, take it for granted the WDV is 0, because when you use it for R&D, almost all 100% of depreciation you claimed. Therefore the WDV must be taken as 0, actual cost must be taken as 0. Next one, inventory converted into capital asset and used for the business or profession. In this case friends, the fair market value of inventory as on the date of such conversion must be taken. Next one friends, asset used by way of gift or inheritance, you have taken as a gift or free of cost, like as a what do you call, inheritance. In this case actual cost is nothing but the actual cost to the previous owner. So what is the cost to your previous owner, the same must be taken. Next one, asset acquired from any other person using the asset for his business or portion with a view to claim enhanced depreciation. Friends, asset acquired from any other person and using the same for the business or portion in order to claim higher depreciation. In this case, the actual cost shall be determined by the assessing officer. If you want to claim higher depreciation, that is the reason if you take back from someone else, in this case assessing officer will calculate the depreciation. Next one, asset earlier transferred and reacquired by the SC. I only sold the asset, again I only bought the asset. In this case original actual cost minus depreciation allowable to him, assuming it is only the asset in relevant block, or else actual price for which it is reacquired, whichever is less. Whenever you only transfer to someone else, again you have taken back. In this case what is the actual cost minus whatever the depreciation related to that person must be deducted, that figure, or else whatever the actual price for which that is reacquired, whichever is lower will be considered as a actual cost. Next one friends, asset transferred and depreciation also claimed by the SC and reacquired by him by way of lease or hire. So I only transferred the asset to someone else, again I have taken on lease basis. In this case actual cost in the hands of the person who has leased back the asset shall be the same as the WDV for this one. Okay, so actual cost of the asset in the hands of the person who has leased back, that must be considered. Next one, buildings brought into use for business purpose for subsequently its reacquisition. In this case actual cost of the building minus depreciation would have been allowable, that must be considered. Next one, assets transferred by holding company to 100% subsidiary company, or else the subsidiary company is an Indian company. In this case actual cost to the transferee company shall be same as a transferor, so that is nothing but cost to the previous owner. Next one friends, another topic, assets transferred under scheme of amalgamation. Scheme of amalgamation, actual cost to the amalgamated company must be taken. Whereas interest pertaining to the post acquisition period, sir, whatever the interest pertaining to post acquisition period ante after acquisition, it must be charged to P&L. Actual cost of asset where ITC available, friends, if ITC has taken, actual cost minus ITC must be deducted. ITC you have to deduct and balance amount only you have to take it. Asset acquired where portion of the cost met by some other person, so that is subsidy. The subsidy must be deducted out of actual cost. Next one, asset acquired by non-resident outside India but brought by him to India for the purpose of business or portion. Friends, asset acquired by non-resident outside India, after that he brought by him to India, so he introduced it into India, then actual cost minus depreciation that would have been allowable in India since from its acquisition. Suppose if you use the asset in India, what would be the depreciation? That depreciation should be deducted and balance amount only will be allowed. Next one, capital asset with respect to 35 AD, then that is nothing but 0, because in 35 AD you will claim 100% depreciation, right? That means 100% deduction, so it will be treated as 0. Next one friends, composite subsidy. Friends, the subsidy is related to that particular asset only, then it should be deducted out of the actual cost. Okay, next one friends, reduced depreciation. Reduced depreciation is nothing but if you put to use the asset for a period less than 180 days in the current year, in the year of purchase, take it for granted 50% of depreciation only allowed. I repeat, if you put to use the asset within period less than 180 days, then half of the normal depreciation only allowed. Less than 180 days means half depreciation only allowed. Okay, chalo. Next one friends, This is not applicable every year. It is only applicable in the first year of usage, in the first year of purchase as well as usage. Okay. Next one, additional depreciation. Very, very important topic. Additional depreciation allowed only for manufacturers. That too, it is allowed only for newly purchased plant and machineries. See the word. The SSE engaged in the business of manufacture or production of any article or anything, or else another amendment, even the SSE engaged in distribution of power, generation of power, distribution of power, then only this additional depreciation also allowed. Next one, friends, additional depreciation allowed with respect to only plant and machinery. The plant and machinery must be purchased and put to use for the business or profession. In this case, depreciation will be allowed. You know how much is the rate of depreciation? 20%. In case of assets which are put to use for a period less than 180 days, half of the depreciation first year it is allowed, and the remaining depreciation 10% will be allowed in the next year. So if you purchase and if you put to use for a period more than 180 days, full depreciation, that is 20% allowed. If you put to use for a period less than 180 days, then half allowed in this year, balance half allowed in the next year. This is the topic called as additional depreciation rate. But for your information, additional depreciation, whatever the rate is given, that 20% is applicable only for plant and machinery. It is applicable even second hand imported plant and machinery also. But if you purchase second hand plant and machinery in India, then additional depreciation will not be allowed. Land not allowed. I repeat, land not allowed. And same way, building also not eligible. Furniture and features also not eligible. Only those assets which are purchased for the purpose of business or profession, that is only allowed. Okay, chalo. And all of you, road transport vehicles also not eligible for additional depreciation. The additional depreciation is allowed only for manufacturers or else those persons who are engaged in power generation as well as power transmission businesses also. Next one, unabsorbed depreciation. Friends, whenever there are no proper profits for claiming the depreciation, or else whenever there is a less profits for claiming the depreciation, then it is called as unabsorbed depreciation. Unabsorbed depreciation can be adjusted in the same year. If any balance amount is there, that can be carried forward next year, and it can be adjusted against any income. I repeat, against any income. That too, it can be adjusted against any income and other than salaries, but it can be carried forward for any number of years. I repeat, it can be used and it can be carried forward for any number of years. There is no restriction on number of years. There is no time limit at all. You can carry forward and you can utilize for any number of years. But only the thing is, it can be adjusted against business income or any income, but except salary. Next one, friends, apportionment of depreciation. Friends, in some cases what happen, asset will be used by the two persons. For example, the same asset used by two persons in case of amalgamation, or else in case of demerger, or else in case of conversion of sole proprietor into company, or conversion of firm into company, or else conversion of company into LLP. In this case, depreciation will be allowed on pro rata basis. For that purpose, what you have to do, you have to calculate depreciation first. The depreciation must be apportioned between predecessor and successor based on number of days of usage. I repeat, based on number of days of usage. You have to use asset. After that, calculate the depreciation throughout the year. After that, apportion between predecessor as well as successor based on number of days of usage by the person. Very important topic. Next one, expenditure on scientific basis. Expenditure incurred for scientific research purpose, R&D purpose. In this case, very, very important topic, section 35 deduction will be allowed. If you do in-house research means that is related to our own business or profession. In this case, take it for granted, whatever the expenditure incurred, revenue purpose, revenue expenditure 100% allowed. Whatever the expenditure incurred for capital purpose, that is capital expenditure, that is also 100% allowed. So revenue expenditure 100% allowed, capital expenditure also 100% allowed, but land not at all allowed, cost of land not allowed. But for your information, if you incur any expenditure prior to commencement of business, that is called as prior period expenditure here, that is also allowed, provided whatever the prior period expenditure incurred for a period of last 3 years. I repeat, last 3 years, whatever the expenditure incurred, that is also allowed. So friends, revenue expenditure allowed, capital expenditure also allowed, and the prior period expenditure also allowed. Okay, chalo, see the word, all of you. Expenses incurred during last 3 years, that revenue and capital expenditure will be allowed at the rate of 100%. Revenue expenditure include salaries and everything, but not perquisites. Perquisites are not covered with respect to prior period expenditure. But prior period expenditure includes even capital expenditure also, except land. Already I told you. But expenses during the period, that means after commencement of business, in this case revenue expenditure fully allowed, capital expenditure also 100% fully allowed, but only the thing is land not allowed, cost of land not allowed. Next one friends, contribution made to outsiders, in this case whether deduction allowed or not allowed. Answer, if payment made to research associations, whereas universities and other recognized colleges, yes, 100% deduction will be allowed. If payment made to any approved by the central government organizations, that is also 100% will be allowed. Payment made to any company registered in India for social and statistical sciences also 100% allowed. And the payment made to contribution to, that is a national laboratory or IITs, in this case also 100% allowed. Whatever contribution you made for scientific research, social and statistical research purpose, 100% deduction will be allowed. So friends, this is the topic called as R&D, research and development, section 35. Babu, whenever you are unable to absorb the amount, the expenditure, unabsorbed scientific research expenditure will have the same treatment as unabsorbed depreciation. That means it can be carried forward for any number of years, it can be adjusted against any income except salaries. Next one, sale of R&D assets. Friends, whatever the assets used in R&D, the assets are finally transferred. Number one, if you sold the asset without put to use in the business, I repeat, you sold it directly without used in the business. In this case, whatever the sale proceedings on sale of that R&D assets, or else whatever the cost of asset, whichever is less is taxable. So I sold R&D asset for rupees 1 lakh, but R&D assets in those days I purchased for 9 lakh and I took as a deduction 9 lakh under section 35. Out of these two, whichever is lower will be allowed, will be taxable. Next one friends, if the sale price is more than cost, no doubt capital gain will arise. That may be short term capital gain, or else that may be long term capital gain. In case of sale of asset, then it is more than cost of the asset, obviously capital gain will arise. Okay, chalo. Next one friends, sometimes what happen, we will sell the asset after put to use in the business. If anybody sold the asset after put to use in the business, in this case first it should be added to block of assets at the cost of nil. Okay, after that section 50 provisions will applicable. I repeat, section 50 provisions will applicable with respect to computation of capital gains also. So friends, this is the topic called as R&D, research and development. But one thing for sure, in case of R&D 100% deduction allowed, therefore depreciation not allowed. In case of R&D, RX, revenue expenditure allowed. In case of R&D, capex also allowed, but cost of land not allowed. In case of R&D, prior period expenditure also allowed, but salaries not allowed. That too up to 3 years, maximum 3 years period expenditure only allowed, prior to 3 years not at all allowed. Next one friends, contribution to approved institutions, universities, colleges, IITs, national laboratories and companies who are doing social and statistical studies, 100% deduction will be allowed. Okay, chalo. Next one, very important topic, 35 AD, that is called as specified businesses. Friends, once upon a time UPA government introduced this topic, which are more important for Indian economy. That is as follows. Number one, setting up and setting up and operating cold chain. If you start cold chain business, that is what you call specified business, 100% deduction allowed. Friends, in case of specified business, 100% expenditure allowed as deduction as a RX. Same way, 100% expenditure allowed as a CAPEX. Okay, RX, CAPEX allowed. And same way, prior period expenditure also 100% allowed. So RX, CAPEX and prior period expenditure fully allowed as deduction. And that too, there is no question of depreciation. And that too, friends, certain assets not allowed. Land not allowed. I repeat, land not allowed. And cost of goodwill also not allowed, if any. And same way, cost of shares also not allowed. These three are not allowed. Land not allowed, goodwill not allowed, shares also not allowed. So what are the businesses? Number one, cold storage. Number two, warehouse for storage of agricultural produce. Next one, cross country pipeline for supply of natural gas and petroleum. Next one, friends, hotel with 2-star facilities. And next one, hospital with minimum 100 beds. Hospital with 100 beds. Next one, housing project for slum development. Housing project for slum development. Next one, housing project for the purposes notified by the government, affordable prices. Next one, that is manufacture of fertilizers business. Next one, inland container depot. I repeat, inland container depot. Next one, warehouse facility for storage of sugar. And the next one, slurry pipeline for supply of iron ore purpose. Next one, that is semiconductor water fabrication businesses. And the last one, friends, that is nothing but new infrastructure facilities development as well as maintenance. If anybody do this one, they are eligible for RX 100%, CAPEX 100%, whereas prior period expenditure also 100%, but land value not allowed, goodwill value not allowed, as well as financial assets like shares also not allowed. Babu, but depreciation not at all allowed, and prior period expenditure also allowed, and whatever the losses you have incurred, the losses can be carried forward for any number of years. I repeat, any number of years, but only specified business losses can be adjusted against same income itself. I repeat, same income. 35 AD business losses can be adjusted only against 35 AD business income. The two, friends, if any expenditure, any capital expenditure incurred, that is more than 10,000 rupees, if incurred, that too if it is incurred by way of other than account pay check, other than account pay draft, or other than ECS, electronic clearance system, take it for granted that expenditure is not at all considered in the deduction. So if it is more than 10,000, compulsory it is paid by account pay check or account pay draft or else ECS. Otherwise, the deduction won't be allowed. Otherwise, the deduction under section 35 AD with respect to that income will not be allowed. Okay, chalo. Babu, here certain points are there. Please follow. Section 35 AD, that is conditions for claiming the deductions. Number one, 35 AD deduction allowed only specified businesses, not for all businesses. That too, it should be a new business. It should not be formed by splitting of other old business, and it should not be transferred by second hand plant and machinery. It should be having only new plant and machinery. But maybe worst case, maximum 20% of plant and machinery you can purchase from abroad. Okay, chalo. And one more thing, friends, this deduction will be allowed under section 35 AD only if you incur for that particular businesses itself. Okay, chalo. And next one, friends, all of you here, in case of hotel business, even transferor also can claim deduction, not transferee. Suppose I am the owner of the business, I only transferred the business to someone else. In this case, transferor only can claim 35 AD deduction. Okay, next one, the assets which are purchased for specified businesses must held for a minimum period of 8 assessment years. If any assessee not used for minimum period of 8 assessment years and sold subsequently, in this case whatever the cost of asset minus whatever the depreciation so far we calculated for this particular purpose shall be reduced. The balance amount is taxable as a business income under section 28. If you observe carefully, in this class PGPB only I told you section 28, if any assets are disposed or any assets sold it out, within the period of 8 years, then total cost of the asset minus depreciation shall be taxable under section 28. Okay, chalo. So friends, this is section 35 AD. Very important topic. Section 35 important topic. Section 35 AD also important topic. Take care. Next one friends, another topic friends, that is number next 35D, amortization of preliminary expenditure. I repeat, amortization of preliminary expenditure. That is nothing but if anybody wanted to start a new business or anybody wanted to go for expansion of business, in this case they will incur some expenses. That expenditure is called as preliminary expenditure. What is the treatment of preliminary expenditure? Point number one, it is applicable for Indian companies or else non-corporate resident SCs. Ultimately it is applicable only for residents, only for Indian companies or else non-corporate resident SCs. Whatever the expenditure incurred, I repeat, whatever the expenditure incurred for commencement of new business or else for expansion of business, that expenditure is allowed. Like what you call prospectus expenditure. And next one is called as market survey, soil testing, or else preparation of project report, or else AOA, MOA, articles of association, memorandum of association. For all the purpose, whatever the expenditure incurred, that expenditure will be allowed as deduction over a period of 5 years. I repeat, whatever the expenditure incurred for preliminary expenditure purpose, that will be allowed as deduction over a period of 5 years commencing from the year in which business started. And one more thing friends, maximum amount is nothing but in case of companies 5% of cost of project or else 5% of capital employed. I repeat, so how much is deduction allowed, you know? Actual expenditure how much you incurred or higher of 5% of cost of project or else 5% of capital employed. Out of these two, whichever is higher, this figure or expenditure whichever is lower will be allowed as deduction for a period of 5 years. Whereas in case of other than companies, only 5% of cost of project only will be considered. That's all friends. One more thing, in case of section 35D, amortization of preliminary expenditure, it will be allowed for a maximum period of 5 years. How much, you know, how much is the expenditure actually incurred, or higher of cost of capital into 5% or cost of project into 5%. Out of these two overall figures, whichever is lower, divided by 5 years. Whereas in case of other than companies, expenditure are 5% of cost of project, whichever is less, the total figure divided by 5 years, it is allowed. Friends, 35 DDA, that is nothing but VRS compensation paid. Amortization of VRS compensation, it is applicable for generally corporate assets. That too it is allowed as deduction for a period of 5 years. That too it is allowed as deduction on payment basis. I repeat, only on payment basis. That's all. This is 35 DDA, not important. Next one, focus points. Deduction will be allowed on cash basis. I repeat, payment basis only. If compensation paid in installments, obviously installment basis only it is allowed. That means if you pay, you have to pay 10 lakh, but you paid 3 lakh. So 3 lakh divided by 5 years. Remaining 7 lakh you paid after 2 years. After 2 years, the 7 lakh divided by 5 years. Like that, it is allowed on pro rata basis, proportionate basis. Okay, chalo. This is the topic called as section 35 DDA. Next one friends, section 36, very important topic, other deductions. I repeat, other deductions. Please follow. Number one, insurance premium paid. Insurance premium paid for stock in trade, that is allowed. Insurance premium paid for livestock, that is also allowed. Whereas insurance premium paid for health of the employees, that is also allowed. But here condition, it must be paid by bank. Health of the employees purpose you have to pay by bank, then only it is allowed. Next one friends, any sum paid to employees as a bonus, I repeat bonus, that is also allowed as deduction, but only the condition is it must be paid, then only it is allowed. It is allowed on payment basis, section 43B. Bonus as well as commission payable to employees is allowed as deduction provided if it is paid within the set time period. That too, it must be paid as a bonus only. If you pay over and above statutory limit, then also it is allowed. If you pay as a dividend, it is not allowed. It must be paid purely as a bonus. Next one, interest on borrowed capital. I hope you know, if you take any loan for business or profession, and on the loan if you have any interest, that interest is also allowed as deduction, provided the following conditions must be satisfied. Number one, the interest must be paid on loan capital only the loan taken for business or profession purpose. That too, the interest must be paid in case of banks. In case of banks, it is mandatory to pay within the set period, then only it is high. It is allowed, otherwise it is not at all allowed. For your info friends, in case of sole proprietary concern, interest paid to partners, own capital, on own capital interest not allowed. Same way, in case of partnership firm, it is allowed, subject to limit. Whereas in case of genuine borrowings, a assessing officer cannot object even the interest rate is very high. Yes, whatever the interest they will allow, no doubt. But in case of partnership firm, there is a restriction. Next one friends, capitalization of interest. Friends, if interest is apportioned, if the interest is accrued before put to use, it must be capitalized. After put to use, it must be charged to P&L. Next one, interest will be allowed as deduction even though it is taken as a working capital. If you take for working capital or if you take for purchase of asset, the interest will be allowed. But after put to use the asset, whatever the interest, that will be allowed as deduction. Next one friends, interest to financial institutions will be allowed as deduction only on payment basis. If you pay, then only the deduction will be allowed. Discount on zero coupon bonds will be allowed as deduction only over a life of the bonds. I repeat, over a life of the bonds. That's all. This is the topic with respect to interest. Next one friends, employer's contribution to employee welfare fund, that is called as welfare contribution. Please follow. Employer's contribution to RPF or else employer's contribution to approved superannuation fund will be allowed as deduction subject to 43B. That means on payment basis only it is allowed. And same way, employer contribution to pension scheme under 80 CCD NPS, that is also allowed, maximum of 10% of employee salary. To that extent only it is allowed. Your salary means basic salary plus DSO provided. So conclusion ma, employer contribution to employee welfare fund allowed as deduction subject to 43B. You know 43B means you have to pay the money on or before due date for filing of return of income. Whereas another point, employee contribution to employee welfare fund, that is also allowed as deduction provided you have to pay the money, that is also on payment basis but not covered under section 43B. It is allowed as deduction if you pay on or before due date specified in the respective act. I repeat, on or before due date specified in the respective act. Next one friends, employees contribution to certain welfare schemes, that is PF, ESI, etc., annuity, etc. In this case, employees contribution will be first treated as income. Whatever deduction done from his salary, you know, with respect to employee contribution, first it will be taken as income. Later on, it will be allowed as deduction. I repeat, later on it will be allowed as deduction, provided it must be paid, that too within the due date specified in the respective act. If you pay within the due date specified in the PF Act or what you call ESI Act, then only it is allowed as deduction with respect to employees contribution to employee welfare fund. Next one, in case of dead animals are useless animals, whatever the cost minus whatever the selling price. I repeat, I purchased one buffalo for 10 lakh, but when it is became useless, I sold it for 1 lakh. Remaining 9 lakh is the loss for me. The 9 lakh will be allowed as deduction. And same way friends, that is deduction with respect to bad debts. Very, very important. Bad debts will be allowed as deduction subject to following conditions. Number one, the bad debts must be incidental to the business or profession. And the bad debts must have taken into computation of income. I repeat, must have taken for computation of income earlier. That too, in case of what you call business or profession must be continued. Discontinued business, bad debts not allowed. It must be revenue nature. That too, the business must be continued. That too, it is incidental to business or profession. In this case only, that particular bad debts will be allowed as deduction. And in case of family planning expenditure, not allowed for all, only allowed for companies. That too, revenue family planning expenditure allowed, whereas capital family planning expenditure that is allowed over a period of 5 years. But it is allowed only for corporate assets, not for all other assets, keep in mind. Whereas unabsorbed family planning expenditure will have the same treatment as unabsorbed depreciation. Okay, chalo. Next one, friends, security transaction tax. Friends, security transaction tax will be treated in the following way. Number one, security transaction tax allowed as deduction or not? Yes, allowed, provided the stocks. Friends, in this lecture we are going to start the topic that is section number 40 series, that is inadmissible deductions. Certain expenses are not allowed as deduction, that is covered under section 40 itself. Okay, chalo, one by one we are going to cover. First one is called as section 40 small a series. Once it is completed, I want to go for section 40 capital A series, and one more section, section 43B and section 41. These topics I am going to cover right now. Please follow, friends. First, let me start the topic section 40 subsection A class 1. Friends, this is nothing but payment made by any person to non-resident or else foreign company. In that case, whatever the amount you paid, that payment like interest, royalty, fees for technical service or any other sum which is chargeable to tax under Income Tax Act. I repeat, if you pay any amount which is chargeable to tax under Income Tax Act to non-resident or foreign company, if you are making the payment, compulsory you have to do two things. First one, you have to deduct tax at source, as well as whatever the tax you deducted, it must be remitted to the government within the due date specified under section 139 subsection 1. For example, if you have not deducted or else if you have not remitted to the government within the said due date, take it for granted, entire such amount will be disallowed. I repeat, entire amount will be disallowed. See the provision, section 40 subsection A class 1. Any payment like interest, royalty and fees for technical services or any other sum chargeable to tax under Income Tax Act, whether it is payable in India or outside India is different issue, but payable to non-resident as well as foreign company, in this case tax must be deducted at source, and whatever the tax deducted, that must be deposited to the government within the due date specified under section 139 subsection 1. If you have not deducted or not paid to government, then 100% of such amount will be disallowed. I repeat, 100% of such amount will be disallowed. Okay, chalo. Next topic, friends, very important topic, that is nothing but section 40 subsection A class 1A. You know what? Payment made by any person to resident, in that case compulsory you have to deduct TDS, as well as whatever the amount you deducted, the amount must be remitted to the government within the due date specified under section 139 subsection 1. If anybody not deducted or else not remitted to the government, take it for granted, in this case 30% of such expenditure will be disallowed. I repeat, only 30% of such expenditure will be disallowed. That's all, not 100%. So whatever the person make the payment, not every payment, those payments which are subject to TDS, that payment if you are making to non-resident, then it is covered under section 40A subsection 1. If you are making to resident, then it is covered under section 40A subsection 1A. Here, if you have not deducted or not remitted TDS, then 30% amount will be disallowed. See the word, any payment made to residents, then tax must be deducted and deducted amount must be remitted to the government. In this case, 30% of such amount will be disallowed. That's all. And Mr. P will be treated as SSC in default, and he has to pay interest and all, and that too 30% of such amount will be disallowed. Okay, chalo. But here one relaxation, you know what, the disallowance is not applicable if all the conditions are satisfied. You know what are the conditions? One by one we are going to cover. Condition number 1, the payee. Payee means in this example Mr. Resident. The payee must file the return of income. That too, the payee must offer this income in his income tax return. That too, the payee must pay the tax on that income. Last one, the payer must obtain CA certificate, chartered accountant certificate for this purpose. If all the conditions are satisfied, take it for granted in the hands of payer. No deduction will be allowed. That too, payer will not be treated as SC in default. I repeat, the resident, whoever the payee, receiver has to file the return. Receiver has to offer the income in that return. The payee has to pay tax on the income which is offered in the return. Okay, in this case the payer has to obtain CA certificate stating that all the things are really done. In this case, assessing officer will not disallow the payment and assessing officer will not collect any kind of interest and all. Okay, chalo. And the last of point its kind, follow section 40 subsection A class 2. You know what? Direct taxes, wealth tax and dividend distribution tax, these kind of direct taxes will not be allowed as deduction. Take it for granted, direct taxes always will not be allowed as deduction. And next one, section 40 subsection A class 2B, that is nothing but any payment made by organization to state government without deduction of TDS or without remittance of TDS, 100% of such amount will be disallowed. For example, Telangana state beverages, they will pay dividend or they will pay certain profits or they will pay license fees to the government. If they have not deducted TDS on that, if they have not remitted TDS to the government, then 100% of such amount will be disallowed. Okay, chalo. Next one, section 40 subsection A class 3, that is nothing but any salary paid outside India to non-resident without deduction or else without remittance, 100% disallowed. Okay, this is salary payable outside India to a non-resident. And another point, friends, that is nothing but any contribution to PF Provident Fund or else any other welfare fund of the employee and on which no arrangements are made for deduction of TDS. Friends, you know, employer will make contribution to PF. Same way, will make contribution to different employee welfare funds of employees, right? In this case, employer has to make satisfactory arrangements for purpose of deduction of tax at source. If you have not done, take it for granted, such expenditure will not be allowed as deduction. Okay, chalo. And the next one, friends, very important point, section 40 small a class 5. You know what? Tax on non-monetary perquisites paid by the employer on behalf of employee. I repeat once again, tax paid on non-monetary perquisites by the employer, employer only paid on non-monetary perquisites on behalf of employee. Take it for granted, it is paid voluntarily by the employer on behalf of employee, therefore no deduction will be allowed. That too, not taxable in the hands of employee also. Neither deduction allowed in the hands of employer nor taxable in the hands of employee. It is exempted in the hands of employee under section 10 subsection 10 CC. Okay, chalo. With this, done with the topic called as section 40 small a series. Once again, please follow. I am the person in India. I want to pay the amount to non-resident. Then compulsory I need to deduct and I need to remit to government within the due date specified under section 139(1). Otherwise, 100% disallowed. Next point, I am a person in India. I am making payment to resident. Then compulsory I need to deduct, I need to remit tax to the government. If not, 30% disallowed. But some relaxation is also there. The relaxation is nothing but payee has to file the return, payee has to offer the income, and payee has to pay tax on that. Okay, whatever the total amount I paid without deduction of tax, no, on that amount payee has to do at his end. In this case, in the hands of payer, answer deduction will be allowed, but payer has to obtain CA certificate. Next one, direct tax payments not allowed as deduction. Next one, another point, whatever amount payable by organization to government without deduction of TDS, without remittance of TDS to state government, not allowed as deduction. And last another topic is nothing but tax paid voluntarily by the employer on non-monetary perquisites, that is also not allowed as deduction. Okay, chalo, with this we done with the topic section 40 small a. Now I would like to cover section 40 small b. You know what? That is nothing but interest, salary or remuneration, commission, anything paid by the firm to partners. I repeat, paid by the firm to the partners. Take it for granted, in the hands of firm it will be allowed as deduction subject to 40 small b, but in the hands of partners it is pakka taxable. I repeat, in the hands of firm it will be allowed as deduction, but in the hands of partners it is pakka taxable. See the point, friends. Partners can receive the following benefits from the firm. Number 1, interest. Yes, taxable on that PGPB. Number 2, remuneration, etc., taxable on that PGPB. Number 3, share of profit. Share of profit anyhow exempt. Don't confuse. Interest is separate payment and the salary remuneration also separate payment, whereas share of profit separate payment. Interest is nothing but on capital contribution you will get taxable, whereas salary remuneration you will get for your extra work done in the firm. These two are pakka taxable, whereas share of profit, no, firm will pay the tax. I repeat, firm will pay the tax. Balance amount will be distributed to partners. Therefore, whatever the share of profit is received, that is after payment of tax by the firm only. Therefore, the share of profit from the partnership firm is exempted under section 10 subsection 2a. Okay, chalo. Next one. How much is the remuneration? How much is the interest allowed? That is section 40 small b. That is the question. Very simple, friends. Please follow. Interest to partners will be allowed as deduction subject to following condition. Condition number 1, all of you, deed must be authorized. I repeat, deed should not be silent. Deed must authorize the payment. If deed authorized, then only it is allowed. The two, friends, the maximum interest is 12% per annum. That is simple rate of interest. Some students may get the doubt, sir, we heard in CA foundation that is 6% kada. Yes, that is as for partnership firm act, but now I am talking about income tax act, that is 12%. So for your information, friend, now deed must authorize the payment of interest. That too, that interest must be pertaining to the period after execution of deed. I repeat, you should not pay the interest prior to execution of deed. Deed must authorize. That is the reason. Afterwards, any time you can pay. That too, maximum 12% per annum you can pay. I repeat, maximum 12% per annum. That too, simple rate of interest only you can pay. Okay, chalo. That's all. Which partner? Answer, all partners. Individual? Yes. Other than individual partners? Yes. Companies? Yes. Everybody can take interest on their capital, but maximum interest is 12%. That's all. Okay, chalo. Next one, friends. Remuneration to partners, it is allowed or not allowed? Answer, remuneration to partners also allowed. Same condition, deed must authorize the same. That too, the period must be pertaining to after execution of deed. But only one change, working partner only can take the remuneration. I repeat, working partner, that too, individual partners only can take, because individual only can do the work. That too, working partner only can do the take the salary. Therefore, only individual partners only can allowed. Full-time partners only can take remuneration. That too, maximum remuneration how much? That is the question. Answer, in case of book profit, in case of first 3 lakh of book profit, or in case of loss of the firm, suppose firm in losses, in this case 1,50,000 or 90% of book profit, whichever is higher can be taken. I repeat, 1,50,000 or 90% of book profit, whichever is higher. That means suppose firm in losses, then also 1,50,000 or 0, whichever is higher, means at least 1,50,000. Next one, in case of balance book profits, over and above 3 lakh book profits, 60% of book profit will be allowed. That's all. Babu Raja, this is the higher amount of remuneration is permissible for entire firm, that too per annum. This remuneration or whatever the remuneration specified in the deed, whichever is lower only allowed. I repeat, whatever the remuneration specified here or specified in the deed, whichever is lower only allowed. In case of first 3 lakh, now that is 1,50,000 or 90%, whichever is higher. Whereas balance, no, 60% of book profit only allowed. That's all. Babu, even in case of losses also, partners are eligible for remuneration by way of 1,50,000, because in case of first 3 lakh or loss also, you can take minimum 1,50,000 or 90%, whichever is higher. Babu, one more point here. The share income from partnership firm is exempted, but whatever the interest remuneration you received, it is pakka taxable under the head PGPB. Next one, friends, if all the conditions are satisfied, like that is deed must be authorized the same, that too the payment must be pertaining to after execution of deed and maximum permissible amount. If all the conditions are satisfied, then only it will be allowed as deduction. Here section 184 is given. Friends, section 184 is nothing but these conditions only. If you satisfied these conditions, do you know what are the condition? There must be partnership form deed. That too, friends, the deed must be filed with the assessing officer. I repeat, that too the deed must be certified by all partners. Then only we will assume that that is a firm. I repeat, it is a firm or not, how do we know? It is a firm or not, how do we know? We know only if there is evidence. For evidence purpose, there must be deed. That too, in the deed, each share of partner must be defined. Each share of partner must be defined. That too, assessing officer must get the deed from the partnership firm, that too which is certified by all partners. Then only it is a firm. Whenever it is a firm, then subject to fulfillment of condition which is specified under section 40 small b, interest or remuneration will be allowed as deduction. Okay, chalo. So partners can take remuneration, interest from the partnership firm only if all the conditions are satisfied. Enough. Friends, with this we done with the topic 40 small a. After that we completed the topic section 40 capital A, 40 small b. Now it is time for section 40 capital A, subsection 2, subsection 3, subsection 7, subsection 9. First let me start section 40 capital A, subsection 2. Only one word, excess payment to relatives. I repeat, excess payment to relatives. Babu, if you make excess payment to your relatives or close associates or else specified persons, take it for granted, the extra money will be disallowed. I repeat, the extra payment will be disallowed. Okay, for example, if you pay extra money to your relative company, or else you paid extra money to your relative's partnership firm, you paid extra money to your relative only for business or profession purpose. If you pay extra money, that extra amount will be disallowed. Okay, chalo, see the conditions ma. Number one, first one, the payment in respect of expenditure only covered. That too, it has been made or is to be made to a relatives or close associates or else specified persons. That too, the payment must be unreasonable and excessive when compared to market value. In this case, the unreasonable or the excessive amount only will be disallowed. Sir, who are the specified persons? In case of individual, your relatives. That too, in case of individuals, person in whose business or profession such individual or relative of individual have substantial interest. I will take one example, Mr. X. In case of Mr. X, all the relatives. And in case of Mr. X, any organization in which Mr. X or relatives of Mr. X has substantial interest. Substantial interest means minimum 20%. That's all. Next one, friends, company. In case of company director or else relative of a directors or else company in which, organization in which such a director or relative of a director or the company has substantial interest. Substantial interest means, minimum 20% of voting power we must have. If any organization, in that organization, if company or director or relative of a director has substantial interest, then also it is covered. Last kind of thing, that is firm. In case of firm, every partner or relative of a partner or organization in which such partner or relative of a partner or else that other persons are having substantial interest, in this case they are eligible for specified person category. If you make payment extra to these specified persons, the extra money will be disallowed. Here relative include spouse, brother, sister, or any lineal descendant and descendant. Only these persons are only covered. Your spouse, your brother, your sister, or any lineal ascendant and descendant. One warning: your sister, your spouse, your brother, these are only covered. Your sister's brother and sisters not covered. I repeat once again: your spouse only covered, but your spouse, brother and sisters are not covered. So excess payment made to your bill, brother-in-law, means your spouse relatives, that is not disallowed, because your relative definition is very very clear. Okay, chalo. Next one, friends, if you pay extra money, the extra amount only will be disallowed under section 40 capital A subsection 2. Next one, very 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 important topic, section 40 capital A subsection 3. Babu, this is nothing but cash payment exceeding 10,000. I repeat, cash payment exceeding 10,000. In case of any business expenditure more than 10,000, it must be paid by way of account pay check or account pay draft or ECS. If anybody paid more than 10,000, anybody paid by other than account pay check, by other than account pay draft, or other than ECS, take it for granted 100% of such amount will be disallowed. So here and onwards, remember, if the payment is more than 10,000, compulsory you have to pay by account pay check or account pay draft or ECS. Otherwise, take it for granted, entire amount will be disallowed. Okay, chalo. But no doubt, some relaxations ma. These payments, even though you made more than 10,000 by way of cash, it is allowed. Number one, payment made to bank. Sir, I can make the payment to banks, no problem. That too, payment made through debit card or credit card, or else what you call any letter of credit or TT transfer, telegraphic transfer, debit, credit cards, all the things are covered. Next one, friends, third point, where the payment of compensation paid as a final settlement to terminated employee or retired employee does not exceed 50,000. I hope you know, some employees, watchmen, or else office boys, once they retired, compulsory we need to pay final settlement. If the amount does not exceed 50,000 per annum, no problem. So you can make by cash. Next one, friends, where payment made to government. Sometimes government asks you to pay in cash only. No option. We will pay, no disallowance. Next one, payment made by adjustment. Once you make the payment through adjustments, book entries, no problem. Next one, where the payment is made for purchase of agricultural produce or forest produce, or else for the animal husbandry, that is dairy farms, or else for fisheries, or else for horticulture and apiculture, it is allowed. Only these categories only covered: agriculture purpose or forest purpose, produce purpose, and next one dairy farm purpose, and another thing is called as poultry and fisheries, and next one is horticulture. These are only covered. And next one, friends, if you make any payment to cottage industries, that is also covered. Next one, friends, where the payment is made in a place where bank facility not there. I repeat, certain villages even today also bank facility is not there, that is also allowed. Next one, if employee working on site, some employees working on site, that too for a period more than 15 days, in this case you can pay by account pay check or account pay draft. If not possible, you can pay by cash also, no problem, because they are working on site. That too, in that site maybe bank facility not there, you can pay by cash also, but after deducting tax at source. And last but one, you can make payment to agents. Certain cases collection agents will come and collect, so no problem, you can pay. Next one, payment made to money exchanger or authorized dealer, also you can make by cash. These are the exceptions. Next one, friends, this provision is applicable for all category expenditure, all expenses which are covered under section 30 to 38. Whatever the expenditure you can make by account pay check, account pay draft, or ECS, if the payment is more than 10,000. Next one, friends, depreciation also allowed. If the asset value is more than 10,000, depreciation also allowed, provided if it is paid by account pay check or account pay draft or ECS. Otherwise, depreciation also will not be allowed. You know why? It will not be added to block of assets. Automatically depreciation will not be allowed. Next one, friends, these are only covered with respect to business expenditure only. Okay, first business expenditure 30 to 38, if you make by account pay check or account pay draft or ECS, it is allowed. If it is more than 10,000, that too you paid by other than account pay check or other than account pay draft or other than ECS, 100% of such amount will be disallowed. In subsequent period also it is not allowed. Okay. Next, 41, deemed business income. I repeat, deemed business income. Friends, here so many points are there, important topic. Number one, recovery of deductions or recovery of certain amounts or recovery of certain tax dues. Whatever we paid earlier, we recovered the same. In that case, it is taxable. For example, GST I paid. No doubt, payment of GST will be allowed as deduction. Let us say I paid 10 crore rupees in the year 2024-25. Now I am in the year 26-27. In this year, what happened? Government of India returned my amount, refunded my amount 2 crore. So indirectly I paid 10 crore, but I got refund of 2 crore, net amount to be 8 crore only. But really what happened? I already taken the deduction of 10 crore. Therefore, 2 crore will be taken as a P&L credit. So recovery of tax payments, or else whatever the deduction I took earlier, subsequently reversed. In all the cases, that will be treated as deemed business income. I would like to take some examples, please follow. So mine is a construction company. So many workers are there in my company. I need to pay 10 lakh rupees wages. I repeat, I need to pay 10 lakh wages. But what happened? These workers left to their hometown during Corona season and they never come back. And I inquired, their addresses and their information not available. Oh, when you are unable to take back the persons, what happened? Now we will already take P&L debit on mercantile basis. But really you have not paid, right? You have not paid. So therefore, you have to reverse the same. Okay, reverse the same. Reverse means earlier you have taken as a debit. Now you have to take as a credit. The credit is nothing but income. That is nothing but occasionally you will generate these kind of incomes. That is the reason it is called as deemed business income. Number one, where deduction already claimed and subsequently recovered or reversed, then it is called as deemed business income. Deemed business income. And second one, balance charge. This to be covered in capital gain chapter. Third one is nothing but sale of assets. Sale of assets related to R&D, that already we covered under section 35. Next one, recovery of bad debts. Very, very, very important. Once upon a time, I sold on credit basis. Then I will take it as a P&L credit. That means I already paid the tax on that. But subsequently what happened? The person not paid my amount back. That is the reason I will take it as a bad debts. Okay. So credit and bad debts, debit, both will get knock off. But today I got the amount back. I received the amount back. Then I have to take it as a, what you call, bad debts recovered as a income. I have to take it. So when there is a recovery of bad debts, the recovery of bad debts is taxable as a income, but not regular income. Therefore, it is called as deemed business income. Okay. Next one, friends. In case of deemed business income, the income can be adjusted out of discontinued business losses. Whatever the discontinued business losses are there, out of that deemed business income also you can adjust even after expiry of 8 years also. Okay, chalo, that is one good news, take it. And next one, very, very important one, last topic of this particular series, 43B, very, very, very important. Certain expenditure will be allowed as deduction on payment basis. If you pay, then only deduction will be allowed. Only these items. Babu, in case of business or profession, you can follow mercantile or cash basis. Any basis you can follow. But in the following cases, only on payment basis only it is allowed. Number one, any tax. I repeat, any tax or duty or cess fees payable to government. So first one is called as tax, will be allowed as deduction on payment basis. Second one, friends, employer contribution to employee welfare fund. I repeat, employer contribution to employee welfare fund, that is also allowed as deduction on payment basis. Bonus and commission payable to employees, that is also allowed as deduction on payment basis. And next one, friends, any interest payable to banks. I repeat, any interest payable to banks, that is also allowed as deduction on payment basis. And the next one friends, any sum paid by the SSE as an employer in lieu of leave salary, that is leave salary is also allowed as deduction on payment basis. Last one, any amount paid by the SSE to Indian Railway for usage of railway assets, that is also on payment basis. See this one is tax. Next one is called as bonus and commission. Next one, employees purpose leave salary. Next one, banks purpose interest. Next one, government point of view, railway usage purpose, assets usage purpose, amount to railways. All the things apart from this, employer contribution to employee welfare fund, all these are allowed as deduction on payment basis only. That too, it must be paid within the due date specified under section 139 subsection 1. If you make the payment after 139 due date, sorry, it is not at all allowed in the current year. No doubt it will be allowed in the subsequent period. Only these items, even though you followed mercantile or even though you followed cash basis, it is immaterial. These expenses will be allowed on cash basis only, even though you are following mercantile method of accounting. Number 1, tax. Number 2, bonus. Number 3, leave salary. Number next, interest payable to banks only, not others. Number next, what do you call, railway assets used no for that purpose, railway charges. And number next, employer contribution to employee welfare fund, all will be allowed as deduction only on payment basis. That too you have to pay the same within the due date specified under section 139 subsection 1. If you pay afterwards, after the particular due date, it is not allowed as deduction in the current year, but it is allowed as deduction in the subsequent period. Okay, chalo. But here some case laws are there, or some special points are there. You know what? Number 1, outstanding interest converted into loan amount. Sorry, it is not allowed as deduction. The reason, there must be clear outflow. I repeat, there must be clear outflow. Then only it is allowed as deduction. But if you convert outstanding interest into loan amount, sorry, it is not at all allowed as deduction. Number 1. Number 2, employer contribution to employee welfare fund is only covered under section 43B. I repeat, employer contribution to employee welfare fund is only covered under section 43B. That's all. But employee contribution to employee welfare fund is not covered under section 43B. That is after all covered with respect to payment basis only, but it must be paid within the due date specified in the respective act. But whereas employer contribution to employee welfare fund, it is allowed on payment basis. That too you have to pay within the due date specified under section 139(1). And last point here, some state governments, what they will do, they will convert the outstanding sales tax liability into loan amount, then it is allowed. I repeat, state government intentionally converted outstanding sales tax amount into loan amount, that is allowed. But banks converted outstanding interest into loan amount, that is not at all allowed. Okay, chalo babu, it must be paid within the due date specified under section 139 subsection 1. Then only it is allowed as deduction. If you pay afterwards, it is not allowed as deduction in the current year, but it is allowed as deduction in the subsequent period. Okay, chalo, that's all. And another topic friends, section 43 CA, this is same as section number 50. I love you. This is same as section number 50 capital C. Section 50 capital C and section 43 CA, both are one and the same. These points we are going to cover in the chapter called as capital gains. Okay, in order to avoid duplication, I wanted to cover this topic in the chapter called as capital gain itself. Okay friends, with this we done with the topic section 40 series. 40 small a completed, section 40 small b completed, section 40 capital A subsection 2 completed, subsection 3 also completed, and section 41 deemed business income completed, and section 43b also completed. Okay, so these are the topics which are relevant for examination. Okay, thank you very much friends. Now we are going to start the last part of PGPB, that is nothing but section 44AA, 44AB and 44AD and 44ADA as well as 44AE. These topics we are going to cover right now. First, I would like to start the topic section 44AA, that is nothing but maintenance of books of accounts. Friends, here first one, section 44AA subsection 1, notified professionals. I repeat, notified professionals. Chartered accountant, cost accountant and company secretary, as well as advocates. Next one, film actress and film actors and sports person, engineers, interior decorators and medical practitioners like doctors. These persons are notified as a specified professionals. In case of specified professionals, we need to check the turnover. If the turnover of the persons exceeds 1,50,000 rupees during last 3 years, I repeat, during last 3 years, their turnover exceeds 1,50,000 during last 3 years, excluding this current year. During last 3 years, it must exceed 1.5. In this case, that persons are required to maintain books of accounts. What are the books? Number one, journal you have to maintain, and cash book you have to maintain, and after that carbon copies of the bills. If the bill exceeding 25 rupees you have to maintain, and original bills you have to maintain if the value is more than 50 rupees. And the next one is in case of medical practitioners, compulsory you have to maintain two separate books. One is called as daily case register, second one is called as inventory register you have to maintain. Sir, these books must be maintained by the doctors only, these two extra books. Rest of the books all specified professionals has to maintain. Cash book as well as journals and ledgers, as well as carbon copies of bills exceeding 25 and original bills in case of it is exceeding 50 rupees. That's all. And one more thing, friends, last 3 years we need to check. During last 3 years, if their turnover exceeds, if gross receipts exceeds 1,50,000 in all 3 years, or else likely to exceed in the current year also. For example, Vijay Devarakonda last 3 years is gross receipts more than obviously 1.5 above, 1.5 above, 1.5 above. Therefore, Vijay Devarakonda has to maintain all these books. For example, in the current year also, if Vijay Devarakonda amount is likely to exceed 1.5 in case of new business, for example budding hero, in this case the person compulsory has to maintain all these books. In the present year itself is gross receipts likely to exceed 1.5 lakhs. Okay, chalo. Next one, friends, next topic, that is nothing but all other professionals. All other professionals and all other business persons and all other points that we are going to cover under section 44AA subsection 2. 44AA subsection 1 only for specified professionals. Other than specified professionals covered under 44AA subsection 2. All. Okay, one by one we will discuss. First one is called as individuals and HUF. In case of individual and HUF, if their business income, I repeat, if their business income or professional income exceeds 2,50,000 in any one of the 3 years, I repeat, out of 3 years, in any one of the year, if their business income or professional income exceeds 2,50,000 in at least 1 year out of 3 years, last 3 years, compulsory they have to maintain such books which enable the assessing officer to compute this tax liability. For example, myself individual, suppose I am a teacher, so I am not a specified professional. I covered under 44AA subsection 2. Now my last 3 years incomes are as follows. First year income is 2.4, another year income is 2 lakh only, another year income is 2.8. Sir, at least 1 year income is more than 2,50,000, then compulsory I need to maintain such books which enable the assessing officer to compute the tax. But in case of newly set up business or profession, already you know, if the income is likely to exceed, I repeat, if the income is likely to exceed 2,50,000 in the current year itself, compulsory I need to maintain such books which enable the assessing officer to compute the tax. That's all. Okay, next one, friends, turnover criteria in case of individual and HUF. So far I told you income base. Income exceeds 2,50,000 I told you. In now I am talking about turnover. Babu, in case of individual HUF, whose turnover, business turnover or professional gross receipts exceeds 25 lakh, at least any 1 year out of last 3 years. Same answer. Out of at least 1 year during last 3 years exceeds turnover 25 lakhs, they have to maintain such books which enable the assessing officer to compute the tax liability. Suppose likely to exceed, also same answer. Likely to exceed 25 lakh, in this case also they have to maintain such books which enable the assessing officer to compute its tax liability. Now friends, others. In case of others, take it for granted if their business or professional income exceeds 1,20,000, 1,20,000 out of last 3 years, at least 1 year it must exceed 1,20,000. In this case, take it for granted friends, they have to maintain such books which enable the assessing officer to compute the tax liability. Okay, chalo. Next one friends, another topic. In case of other than individual and HUF, turnover base is concerned, if their business turnover or professional gross receipts exceeds 10 lakh in out of 1 year during last 3 years exceeds 10 lakh, compulsory they have to maintain such books which enable the assessing officer to compute the tax liability. Friends, not only exceeds, here another point is there likely to exceed. Even in case of likely to exceed these amounts, then also they have to maintain such books of accounts without any fail. Okay, chalo. Sir, whatever the points I specified right now, compulsory they have to maintain books of accounts, no doubt. For example, if their amounts are not exceeding these points, I told you, in case of individual HUF, it must be more than 1 lakh, 2,50,000. In case of other than individual and HUF, their income must exceed at least 1,20,000. And in case of individual and HUF, business turnover must exceed 25 lakhs. In case of other than individual and HUF, at least their turnover exceeds 10 lakh. I told you, right? Suppose if it is not exceeding these limits, then they no need to maintain any books of accounts. They no need to maintain any books of accounts. Okay, chalo. Next point friends, another point, last point, please follow. Number next, 44AA. Okay, chalo. Friends, in case of 44AA, please follow this answer. Now, those persons covered under section 44AE, but they offered lower income than the presumptive income. I repeat, they offered lower income than the presumptive income. Or else certain persons covered under section 44 AD series, but who are not entertained to follow section 44 AD provisions. In this case also, they are required to maintain books of accounts which enable the assessing officer to compute the tax. Okay, this is the special points. I repeat once again, those persons who are covered under section 44 AE, but they offer lower income than the presumptive income. In that case, the person has to maintain those books which enable the assessing officer to compute the tax. And same way friends, some SSCs are not eligible to claim the benefit of section 44 AD subsection 1. They cannot claim. In this case, the persons also required to maintain the books of accounts which enable the assessing officer to compute the tax. Next one friends, compulsory you have to keep the books of accounts in the place of business or place of profession without fail. Okay, chalo. Next one, maximum you have to maintain the books of accounts for 6 assessment years for sure. Okay, minimum 6 assessment years you have to maintain these books of accounts. That's all friends. With this, we're done with the topic called as section 44 AA. Now it is time for section 44 AB, that is nothing but tax audit. A for audit, B for books, audit of books. But it is not company audit, it is not cost audit, it is nothing but tax audit. Please follow friends, section 44 AA, tax audit. Sir, limits for tax audit. Number 1, here I can classify into 3 categories. One is business SSC, one is professional SSCs, one is specified SSCs. One by one follow friends. First one is professional SSCs. Very simple, whose gross turnover exceeds or gross receipts exceeds 50 lakh during the previous year. If any chartered accountant or any film actor or anybody whose professional gross receipts exceeds 50 lakhs, compulsory their books must be audited by the practicing chartered accountant. That's all. But whereas in case of business SSCs, their turnover or gross receipts must exceed 1 crore rupees. I repeat, must exceed 1 crore. In this case, audit compulsory. But subject to certain other points, 10 crore limit is also applicable. In some cases, 10 crore is the limit. When 1 crore, when 10 crore, I let you know in couple of minutes. Next one, last but one, that is nothing but SSE who covered under section 44 ADA and who offered lower income than the presumptive income. I repeat, who offered lower income than the presumptive income, but their income is more than basic exemption limit. In this case, that persons are required to get their books audited. Same way, SSE covered under section 44 AD subsection 4 and their income is more than basic exemption limit. In this case also, the persons are required to get their books audited. Next one, friends, applicability of audit. Applicability of audit just now I covered. So that is business turnover exceeds 1 crore. In some cases that is 10 crore. Whereas in case of professional it exceeds 50 lakh. In case of specified SC's case, those persons who are covered under section 44 ADA presumptive income, but they offered lower income than the presumptive income but higher than the basic exemption limit, then they have to books must be audited. Same way, in case of SSE covered under section 44 AD subsection 4 also same answer. Okay, chalo. Friends, here the points are as follows. For audit purpose, the deadline is 1 month prior to due date for filing of return of income. Friends, in case of audit, no, we need to file return of income on or before 31st October. Exactly 1 month before means that is nothing but 30th September. Sir, the specified date for uploading audit report is nothing but September 30th. Okay, chalo. These SSCs are required to get their books audited by chartered accountant in practice. And next one, audit report must be given in form number 3CA, 3CD as well as 3CB. That's all. And one more thing, friends, in some cases turnover for business people is 1 crore. In some other cases that is 10 crore. When that is 10 crore, when that is 1 crore, I would like to cover right now. Follow. In case of business SC, the threshold limit is 1 crore, but it is increased to 10 crore only subject to fulfillment of two conditions. Condition number 1, their aggregate receipts, I repeat, their aggregate receipts in cash during the previous year does not exceed 5% of such receipts. I repeat, out of their total receipts, their cash receipts does not exceed, I repeat, out of their total receipts, their aggregate cash receipts does not exceed 5%. Same way, friends, out of their total payments, aggregate payments does not exceed 5%. I repeat, aggregate of all payments does not exceed 5% out of total payments. If these two conditions are satisfied, take it for granted the person's business turnover limit for audit is not 1 crore, that extended to 10 crores. Okay, chalo. Next one, friends, other points, non-applicability of audit. Friends, follow. SSE who wanted to go for 44 AD presumptive income, then not applicable. Common sense, in case of presumptive taxation audits not applicable. And the same way, those persons who are covered under presumptive income under section 44B, 44BB audit not applicable. Next one, friends, if any person not get their books audited, then penalty must be paid like that, whichever is lower. How much, you know? That is nothing but 0.5% of turnover or else 1,50,000, whichever is lower. I repeat, 0.5% or else 1,50,000, whichever is lower, they must pay as a penalty. Okay, chalo. Friends, this is the topic 44AB. And last topic of its kind, friends, that is nothing but 44AD, 44ADA as well as 44AE. These are nothing but presumptive taxation. Please follow, friends. 44AD is applicable for only resident individual, resident HEF, resident partnership firm. I repeat, only applicable for individual HEF partnership firm but not LLP also. But eligible business, friends, any business they can do, but not, I repeat, but not provision. Only they can carry any business. That too, friends, they should not carry any business covered under 44AE because 44AE separate section is there, no? Therefore, other than 44AE business they can do. Next one, friends, any person carrying commission business, they are not covered under 44AD series. Suppose if you are having business of commission or brokerage, sorry, you cannot follow 44AD section. And same way, any person carrying agency business also cannot claim presumptive taxation provision under section 44 AD. And one more thing, if you want to claim 44 AD, your turnover does not exceed 2 crores. I repeat, the turnover limit does not exceed 2 crore. The two friends, your presumptive income is nothing but minimum 8%. 8% of gross receipts or else actual income, whichever is higher. But friends, in case of gross receipts, if received only by way of account pay check or account pay draft or ECS, take it for granted, then presumptive income is not 8%, presumptive income is only 6%. Because your turnover is only by way of account pay check or account pay draft or ECS, to that extent, that is 6% only to be calculated as a presumptive income. Suppose if SSE has both the turnover, like a cash turnover as well as bank turnover, in this case on the bank turnover only 6% is the presumptive income, whereas other than bank turnover, other than account pay check or account pay draft or ECS, on the balance amount 8% is the presumptive income. And next one friends, 44 ADA, that is professionals friends, only professionals, the two specified professionals. Resident individuals covered and a partnership firm only covered, LLP not covered. So only specified professions only covered. In this case, their gross receipts does not exceed 50 lakh. In this case, 50% of their receipts or else higher income, whichever is higher is only taxable. Minimum 50% they have to offer. Okay, chalo. And the last one friends, section 44 AE, that is nothing but SSE engaged in the transport business, transportation of goods or hiring of vehicle, etc. In this case, all SSEs are covered. The two SC engaged in the business of playing, hiring, leasing of vehicles. In this case, SSE does not own more than 10 vehicles. I repeat, SSE does not own more than 10 vehicles at any point of time out of 365 days. Out of 365 days, at any point of time, his number of vehicles does not exceed 10. In this case, heavy vehicle norm per ton 1000 rupees for gross weight 1000 rupees must be taken. Whereas in case of other than heavy vehicle, 7500 per ton, sorry, 7500 per vehicle per month shall be considered as a presumptive income. Okay, chalo. Here friends, heavy vehicles means where the gross vehicle weight exceeding 12 tons, obviously that is heavy vehicle. Next one friends, common points to be considered under 44 AD, 44 ADA, 44 AE. If SSE declare lower income than the presumptive income, then compulsory has to go for audit and his books must be maintained under 44 AA and he has to go for books audited under 44 AB sections. Okay, chalo. And one more thing friends, in case of partnership firm, I repeat, in case of partnership firm, do you know salary or remuneration paid by the firm to partners allowed as deduction under 40 small b. Babu, take it for granted, this 40 small b, that is expenditure not allowed, deemed to be allowed under section 44 AD, whereas section 44 ADA, that means 44 AD, that is any business, eligible business, 44 ADA specified provisions. In the two cases, if partnership firm wanted to adopt presumptive taxation, all expenses are deemed to be allowed, including 40B also. Section 40B amount also deemed to be allowed. That means separately not at all allowed. Okay, separately not allowed because section 40 small b, that is interest, remuneration, etc. deemed to be allowed. Okay, chalo. But this rule is not applicable for 44 AE. So in case of 44 AE, if it is a partnership firm, further deduction may be allowed out of presumptive income with respect to interest, remuneration, etc. paid by the firm to partners. Next one friends, expenses generally not allowed in case of presumptive taxation under section 30 to 38. Expenses are not allowed because deemed to be allowed. Already we have taken, then only net income is the presumptive income. Next one friends, deduction under chapter 6A anyhow allowed, that is normal allowed. And in case of 44 AD and 44 ADA, SSC has to pay advance tax. I repeat, 44 AD and 44 ADA, SSC has to pay advance tax only in one installment, that is a final installment. Okay, final installment he has to pay advance tax, that too on or before 15th March of the year. Okay, last and final installment. Next one, friends, SSC can claim profits and gains from the business lower than the presumptive income. In this case, he has to go for audit and he has to maintain the books of accounts. He has to maintain books of accounts under section 44 AA and he has to go for audit under section 44 AB. Okay, chalo. Friends, with this, we done with the topic called as PGPB chapter. Very, very, very important chapter, deciding chapter. I would like to clarify like that. First one, section 28 is the charging section, 29 is the computation, 30 to 38 is the expenditure, section 40 series is the disallowance, section 41 is the presumptive deemed income, and 44 series special provisions, 44 AA books of accounts, 44 AB audit, whereas 44 AD as well as 44 ADA as well as 44 AE, 44 AD presumptive income, 44 ADA what you call provisionals, 44 AE is nothing but the SSC who is engaged in the transportation or leasing and hiring of vehicles. Sir, very, very, very important chapter. Out of this chapter, one practical question pakka we can expect out of this chapter. A category chapter, most important chapter, lengthy chapter. So out of this, problematic question they will ask for sure. Okay, so please do practice while solving the total income problems. One point compulsorily they will ask, like depreciation topic, section 35 topic, and section 43B topic, and section 41 topic. These topics compulsory they will cover in the examination. Okay, sir, please take care of this chapter. Please revise this chapter n number of times. Okay, thank you very much. Friends, in today's lecture I am going to start the topic income from the head capital gains. Very important chapter, A category chapter for exam point of view is concerned. Out of this chapter we can expect one practical question. Friends, in fact there are total 5 heads. First one is salary, next one is house property, next one is PGPB, next one is capital gain, last one is other sources. Friends, out of 5 heads, all the heads incomes are nothing but revenue in nature. But for your info, in case of capital gains, the income is not in revenue nature, not in recurring nature. It is in capital nature. Generally, capital receipts are not taxable. Generally, unless otherwise provided, capital receipts are not taxable. But for the first time, capital receipts are taxable under one particular head. The head is called as capital gains. Friends, in this chapter, we are going to start with the basic concept, that is charging section first. What is the charging section? Charging section, section 45. Friends, profits or gain arising on transfer of capital asset is taxable under that capital gain. I repeat, profit or gain arising on transfer of capital gains is taxable under that capital gains. So, number one, there must be a transfer. That too, there must be a capital asset. That too, profit or gain arising on transfer of such capital asset is taxable under the head capital gains. That means, ma'am, I need to purchase one capital asset for example 10 lakh rupees, but the same capital asset I sold for 15 lakh. Sir, sale consideration 15 lakh, whereas purchase price is 10 lakh, that is nothing but 5 lakh is the profit. The 5 lakh profit is taxable under that capital gains. Friends, here capital asset definition is as follows. Capital asset includes, capital asset excludes. Capital asset includes every kind of property. I repeat, every kind of property. Maybe movable, yes. Maybe immobile, yes. Maybe tangible, yes. Maybe intangibles, yes. Maybe all of you depreciable or else non-depreciable, all are covered. See the word, any kind of property, whether movable or immobile, whether tangible or intangible, whether related to business or personal. So see the words, ma. Now movable or immobile, tangible or intangible, next one depreciable, non-depreciable, next one is called as business related or personal related, everything is covered. So every kind of property is covered And also friends, securities held by FII. I repeat, securities held by FII. FII means that is foreign institutional investors. Take it for granted, whenever shares owned by FIIs, that is nothing but capital asset only. Irrespective of the holding period, whatever the assets, whatever the shares held by FII is always covered under the category called as capital asset. Next one friends, ULIPs. Now amendment ma'am, ULIPs also covered under the category of capital asset. So whatever the ULIPs issued on or after 1/2/2021 to which exemption under section 1010D not applicable, that ULIPs are also covered under the definition of capital assets. Babu, but these are not capital asset. You know what? Number one, stock in trade. Sir, which is meant for resale, that is not a capital asset. Best example I will tell you, JBR Real Estate in Hyderabad, what they will do, they will buy the land, they will construct the buildings. So many buildings they constructed for the purpose of resale. That is called as stock in trade. Sorry, that is not a capital asset, therefore not taxed on that capital gains. Next one, personal assets. Sir, those assets which are mobile, that too we have personal interest. Repeat, number one mobile, number two personal interest. Whenever it is mobile and we have personal interest, that is also called as personal asset. That is not a capital asset, not taxable. Next one friends, agricultural land situated in India. Sir, agricultural land situated in India, that too rural agricultural land, that is not a capital asset. I repeat, rural agricultural land not a capital asset, therefore not taxable. Next one, special bonds, specified gold bonds or special bearer bonds, all the gold monetization bonds, these are also not a capital assets. Okay, so any bonds which are notified by the central government with respect to particular notification is concerned, that is also not a capital asset. So friends, these are not a capital asset. Number one, stock in trade is not a capital asset, personal assets are not a capital asset, rural agricultural land is not a capital asset, and bearer bonds or else any particular gold monetization bonds, these are not a capital asset. For your information, it is taxable in the year of transfer. I repeat, it is taxable in the year of transfer. The year in which you did the transfer, that year only it is taxable. Babu, amount received or not received, that is not relevant. Only relevant is if the assets are transferred, automatically tax liability will be triggered. Okay, chalo. Next one, some exceptions are there for this rule, that anyhow we will discuss after some time. There are 4 exceptions. In the 4 cases, take it for granted, it is not taxable in the year of transfer, it is taxable in the year in which the amount is received. I repeat, in 4 cases only it is taxable the year in which the capital gain amount is actually received. So I can say only on receipt basis only it is taxable in 4 cases. In rest of the cases, even though money received or not received, it is immaterial, it is taxable in the year of chargeability is nothing but in the year of transfer. Okay, chalo. So next one, I told you already, personal effects means movable assets which are used for personal purpose of the SSC or else his family members, but excludes jewelry. Jewelry is not a personal effects. Same way, archaeological collections are also not covered. Drawings, paintings, sculptures, any work of art, these are also not covered in the personal effect definition. Therefore, these are come under capital asset. Next one friends, this is the specified area given for the definition of capital gains purpose. Only this definition is given with respect to agricultural land is concerned. I would like to tell you one word, urban agricultural land is a capital asset, but a rural agricultural land is not a capital asset. Sale of urban agricultural land is always taxable. Sale of rural agricultural land, that too in India, that is always not a capital asset, not taxable. Next point friends, transfer definition. Section 2 subsection 47, transfer definition. Transfer includes sale, exchange, relinquishment, extinguishment, compulsory acquisition by the government of India or particular state government, or redemption of zero coupon bond, or else transfer of any property as per the provisions of section 53A of Transfer of Property Act. And next one, conversion of capital asset into stock in trade. This is the definition of transfer includes, whereas transfer excludes. There are so many points. First we need to cover transfer include. Sale means consideration received in the form of cash or anything, and in return we transfer the asset, that is called as sale. In case of sale, capital gain will arise. Next one is called as other point, exchange, barter system. I will give my capital asset. In return, I will take a consideration in the form of kind. I will take gold or something. That is also called as exchange. That is covered under the definition of transfer. So it is taxable. Next one, relinquishment. Relinquishment, that is foregoing a right. Foregoing a right. For your information, redemption of preference shares. I repeat, in case of redemption of preference shares, I am foregoing my right. That is nothing but relinquishment. Odulukovatam. So extinguishment of any asset. Same way, extinguishment is also is a transfer. Therefore, it is pakka taxable. Next one, compulsory acquisition of capital asset. Now in Hyderabad, for metro purpose, L&T has taken over the land of private parties. Yes, with the government approval, they have taken the land of private parties. That is also come under compulsory acquisition of capital asset. That is also covered. Next one, last one, that is called as redemption of zero coupon bond. In case of redemption of zero coupon bonds, that is also taxable. Next one, already this point we covered. Section 53 of Transfer of Property Act, that is also come under transfer definition. Next one, conversion of stock in trade into capital asset is taxable under that PGPB, but conversion of capital asset into stock in trade, conversion of stock in trade into capital asset is taxable under that PGPB, whereas conversion of capital asset into stock in trade, that is covered under the head capital gain chapter. Okay, chalo. So friends, now let's start the topic that is called as includes. Babu, transfer includes so many things, one after one. Number one, if you transfer by way of sale, it is taxable. If you transfer for a consideration in kind, that is also transfer. Okay, that is also taxable. So disposing or parting with an asset or any particular interest directly or indirectly, that is also covered. Sir, transfer includes, that is, foregoing the right and extinguishment of right or relinquishment of right, that is also covered. And next one, section 53 of Transfer of Property Act, that is also covered. But here conditions are there, already we covered many times. The agreement must be in written form. That too, part of the consideration must be paid. And that too, the transferee has taken over the possession of the property. If all the conditions are satisfied, then only it is covered under the category of transfer. In case of reverse mortgage, it is not a transfer. Now it is applicable for generally senior citizens. By giving their house property to the banks by way of mortgage, they will get the loan amount or some fixed income from the bank. This concept is called as reverse mortgage. In case of reverse mortgage, capital gain generally not applicable because it is covered under the category called as not a transfer. Now the following transactions are not a transfer, that is covered under section 47. Number one, total partition of HUF. I repeat, HUF partitioned. In case of partition of HUF, assets will be distributed. Sorry, it is not a transfer. Next one is called as gift, by way of gift, by way of will, or by way of irrevocable trust. Irrevocable trust, in the cases also, that is not a transfer. Suppose for your marriage you got the gift from someone else, that is also not a transfer. Next one, transfer of capital asset by holding company to its fully owned subsidiary company. Holding company to 100% subsidiary company is also not a transfer. Same way, transfer of capital asset by 100% subsidiary company to holding company, that is also not a transfer. But here only one condition, the recipient must be Indian company. Next one, transfer of capital asset by amalgamating company to amalgamated Indian company in the scheme of amalgamation. Best example, Vodafone Idea. At the time, Idea transferred some assets, Vodafone also transferred some assets to another company called as V. In this case, that is also not a transfer. And the same way, transfer of capital asset by demerged company to the resulting company. Whenever demerged and resulting company transfer the capital asset, that is also not a transfer. Next one, friends, transfer or issue of shares by a resulting company in the scheme of demerger. Sir, see this one, issue of shares by a resulting company in the course of demerger. In this case also, it is not a transfer. Okay, recently Pyramid, one company got the splitted, that is demerger took place. that is the reason they issued the new shares, that is also not a transfer. Next one, transfer of shares by a shareholder in the scheme of amalgamation, that is also not a transfer. Babu, at the time of amalgamation we need to give the old company shares to the new company, that is also not a transfer. Next one, transfer of rupee denominated bonds outside India by one non-resident to another non-resident. Sir, outside India, if one non-resident sold rupee denominated bond to other non-resident, that is not taxable. Next one, transfer of government security carrying periodic payment of interest outside India by one non-resident to another non-resident. Sir, any transaction took place between two non-resident, the two outside India, with respect to some specified assets, no capital gain will arise. Therefore, it is covered under section 47. Next one, redemption by an individual, that is sovereign's gold bonds, that is also not transfer, not taxable. Next one, friends, any transfer on conversion of bonds into shares or else debentures into shares, that is also not a transfer. Sometimes redemption of debentures into shares, that is not a transfer. For encouragement purpose, to retain the debenture holders in the company, Government of India introduced this concept. They have debentures, right? They will just convert the debentures in the form of shares, that is not a transfer. Last one, conversion of preference shares into equity shares. I repeat, redemption of preference shares for a cash is taxable, but whereas a conversion of preference shares into equity shares, that is not a transfer. Last one, transfer of capital asset under reverse mortgage. Reverse mortgage, that is applicable for senior citizens, that is also not a transfer. Sir, before beginning of this topic I told you, as for section 45, the following conditions must be satisfied. There must be capital asset, that too the capital asset must be transferred, that too there must be profit or gain. Profit or gain arising on transfer of capital asset is taxable under that capital gain. Suppose if there is no capital asset, no capital gain. Suppose there is no transfer, no capital gain. Okay, chalo. Next one, friends, computation of capital gain. If you want to compute capital gains, first you have to check what type of capital asset. Some are short term, some are long term. I repeat, in case of certain assets, 12 months is the criteria for considering as a short term capital asset. That is called as GEL, Z-E-L, GEL. In case of GEL, 12 months is the period. Z for zero cover bond. E for equity oriented mutual funds. I never told you listed, I never told you unlisted, I told you equity oriented mutual fund. L for, that is called as listed securities. I repeat, listed securities. GEL, remember GEL, Z-E-E-L, GEL. In case of GEL, if it is hold for a period less than or equivalent to 12 months, up to 12 months or less than 12 months, then that is called as short term capital asset. More than 12 months, obviously long term capital asset. Next topic, that is UI. Okay, UI, that means unlisted shares as well as immobile property like land or building or both or anyone. Immobile property, in this case 12 months is the criteria. If immobile property are unlisted shares, not securities, unlisted shares held for a period less than or equivalent to 24 months, that is short term. More than 24 months, then that is long term. Last one, any other asset. In case of any other asset other than GEL, other than UI, then 36 months is the criteria. Less than or equal to 36 months, that is short term. More than 36 months, obviously that is long term. That's all. Next one, holding period. Special points are as follows. Number one, if property acquired directly by you, then the date of purchase only must be considered for consideration of holding period. Suppose if you have received from someone else by way of gift or by way of inheritance, in this case the previous owner holding period also must be included. Suppose father given the property to the son at free of cost by way of gift. In this case, in the hands of son, the house property holding period shall be reckoned, calculated from the day when father only bought the asset. That means the previous owner holding period also shall be included. Next topic, liquidation. In case of liquidation, after subsequent to date of liquidation, the holding period shall be excluded. The reason that is a dormant stage. After liquidation, the liquidation afterwards, whatever the time period shall be excluded. Next topic, shares in amalgamated company acquired in the scheme of amalgamation. So it include the shares holding period of amalgamating company. I hope you know that is Idea. So Idea plus Vodafone amalgamated and formed another company called as V. So the V company holding period I can calculate from the day when the old companies only purchased the shares. Next one, in case of demerger, the holding period of shares of demerged company also included. Next one, in case of conversion of preference shares into equity shares, once upon a time I am a preference shareholder, but now I became equity shareholder. In this case, the preference shareholder holding period also shall be included. Next one, conversion of bonds or debentures into shares. In this case, the holding period of that bonds or debentures also shall be included. Next one, if shares are purchased in the primary market, in this case, the holding period shall be calculated from the date of allotment, not from the date of application of shares, only from the date of allotment. Next one, in case of right shares, the date shall be calculated from the date of offer of such right shares. I repeat, from the date of offer of such right shares must be considered. In case of bonus shares, from the date of allotment of bonus shares only must be considered, not original shares, only bonus shares. Next one, sweat equity shares, the same answer, from the date of allotment of sweat equity shares only must be considered. In case of cooperative society, if any flat allotted, in this case, from the date of allotment only we need to consider. In case of transfer of security by depository, demat, no. In this case, the holding period shall be calculated from the date of credit to the demat. First in first basis, FIFO basis we need to consider. Okay, that's all. If you know short-term capital asset or long-term capital asset, then only we know the computation. How to do computation? Answer, there are two types of capital asset. One is short-term capital asset, long-term capital asset. Same way, there are two types of capital gains. One is short-term, one is long-term. In case of short-term, sale consideration minus expenses on transfer, then you will get net consideration, then cost of acquisition, then cost of improvement, then you will get short-term capital gain minus exemption under section 54B, 54D, 54G, 54GA, then you will get taxable short-term capital gain. This is the way we need to do computation. Whereas in case of long-term, answer is as follows: sale consideration minus expenses on transfer, net consideration minus ICOA, not COA, ICOA, indexed cost of acquisition and indexed cost of improvement, and then you will get long-term capital gain minus exemptions under section 54, all the topics, then you will get taxable long-term capital gain. Babu, in case of depreciable asset, the computation shall be made as per section 50. You know what? Here consideration, sale consideration minus expenses on transfer, net consideration. Don't deduct cost of acquisition, don't deduct indexed cost of acquisition. You have to deduct opening WDV if any. You have to deduct cost of additions, cost of acquisition during the year. You have to deduct these two figures, then you will get taxable you have to get short-term capital gain minus exemptions under respective sections, then you will get taxable short-term capital gain. For your information, the gain arising in case of depreciable asset always short-term capital gain only. That is the reason here we have written the word short-term capital gain. Okay, chalo. Next one, full value of consideration. Babu, full value of consideration, please follow. In case of damage or destruction of capital asset, suppose my building collapsed because of tsunami or because of earthquake. In this case, answer, consideration is nothing but what? Whatever the compensation paid by the insurer, that is only the answer. See the word insurance company paid compensation. No, the insurance compensation is the full value of consideration. Next one, conversion of capital asset into stock in trade. Babu, when capital asset is converted into stock in trade, then taxable capital gain purpose full value of consideration is nothing but fair market value of the capital asset as on the date of conversion. Next one, introduction of capital asset as a capital consideration by the partnership firm or else into the to the partnership firm. In this case, answer is as follows: amount recorded in the books of accounts of the particular firm. And same way friends, distribution of capital asset at the time of dissolution under section 45(4), that is fair market value as on the date of distribution must be considered. In case of compulsory acquisition, we need to take consideration awarded by the government. Whereas in case of assets received with respect to shareholders on liquidation time, then fair market value of the assets as on the date of distribution minus deemed dividend under section 2 subsection 22 class C, because deemed dividend under section 2 subsection 22 class C is relevant for deemed dividend with respect to liquidation of companies are concerned. Next one, transfer of land or building or both as for section 50 capital C. In this case stamp duty value must be considered. Section 50 capital C applicable when the sale consideration is less than stamp duty value. In this case, stamp duty value is only taxable. Next one, in case of exchange of capital asset, I have given one capital asset, in return I have taken another capital asset. In this case, fair market value of the asset received as on the date of exchange. Whatever consideration received, fair market value of the asset as on the date of receipt must be considered. Next one, where consideration is not ascertainable, in that case Supreme Court decision afterwards amendment also made under section 50 capital D, fair market value of the asset as on the date of transfer only must be considered. In case of slum sale, the fair market value as on the date of transfer of such establishment also must be considered. So this is the topic called as full value of consideration. All are independent topics actually, but we have covered consolidatedly at one place. Next one, expenses on transfer called as transfer expenses like brokerage, commission, stamp duty, etc. will be allowed as deduction. That's all, will be allowed. Next one, COA, cost of acquisition. In case of goodwill, I repeat, in case of goodwill, if self-generated, 0. In case of goodwill which is purchased, actual cost. In case of goodwill which is purchased now before particular date, in this case also whatever the, see the word purchased either directly or through mode specified under so and so section and claimed depreciation up to the same, in this case actual cost is equal whatever the depreciation claimed up to this. This is the old provision, leave it. Next one, in case of circumstances mentioned under so and so sections, other sections otherwise, then cost to the previous owner. Generally here you can remember two special points, self-generated, in this case nil, whereas purchased, in this case actual cost. Next one, other intangible assets. In case of other intangible assets, anything self-generated 0, purchased actual cost. That's all. Next one, assets acquired by any mode specified under section 49 subsection 1 by way of gift, will, inheritance, etc., then cost to the previous owner. If cost to the previous owner is not ascertainable, then you can take fair market value as on the day on which the capital asset became the property of the previous owner. So simply you can take cost to the previous owner must be considered. If it is not known, fair market value of the asset must be considered. Next one, shares acquired in amalgamation, then is nothing but cost of shares of amalgamated company only. And shares acquired in demerger, then in this case we need to take pro rata basis. How you know? Whenever demerger took place, you will get two company shares. In this case, resulting company shares is nothing but all of you the total cost of acquisition before demerger into net worth transferred to resulting company divided by total net worth before demerger. Whereas in case of others, no demerged company shares purpose. Now answer is total cost of acquisition minus cost of acquisition of shares of resulting company. The net figure is only the answer. That net figure is the cost of shares of demerged company. Next one, specified securities are sweat equity shares. In this case, fair market value of the shares for the purpose of perquisites valuation, whatever the answer, that is the thing. Right shares. In case of right shares acquired by the shareholder directly, amount paid to company. If it is not acquired by the shareholder, he transferred to someone else. In this case, amount paid to the company plus amount paid to renouncer, that means the person who foregone the rights. Next one, that is renouncement of right. Answer 0. In case of renouncement of right, answer is 0. No question of a cost of acquisition. Next one, in case of bonus shares, if it is allotted before 1/4/2001, answer is fair market value as on 1/4/2001. If it is allotted on or after 1/4/2001, then cost of acquisition is equal to 0. Next one, friends, if shares or debentures acquired on conversion of bonds or debentures or debenture stock or deposit certificates, then answer cost of the previous asset. Next, if property acquired by way of what you call gift, for gift purpose, in this case immovable property, then we have to take stamp duty value. Movable property, we have to take the fair market value. Next one, equity shares acquired in conversion of preference shares. In this case, obviously previous asset value, that is cost of previous assets, that is nothing but preference shares. Next one, capital asset received under specified agreement as specified under section 45 subsection 5a, that is nothing but joint development agreement. In this case, full value of consideration while computing capital gain, full value of consideration only must be considered. Next one, long term capital asset being equity shares in a company on which STT paid both at the time of purchase or so and so. In this case, what is the answer? Higher of the following: actual cost or lower of fair market value of such asset and fair market value received or accruing as a result of the transfer. Out of these two, whichever is lower, that figure, or actual cost, whichever is higher. This concept is applicable with respect to long term capital asset being equity shares where STT paid either at the time of what you call purchase and at the time of transfer. Same way it is applicable for units of equity oriented mutual funds, that too STT paid at the time of transfer, that is the point. In this case, actual cost or lower of fair market value of that asset or full value of consideration. Out of these two, whichever is higher only we have to take. But in B point, lower internally we have to take the lower figure. And the last one, friends, capital asset which was used as a inventory before conversion into capital asset. In this case, fair market value as on the date of conversion of inventory must be considered. Sir, here focus points. You know, goodwill. Once upon a time, goodwill is a depreciable asset, but nowadays goodwill is a non-depreciable asset. If goodwill is in relation to business or portion, in this case depreciation once upon a time allowed. Therefore, the purchase price must be reduced by that goodwill once upon a time. Nowadays, if any goodwill related to recent past years, there is no question of depreciation. This point will not arise. Next one, in case of other assets, that is fair market value as on 1/4/2001. See the word, friends. If the assets are acquired, any asset acquired before 1/4/2001, in this case SSC has to take fair market value as on 1/4/2001, or else actual cost, whichever is higher, must be taken. But whereas if any asset acquired on or after 1/4/2001, this criteria is not applicable. Simply cost of acquisition is equal actual cost. Next one, friends, the concept of this fair market value as on 1/4/2001 not applicable to intangible assets. So this benefit is only applicable for tangible assets but not for intangible assets. Next one, friends, 49 subsection 1. I told you, no, one or two times 49 subsection 1. I told you, no, gift, will, partition of HUF and inheritance, as well as liquidation of company time, distribution of assets and irrevocable transfer that is revocable or irrevocable trust, and next one that is called as holding to subsidiary company and subsidiary to holding company, next one amalgamation time and demerged company time, whatever the transaction took place, that is covered under section 49 subsection 1. Friends, next topic, that is nothing but cost of improvement. Take it for granted, in case of cost of improvement, only tangible value additions only allowed. That too friends, whatever the tangible value additions made on or after, I repeat, on or after 1/4/2001 only allowed. If it is incurred before, sorry, not allowed. If it is related to intangible, not allowed. Only tangible only allowed. If it is intangible, it is not at all allowed. Okay, chalo. So it includes only capex, capital expenditure incurred by the SSE or previous owner for the improvement of capital asset. That too, it must be incurred on or after 1/4/2001. But cost of improvement not allowed with respect to following intangible assets: goodwill, right to manufacture, right to carry on business, not allowed. Whereas indexation benefit anyhow applicable. What is indexation benefit? Indexation facility is applicable for long-term capital asset. In case of ICOA, COA into CII in thereof transfer divided by CII in thereof purchase. Whereas ICOI is equal COI into CII in thereof transfer divided by in thereof improvement. Same way friends, indexation benefit is not applicable to certain assets. Not applicable to short-term capital asset, not applicable to non-residents also, not applicable for depreciable asset, not applicable for slum sale, and not applicable for debentures, not applicable for certain bonds, and not applicable for previous owner holding period. Sir, indexation applicable in all other cases except this one. Sir, indexation started from the year 2001-2, that is 100. Afterwards, every year indexation is given for the previous year itself. These are the indexation given for previous year itself. Indexation benefit is applicable to the previous owner holding period also. My suggestion in exam hall, take this assumption only. So take the assumption of indexation benefit is applicable for previous year holding period itself. If you receive any asset by way of gift or inheritance or something from your previous owner, then indexation benefit shall be given from that period only. The year in which the previous owner hold the asset, that period onwards indexation must be given. For that one High Court judgment is there, Manjula J. Shah case law. Okay, chalo. Next one, here some special provisions are there. Section 48 proviso 1. Babu, in case of 115A, this is generally CA final topic 115A. Anyhow, this is nothing but all of you. This is the topic related to foreign exchange assets. See the word capital gain in case of non-resident shall be computed in foreign currency and converted into Indian currency as per the following rules. Number 1, it is applicable only for non-resident as well as foreign company. That too, it is only shares and debentures of Indian company. That too, it is purchased in foreign currency. In this case only it is applicable. In this case, we have to consider the following TT rates. For the purpose of COA, we have to take average of TT buying rate as well as TT selling rate as on the date of acquisition. In case of transfer of expenses, same way, average TT buying rate and TT selling rate must be taken as on the date of transfer. Whereas in case of sale consideration, same, average buying rate and average selling rate as on the date of transfer must be considered. Whereas that for total capital gain, that must be considered by using TT buying rate, that too as on the date of transfer. So this is the special proviso, that is section 48. Sir, SC should be non-resident in the year of sale. In this case only these provisions are applicable. Indexation benefit not applicable to non-resident, as I told you earlier. Next one, proviso 2, indexation benefit is applicable in computation of long-term capital gain, but it is not applicable to non-resident anyhow. And provision 3, first and second proviso is not applicable for computation of long-term capital gain in respect of equity shares or equity oriented mutual funds, or else any business trust referred under section 112A. Sir, for other equity shares or else equity oriented funds, for that it is applicable. Indexation benefit is that is applicable. Next one friends, indexation is not available to bonds and debentures. For bonds and debentures not applicable unless otherwise it is a specified bonds, generally not applicable. Next one friends, in case of non-resident, any gain arising on transfer of that is a rupee denominated bond by one non-resident to another non-resident, that to outside India, if they transfer, then it is not at all taxable. Not a transfer, not at all taxable. Friends, very important concept, section 45 series. These are the special points. Please follow. 115A, that is applicable for CA final, so don't worry about that topic. And section 48 provisos also not that great important for inter level. Anyhow, now we are going to start the topic, section 45 series. Friends, in today's lecture we are going to start the topic, that is income from the head other sources. A category concept, very important concept for exam point of view. Friends, in Income Tax Act, section number 56 to section number 59, these sections are dealing about the provisions of IFOS. In this, section 56, that is charging section, whereas section 57, deductions which are allowed. Section 58, deductions which are not allowed. Last one, section 59, that is nothing but deemed income. Friends, out of that, the first section is the charging section, section number 56. Very important concept, please follow. Friends, there are total 5 heads. First one is called as income from the head salary. Second one is called as income from the head house property. Next one is called as income from the head business or profession. Next one is called as income from the head capital gains. And last but not least, that is called as IFOS. So take it for granted, this is the last and residuary head. Take it for granted, those incomes which are not taxable under the head 4 heads automatically may be covered under the head IFOS. I repeat, if it is an income, that too the income is not exempted anywhere, that too that income is not taxable under the head salary, not taxable under the head house property, not taxable under the head PGPB, not taxable under the head capital gains, then take it for granted by default that income is taxable under the head IFOS. So this is the last and residuary head. Okay, fine. Next one friends, now for computation of income from the head other sources, we need to follow dash method of accounting. That is the question. Friends, we can follow, that may be mercantile or that may be cash method. Any method we can follow, but follow that particular method on regular basis. I repeat, you can follow either mercantile or cash basis regularly. Okay, chalo. So next one friends, as far as income from the head other sources are concerned, certain incomes are taxable. One by one we are going to cover. First one is called as dividend income. Take it for granted, any dividend income, that may be domestic company dividend, that may be foreign company dividend, or that may be deemed dividend, every dividend income is taxable. I repeat, every dividend income whatever we earned, that is taxable under the head IFOS, that too taxable as per normal provisions only. Okay, so that is the first one is called as dividend income. Generally, if you purchase the shares of a company, that company may declare the dividend. The dividend if you receive, the dividend is taxable. That may be interim dividend, or that may be final dividend, or that may be equity dividend, or that may be preference dividend, or that may be deemed dividend also. All the dividends, even foreign or even Indian company or else domestic company dividends, all are taxable under the head IFOS. Next one friends, that is casual income. You know what? Casual income is nothing but sin money. So in case of casual income, we may have following incomes. Number one, winning from lotteries, card games, horse races and TV shows, and next one is called as card games, etc., etc. Take it for granted, these incomes are taxable as per the provisions of section 115BB. Okay, as per provisions of section 115BB. That means that is nothing but special tax rates and special tax provisions are applicable. Take it for granted, casual income is taxable at the rate of 30%. I repeat, gross amount only taxable at the rate of 30%. and that too friends, in case of winning from lotteries, card games, etc., that is subject to TDS also. The TDS provisions are 194B as well as 194BB. And one more point I would like to tell you, expenses are not at all allowed. I repeat, no expenses will be allowed. With respect to casual income, losses are not possible. With respect to casual income, gross amount only taxable at the rate of 30%. There is no question of deductions and no question of any kind of expenditure and no question of any kind of allowances. Straight away that amount is taxable at the rate of 30%. And in case of certain exams, examiner will provide the net figure. Whenever net figure is given, then you have to add a TDS portion and gross amount only taxable. That too, that is taxable under the head IFOS. Okay, chalo. Next one friends, interest on enhanced compensation or compensation received with respect to compulsory acquisition of immovable property. Friends, you know, roadside buildings or else in certain projects, no, government will acquire your properties. That is called as compulsory acquisition of immovable property. In Hyderabad, L&T metro project purpose, Government of India has acquired so many private properties. For that purpose, they paid certain amounts. Take it for granted that amount is nothing but compensation paid. That compensation is taxable under the capital gains. But friends, in case of delay payment of such compensation, they will pay interest. Yes, take it for granted that interest on enhanced compensation or else compensation is taxable under that IFOS. And take it for granted friends, out of that interest portion, 50% will be allowed as deduction. I repeat, 50% will be allowed as deduction. Okay, chalo. And next one friends, gift. That gift point I will explain separately in this chapter. Next one, forfeiture of advance money on or after 1/4/2014 on transfer of capital asset. So friends, in case of advance money forfeited, no, in that case the advance money whatever forfeited by the person is taxable under the head IFOS. So friends, you know, sometimes we wanted to transfer our properties. At the time we will take the token amount. Okay, after that balance amount we will get within 2 months or 3 months, and after that period only we will get back the amount and we will transfer the property. But what happens certain times, we will take advance amount, but buyer, he will not come to the particular place and will not pay the balance amount. Therefore we will forfeit that advance amount. Take it for granted that advance amount whatever forfeited before 1/4/2014, no, the treatment is different. If it is forfeited before 1/4/2014, it should be reduced from the cost of asset while calculating capital gain. But if the advance money is forfeited on or after 1/4/2014, take it for granted it is pakka taxable under the head IFOS. Next one friends, share premium in case of issuance of shares by closely held company. Friends, in case of closely held company, if they issue shares at a premium, take it for granted that amount is taxable under the head IFOS. So if you issue shares at a premium, in that case the differential amount between issue price and market value, that differential amount is pakka taxable under the head IFOS. And next one friends, interest on securities. Now if you purchase debentures or else if you purchase any kind of bonds, you may get interest on that. That interest amount is taxable under the head IFOS. Next one friends, employees contribution to employees welfare funds, that is also covered under the head IFOS. So friends, in some cases employer will contribute as well as employee also will contribute. Employee contribution received by the employer, after that only he will remit it to particular schemes. Whenever he received the amount, take it for granted that amount is taxable under that PGPB, but in certain cases that amount is taxable under that IFOS. Next one friends, income from let out of plant and machinery, that is also covered under the head IFOS. Maybe PGBP it is covered, but sometimes it is other sources. If you give on regular basis, that is PGPB. If you give on rental basis occasionally, then that is covered under the head other sources. Next one, friends, composite rent income received with respect to buildings. Friends, sometimes furnished accommodations we will provide on rental basis. Furnished accommodation means we will provide the building as well as furniture. Friends, rent received for building as well as furniture altogether, that is known as composite rent. Friends, if you able to separate the composite rent portion, then building rent is covered under the head house property and other rent is covered under the head other sources. Suppose if you unable to separate inseparable composite rent, in that case take it for granted that entire amount is covered under the head maybe PGBP if it is regular basis, otherwise it is covered under the head other sources. Next one, friends, that remuneration received from any person other than employer. Sir, if you receive remuneration from your employer, take it for granted that is covered under the head salary chapter. If you received the same from other than employer, that is covered under the head other sources. Next one, friends, director sitting fees. Now friends, in case of directors, there are two types. One is called as executive, another one is called as non-executive director. Executive director relation is employer and employee. In case of non-executive director, take it for granted the amount whatever received like sitting fees or commission or anything, that is covered under the head IFOS. And next one, friends, pension. Any pension received is covered under the head salary, but sometimes if the employee died, then the employee's relatives will get the pension. That pension is called as family pension. Take it for granted family pension is covered under the head IFOS. Next one, friends, salary received by others, no, that is covered under the head salary. But if salary received by MPs and MLAs, take it for granted it is covered under the head IFOS. Next one, friends, any sum received under Keyman insurance policy by legal heirs of employee. Sir, if employee died, employee's legal heirs may receive the compensation from the company. That compensation whatever they received from life insurance corporation or else any other insurer under Keyman insurance policy, that is covered under the head IFOS. So if it is received by the employee, it is taxable on that salary. If it is received by other than employee, employee's relatives legal heirs only received, then it is covered under the head IFOS. Okay now friends, this is the points covered under the section number 56. Other points. Number one, commission, that is LIC agents commission. Friends, if you get the policies, no, you will get the commission. That commission is covered under the head IFOS. Next one, agriculture income. Friends, agriculture income is always exempted. Agriculture income in India is exempted, but agriculture income earned outside India, that is pakka taxable. Agriculture income received from foreign countries, pakka taxable, that is taxable under the head IFOS. Next one, income from subletting. In case of subletting, SSE may not be the owner, therefore it is not taxable under the head house property, it is taxable under the head IFOS. Next one, interest on bank deposits and loans, that is also covered under the head IFOS. Whatever the loans you have given to third party, and if you receive the interest and the two it is not your business, then it is covered under the head IFOS. Suppose if it is your business, no, answer would be different. It is covered under the head PGBP. Okay, chalo. Next one, friends, royalty income received. Any royalty income received by other than professionals may cover under the head IFOS only. And next one, friends, vacant land rent. So ground rent or else open land rent received covered under the head IFOS. And honorarium, in case of papers valuation or else paper setting purpose, we may get some honorarium from other than employer, that is covered under the head IFOS only. And last one, interest on contribution made to URPF with respect to employees contribution, whatever the interest portion received from that contribution to URPF is covered under the head IFOS. Income from the head other sources only. Friends, very important chapter. This is IFOS chapter. Section number 56, charging section. The following incomes are covered under the head IFOS. Point number 1, directors remuneration. Number 2, MPs and MLAs remuneration. Number 3, remuneration received from other than employer. Okay, these are. And next one, composite rent. And the next one is called as rent from let out of plant and machinery, and subletting rent, and open land rent. These are also covered under the IFOS. And afterwards, other topics are as follows. Number 1, casual income. Number 2, dividend received. Number 3, interest on loans as well as deposits. Number next, interest on enhanced compensation or compensation. These are also covered. And next one, agriculture income in India is anyhow exempted. Agriculture income from foreign countries pakka taxable. Next one, friends, that advance money received and forfeited by the person for failure in transfer of capital asset at the time, whatever advance money received on or after 1/4/2014, that amount pakka taxable under the IFOS. Okay na friends, chalo. Now other topics, that is called as gift. Okay, very very important topic, take it for granted. Exam point of view, one compulsory question. Number 1, whatever the gift we received is taxable or not, that is the question. Friends, generally gift we can classify into 3 things. One is called as cash, second one is called as movable assets, next one is called as immovable asset. Okay, in case of cash, take it for granted, if the sum or aggregate of sum received by the persons more than 50,000, take it for granted, in year if it is more than 50,000 gift, then entire amount is taxable. I repeat, entire amount is taxable, not excess amount. For example, for my birthday I received 30,000 and 20,000 and 10,000, total 60,000. Yes, 60,000 is taxable. Okay, chalo. Next, in case of movable asset, in case of movable asset means not all movable assets, only capital assets are only covered. I repeat, only capital asset category items are only covered, like shares or else what do you call gold or archaeological collections. These are only covered. Sir, if you receive any kind of movable asset being capital asset, that too the fair market value of that asset exceeds 50,000, in that case take it for granted the entire value is taxable. Suppose if the fair market value of the movable asset, whatever you received for a inadequate consideration, in that case if the differential amount, that means fair market value minus consideration is more than limit of 50,000, then take it for granted that asset is also taxable. And next one is called as that immovable property. Very very important topic. In case of immovable property, we need to see transaction wise. I repeat, transaction wise. In case of immovable property, the stamp duty value of immovable property is more than 50,000, then the entire amount of stamp duty value is taxable. But there are some conditions. Condition number 1, the stamp duty value must exceed 110% of the consideration. If any consideration is there, then the stamp duty value must exceed 110% of the consideration. That too, the stamp duty value minus consideration amount must be more than 50,000. In that case, the gift is taxable under the head IFOS. Okay, chalo. But friends, the following gifts are not taxable. Number 1, gift received from relative, not taxable. Number 2, gift received at the time of marriage, not taxable. Next one, gift received by way of will or inheritance, not taxable. And gift received from the local authority or else hospitals or else charitable trust, not taxable. Okay, chalo. Next one, friends, gift received from any educational institution, hospital, trust, not taxable. And local authority gifts also not at all taxable. And another topic, friends, in contemplation of death, if you receive any gift, that is also not taxable. Okay, chalo. And certain items not covered as a transfer, that items are also not taxable. Okay, very 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 important topic, friends. That too, your relative definition is as follows. Spouse, relative definition, relative means spouse of the individual, as well as brother and sister of the individual, and brother and sister of spouse of the individual, and brother and sister of either of parents of the individuals, and any lineal ascendant and descendant of the individual, and as well as lineal and ascendant and descendant of above specified persons. These persons are called as relatives. Whereas in case of HUF, any member is a relative. Any member is a relative. Okay, chalo. And in case of immovable property, you know, land or building, and land and building. Whereas mobile assets means, as I told you earlier, shares, securities, as well as jewelries and archaeological collections, drawings, paintings, and sculptures, any work of art, bullion, these are only covered. Okay, chalo. So friends, very important concept. See the word, first one, any money including DD, checks, everything, cash, then sum or aggregate of sum more than 50,000, then the entire amount is taxable. In case of mobile property, without consideration, if the aggregate fair market value or fair market value of immobile property exceeding 50,000, entire fair market value is taxable. And inadequate consideration case, in this case, take it for granted the differential amount between aggregate fair market value and consideration exceeds 50,000, then the differential amount is only taxable. Friends, with respect to immovable property is concerned, without consideration case, stamp duty value of immovable property exceeding 50,000, then entire stamp duty value is taxable. But friends, if you receive any consideration inadequately, no, in this case, take it for granted that stamp duty value minus the consideration must exceed 50,000, as well as the stamp duty value must exceed 110% of the actual consideration. In this case only, that amount is taxable. Okay, chalo. So this is the topic called as, what you call, gift. Very important topic. You know, dividend, friends, any domestic dividend as well as foreign company dividend as well as deemed dividend, all are covered under the head IFOS only. Here, deemed dividend concept, section 2, subsection 22A. Please follow. Important concept. Once upon a time, dividend means only in the form of cash. That means company will declare some profits to the shareholders, that is in the form of dividend. That is pakka taxable. But some people, what they will do, in order to avoid the tax, they will distribute the assets. I repeat, they will distribute the assets. If you distribute the assets, take it for granted, that is deemed dividend under section 2, subsection 22, class A. See the word, distribution of accumulated profits ultimately which result into distribution of assets is called as deemed dividend. Sir, you distributed the assets. Even though you have reserves and surplus, even though you have accumulated profits, you distributed the assets. Indirectly, that is nothing but dividend. That is the reason government introduced one concept, deemed dividend. That is under section 222A. It is covered under the head IFOS only. And section 2, subsection 222B, you know what? Distribution of bonus shares as well as distribution of debenture stock to shareholders, that is pakka treated as deemed dividend. You have reserves and surplus, but you have not declared the dividend. Instead of declaring the dividend, you only distributed, what do you call, preference shareholders. You only distributed bonus shares, and you only distributed that debentures to the shareholders. In that case, that is also treated as deemed dividend to that extent of accumulated profits. And next one, section 2, subsection 22, class C. Distribution of assets at the time of liquidation. I repeat, at the time of liquidation, in this case, that is also deemed dividend. If you distribute any assets at the time of liquidation of company, that is deemed dividend. And the next one, friends, section 2, subsection 22, class D, reduction of capital. In case of reduction of capital, if you have accumulated profits and you done reduction of capital, that is also covered under the head IFOS because it is a deemed dividend. So friends, memory code, A for assets, B for bonus shares, and C for closure of the company, that means liquidation of the company, D for reduction of share capital. Last one, Section 2 subsection 22 class E. You know what? Loan or advance given by closely held company to a shareholder who has not less than 10% of beneficial ownership in that organization. In that case, that is treated as deemed dividend to the extent of accumulated profits. And same way, friends, in case of distribution of profits, that is anyhow dividend, no doubt at all. But here the beauty is loans or advances given to a shareholder by the closely held company, that too the shareholder must have 10% of, I repeat, minimum 10% of voting power in our organization. Then that is deemed dividend. Or else, if the closely held company has given loans to an organization, in that organization our shareholder has substantial interest, in that case also that is treated as deemed dividend. This deemed dividend also taxable under that IFOS, that too it is subject to tax in the hands of shareholder only. So friends, A for assets, B for bonus shares, C for closure of the company, that means liquidation, D for reduction, and E for, that is loans or advances given by closely held company. Okay, closely held company means other than widely held company, all companies are called as closely held company. This closely held company given loans or advances to a shareholder who has 10% of voting power. Or else we have given loan or advance to the organization in which such shareholder has substantial interest. You know, substantial interest means 20%. No, then the loans or advances are treated as deemed dividend. Okay, chalo. In case of deemed dividend, that is taxable under the IFOS. Next one, friends, in case of premium on issue of shares by closely held company, in that case the premium amount is also covered under the head IFOS. So see this one, friends. One closely held company, what it did, you know, the closely held company issued share capital. The face value of the share, let us say 100 rupees, but they issued for 250 rupees. Sir, whenever issue price is greater than face value, take it for granted, that is called as premium. But friends, you know what? How much is taxable? You know, that issue price minus market value. Let us say market value is 200 rupees, but we issued for 250 rupees. Yes, this differential amount is only taxable. If any person issued a share at a price higher than the market value, in that case the differential amount is only taxable. Don't confuse ma. Here two condition. Condition number one, there must be premium. That means issue price must be greater than what? You know, face value. In that case, how much taxable? You know, issue price minus fair market value is taxable. See the points. Company in which public are not substantially interested, that means closely held company. These closely held company issued a share at a premium, that too the premium price exceeding fair market value. In that case, what amount taxable? You know, taxable value is equal amount of premium in excess of market value, fair market value, that amount is only taxable. Next one, friends, winning from lotteries, card games, etc., casual income. As I told you earlier, these casual incomes are taxable under the section 115BB. That too, flat rate is 30%, as well as surcharge and health and education is normally applicable. But friends, whereas expenses not allowed, deductions also not allowed, and losses also not possible, and other losses also cannot be adjusted, and threshold limit is also not applicable. Simply gross amount is only taxable. Okay, chalo. If examiner has given the net figure, no, we need to calculate gross. Net figure is nothing but, all of you, that gross amount minus TDS. In exam, sometimes examiner will provide the net figure. Whenever net amount is given, then we have to calculate gross. How you know? Net plus TDS, then we will get the gross amount. That gross amount only taxable. For that purpose, one formula, no, gross winnings is equal net winnings into 100 divided by 100 minus tax rate, TDS rates, TDS portion. Okay, chalo. Next one, friends, interest. Take it for granted all interest amounts are taxable under the head IFOS. See the word interest on securities, that is taxable on due basis only under the head IFOS. Whereas in case of interest other than interest on securities, that is also taxable under the head IFOS. On periodic basis it is taxable. Okay, chalo. Next one, friends, another topic, allowable expenses under section 57. Certain expenses are allowed as deduction under section 57. Number 1, in case of family pension, least of the following is allowed as deduction. How much? 1/3 of the pension, or else 15,000, whichever is lower, will be allowed. Whereas in case of dividend income, I repeat, dividend income, take it for granted that what you call deduction will be allowed least of the following. Number 1, interest on loan, or else 20% of such income, whichever is lower. I repeat, interest portion or else 20% of that income, whichever is lower, only will be allowed as deduction. And next one, friends, in case of employee contribution to employee welfare fund, that is also allowed as deduction on payment basis. If you pay, then only it is allowed, but it must be paid within the due date specified in the respective act. If PF, no, PF act. Gratuity, no, gratuity act. Like that, you have to pay within the due date specified in the respective acts. Next one, friends, interest on enhanced compensation or compensation, 50% amount allowed as deduction, balance 50% is only taxable. Next one, winning from lotteries, winning from card games, in this case also take it for granted expenses are anyhow not at all allowed. And next one, friends, other income, proportionate reasonable expenses will be allowed as deduction. Okay, only reasonable expenses only will be allowed. That's all. These are the expenses which are allowed as deduction. Next, section 58. Certain expenses are not allowed as deduction. What are not allowed? All of you. Number 1, income tax, that is a personal expenditure, not allowed. And other personal expenses anyhow not allowed. Next one, interest or salary paid outside India without deduction of tax at source, not allowed. Without TDS, if you remit to abroad, sorry, not at all allowed. And next one, in case of casual income, no expenses are allowed. I repeat, in case of casual income, no expenses are allowed. Next one, friends, in case of excess payment made to relatives, I repeat, in case of excess payment made to relatives, that excess amount also not allowed. And another point, in case of cash payment more than 10,000 rupees, that cash expenses are also not allowed as deduction. I repeat once, if any expenses more than 10,000, compulsory you have to pay by account pay check or account pay draft or ECS. If you are not paid, no, not at all allowed. Entire amount will be disallowed. And next one, friends, in case of payment to resident, tax must be deducted at source as for TDS provisions. But some people will not deduct TDS or else will not remit TDS. In that case, 30% of such expenditure also not allowed. Okay, so income tax not allowed, personal expenses not allowed, any salary or any interest paid outside India without deduction of tax not allowed, and expenditure with respect to casual income anyhow not allowed, and excess payment made to relatives not allowed, and that too whatever the cash expenses more than 10,000 if you made, that is also not allowed, entire amount. And in case of payment made to resident without deduction of tax or without remittance of tax, in that case also 30% of such expenditure not allowed. Okay, fine. Friends, this is very, very, very important concept for exam point of view. Very important. Out of this chapter, we can expect one question for sure. Okay, chalo friends, see the revision, just revision. 56 charging section, 57 deductions, 58 disallowances, 59 deemed income. Okay, now you know there must be one income, that too that income is not chargeable under that salary, house property, PGPB, capital gain. That too it is not exempted under any other section, then by default it is covered under the head IFOS. But certain items are covered under section 56 charging section. The items, you know, winning from lotteries, card games, etc., casual income, take it for granted, casual income is covered under the IFOS. That too 30% is the tax rate, no expenses, no losses, no set-offs, and as well as no basic exemption limit. That too friends, gross amount only taxable. That too TDS under section 194B and 194BB applicable. As I told you, no expenses, no deductions, no losses, no set-off, no basic exemption limit, and no slab rates also. But yes, flat rate applicable, that too applicable for resident as well as non-resident, and TDS sections are also applicable simultaneously under section 194B and 194BB, and it is covered under that IFOS, gross amount only taxable. That's all. Next one friends, directors, executive directors salary, whereas non-executive directors covered under the head IFOS. Agriculture income in India exempted, whereas outside India that is pakka taxable under the head IFOS. Next one friends, income tax, whatever you paid, anyhow no deduction allowed. In case of refund also not at all taxable, but income tax interest, no, income tax refund interest, that means interest on income tax refund covered under the IFOS. And friends, income from undisclosed sources, that is also IFOS. In case of pension covered under the salary, whereas in case of family pension, that is received by the family members of deceased person, therefore that amount is subject to deduction, that is least of the following: 15,000 or one third of family pension, whichever is lower allowed as deduction, balance amount only taxable. Next one friends, another concept, that is nothing but dividend. Take it for granted, dividend income is always covered under the head IFOS. Whatever the dividend, interim, final, equity, preference, foreign company, domestic company, everything is covered here. And take it for granted, in case of interest income, that expenses are allowed, but whereas in case of dividend income, take it for granted, expenses not allowed, only one expenditure allowed, that is nothing but interest portion if you take the loan. The two least of the following allowed: 20% of such income, or else interest whatever you paid on that loan, whichever is lower only allowed as deduction. And next one, taxation of dividend. As I told you earlier, dividends are anyhow taxable at normal rates, but in case of surcharge, I repeat, in case of surcharge, I am telling you, individual HEF, AOP, BY, AJP, highest rate of surcharge 25 and 37% are not applicable with respect to dividend portion. With respect to dividend, the highest surcharge rate is 15% only. Okay, and friends, subletting, that is covered under the head IFOS only. Next one friends, interest on savings bank, FD, debentures, loans, every interest income generally covered under the head IFOS only. Next one friends, whatever the interest income you received on debentures also IFOS, and remuneration received by MPs and MLAs, that is also IFOS only. And that too, examiner fees received from non-employer, IFOS only. And next one, interest portion received on URPF contribution with respect to employees contribution to URPF, on that if you receive any interest, that interest is only covered under the head IFOS. Next one, vacant land rent, that is also covered under the head IFOS. Underwriters commission received by directors, that is also covered under the head IFOS. Next one, interest on enhanced compensation, that is also covered under that IFOS, but take it for granted, 50% amount is only allowed as deduction, balance 50% only taxable. And next one, advance money received and forfeited before 1/4/2014, it should be reduced from cost of acquisition before giving indexation. Whereas advance money received and forfeited on or after 1/4/2014, it is taxable under the IFOS. I repeat, taxable under the IFOS, that it is taxable in the year in which the forfeiture was made. And next one, friends, very important concept, premium on issue of shares by closely held company. Friends, take it for granted, one closely held company issued its shares at a premium. You know what premium means? More than what do you call, more than face value. In that case we can say it is premium. But how much taxable? The issue price minus fair market value, that is only taxable. See the word issued at premium or not. For that you have to check issue price must be greater than face value. How much taxable? Issue price minus market value is only taxable. Okay, chalo friends, if company is a widely held company, not applicable, these provisions are not applicable. If it is closely held company, that too issued at a premium, yes or no? No, then not taxable. If we issued at a premium, that too the issue price is greater than fair market value, then it is only taxable. If the issue price is not greater than fair market value, nothing is taxable. Next one, friends, here we can do one exercise so that you will understood this problem better. All of you see the word, friends. A company, number of shares 10,000, face value 100, but issue price 130. Yes, so 130 is greater than 100, therefore premium. The two, friends, the issue price is greater than fair market value, therefore this 130 minus 120, the 10 rupees into 10,000 shares, 1 lakh only taxable. So 2 points, it must be issued at premium. In this case the difference amount between issue price and fair market is only taxable. Second question, 20,000 shares, face value 100 rupees, whereas issue price 110, yeah, premium. But market value 120, but you issued at 110, sorry, not at all taxable. I repeat, two condition, it must be at premium, that too the differential amount between issue price and fair market value is only taxable. Okay, chalo. Third one, 100 rupees face value but 98, sorry, no premium, light, nothing is taxable. D, that is 100 is the face value, whereas 110, wow, it is a premium, that too it is greater than fair market value, so the differential amount 20 rupees into 40,000 shares, 8 lakh is taxable. Next one, E, 5,000 shares, 100 rupees face value, issued at 80, sorry, no premium, nothing. Whereas F company, 10,000 shares, 100 rupees is the face value, issued at 120, super, at premium. That too, this 120 fair issue price is all of you, sorry, 120 is the fair market value, whereas issue price 130, therefore take it for granted it is not greater than fair market value, therefore nothing is taxable. Last one, G company is a widely held company, 100 but issued at 150, wow, answer, it is issued at premium, but sorry to say the provisions are not applicable for widely held company. Okay, chalo. And closely held company, everything is 100, nothing is taxable. Okay, chalo friends, next topic is gift. If gift received by the person in the capacity of employee, it is taxable under their salary, provided the aggregate value of gift must exceed 5,000. And next one, friends, in case of gift received by way of your business or profession, no, it is covered under the head PGPB. And if you receive gift other than employer-employee relationship, other than business or profession, then it is covered under the head IFOS. Friends, in case of taxation or gift, generally gift three types, one is cash, one is movable asset, one is immovable asset. In case of cash, sum or aggregate of sum more than 50,000, the entire amount is taxable. In case of movable asset, fair market value or aggregate fair market value without consideration and the differential amount is more than 50,000, then the entire fair market value is taxable. Whereas in case of immovable property, if the stamp duty value of immovable property, if it is without consideration, no, the stamp duty value, if it is more than 50,000, then stamp duty value is taxable. In case of with inadequate consideration, there are two conditions. Stamp duty value minus consideration must exceed 50,000, and the two, stamp duty value must exceed 110% of the consideration. In this case only it is taxable. Okay, chalo. So friends, this is with respect to gift provisions are concerned. Very important provisions. And here relative gift not taxable, marriage gift not taxable, on account of death if you receive any gift, that is also not taxable, and which is not a transfer as per section 47, that is also not taxable, and gift received from hospitals charitable trust, that is also not taxable. Friends, these are the gift provisions. And next one friends, another topic, that is IFOS. Other points are as follows. Number next, if you receive remuneration from your employer, it is covered under the head salary. If you receive any compensation from other than employer, that is not at all taxable under that salary, that amount is taxable under the head IFOS. See the word, any compensation received by a person, whatever name called, in connection with the termination of employment, that too you received from other than employer, then it is covered under the head IFOS. Okay, see the chart ma. If you receive compensation from your employer, it is covered under the head salary. If you receive the compensation from your other than employer, that is not at all taxable under that salary, covered under the head IFOS. Composite rent, separable, house rent is house property, other rent is PGPB or IFOS. If it is inseparable, entire amount is taxable under that, maybe PGPB or else other sources. Friends, keyman insurance compensation, if it is received by employees, covered under the head salary. If it is received by the owner or professional, PGPB. If it is received by the legal heirs, that is covered under the head IFOS. And next one friends, another topic, section 57, admissible expenditure. Any reasonable expenditure is allowed. That too, any contribution to employee welfare fund, that is also allowed, provided you have to pay within the particular time. Next one, any repairs or insurance with respect to land and building, that means building, as well as plant and machinery and furniture allowed. Whereas in case of family pension, least of the following allowed, 15,000 or 1/3 of the family pension it is allowed. And in case of any other expenditure, that means a reasonable expenditure, general expenditure is also allowed. With respect to interest on enhanced compensation, 50% is allowed as deduction. And last one, in case of dividend, interest expenses are only allowed sub to least of the following is allowed. Interest amount or else 20% of such income, whichever is lower, only allowed as deduction. Okay, chalo. Next one friends, inadmissible expenditure, personal expenditure anyhow, that is not allowed. Interest on salary paid outside India without deduction of tax, TDS not allowed. Wealth tax not allowed. That too, income tax not allowed. And disallowances which are already covered under section 40A provisions, 40 capital A subsection 2, 40 capital A subsection 3, that is not allowed. 40 capital A subsection 2 means excess payment made to specified persons not allowed. 40 capital A subsection 3, cash payment more than 10,000 not allowed. And in case of what you call casual income related expenses not allowed, but expenses with respect to activity of owning and maintaining of resources anyhow it is allowed. Okay, chalo. Friends, in case of payment made to resident without deduction of TDS, 30% of that amount will be disallowed. With this, completed the topic section 57, admissible expenditure, as well as section 58, inadmissible expenditure. And last but not least, that is nothing but section number 59, that is nothing but deemed profits ma. This is same as section number 41. Already in business or provision there is one section called as section 41, that is nothing but deemed business profits. Same section here, deemed income. So section number 59, that's all. So with this we completed complete revision of this chapter called as IFOS. Very important chapter, especially one theory question or one practical question we can expect out of this chapter. Thank you very much. Friends, in today's lecture we are going to start the topic, that is clubbing of income. Friends, if you want to determine the total income of someone else, first we have to determine the assessment year and previous year. After that you have to determine the residential status. After that you have to calculate income from all 5 heads. Then only we need to apply clubbing provisions. After that we need to apply set off and carry forward. Then we will get gross total income. out of gross total income we will give deduction under section 80C to 80U, then only we will get taxable income or net income. Friends, here I would like to highlight one point. First we need to apply the clubbing provisions. Afterwards only we need to consider the deductions under chapter 6A. That means clubbing provisions we need to consider before allowing the deductions. I repeat, before allowing the deductions we need to consider the clubbing provisions. See the heading, income of other persons will be clubbed in the our SSC's total income. For example, our SSC Mr. X, in order to avoid the tax, what SSC will do, you know, he will transfer some of his income to someone else. So let us say Mr. Y, the person who transferred is called as transferor, to whom we have transferred is called as transferee. Friends, whenever any person transferred to someone else, in this case whatever the income you transfer to transferee will be clubbed in the hands of transferor. These are called as clubbing provisions. Income of other person will be clubbed in the hands of our SSC. These are the clubbing provisions. For that purpose, section number 60, section number 61, section number 62 as well as 63, and last but not least section number 64 series, these are relevant for this chapter, clubbing provisions. Friends, here I am going to start one by one topic. Please follow. Generally, taxpayer is required to pay tax in respect of income earned by him, which is chargeable to tax at slab rates. I hope you know, up to 2.5 some 0 and 2.5 to 5 as well as 5 to 10, above 10, like that slab rates are applicable. The more income you have, the more tax you have to pay. That is the reason so many taxpayers voluntarily transfer the income to someone else in order to avoid the tax payments. So lawmaker wanted to put the check to these kind of transactions. That is the reason they introduced the clubbing provisions. Here first one, see the word friends, revocable transfer of asset. I repeat, revocable transfer. A revocable transfer means one person transferred his asset to someone else, but there is a provision for revocation. That means he wanted to cancel the such a transfer in future. When any person wanted to cancel the transaction in future, then that is called as revocable transfer. Today I will give you, but tomorrow or day after tomorrow or next year or after next year I will take back my asset. That is called as revocable transfer. Whenever there is a revocable transfer, take it for granted, the income from such asset is taxable in the hands of transferor. Okay, I will take one example, Ablu and Bablu. Ablu transferred billing to Bablu, and that too he said like this, Bablu, whenever I want I will take back my asset, like this Ablu made the statement. So this is called as revocable transfer. See the heading, revocable. See the word, all income arising to any person by virtue of revocable transfer is included in the hands of transferor. That's all. Meaning of revocable transfer. A transfer is deemed to be revocable if it contains any provision for the retransfer. I repeat, retransfer, taking back the asset. That's all. That is called as revocable transfer. It gives the transferor a right to reassume the power over the income or over the asset any point of time. So today I will give you, in future I will take it back the asset. That is called as a revocable transfer. Okay, chalo. Exceptions. If there is a transfer of asset which is not revocable during the lifetime of the transferee. See, Ablu said like this, hey Bablu, take the building, but I will not take back the asset during your lifetime. If you die, then only I will take back the asset. Friends, this is not called as revocable. This is called as revocable. If you are not taking back the asset during the life period of other transferee, that is not called as revocable transfer. Okay, chalo. Next one, if there is a transfer before 1/4/1961, transfer is for a period exceeding 6 years. So beyond 6 years, that is not a revocable transfer. Okay, chalo. Friends, this provision is applicable if you transfer the asset before 1/4/1961. This is the special provision, not important, leave it. So conclusion friends, if you make any revocable transfer, take it for granted that is pakka taxable. If you do irrevocable transfer, not at all taxable. In Kantara, hero, one person king, he transferred his lands to someone else. That is called as irrevocable. Suppose the king given the land, after that he want to take back the land, that is called as revocable. In case of revocable it is taxable, irrevocable it is not at all taxable. Okay, chalo friends, next topic. See the word, all of you, remuneration to the spouse. Friends, some individuals will have organizations, will have companies, or else will have partnership firm, or else will have other entities, and in that entities their wife or husband, as the case may be, may do the job. For that purpose they will take remuneration. In this case, take it for granted, if they take remuneration, that is well and good, but without proper qualification or without proper experience, without proper expertise, if they get the remuneration, then the problem starts. In that case, clubbing provisions applicable. See the heading, all of you, Mr. X is the one of the partner in XYZ partnership firm. Okay, in this firm what happened, his wife Mrs. X is working as a CFO, but our educational background second class completed. I repeat, only second class completed, the two mathematics subject failed in those days, but she is working as a CFO of the organization. For that she is getting 4 crore rupees salary per month 4 crore. See this one, second class failed person acting as a CFO of the company, that too she, our firm, that too she is drawing 4 crore rupees salary per month. Now my point is, it is clearly indicates that there is no clarity in this transaction. Therefore lawmaker wanted to introduce one provision, whenever any spouse of the individual got the remuneration from the organization in which such individual has substantial interest. Sir, here one condition, Mr. X must have at least 20% or more than 20% of voting power. In this case, whatever the remuneration drawn by the person is taxable in the hands of individual. In my example, she received 4 crore rupees per month salary. So 48 crore rupees salary she received. So the 48 crore salary is taxable in the hands of Mr. X, but not in the hands of Mrs. X, because without proper educational background she only took the remuneration. So the provision is as follows: remuneration drawn by the spouse from an organization in which such individual has substantial interest. In this case, clubbing provisions are applicable, but exception, if she possesses with technical as well as professional qualification. Suppose she is a CA, CMA, CS qualified and she has 4 years experience or 5 years experience, something, at that time clubbing provisions not applicable. Okay, chalo Babu, one more point. What? Suppose both wife and husband both are having substantial interest. In this example, Mr. X as well as Mrs. X both have substantial interest. One person has 20%, another person has 22% or 20%, something about 20 or equivalent to 20% they have. When both have substantial interest, no doubt the remuneration will be clubbed in the hands of, I repeat, whose total income is higher. See the word, if both wife and husband both have substantial interest, in this case it will be clubbed in the hands of all of you whose total income before considering this remuneration is higher. In their hands it will be clubbed. Okay, chalo next one. Here substantial interest means, I already told you, minimum 20% or more than 20%. That too, your relative definition, relative means spouse or brother and sister or any lineal descendant or lineal ascendant. That's all. Next one friends, another point, income from transferred assets to spouse. Very simple point, follow. If any individual transferred income to spouse, wife or husband, no doubt that income will be clubbed in the hands of transferor. That's all. But friends, here one point is clear. If you transfer in agreement to live apart means at the time of divorce if you transferred, clubbing provisions not applicable. If you transfer before marriage, this condition not applicable because I told you wife and husband. But if you transferred before marriage, there is no question of wife and husband relation. That too, if you transferred for adequate consideration, adequate monetary consideration, suppose wife only paid 10 crore rupees for that property, in this case there is no clubbing because she only paid the consideration, mean genuine transaction. Last one, she purchased out of pin money. In case of boys, that is called as pocket money. In case of girls, that is called as pin money. If she only purchased the property by using her pin money, in this case as also there is no question of clubbing. So I would like to tell you one thing, before marriage if you transfer, no clubbing, or else at the time of divorce also no clubbing. So moral of the story, the moment when you transfer the property, the moment when the income accrue, both the time take it for granted, wife and husband relation must be there. Wife and husband relation must be there at the time of transfer and at the time of accrue the income and clubbing time. Wife and husband relation must be there. If wife and husband relation is there at the both the times, in this case clubbing applicable. If wife and husband relation is not there, in this case there is no question of clubbing. Okay, chalo. And next one, friends, if any husband has given, I repeat, husband has given the amount to wife for carrying any business, with that amount she only continued the business and she got the profits. Suppose let us say 10 crore profit. In this case, what is the treatment? Take it for granted this amount will be segregated between wife and husband in proportionate to their capital. I repeat, in proportionate to their capital. Whatever the amount given by husband to wife, and by using that amount she only got the profits, then the profits will be apportioned between wife and husband in proportion to, I repeat, in proportion to their opening capital of the firm. Suppose let us say husband given 30 crore, whereas wife she kept 70 crore for that. Finally she got 10 crore profit. In this case, in the hands of husband, how much will be clubbed? That is nothing but 10 crore profit into 30 divided by 100. That means total profit into is capital share divided by total capital. Whereas in the hands of wife, that is whatever the profit 10 crore into investment made by her, that is her own capital 70 divided by total capital or total investment, that is 100. That amount will be clubbed in the hands of the wife. That is the way we need to follow. We need to take the opening capital during the first day of the previous year. Okay, chalo. Same way, friends, if you transfer the income of a property to your son's wife, I repeat, to your son's wife, nothing but daughter-in-law, clubbing provisions are applicable. One and only exception, in case of adequate consideration, there is no clubbing. Best example, Amitabh Bachchan transferred to Jaya Bachchan, clubbing applicable because individual and wife. Same way, Amitabh Bachchan transferred to Aishwarya Rai. In this case, the income will be clubbed in the hands of Amitabh because individual transfer to son's wife, clubbing provisions are applicable. Next one, friends, if any person like Amitabh Bachchan given the same to any AOP or BOI, I repeat, AOP or BOI for the benefit of spouse or son's wife, then only that proportionate amount will be clubbed. I will take one example. Amitabh Bachchan transferred the income of the property to Ramakrishna Mutt, that is 100 crores. But Amitabh Bachchan only put the stipulation or condition that out of 100 crores, 30 crores must be given to Jaya Bachchan, whereas 10 crore must be given to Aishwarya. That is the condition. In this case, what is the treatment of that amount 100 crores? Take it for granted 30 crore given for wife, indirect benefit of wife. So clubbed in the hands of 30 crore, clubbed in the hands of Amitabh Bachchan. Whereas for daughter-in-law purpose, son's wife purpose 10 crore given, Aishwarya Rai purpose 10 crore given, that also will be clubbed in the hands of Amitabh. and whereas balance amount of 60 crore will not be clubbed, that will be given to Ramakrishna Math AOP, that is taxable in their hands only. That's all. This is the topic with respect to gift given to third party for the benefit of spouse. That amount will be clubbed in the hands of the individual only. Always remember, the benefit whatever the amount transferred will be clubbed in the hands of individual or else in the hands of transferor. Same way here, gift given to third party like AOP or BOI for the benefit of son's wife, in this case also clubbing provisions are applicable. I repeat, for the purpose of son's wife, clubbing provisions are applicable. Okay, chalo. Next one, friends, all of you, another topic, very important topic, clubbing of minor income. Friends, in case of clubbing of minor income, please recap. If father mother in between them marriage relation subsist, father and mother their marriage relation subsist, in this case income will be clubbed in the hands of father or else mother, whose total income before considering this minor clubbing income is higher. I repeat, father or mother whose total income, I never told you gross total income, I told you total income before considering this clubbing income is higher. Okay, chalo, this is the topic, clubbing of minor income if parents marriage relation subsist. Suppose parents marriage relation does not subsist, for example they died or else they took the divorce, in this case clubbing of minor income concept is like this. Income will be clubbed in the hands of legal guardian. Sir, wife and husband relation is there, then income will be clubbed in the hands of father or mother whose total income is higher before considering clubbing of income. Suppose wife and husband relation not there, in this case income will be clubbed in the hands of legal guardian. But take it for granted, these clubbing provisions are not applicable if the minor earn the income because of skill or talent or special knowledge or experience or manual work. For your information, even minor can work in factory also. Below 14 years they cannot work, but above 14 years they can work. So they can work in factory. So minor can earn the money, that is not clubbed because that is their manual work income. Whereas they have special talent. Some minors will act in cinemas, or they will act in some serials, or they will participate in TV shows. Sorry, that income will not be clubbed. Okay, chalo. Other income without any skill or any talent, that income will be clubbed in the hands of father or mother whose total income before considering clubbing of income is higher if marriage relation subsist. If does not subsist, it will not be clubbed in the hands of parents, it will be clubbed in the hands of legal guardian. Next one, in case of clubbing of minor income, take it for granted for every child section 10 subsection 32 exemption will be allowed at the rate of 1500 per annum per child. I repeat, if clubbing is done, take it for granted 1500 per annum per child. Per annum per child will be allowed as exemption, maximum exemption 1500 if clubbing provision is done. If there is no clubbing provision, then there is no question of 1500 exemption. Okay, chalo. Suppose one son is a cricketer. So whenever he is a cricketer, he participate in the cricket tournaments and got the remuneration. Sorry, it will not be clubbed in the hands of father. Then 1500 exemption is not applicable with respect to that child. Okay, chalo. Next one, any income to minor child on investment income or something will be clubbed. I repeat, income will not be clubbed, but on that income, minor income, if you get any income, that will be clubbed. Okay, chalo. If minor attained majority during the year, in this case it will not be clubbed. So once minor became major, then there is no question of clubbing. Okay, chalo. Next one, HUF. Follow friends, in case of HUF Hindu undivided family, if any person, any family member, co-partner, individual transferred is a self-acquired property to HUF. I repeat, transferred is self-acquired property to HUF. Take it for granted, the income of such property will be clubbed in the hands of transferor. Example I will take, One example, here one family is there, XYZ family. Our individual is Mr. X. He is a chartered accountant. One day he did the job and he got the salary of 10 lakh. With this 10 lakh, he bought one house property. I repeat, with this 10 lakh, he bought one house property. So on that, he transferred this property to family HUF XYZ HUF. On that house property, they got rental income of 4 lakh. For example, what is the treatment? Answer, that income will be clubbed in the hands of Mr. X only. Even though he transferred the property to HUF, income on that transferred property will be clubbed in the hands of HUF or individual. In the hands of individual means transferor. Leave it. Suppose in future that HUF wanted to partition, I repeat, the properties of HUF wanted to be partitioned. That means the building and land, everything they want to partition. Suppose in future, if such a transferred property, I repeat, such a transferred property, in my example, X transferred the property to HUF, no, that transferred property in future they wanted to segregate, they want to divide among the all other family members like X, Y, Z, like that. In this case, whatever the share of, I repeat, whatever the share of spouse of transferor will be clubbed in the hands of transferor. Don't confuse, very simple. Suppose this first portion given to X, yes, it will be taxable in the hands of X only. Suppose second portion given to Y, it is taxable in the hands of Y only. When? At the time of partition. Third portion given to Z, yes, that is taxable in the hands of Z only, no clubbing. Suppose fourth portion and last portion given to Mrs. X, you know what? Mrs. X means spouse of the transferor, no. Spouse of the transferor, no. The income from such share will be clubbed in the hands of transferor. So conclusion, 2 points only 2 points. If any individual transferred property to HUF, in this case, the transferred property income is taxable not in the hands of HUF, is taxable in the hands of transferor. Suppose in future if partition took place, in this case, only the share of, I repeat, only the share of spouse of the transferor will be clubbed. That's all. Next one, other special points, please follow, friends. Number 1, income will be clubbed, but income on income will not be clubbed. I repeat, income will be clubbed, income on income will not be clubbed. Some persons will change identity of the assets, then also clubbing provisions are applicable. For example, I given cash to you. With that cash, you bought one property, then you are getting rental income. No doubt that rental income will be clubbed. Suppose if you receive any capital asset and you sold it out and you got the consideration, that is also clubbed. But exempted income will not be clubbed. Suppose I did agriculture in your name, sorry, that agriculture income will not be clubbed. And chapter 68 deductions will be allowed against clubbing income also. Suppose my income 10 lakh, but I took my son's income also in my hands as a clubbing provisions. Suppose my son income 2 lakh, total 12 lakh. Yes, deductions will be allowed against 12 lakh. So deductions will be allowed with respect to clubbing income also. Next one, accretion of income will not be clubbed. Suppose my name is Mr. H husband, my wife, I only transferred one property to my wife. On that property, whatever the income, that income lifelong will be clubbed in the hands of husband. But friends, with this amount, she purchased another property. On that property, if she get any income, sorry, it will not be clubbed. So income will be clubbed, friends. Accrued income, on that income will not be clubbed. I repeat, income will be clubbed, but income on income will not be clubbed. Okay, chalo, heads of income. Sir, it is clubbed in the hands of particular heads only. See the word, after computing the income in the hands of recipient, it will be included under the same head. Whatever the head, general head, suppose Business profits received in the name of son. It will be clubbed in the hands of father's hands only, but under the head PGPB. Maybe father or mother whose total income is higher. Next one, clubbing negative income. Clubbing of negative income means losses. Yes, losses also will be clubbed. Clubbing provisions are applicable for income as well as losses also. Last topic, cross transfer. Important topic for exam. See the word. Salman Khan. He transferred the property to Salman Khan wife, Mrs. Salman Khan. Don't ask me that, sir, Salman is unmarried. None of our business. Follow the example. If Salman Khan transferred to Salman Khan wife, then the income from such property will be clubbed in the hands of Salman. It is okay, kada? Reverse. Follow. Salman Khan, he transferred 10 crore rupees to Mrs. Shah Rukh Khan or Mrs. Amir Khan. Whereas Amir Khan transferred the amount to 10 crore, he transferred to Mrs. Salman Khan. Oh, Amir Khan transferred to Salman Khan wife, whereas Salman Khan transferred to Amir Khan wife. I hope you know the reason. Very simple. If you transfer to your wife, clubbing applicable. That is the reason these fellows wanted to transfer to others' wife. In order to escape from the tax, they want to do like this. This is the reason government introduced one concept, lawmaker introduced one concept, cross transfer. You know what? There are more than one transfer. The two, each one is a consideration for other. Here, Salman Khan transaction is a Salman Khan transaction is a consideration for Amir Khan transaction. Same way, Amir Khan transaction is also consideration for Salman Khan transaction. Consideration means very simple. Why Salman Khan transferred? Because Amir Khan transferred. That is the reason Salman also transferred. Why Salman transferred? Amir transferred. That is the reason Salman transferred. Salman transferred. That is the reason Amir Khan transferred. Therefore, cross transfer is a transfer where two parallel transactions will be there. One is a complement to other. One is consideration for other. In this case, what is the answer? Very simple. Suppose 10 crore given by Salman Khan to Amir Khan wife. Amir Khan also given 10 crore rupees to Salman Khan wife. Suppose they made FD. She got 1 crore. Here she also got 1 crore. Take it for granted. Mrs. Amir Khan, whatever the amount she earned, that is not clubbed in the hands of transferor Salman. It is clubbed in the hands of husband only, Amir Khan only. Same way, Mrs. Salman Khan, whatever the income she earned because of that cross transferred FD or amount, that amount will be clubbed in the hands of Salman only. Okay, indirectly it is transferred in the hands of their spouses. That's all. I would like to take one example, another example, then you will get more clarity. This is very, very important for exam. Follow. Mr. X, he transferred to Mrs. X. Mrs. X, how much you know? 40 crore. The 40 crore they made deposit in the bank, they got 4 crore. I repeat, Mrs. X transferred to Mr. X transferred to Mrs. Y. Mrs. Y, 40 crore. Mrs. Y deposit in the bank got 4 crore rupees. Same way, Mr. Y transferred 50 crore rupees to Mrs. X. Mrs. X made the FD, she got 5 crore rupees. Now my question, what is the treatment of 4 crore? Answer, this 4 crore, whatever the income earned by Mrs. Y is clubbed in the hands of Mr. Y only. Okay, because indirectly it is taxable in the hands of ultimate transferor Mr. Y only. Same way, Mrs. X also got 5 crore rupees. No, out of 5 crore, clubbing applicable only for 4 crore. For 1 crore, there is no clubbing. For 1 crore, there is no clubbing because cross transfer means consideration for each other. Why Mr. X transferred 40 crore means Y transferred 40 crore. That is the reason X also transferred 40 crore. This is the consideration. But if you observe carefully, someone transferred 50 crore and 10 crore extra. So out of these two transaction common figure is 40. So common consideration 40 crore only. Therefore clubbing provision applicable only for 40 crore. For this extra 10 crore clubbing provision not applicable. Come to this topic. Mrs. X got 5 crore income gada. Out of that 4 crore income only will be clubbed in the hands of Mr. X. Whereas the 1 crore will be taxable in the hands of Mrs. X only. Mrs. X only. For 1 crore there is no clubbing. Because in case of cross transfer, whatever the common consideration, that is only subject to clubbing provisions. Any extra amount given beyond the common consideration, that should not be considered for clubbing purpose. Very, very important topic for exam. With this, done with the topic called as clubbing provisions. Out of that, minor income topic is very important. Friends, in today's lecture, we are going to cover set off and carry forward of losses. Very important topic for exam point of view. Out of this topic, we can expect minimum 4 to 5 marks. In maximum cases, we can get problem out of this chapter. Friends, before going into this chapter, I would like to tell you one word. While calculating total income or else tax liability, we will follow the steps. Number 1, we will determine assessment year as well as previous year. Number 2, we will determine residential status of SSE. Number 3, we will calculate income from all 5 heads. That may be salary, that may be house property, that may be business or profession, that may be capital gains, and the last one but not least one, that is IFOS, income from the head other sources. After calculating all the things, we need to consider the provisions of clubbing of income. After that, we will consider the provisions of set off and carry forward of losses. Then only we will get gross total income. Out of the gross total income, we need to give deductions under section 80C to 80U. After that, we will get total income or else net income. Such a total income is only taxable. Okay, chalo. Friends, here I would like to highlight one point. Set off and carry forward provisions shall apply before claiming deductions under chapter 6A. First, we need to consider clubbing as well as set off and carry forward provisions. Then only we need to calculate gross total income. Out of the gross total income only we need to give deductions. So first we need to consider set off of losses. Afterwards only we need to give the deductions. So set off of losses shall be considered before claiming deductions. I repeat, set off of losses shall be considered before claiming deductions. That is first one. And next point ma. Set off and carry forward of losses shall consisting of two things. One is set off of current year losses. Second one is carry forward of unabsorbed losses of earlier years. So friends, first we need to consider set off of losses. We need to adjust current year losses. For that purpose, there are two possibilities. First one is section number 70, that is called as intra-source adjustment. I repeat, intra-source adjustment. That means one source loss can be adjusted within the same source. For example, house property loss can be adjusted against other house property income if any. That is called as intra-source adjustment or else called as intra-head adjustment. This is nothing but section number 70. And another topic is there, section number 71, that is nothing but inter-head adjustment. Inter-head adjustment means one head loss can be adjusted against other head income. That is called as inter-head adjustment. That is section number 71. Okay, so set off of current year losses can be adjusted in two ways. That is section number 70, intra-source adjustment, whereas section number 71, inter-head adjustment. After that, if you have any unabsorbed losses in the current year, that losses can be carried forward for next year and can be adjusted against income of next year. That is called as carry forward of losses. Okay. So now we are going to cover the concept of set off and carry forward of losses, and we need to consider the conditions as well as other points related to set off and carry forward of losses. Before that, I would like to tell you one word. Section number 70 to section number 80. I repeat, section 70 to section number 80. These provisions are dealing about the provisions of set off and carry forward of losses. Here and onwards, please remember, when you heard the word section number 70, 71, 72, 80 like that, these sections are exclusively related to set off and carry forward of losses. Now, let's start with the heads. First one is called as salary. Friends, take it for granted. Set off and carry forward of losses, this concept is not applicable for salary chapter. Very simple reason, there is no question of loss in case of salary head. While computing income from the head salary, there are no much deductions will be allowed except section number 16. Whenever there are no much deductions are allowed, there is no concept of loss. Whenever there is no concept of loss, there is no concept of set off and carry forward of losses. When there is no concept of set off and carry forward of losses, then where is the question of provisions of section 70 to section 80 are applicable for salary? Not at all applicable. Okay, chalo. So set off and carry forward of losses are not applicable to salary chapter. Leave it. Next, house property losses. Is it possible? Yes, possible. How? While computing income from the head house property, we will allow deduction with respect to interest on housing loan taken. Because of that interest portion, our computation may result into losses, that is called as house property loss. Now, what is the treatment of house property loss? Yes, number one, house property loss can be adjusted against house property income, that is called as intra-source adjustment or else intra-head adjustment. Yes, allowed without any limit. Second, if you have some more losses, that losses can be adjusted against any other head income. I repeat, other head income. Yes, house property loss can be adjusted against salary. House property loss can be adjusted against PGPB. House property loss can be adjusted against capital gain. House property loss can be adjusted against other income also. But your maximum monetary limit is 2 lakhs. We can adjust house property loss against other heads for a maximum amount of 2 lakhs. More than 2 lakh we cannot adjust. That's all. Next one. After doing intra-source adjustment as well as inter-head adjustment, if you have any other losses from the head house property, that losses can be carried forward for next year. In next year, we can adjust only against house property income only. Next, it can be carried forward for a maximum period of 8 assessment years, only 8 assessment years. And the two friends, that carry forward purpose, compulsory we need to file the return of income. The two return of income must be filed within the due date specified under section 139 subsection 1. But there is relaxation. The relaxation is nothing but return if you file lately. If you filed house property loss return belatedly, then also house property loss can be carried forward. So friends, filing of return of income within the due date specified under section 139 subsection 1 is not mandatory, that is purely optional. Last one, continuity of the source. Shall I need to maintain the same house property or not? That is the question. Answer, not at all. Suppose I have one house property in Hyderabad, that house property resulted into loss. Yes, that loss can be carried forward even though I sold such house property, even though I sold Hyderabad house property. Yes, such loss can be carried forward. That means continuity of the particular source of income is not at all mandatory, purely it is optional. Okay friends, with this we done with the topic called as loss from the head house property. First one, salary topic. Set off and carry forward provisions are not applicable. Second one, house property loss. Yes, intra source available, inter source available, maximum of 2 lakh. And next one, carry forward purpose. Intra source of losses of this year can be carried forward for next year, but it can be adjusted only against such income only. Such income means only house property income only. That too, it can be carried forward like this for maximum period of 8 assessment years, and filing of return of income condition is not at all applicable, that is purely optional. And the last one, continuity of the particular source of income is not at all mandatory. Even though you sold that particular house property, no problem, that loss can be adjusted against any other house property which is owned by our SSE. That's all. Next other topic is business or profession. Friends, here there are total 4 things. First one is called as speculative business. Another one is called as non-speculative business. Another one is called as unabsorbed depreciation. Another one is called as specified business loss covered under section 35 AD. First, let me introduce the concept of non-speculative business. Friends, non-speculative business means the business which is not a speculative. I repeat, other than speculative business is called as non-speculative. In case of non-speculative business, if you have any loss, that loss can be adjusted against any other business income only. That means intra source available. Next one, such losses can be adjusted against any other heads also, but except salary. So business losses cannot be adjusted against salary. Next whatever the business loss, non-speculative business loss unabsorbed so far, that unabsorbed amount can be carried forward for next year, and it can be carried forward for a maximum period of 8 assessment years, and the filing of return within the due date specified under section 139 subsection 1 is mandatory, compulsory. And the two friends, continuity of the particular source of income is not at all mandatory. Suppose I am doing computers business, I got the loss. That loss I can carry forward even though I closed that particular business. Even though I closed that business, I can carry forward the loss. That means the condition of continuing source of particular income is not at all mandatory. Okay, chalo. Next one, speculative business loss. Friends, speculative business means that transactions which are settled other than physical delivery of goods, other than physical delivery, that is called as speculative. In case of speculative business losses, it can be adjusted only against speculative business income only. It cannot be adjusted against any other business income. It can be adjusted only against speculative business income only. The two, that speculative business loss cannot be adjusted against any other heads. Speculative business loss cannot be adjusted against even salary. It cannot be adjusted against house property. It cannot be adjusted against capital gains. It cannot be adjusted against other sources also. Speculative business losses can be adjusted only against speculative business income. In case of unabsorbed amount, that unabsorbed amount can be carried forward for next 4 assessment years. I repeat, only 4 assessment years, not 8 assessment years. That too, in the next year also, it can be adjusted only against speculative business income itself. Next filing of return of income is mandatory. Compulsory, we need to file the return of income within the due date specified under section 139 subsection 1. Then only such losses can be carried forward. And continuity of the source is not at all relevant. I repeat, continuity is not at all relevant. That is called as speculative business loss. Next one, friends, another topic is called as unabsorbed depreciation. Very, very important concept. Very important and a special point, friends. Unabsorbed depreciation can be adjusted against any income. It can be adjusted against business income, and it can be adjusted against any other head also, but except salary. Unabsorbed depreciation cannot be adjusted against salary income. But friends, unabsorbed depreciation can be carried forward for next year and can be adjusted against any head of income except salary. The two, friends, it can be carried forward for any number of years. There is no such restriction. There is no concept of 8 years. There is no concept of 4 years. It can be adjusted for any head of income, and it can be adjusted and it can be carried forward for any number of years. And next one, friends, filing of return of income within the due date is not at all mandatory. That is optional. So here there is no such criteria, there is no such condition. So filing of return of income is not mandatory. That is purely optional. Next one, friends, continuity of the particular source of income is not at all mandatory. Not at all mandatory. Okay, chalo. Next one, friends, specified business losses which are covered under section 35 AD. Yes, that specified business losses can be adjusted against only specified business income. I repeat, only against specified business income. That too, it can be adjusted only against specified business income but not against any other income. And it can be carried forward for any number of years. And filing of return of income is compulsory. And continuity, the particular source of business is not at all mandatory. Even though you closed such a specified business and you can start another specified business, and that old business losses can be carried forward and can be adjusted. And friends, last but one head, that is called as capital gains. There two parts are there. First one, short-term capital loss, and the second one is called as long-term capital loss. As far as short-term capital loss is concerned, it can be adjusted against capital gain income itself. But such short-term capital loss cannot be adjusted against any other head of income. The two, friends, short-term capital loss can be carried forward for next 8 assessment years, and filing of return of income is compulsory. We need to file the return within the due date specified under section 139(1). Then only that short-term capital loss can be carried forward. Next, short-term capital loss can be adjusted against short-term capital gain, or else maybe can be adjusted against long-term capital gain also. There are no such condition that short-term must be adjusted against short-term. There is no such restriction. You can adjust against short-term, or else you can adjust against long-term also. Okay, chalo. Next one, friends, long-term capital loss. Friends, long-term capital loss can be adjusted only against long-term capital gain. I repeat, long-term capital loss can be adjusted only against long-term capital gain. The two, long-term capital loss cannot be adjusted against any other heads of income. Next one, friends, that unabsorbed long-term capital loss can be carried forward for a period of 8 assessment years, and filing of return of income is mandatory. The two, that can be adjusted only against long-term. So I would like to say the point again. Short-term loss can be adjusted against short-term gain or else long-term gain. But whereas long-term losses can be adjusted only against long-term gain but not against any other head of income. Next one, that is losses from the head other sources. Again, there are two parts. One is called as other losses. Another one is called as loss from the activity of owning and maintaining of race horse. I repeat, owning and maintaining of race horse. First one is other losses. Friends, other losses, yes, it can be adjusted against any other head of income. That means other sources, against other sources income we can adjust. Still if you have any losses, that losses can be adjusted against any other head like house property, PGPB, capital gain, like that. Next one friends, whatever the unabsorbed other losses, it cannot be carried forward. Take it for granted, it cannot be carried forward. And last point friends, loss from the activity of owning and maintaining of race horses. Such loss can be adjusted against such income only. But such losses cannot be adjusted against any other head of income. If anything left over, then the unabsorbed amount can be carried forward for a maximum period of 4 years. That too, filing of return of income within the due date is mandatory. That too, continuity of the particular source of income is mandatory. Maintaining of horses and owning them as well as maintaining that race horses is mandatory. Here, if you carry the particular activity, then only that losses can be carried forward against such income only. So here, continuity of the particular source of activity, particular source of income is mandatory. Okay, chalo friends, with this we're done with the topic that is called as set off and carry forward. Here I would like to revise the points again. Please follow. Number one, first one friends, we need to consider salary income. While calculating salary income, take it for granted there is no question of losses. Therefore, set off and carry forward provisions are not applicable. See the word set off and carry forward losses, that provisions are not applicable for income from the head salary, as there is no salary under the head, as there is no losses under the head salary. There are no possibility of losses. Therefore, set off and carry forward provisions are not applicable. Next one friends, loss from the head house property. Already I told you, house property loss, first we need to adjust against house property income. That too there is no limit. But house property loss can be adjusted against salary or else PGPB or else capital gain or else other sources, maximum of 2 lakh within this year. If anything left over, that can be carried forward and it can be adjusted against income from the head house property of next year only. Like that, it can be carried forward for a maximum period of 8 assessment years. I repeat, only 8 assessment years. But here one important point, that is nothing but filing of return is not at all mandatory. Filing of return of income is optional. Okay, chalo. Next one friends, another topic is called as business or profession. There are 4 concepts. One is non-speculative, second one is the speculative, next one is the unabsorbed depreciation, and the last one is the specified business loss. Friends, non-speculative, normal things only. It can be adjusted in the same year against business income, and the two balance, if any, it can be adjusted against any other rates of income except salary, and balance can be carried forward for 8 assessment years, and filing of return of income is mandatory, and the continuity of the source is not at all required. And next one friends, speculative business loss. It can be adjusted only against speculative business income itself. That too, it can be carried forward only for maximum period of 4 years. It cannot be adjusted against any other head of income also. And continuity is not relevant. That means if you discontinued one speculative business, another speculative business income can be utilized for the purpose of set off. Next one, unabsorbed depreciation. Unabsorbed depreciation is a non-cash expenditure. It can be adjusted and it can be carried forward for any number of years, and it can be adjusted against any income except salaries. And the two, filing of return of income is not mandatory. Filing of return of income is optional. Next one friends, specified business loss covered under section 35 AD. Such specified business loss can be adjusted only against such income itself. The two, it can be carried forward for any number of years, and the filing of return of income is compulsory. Next one friends, that is called as other in losses, that is capital gains. Here short term capital loss can be adjusted against short term as well as long term, but capital losses cannot be adjusted against any other head of income. That too, it can be carried forward for 8 assessment years, and filing of income return is mandatory. Next one, friends, long-term capital loss. Yes, long-term loss can be adjusted and can be set off against only such long-term capital gain only, but it cannot be adjusted against short-term itself, and it cannot be adjusted against any other head of income also. It can be carried forward for 8 assessment years, and filing of return of income is mandatory. And last head, friends, that is other losses. Other losses can be set off against other income, as well as it can be carried forward against other heads of income in the same year. But if any unabsorbed amount, it cannot be adjusted against any other heads of income of further years. Next one, friends, another topic, last concept is losses from the activity of owning and maintaining of resources. Yes, such losses can be adjusted only against such income only. It can be carried forward for a maximum period of 4 years, and filing of return of income is mandatory, and continuing the source is relevant. I repeat, is relevant. That's all. And friends, here special points I would like to tell you. Please follow. Number 1, there is a concept called as sin money. S-I-N, sin money. That means casual income. Lottery, card games, horse races, etc. No expenses are allowed with respect to such income. Therefore, no question of losses. Therefore, set off and carry forward provisions are not applicable for casual income. But there is another concept called as the activity of owning and maintaining of resources. There, expenses are allowing. That is the reason there is a possibility of losses. Therefore, set off and carry forward provisions are applicable for that. The two, that losses can be carried forward for maximum period of 4 years, but not for a period of 8 assessment years. Next one, how many years we can carry forward? Already we completed the table, right? There, sometimes we can carry forward for any number of years. Sometimes we can carry forward for 8 years. Sometimes we can carry forward for 4 years. Sometimes we cannot carry forward. So let's check the table. Point number 1, other losses, income from the head, other sources. No, their other losses cannot be carried forward at all. Only we can do adjustment in the current year, but we cannot carry forward. Number 2, in some cases we can carry forward for a maximum period of 4 assessment years. That may be speculative business loss, or else loss from the activity of owning and maintaining of resources. Next one, some are carry forward for any number of years. There is no time limit at all. That is unabsorbed depreciation, as well as a specified business loss covered under section 35 AD. And rest of the things can be carried forward for 8 assessment years. Next one, friends, another topic, that is filing of return of income. Friends, common sense, if we want to carry forward the losses, compulsory we need to file the return of income within the due date. Then only assessing officer know about the tax implication. Then only assessing officer know about how much is the loss, how much they want to set off, everything they will know. If you have not filed the return of income, take it for granted such losses cannot be carried forward. So filing of return of income is mandatory for carry forward of losses. The two, that return of income must be filed within the due date specified under section 139 subsection 1. So filing of return of income is mandatory in all cases, but in 2 cases it is not at all mandatory. Even though you filed belatedly, that losses can be carried forward. That is nothing but number 1, house property losses purpose. Number 2, unabsorbed depreciation purpose. So therefore, I can say that even though we filed the loss return belatedly, then also 2 losses can be carried forward happily. That is called as house property loss, and the second one is called as unabsorbed depreciation. Next one, business losses or provisional losses. Take it for granted, it cannot be adjusted against salaries. Next one, unabsorbed depreciation can be adjusted against any income except salaries. Take it for granted, finally, business loss cannot be adjusted against salaries. Any business loss, maybe speculative, maybe non-speculative, maybe specified business loss, or maybe unabsorbed depreciation, cannot be adjusted against salary. Okay, next one. Sir, set off and carry forward provisions are applicable for all? Yes, all, but not applicable for particular income. Number one, not applicable for salary. I told you the reason also, because in case of salary there is no question of loss. There is no loss means there is no question of set off and carry forward. Okay, number two, exempted source of incomes. Example, agriculture income. You know, any farmer will get the agricultural loss. Answer, maybe yes, but technically as for the subject it is not. The reason is agriculture income neither taxable nor allowed as deduction. Therefore, take it for granted, exempted source of income. I repeat, exempted source of income. Set off and carry forward of losses not applicable. I got agriculture income 10 crores, no need to pay tax. I got agriculture loss 10 crores, no importance at all, because that is none of our business. Any exempted source of income not taxable. Same way, any loss if you get from the exempted source, that is also not relevant. Therefore, I can say that set off and carry forward provisions are not applicable for exempted source of income. Next one, casual income. Sir, easy money, sin money. Set off and carry forward provisions are not applicable for casual income concept. For example, I participated in KBC, Kaun Bane Crorepati, and I got the amount of 5 crore. Yes, my 5 crore is taxable. Suppose I participated in KBC, Kaun Bane Crorepati, I got loss of 1 crore. Sorry, no loss, because no expenses are allowed. Lawmaker is telling that if you get the income, pay the tax. If you get the loss, get lost. You no need to pay tax and you no need to ask me set off. Therefore, set off and carry forward of provisions are not applicable for casual income also. But one activity is there that is called as activity of owning and maintaining of race horses. Yes, that losses can be carried forward for a maximum period of 4 years. So friends, special points. The following losses cannot be set off against the following incomes. Number one, business loss, not against salary. Short-term loss. Short-term loss cannot be set off against any other income. Long-term loss. Long-term loss cannot be set off against short-term capital gain, and long-term loss cannot be set off against any other income also. Next one, speculative business loss. Sorry, it cannot be adjusted against any other income. Even it cannot be adjusted against non-speculative income also. Next one, loss from the activity of owning and maintaining of race horses. Yes, that cannot be adjusted against any other income also. That's all. Next one, friends, IFOS, income from the head other sources. That other losses can be set off but cannot be carried forward. If you want, you can adjust in the current year, but sorry to say, you cannot carry forward for further years. Next one, continuing of the particular source of income is mandatory or not for the purpose of set off. Answer, not mandatory. For example, I have two houses. One is a Hyderabad house, another one is Chennai house. From my Hyderabad house, I got the loss, and I sold my Hyderabad house. Now my question is, that Hyderabad house loss can be adjusted against Chennai house, yes or no? Answer is yes. It is not mandatory to maintain Hyderabad house permanently. So continuity of the particular source of income is not mandatory. But friends, in one case it is mandatory. That is nothing but the activity of owning and maintaining of race horses. In that concept it is mandatory. Friends, another concept, order of set off. How to do adjustment? Number one, first we need to take care of current year losses, if any. Number one, current year scientific research expenditure covered under section 35, that only we need to consider first, if any. Number two, current year depreciation. Number three, current year family planning expense. I repeat, current year scientific research expenses and current year depreciation and current year family planning expenditure we need to consider. Afterwards, we need to consider unabsorbed business loss, and unabsorbed depreciation and unabsorbed scientific research expenditure and unabsorbed family planning expenditure. So this is the way we need to consider. I would like to tell you one technique so that you can easily remember. Student fail because don't study as well as Facebook. I repeat, student fail because he don't study as well as because of the Facebook he is not opening at all. He is not at all opening the regular books, so he may fail. So remember, S D F B D S F. Okay, so this is the order. First three are current year. So current year scientific research, current year depreciation, current year family planning expenditure. Last one, unabsorbed business loss, unabsorbed depreciation and unabsorbed scientific research expenditure as well as unabsorbed family planning expenses. Okay, chalo friends, this is the chapter set off and carry forward of losses. Let's check the material ones. All of you please follow. First one, section number 70, that is nothing but intra-source adjustment. After that, next one is called as section number 71, that is called as interhead adjustment. So friends, section number 70 means intra-head adjustment, section number 71 means interhead adjustment. Always first we need to take care of intra-head adjustment. After that only we need to go for interhead adjustment. Okay, so salary chapter anyhow not applicable. Next one, house property chapter, yes, that is intra-head applicable, interhead that is also applicable, but maximum 2 lakh. That too, it can be carried forward for 8 assessment years and as well as filing of return of income optional. Next one, business concept also we covered. One is non-speculative, normal way, and speculative, that means without physical delivery if you settled anything, that is called as speculative. Next one is called as specified business, which is covered under section 35 AD, that also we completed. That can be adjusted against same head of income, that means same source of income. It can be carried forward for any number of years, but filing of return is mandatory. Next one, capital gains, long term as well as short term. So long term can be adjusted only against short term, whereas short term loss can be adjusted against short term as well as long term. Next one friends, another topic we covered, that is called as loss from the activity of owning and maintaining of resources. It can be adjusted against same head of income. Okay, chalo. And next one, other casual income, anyhow it cannot be set off, it cannot be carried forward. Next one friends, other information, filing of return of income is mandatory in many cases but not mandatory in 2 cases, that is house property loss as well as unabsorbed depreciation. And no losses can be set off against casual income. I told you, no, casual income is taxable at the rate of 30% as per the provisions of section 115 BB. Therefore other losses cannot be adjusted against such income. Other losses cannot be adjusted against casual income because casual income always taxable on gross basis, the two at the rate of 30%, the two as per the provisions of section 115 BB. Next, losses related to exempted income not at all allowed for carry forward. I told you the lawmaker intention. Whenever one particular income is exempted, lawmaker intention is very clear. No need to pay the tax, as well as in case of loss, no need to set off. That's all. Next one, long-term capital gain covered under section 112A, that is anyhow exempted up to 1 lakh. Over and above 1 lakh, if anything is there, that amount is only taxable, that we know. But friends, in case of loss, take it for granted, the entire amount can be carried forward. Special point, okay? In case of capital gain, the two specified capital gain covered under section 112A, any loss, the entire loss can be carried forward. Okay, next, sixth point, loss can be set off against income clubbed in the hands of SSC. Suppose friends, father and son minor income is clubbed in the hands of father. For example, in this case, father losses can be adjusted against the income which is clubbed in the hands of father. Okay, so while clubbing the income, then also set off and carry forward provisions we can apply. Next one, friends, the SSC opted provisions of section 115 BAC, that is a alternate tax regime. In this case, the losses of house property cannot be set off against any other head of income. So friends, interhead adjustment is not at all applicable. I repeat, interhead adjustment is not applicable in case of SSC who opted the provisions of section 115 BAC. Okay, this is the amendment. Take care. Next one, if more than one source of income is available for set off, then SSC can choose which is beneficial to him. When lawmaker is silent, when there are two options are available, then take the best option, which is best to the department or best to the SC. Yes, which is best to the SSC, that only we can take it. Under which option the tax liability would be less, that option we can avail if lawmaker is silent. Okay, chalo, that is the another point. Next one, friends, another topic is as follow. Set off is mandatory. I repeat, set off and carry forward is mandatory. Set off is mandatory in the first available chance. Okay, next, brought forward losses shall be set off in the immediately succeeding years or years. So next possible opportunity, you have to do it. So immediately next year, if income is there, you can adjust. If no income, then you can carry forward for another year. Next one, set off of losses not permissible against unexplained income as well as unexplained investment as well as unexplained money, unexplained bullion, etc. So friends, certain incomes are covered under section 115 BBE. I repeat, 115 BBE. So that incomes which are covered under 115 BBE, that incomes are not eligible for set off. That means, friends, suppose I got the loss. Similarly, I have certain incomes which are taxable under section 115 BBE. Take it for granted, such losses cannot be adjusted against income which is covered under section 115. Next one, friends, 12th point, any loss incurred in the year in which the business is discontinued by the SSC shall be allowed to set off against the deemed profits, and only the balance income shall be taxed under section 45 subsection 5. In this situation, 8 years limit is not applicable. So friends, in the case of business or portion chapter, there is a concept called as a discontinued business. In the discontinued business, whatever the losses you have, that losses we can adjust and we can carry forward against deemed business profits even after expiry of 8 years also. So there is a concept called as deemed business profits under section 41. So any discontinued business loss, if any, it can be adjusted against deemed business profits also even after expiry of 8 assessment. And next one and last one, friends, order of set off of loss. As I told you earlier, that is a student. Okay, so fail because he don't study because of Facebook. See the word, that is current year scientific research, current year depreciation, and current year family planning. Don't study, no, because of Facebook, so they fail. That is nothing but brought forward business loss and brought forward depreciation as well as brought forward of scientific research expenditure, and last one is unabsorbed expenditure related to family planning. This is the order of set off of losses. Compulsory we need to stick on to the particular order while doing set off and carry forward of loss. Okay friends, with this I completed the topic called as set off and carry forward of losses, and I revised this topic already. Okay, thank you very much. See you. Friends, in today's lecture I am going to cover the important topic that is called as computation of total income and tax liability. Friends, very important concept. Out of this concept we can expect minimum 18 marks question. But friends, if you want to learn this concept, First you have to learn all the heads of income, as well as you have to cover clubbing provisions, and you have to cover set off and carry forward of losses, and you have to cover the chapter called as deductions, and you have to learn special tax provisions also. Anyhow, please follow. The concept is a computation of total income and tax liability. Friends, first, if any SSC comes to your office, then first you have to ask, sir, what is the assessment year as well as previous year? That you have to learn. So, assessment year and previous year. Number 2, you have to determine a residential status. Sir, are you resident or non-resident? Tell me. If you are a resident, then again tell me, are you resident but ordinary resident or resident but not ordinary resident? Tell me. Like that, we need to determine the residential status. Afterwards, we need to calculate income from different heads. First head is income from the head salary. Second one is income from the head house property. Third one is income from the head business or provision. Next one is income from the head capital gains. Next one is income from the head other sources. After that, what you have to do, you have to apply clubbing provisions. That means if you transferred income to anyone, that income also will be clubbed in the hands of the transferor. That clubbing provisions we need to apply. Same way, we need to consider clubbing of minor income. After that, we need to apply the provisions of set off and carry forward of losses. After that, we need to make the total, that is called as gross total income. Out of the gross total income, we need to give deductions under chapter 6A, or else we need to give deduction under section 80C to 80U. Then we will get total income or net income. That's all. This is the way we need to calculate the total income computation. After that, we have to calculate tax liability. Friends, for tax liability purpose, what we have to do, there are two types of income. First one is income which is subject to special tax provisions. Second one is income which is subject to normal tax provisions. First, remember, we need to calculate income tax liability which are subject to special tax provisions. Special tax provisions, that is as follows. Number 1, in case of capital gains, I repeat, in case of capital gains, special tax provisions are applicable. First one, short-term capital gain. I repeat, short-term capital gain, that is which is covered under section 111A, that is subject to 15% tax rate. Whereas long-term capital gain, that is subject to 20% tax rate. Whereas long-term capital gain covered under section 112A, that is subject to 10% tax rate. Like that, first you have to calculate special tax liability. And same way, friends, in case of income from the head other sources, we need to calculate special tax liability, that is winning from lotteries, card games, etc., which is subject to 30%. That one also we need to calculate. So first remember, you have to calculate special tax. After that, we need to calculate normal tax provisions as well as normal slab rates. Okay, chalo. Normal taxes applicable for all others other than capital gains and other than casual income. Generally, that income is subject to normal tax provisions, that is salary, house property, and business or provision, as well as income from that other sources other than casual income. Anyhow, these are subject to normal tax rates. These we need to calculate. But I would like to highlight one more point. While giving deduction under chapter 6A, take it for granted that deductions are not applicable against following incomes. Number 1, long-term capital gain income is not subject to any more deductions. Very simple reason. we have given special tax provisions, no, we have given a very special tax rates, no, therefore other benefits not applicable, therefore no deductions will be allowed against a lump term capital gain. Same way, no deductions will be allowed against a short term capital gain covered under section 311A. Therefore, no deductions will be allowed against casual income which is covered under section 115BB. So take it for granted, deductions will not be allowed against the special taxed incomes. And another point, very important point, when the SSE has agricultural income as well as non-agricultural income, then grossing up provisions are also applicable. I repeat, agricultural income as well as non-agricultural income, take it for granted, grossing up provisions are applicable. Very, 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 very important concept. If you see the problems, in many problems examiner has given this figure, take it for granted. When agricultural income is more than 5,000 as well as non-agricultural income is more than basic exemption limit, take it for granted, we need to calculate tax liability as per aggregation method. Okay, chalo. So this is the way we need to calculate total income and tax liability. Okay, now see the material ones. First one, friends, determine assessment year as well as financial year, means previous year. Number 2, determine the residential status. After that, determine the income from different heads, salary, house property, business or portion, capital gain, other sources. After that, apply the provisions of clubbing as well as set off. Then determine gross total income minus chapter 6A deductions. After that, calculate net income. And take it for granted, deductions will not be allowed against those incomes which are subject to special tax rates. That is long-term capital gain covered under section 112 or else 112A, and short-term capital gain covered under section 311A, as well as casual income covered under section 115BB. And one more point I would like to highlight, if SSE has agriculture income more than 5,000, in case of individuals as well as HUF, take it for granted, grossing up provisions are also applicable. Agricultural income more than 5,000, non-agricultural income is more than basic exemption limit, take it for granted, grossing up concepts also applicable. And some incomes are subject to special tax rates, some incomes are subject to normal tax rates. My suggestion, please memorize the concept which are subject to special tax rates. One is long-term capital gain as well as short-term capital gain, one is casual income. Okay, chalo. And other point, friends, that is 115 BAC, alternative tax provisions. So friends, those persons who wanted to go for the concept of section 115 BAC, that is alternative taxation provisions, in this case, take it for granted, very less tax rates are applicable. I repeat, very less tax rates are applicable, but no certain benefits. The benefits are not applicable. If you are following 115 BAC and you have income from the head salary, these deductions not allowed, standard deduction not allowed, and entertainment allowance deduction which is applicable for government employees not allowed, and provisional tax deduction also not allowed. Take it for granted, section 16 deduction not allowed, and leave travel concession not allowed, HRA exemption also not allowed. Okay, chalo. And next one, friends, another point, special allowances benefits also not applicable, only few are applicable, that is conveyance is allowed, whereas transport allowance is also allowed, and transfer allowance and daily allowance, these are only allowed, others not at all allowed. Next one, if SSE is having income from the head house property, take it for granted, interest with respect to self-occupied property not allowed. I repeat, interest with respect to self-occupied property not allowed, but other than self-occupied property, let out interest anyhow allowed. Next one, if you are the SSE who are following business or provision, who are having business or provision income, deductions, certain deductions not allowed, additional depreciation not allowed, but take it for granted, normal depreciation allowed, but additional depreciation benefit not allowed if you want to follow 115 BAC provisions. And deduction specified business 35 AD not allowed, and specified deduction for donation covered under section 35 also not allowed, section 35 not allowed. Next one friends, if you have IFOS income, take it for granted, deduction for family pension, that is 1/3 of pension, or else 15,000, whichever is lower benefit is there, no, that is not at all allowed for those SSEs who are opted the provisions of section 115 BAC. And next one, in case of clubbing provisions, clubbing of minor income, that 1500 exemption under section 1032 not allowed. And next one, in case of set off and carry forward, certain benefits not allowed, that is interhead adjustment not allowed, whereas set off of house property losses not allowed under section 31. Interhead as well as set off of house property losses not allowed with respect to those SSEs who opted 115 BAC provisions, and with respect to chapter 6A deductions also not allowed. Only two deductions only allowed, 115 JAA, that is additional employment, and 115 CCD subsection 2, that is nothing but contribution made by the employer to NPS. These two deductions are only allowed, rest of the deductions not allowed. And next and last one, exemptions under section 10, that is also not at all allowed. Okay, chalo. So these are the topic. Next one friends, these tax rates are very low, as well as these benefits are also not at all allowed. Okay, chalo. Next one friends, another concept, that is AMT. That AMT means alternative minimum tax. You are going to learn in detail in CA final. In CA final we will learn about AMT as well as MAT, minimum alternative tax, but now the concept is AMT. Follow. Number one, some SSEs are paying low amount of tax or no tax at all. Therefore, Government of India wanted to collect some nominal tax from them. For that purpose, they introduced the concept called as AMT, alternative minimum tax. This AMT concept applicable to all SSEs other than companies, because for companies MAT concept is applicable, for other than companies AMT concept is applicable. The two friends, it is applicable to all SSEs other than companies. But one request, in case of individual HUF, AOP, BOI, AJP, I repeat, individual HUF, AOP, BOI, AJP, if their adjusted total income is more than 20 lakh, in that case only AMT applicable. So in other way, AMT provisions not applicable if their adjusted total income is up to 20 lakh in case of individual HUF, AOP, BOI, AJP. But this restriction not applicable for partnership firm and LLP. In case of partnership firm and LLP, anyhow the AMT provisions are applicable. How to calculate AMT? Very simple. First calculate adjusted total income. How to calculate adjusted total income? For that purpose, take your total income first. After that, add back the following deductions if any. Number one, deduction under section 10A, add back. If you have claimed, add back. Number next, deduction under section 35 AD, add back. If anything is there, add back. Last one, deduction under section 80 H2 80 TT. I repeat, deduction under section 80 H2 80 TT. These deductions if you claim, in this case these must be added back. Okay, chalo. Next one friends, we have to deduct depreciation with respect to investment made under section 35 AD. Sir, simple logic. Section 35 AD deduction, if you have taken, take it for granted, depreciation not allowed in general way, correct? But what I am doing here, while calculating adjusted total income, I am asking you to add back 35 AD deduction if you have claimed earlier. That means 35 AD deduction indirectly not allowed. When 35 AD deduction not allowed, take it for granted, depreciation will be allowed. Therefore, if 35 AD deduction, if you added back, take it for granted, corresponding depreciation on 35 AD deduction will be allowed. Therefore, we have to deduct. Then you will get adjusted total income. On that adjusted total income, we have to calculate AMT at the rate of 18.5%. Okay, chalo. So friends, generally the steps are as follows. Step number 1, we have to calculate normal total income. Step number 2, we have to calculate normal tax liability. Step number 3, we have to calculate adjusted total income. Number 4, we have to calculate AMT, alternative minimum tax. Common sense ma, we have to pay tax liability to the government is nothing but higher of normal tax or AMT. If AMT is higher, we have to pay as per the AMT. If normal tax is higher, then there is no headache at all. We can pay normal tax alone. So higher of normal tax as well as AMT we need to pay to the government. Suppose if anyone pay AMT, then automatically the differential amount between AMT and normal tax, that will be allowed as AMT credit. The AMT credit can be carried forward for a period of 15 years. I repeat, it can be carried forward for 15 years. It can be adjusted in the year in which your normal tax liability is higher than the AMT liability. I repeat, whenever normal tax liability is higher than the AMT liability, in that case that AMT credit can be adjusted. Otherwise, it can be carried forward for a maximum period of 15 years. If you are unable to adjust within the said period of 15 years, take it for granted it will get lapsed. That's all. With this, we done with the topic called as computation of total income and tax liability. Friends, very important concept. A category concept. Minimum 12 marks, maximum 18 marks we can expect out of this chapter. But that is not easy. If you want to get that 18 marks, compulsory you have to cover all the heads, all the chapters you have to cover thoroughly. You have to revise n number of times so that you can get command over the concept total income and tax liability. Okay, thank you very much. Friends, in today's lecture we are going to cover the topic called as advanced tax and interest. Friends, B category concept for exam point of view. First I would like to start the topic, that is advanced tax. Friends, section number 207 to section number 211, these provisions are dealing about the concept of advanced tax. Generally, income of this current previous year is taxable in the assessment year. Other way, income of this year is taxable in the next year. But as for the concept of advanced tax, income of this year is taxable in the current year itself. For that purpose, SSE has to estimate the income. On such estimated income, SSE has to estimate the tax liability. The so-called tax liability shall be paid in the current year itself. This is the concept called as advanced tax. Friends, now applicability of advanced tax. Advanced tax concept applicable to whom? That is the question. Friends, this concept is applicable only to those SSEs whose tax liability is 10,000 or more. See the word, tax liability of the SSE is 10,000 or more than 10,000. In this case, such SSE has to pay advance tax. So every SSE has to estimate its tax liability in the current year itself. Every SSE has to estimate its total income as well as tax liability. If the tax liability is at 10,000 or else more than 10,000, such a person compulsory has to pay advance tax. But the concept of advance tax is not applicable to one person. You know what? Those persons being residents as well as senior citizens and who does not have income from the head business or profession. For example, Mr. Rajnikanta is a resident of India as well as is a senior citizen. The two is not acting in cinemas, as well as he does not have any income which is taxable under that business or profession. For example, in that case, Mr. Rajnikant is no need to pay any advance tax, even though his tax liability, even though his estimated tax liability is more than 10,000. So friends, advance tax concept is applicable to all SSEs whose estimated tax liability is 10,000 or else more than 10,000 in the current year itself. But if is a resident senior citizen and the two who does not have business or profession income, he no need to pay advance tax at all. He has to pay tax in the normal way. Normal way means like a self-assessment tax, or else by way of TDS and TCS he can discharge his tax liability. That's all. Next one, friends. How many installments are there? And what are the ratios we need to pay the advance tax? So friends, advance tax we need to pay within 4 installments. I repeat, 4 quarters. So we need to pay advance tax within 4 installments. So please follow the due dates for the purpose of payment of advance tax installments. One by one we can check. First one, friends, on or before 15th June of the previous year. So for the first quarter, April, May, June, for that we need to pay on or before 15th June. So friends, 15% of estimated tax liability, that means 15% of advance tax liability we need to pay. Next one, friends, on or before 15th September of the previous year, we need to pay 45%. I repeat, 45%. Next one, on or before 15th December of the previous year, we need to pay 75%. Last one, on or before 15th March of the previous year, we need to pay 100% of the advance tax. So friends, for every year, we need to pay advance tax within 4 quarters. That is April, May, June, July, August, September, and October, November, December, and Jan, Feb, March. For first quarter, we need to pay on or before 15th June. For second quarter, we need to pay on or before 15th September. For third quarter, we need to pay on or before 15th December. For last quarter, we need to pay on or before 15th March. So in first quarter, we need to pay 15%. In second quarter, we need to pay 30%. But 15 plus 30, total 45%. Whereas in third quarter, we need to pay another percentage 30%. So 45 plus 30, that is 75%. And in last quarter, we need to pay balance 25. Altogether cumulative figures are 100%. So friends, lawmaker intention is very clear. He is requesting every SSE to discharge his 100% tax liability within the current previous year itself. That too, the due date is on or before 15th March of the previous year. That's all. So friends, here some relaxations also there. So that relaxation is applicable for those SSEs who is following presumptive taxation. Friends, those SSEs who are following presumptive taxation provisions under section 44 AD as well as section 44 ADA, okay, these persons has to pay advance tax only in one installment, the two, that is last installment, one and only final installment that must be paid on or before 15th March of the previous year. So friends, let us take one example here. Suppose one SSE Mr. X now is following presumptive taxation provision under section 44 AD. In this case, he has to pay advance tax in only one installment, the two, that is nothing but last installment. That means he has to pay on or before 15th March of the year, he has to pay that single installment. So this is the concept called as advance tax. Friends, in case of advance tax, delay payment or else short payment, we need to pay interest also. So friends, here there are two interest. First one is called as interest under section 234B. And the next one is called as interest under section 234C. Friends, interest under section 234B is applicable for short payment of advance tax as well as non-payment of advance tax. Whereas interest under section 234C is applicable for delay in payment of installment of advance tax. Okay, so in that case 234C interest is applicable. So friends, there are total two sections are applicable for the purpose of levy of interest. That is, first one is 234B and the next one is 234C. Okay, now see the material ones. Section 207, that is nothing but advance tax. Advance tax is a tax which is payable in the financial year itself, in the current year itself, in the previous year itself. Next one, section 208, that is applicability. So every SSC whose estimated tax liability is 10,000 or more than 10,000, he has to pay advance tax. But one exception, it is not applicable for a resident as well as a senior citizen who does not have income under their business or profession. And next one, computation is as follows. First, estimate your income under the head salary, house property, business or profession, capital gain, other sources all together, and take all possible deductions and calculate total income and calculate tax liability. So like that, first you have to do calculate estimated total income as well as estimated tax liability. So see the word. So estimate current year income. Number 2, compute tax on such estimated income. Number 3, add surcharge as well as education cess in normal way. Number next, any TDS or any TCS or any relief under section 89 we need to deduct, and the balance amount must be paid in installments provided that amount is 10,000 or else more than 10,000. Next one, installments must be paid as per the section 211. Now the 211 is as follows. 4 installments. First installment, that is on or before 15th June. Second installment on or before 15th September. Third installment on or before 15th December. Last installment on or before 15th March. Percentages, minimum 15% in the first quarter, second quarter 45% cumulative figure, third quarter 75% cumulative figure, last quarter 100% cumulative figure. And next one, ultimately whatever the tax you paid on or before 31st March of the previous year will also be considered as a advance tax. And next one, whatever the advance tax you paid, that advance tax will be allowed as a credit. It can be adjusted in the future tax liability. Against future tax liability, we can reduce that advance tax. Whatever amount we paid, we can deduct. Okay, next, interest portion, section 234B, that is interest for non-payment or short payment of advance tax. 234B. So friends, if any person not at all paid any advance tax, or else he paid less than 90% of assessed tax, in that case he has to pay interest at the rate of 1% per month or part of the month. The two, he has to pay for a period that commencing from 1st April of assessment year 2 up to the date of actual payment. He has to calculate the interest and he has to pay. And the principal amount is nothing but difference between assessed tax as well as advance tax. How much is the amount payable, how much you paid, the differential amount is only subject to interest at the rate of 1% per month or part of the month, and number of months are nothing but the period starting from 1st April of the assessment year 2 up to the actual date of payment. So this is the interest under section 234B. And last section friends, interest under section 234C, that is nothing but delay payment of advance tax. So friends, advance tax will be payable in 4 installments. If anybody paid lately, in that case that person has to pay interest. That person has to pay interest at the rate of 1% per month or part of the month for 3 months in first quarter. Second quarter also the differential amount into 1% per month or part of the month into 3 months, and third quarter also the differential amount into 1% per month or part of the month into 3 months. But whereas in case of last quarter, whatever the differential amount into 1% per month or part of the month into 1. month we have to take it. And next and last one, friends, in case of those SSCs who are covered under section 44 AD and 44 ADA, they are also liable to pay interest at the rate of 1% per month or part of the month. Okay, chalo. So friends, these interest section not applicable. Interest under section 234C is not applicable even in case of delay of payment of advance tax because of the following amounts. Number one, capital gains. We can't estimate capital gain every time correctly, therefore estimation will be very negligible way. Estimation is not at all possible. Therefore, in case of capital gains, even though you made late payment, there is no question of interest under section 234C. And same way, casual income, that is winning from lotteries, card games and all, because of that also there is no question of interest under section 234C. And last one, that is new business or profession. In case of new business or profession, once you commence it for the first time, on that whatever the delay happened, that no need to pay interest under section 234C. And last one, dividend, that is deemed dividend under section 222 A, B, C, D. In this following cases also estimation may not be possible, so therefore whatever the interest is there, that no need to calculate. Okay, chalo. So friends, in the following cases, capital gains as well as casual income as well as business or profession as well as dividend income, we need to pay the advance tax portion at least on or before 31st March of the financial year. The two, there is no question of interest at all. So friends, with this we done with the topic called as advance tax, and we done with the concept called as interest. So friends, here interest under section 234B is applicable for short payment or non-payment of advance tax. Suppose advance tax I estimated, for example, 10 lakh rupees, but assessed tax means what is the tax computed by the assessing officer, let us say 25 lakhs. So friends, this is called as assessed tax, whereas 10 lakh is the advance tax whatever that computed by the SSC. So if you made the payment less than 90% of assessed tax, in this case on the differential amount, that is 15 lakh no into 1% per month or part of the month, and that interest must be calculated per a period commencing from 1st April of the assessment year 2 up to the last day of the payment. The day when you made the payment, up to that period we need to calculate interest under section 234B. This is called as interest in case of advance tax short payment or non-payment. Whereas interest under section 234C, see the first quarter, okay, that is on or before 15th June, and the second quarter on or before 15th September, last quarter on or before 15th December, and another one is on or before 15th March. So how much we paid, that examiner will give you. And what is the amount payable, you know, payable we know that is 15% and 45% and 75%, and the last one is 100%. And calculate the differential amount. Okay, suppose we paid only 10% but payable is 15%. In this case, see the differential amount. The differential amount into 1% into 3 months. In the second quarter also, how much we paid cumulatively, how much you paid, how much payable, 45%. The differential amount into 1% into 3 months. Whereas in the third quarter, how much you paid and payable is 75%, differential amount into 1% into 3 months. Whereas in the last quarter, how much we paid and how much is payable, and the differential amount, if any, into 1% into 1 month. But here one small change, in case of first quarter, no need to pay 15%, at least we have to pay 12%. If you made payment less than 12%, then we need to calculate interest. and in the second quarter also no need to pay 45%. For this interest computation purpose alone you can pay at least 36%. If you pay less than 36%, then we need to calculate differential amount, and we need to calculate interest at the rate of 1% per month or part of the month, and we need to calculate interest for minimum period of 3 months, 3 months, 3 months, 3 months. Whereas in the last case, last quarter, we need to calculate interest only for 1 month. Friends, thank you very much. With this, we're done with the topic called as advanced tax as well as interest. Okay. Friends, now we are going to start the topic that is TDS and TCS. A category topic, important topic for exam point of view. First, let's start the TDS portion. Friends, actually in Income Tax Act, there are two ways of making the payment of tax. One is a direct way, second one is indirect way. Direct way means that is nothing but advance tax or self-assessment tax. Indirect way is nothing but TDS or TCS. Let's start the topic TDS. Out of that, first section is 192. Friends, in case of section 192, that is TDS on payment of salary. Tomorrow once you qualified, if you do job, the payer will pay salary to you. On the salary amount, the payer will deduct tax at source. That is called as 192 TDS. Here payer, all SCs, because your employer can be individual, HUF, anybody, all SCs. Payee, not all SCs, only individuals. The two resident or non-resident, both are covered. Whereas TDS rates are nothing but slab rates. Exemption limits also nothing but slab rates, up to 2.5, up to 3 lakh or up to 5 lakh as the case may be. And whatever the payment made by payer to the payee in the relationship of employer and employee, that is subject to TDS under section 192. Here all the payments are covered, allowances, perquisites and retirement benefits, everything is covered. And same way we should give deductions as well as we should give importance to exempted portion of allowances, exempted portion of perquisites. We need to give importance also. That means we need to deduct that exemption portions. Rest of the payment is only subject to deduction of tax at source. Next one, friends, another topic that is called as 192A. That is 192A is nothing but premature withdrawal of amount from RPF. Sir, here payer is nothing but trustee, whereas payee is nothing but individual. Whenever you rendered services for a period of 5 years or more than 5 years in an organization, if you withdraw any PF amount, that is not at all subject to TDS. But if you rendered services for a period less than 5 years and if you withdraw the amount, that leads to premature withdrawal of RPF. In case of premature withdrawal of RPF, 10% is the rate of TDS. Whereas PAN number is not punished, then MMR is the rate of TDS. And your exemption limit is also 50,000. If you rendered services for a minimum period of 5 years, there is no TDS. Less than 5 years, automatically TDS is applicable. Next one, friends, 193. That is nothing but interest on securities like debentures, bonds, etc. Here payer means all SCs, payee means all SCs being resident. TDS rate 10%. The two, friends, if the payment is made to government, no TDS. If the payment is made to insurer, no TDS. If the payment is made with respect to demat securities, no TDS. And if the payment is made to other insurer owned by insurer, that is also not subject to TDS. And exemption limits 10,000 in case of 8% savings bonds or 7.75% savings bond. Whereas in case of individual and HUF, if the interest amount paid by the widely held company does not exceed 5,000, then automatically no TDS. So your exemption limit is 10,000 or 5,000 as the case may be. Sir, this is nothing but interest on debentures or interest on bonds, etc. Next one, friends, 194. That is nothing but interest topic already over now. This is dividend topic. Corporate assessee will pay the dividend. So payer company, pay is nothing but any person being resident. TDS rate 10% if PAN number is not furnished MMR. So whatever the dividend paid to insurer, that is not subject to TDS. Exemption limit is 5,000. Up to 5,000 no TDS. And next one friends, 194A, that is nothing but TDS on payment of interest other than interest on securities. I repeat, any interest is covered other than interest on securities. Here payer, all assessees other than individual and HF whose turnover during the preceding financial year does not exceed 1 crore, whereas proportional receipt does not exceed 50 lakhs. I repeat, only individual and HF whose last year turnover we need to check, that turnover does not exceed 1 crore, whereas proportional receipts does not exceed 50 lakh. Whereas pay is nothing but any resident, and the rate is also 10% rate of TDS, and whatever the interest paid, interest on income tax refund no TDS, savings bank current account no TDS, whereas interest paid to banks no TDS, whereas interest paid by cooperative society to its members or else any other cooperative society no TDS, whereas interest paid on Kisan Vikas Patra like this notified bonds also not subject to TDS. But very important point, exemption limit 40,000 is the exemption limit in case of payment made, interest amount paid, then 40,000 is the limit. Whereas if interest is paid in case of senior citizen, 50,000 is the limit. I repeat, if the banks or financial institution or post office paid the interest, in case of normal citizen 40, in case of senior citizen 50, whereas in all other cases 5,000 is the limit. Okay, chalo friends, this is the exemption limits applicable with respect to interest other than interest on securities. Friends, interest on securities already we covered under section 193, but other than interest on securities means that is covered under section 194A. Next one friends, next topic 194B and 194BB. Now it is time for 194B. What is 194B, you know? Friends, winning from lotteries. In case of casual income, winning from lotteries, card games, etc., everything is covered except horse races. In that case, payer all assessees, payee also all assessees, whereas tax rate is 30%. Exemption limit is 10,000. I repeat, exemption limit is 10,000. Okay, chalo. Whereas in case of 194BB, that is only casual income being horse races. In this case, payer all assessees like bookmaker, whereas payee is nothing but all assessees, whereas tax rate is 30% and exemption limit is 10,000. So conclusion friends, 194B is applicable for entire casual income other than horse races, whereas 194BB is applicable only for winning from horse races. Okay, chalo. Next one, most important one, 194C, that is nothing but contracts. TDS applicable on contractual payments. Sir, here payer is nothing but all SCs other than individual and HF whose last year turnover does not exceed 1 crore, whereas last year proportional receipts does not exceed 50 lakh. Pay means all SCs. Here TDS rate, that is nothing but in case of individual HF 1%, whereas in case of others that is 2%. On the two, exemption limit in case of single contract 30,000. In case of multiple contract, aggregate amount does not exceed 1 crore. Whereas friends, other information is as follows. In case of lorries, that is goods transport agencies, generally there is no question of TDS, provided SSC does not own more than 10 vehicles. In that case, there is no question of TDS. And same way friends, any contracts entered for the purpose of personal nature, that is like individual and HF for personal purpose, there is no question of TDS. Okay, very important concept it is. Next one, 194D, that is nothing but insurance commission paid. You know friends, LIC and these kind of insurance companies will pay commission to the LIC agents. So here payer is nothing but the insurer, pay is nothing but any person, whereas TDS rate that is 5%, exemption limit is 15,000. Next one, 194DA, that is nothing but insurance compensation received, insurance amount received. In this case, payer all SCs, payee also all SCs. TDS rate, that is nothing but year 5%, whereas TDS is applicable provided if the amount is more than 1 lakh. The two friends, the TDS amount is applicable only if the insurance compensation is not exempted under section 1010D. If it is exempted under section 1010D, then there is no question of TDS. Okay, chalo. Next point ma, that is 194E, E for entertainers. Remember like that. That is TDS in case of making the payment to non-resident sports person, non-resident entertainer, and non-resident sports bodies. I repeat, only foreigners, the two non-resident sports persons only covered. In this case, whatever the payment made to this non-resident sports body, non-resident sports person, non-resident sports entertainer, or any entertainer, then automatically TDS is applicable at the rate of 20%, and such anyhow applicable, and health and education says anyhow 4% is applicable. So these are covered only with respect to payments made to NR non-residents. Okay, chalo. Next one, 194EE, that is payment of deposit under NCS, that is National Savings Schemes. In this case, any person can pay the money with respect to individual and HUF, that to TDS rate 10%. The two friends, 2500 is the exemption limit. This is only for national savings schemes. Whereas 194G, that is nothing but commission on sale of lottery tickets. In this case, payer all SCs, payee also all SCs, whereas rate of TDS, that is 5%, exemption limit 15,000. This is commission with respect to sale of lottery tickets. Next one, very very important one, that is nothing but 194H, very very important, TDS on other commission. Friends, so far we covered 194D, that is nothing but insurance commission, whereas 194G, that is nothing but commission on sale of lottery tickets. Now it is time for 194H. Any other commission, any other brokerage is covered. Payer all SCs, payee also all SCs, rate of TDS, that is 5%, exemption limit 15,000 rupees. Okay, chalo. Last of its kind, that is 194I. Friends, 194I is nothing but, that is TDS on payment of rent. I repeat, TDS on payment of rent. Friends, in case of payment of rent, the payer is all SSEs other than individual and HUF whose last year turnover does not exceed 1 crore, or else professional receipts does not exceed 50 lakh. Your pay is nothing but all SCs, whereas rate of TDS in case of let out of plant and machinery as well as equipments, that is 2%, whereas in case of let out of building and furniture, the rate of TDS is 10%. Friends, here exemption limit is 2,40,000. I repeat, 2,40,000 per annum. That too, friends, if the property is owned by co-owners and if each share is defined clearly, in this case 2,40,000 exemption is applicable for each co-owner separately. I repeat, for each co-owner 2,40,000 is the limit. Okay, chalo. Friends, so far I covered the topic section 192, TDS on payment of salary. Next one we covered section number 192A, premature withdrawal of RPF amount. Section number 193, interest on securities. Section number 194, that is dividend amount. Section number 194A, interest other than interest on securities. Section number 194B, casual income other than winning from horse races. Section number 194BB, winning from horse races. Section number 194C, payment to contractuals. Whereas 194D, insurance commission. Whereas 194G, commission on sale of lottery tickets. 194H, any other commission. 194E, payment to non-resident sports person, non-resident sports body, non-resident entertainer. 194EE, that is payment with respect to national savings scheme. Whereas 194I, that is payment on payment of rent, TDS with respect to payment of rent. These things are covered under TDS chapter. Okay, fine. Rest of the TDS points we are going to cover right now. Friends, our next topic is section 194 IA. Remember the word IA means immovable asset. I repeat, memory code, immovable asset. That means if you purchase any immovable asset, at that time we need to pay some consideration. On that consideration compulsory we need to deduct tax, that is called as TDS on payment of consideration for purchase of immovable property. Important topic, because many people wanted to buy the house properties for their personal purpose or else commercial purpose. At that time obviously they will pay the money. That payment is subject to TDS under section 194 IA. See the provision friends. TDS on payment on transfer of certain immovable property. That to your exemption limit 50 lakh rupees. Friends, if it is less than 50 lakh, there is no TDS. Exactly 50 lakh or above 50 lakh, obviously TDS is applicable. That too friends, the consideration shall include all charges in the nature of club membership or else electricity deposit, whatever the amenities purpose. If you pay the amount all together, we need to check. If you pay the amount more than 50 lakh or equivalent to 50 lakh, 100% on payment of each installment you have to deduct TDS. Friends, here payer is nothing but here all SSCs are covered. Okay, any person being transferee, that means who are making the payment to the person, that is covered. All the SSCs are covered. Next one here, payee is nothing but transferor, that means who is transferring the property, and the rate of TDS is nothing but 1%. And friends, here exemption is nothing but rural agricultural land is not subject to TDS at all, because rural agricultural land is not at all taxable, therefore there is no question of TDS. So friends, this is the topic section 194 IA, important topic, that is memory code. IA means immovable asset. If you want to buy any immovable property, so someone will transfer to me, the fellow is called as transferor, he is the payee. I am the transferee, I am the payer, I will make the payment. On the payment I will deduct TDS at the rate of 1%. That's all. This is the topic friends. So the consideration is equivalent to 50 lakh or above 50 lakh, then only TDS applicable. If it is less than 50 lakh, no question of TDS. The two friends, the consideration may consisting of club membership or else parking charges, that means parking slot allotted no, or else amount paid for all other amenities, everything is covered. Chalo. Next one friends, 194 IB, that is nothing but TDS on payment of rent. Friends, already we covered 194 I. 194 I is nothing but TDS on payment of rent, whereas 194 IB is nothing but TDS on payment of rent by two members, that is individuals or HUF. If the rent payment is made by individual and HUF, that is covered under section 194 IB. Friends, here payer is nothing but, see the word, individual and HUF who are not covered under section 194 I. That means individual and HUF whose last year turnover does not exceed 1 crore or last year business receipts or professional receipt does not exceed 50 lakh. Sir, in case of profession the limit is 50 lakh, whereas in case of business the limit is 1 crore. Last year their turnover does not exceed 1 crore, whereas last year their professional gross receipts does not exceed 50 lakh. That persons are called as payer, whereas payee means all other persons. Whereas TDS rate is 5%, and that too friends, the rent exceeding 50,000, in this case only that 50,000 per month, in that case only TDS is applicable under section 194 IB. That means 194 I is applicable all SSC's general sense, whereas IB is applicable to only for individual and HUF, that too whose last year turnover, that is does not exceed 1 crore or else 50 lakh, as the case may be. With respect to business 1 crore, whereas with respect to professional receipts, that is 50 lakh. Next one friends, 194 IC. Friends, that is nothing but joint development agreement, JDA, that is covered under section 45 subsection 5A. Any payment covered under joint development agreement, that is subject to TDS under section 194 IC. Here payer all SCs, payee also all SCs being resident, the rate is 10%. Okay, chalo. Joint development agreement means, you know, I have one land, that land I surrendered to one person, the person only will construct the building on that and will give the consideration in the form of part of the building he will give as a consideration. So this is called a joint development agreement, that is covered under section 194 IC. The person who is transferred the asset, that fellow will get some consideration in the form of kind. Okay, chalo. Next one, very important, 194J, that is nothing but TDS on provisional payments. Friends, any provisional payment or any technical services related payment or non-compete fees or director remuneration, these are covered. I repeat, provisional or else technical or else non-compete fees or else director's remuneration, these payments are covered. And royalty is also covered. Friends, exemption limit is 30,000 for each payment. For professional 30,000 is the limit. For technical also 30,000 is the limit. For royalty also 30,000 is the limit. For non-compete fees also 30,000 is the separate limit. Whereas for director remuneration there is no limit at all. Friends, here the TDS payer is nothing but all assets subject to certain turnover limit. Anyhow friends, that already we covered in section 194A. Whereas payee is nothing but resident SSC only. The two friends, a TDS rate is 2% in case of call centers, whereas in case of other cases that is 10%. Friends, this is applicable only for business related transaction. But if it is personal in nature, no TDS. See the word. If the payment is made by individual or HEF for personal purpose, exclusively for personal purpose, there is no question of TDS. Suppose for your personal education purpose or some any reason, personal reasons, if you take these services and if you make payment under these sections, there is no question of TDS. In all other cases, TDS is applicable. Friends, next topic is called as 194K. That is nothing but income in respect of units of mutual funds. Friends, here payer is nothing but all assets. Pay is nothing but resident individuals or resident any person, whereas tax rate is 10% and that exemption limit is 5,000. So in case of income on mutual funds, if it is exceeding 5,000, then only TDS applicable under section 194K. Next one, 194LA, that is a compulsory acquisition. Friends, in case of compensation paid for compulsory acquisition of immovable property, then the question of TDS under section 194LA will arise. Here payer means all assets, payee means all assets being resident, whereas TDS certificate, that is form number 16 series only, whereas TDS rate is nothing but 10%, and friends, the exemption limit is 2,50,000 per annum. Whereas if the compensation is paid for agricultural land, rural agricultural land or else urban agricultural land, generally no question of TDS. Other than any agricultural land, if you do compulsory acquisition of immovable property, on that if you make any kind of payment, that is subject to TDS under section 194LA. Friends, next one is called as 194M. Very important. That is nothing but in case of payment to contractors, whereas commission or brokerage or else fees for professional services. Friends, if you observe carefully, payment to contractors is covered under 194C, whereas brokerage and commission covered under 194H, whereas professional services covered under section 194J. Friends, generally these are covered under 194C, 194H, 194J, but those which are not covered, not subject to TDS under those sections 194C, 194H, 194J, they are covered under TDS under section 194M. Here payer is nothing but individual and HEF other than those who are required to deduct TDS under section 194C, 194H, 194J, whereas payee is nothing but resident SSC anybody, whereas the TDS rate 5%, exemption limit is 50 lakh. If it is exceeding 50 lakh, TDS applicable. Okay, chalo. So friends, if it is not covered under section 194C, not covered under 194H, not covered under 194J, then it is covered under section 194M. Next one friends, 194N, that is important topic, cash withdrawal from banks. Friends, if anybody withdraw up to 1 crore rupees, there is no TDS. If it is exceeds 1 crore rupees, on each and every withdrawal 2%, I repeat 2% is the TDS. Okay, but these provisions are anyhow not applicable if the payment is made to government, or payment is made to another bank, or payment is made to cooperative bank, or else white label ATM operator, or else any other notified persons, there is no question of TDS. Otherwise friends, if you or me or anyone will go to bank and withdraw the cash up to 1 crore, there is no TDS. Above 1 crore, compulsory on each and every withdrawal 2% is the TDS. Okay, chalo. But here I would like to tell you one special point friends. If you want to avail the 1 crore benefit, compulsory you have to submit your last 3 years returns. I repeat, last 3 years returns you have to submit. If you have not submitted, then the limit is not 1 crore friends. The limit is 20 lakhs only. If up to 20 lakh, if you do cash withdrawal, there is no TDS at all. About 20 lakh, pakka TDS is applicable at the rate of 5%. Okay, chalo. So take care. Compulsory, if you want to take the benefit of 1 crore, you have to submit your income tax returns for sure to the department. Then only up to 1 crore cash withdrawal they will not deduct. Above 1 crore, they will deduct 2% on each withdrawal. Suppose you have not submitted any income tax return to the government, then automatically up to 20 lakh there is no question of TDS. Above 20 lakh compulsory TDS will be deducted at the rate of 5%, and if it is exceeds 1 crore, automatically 2% TDS is applicable. Okay, chalo. Next one friends, 194O, that is nothing but payment by, I repeat, payment made by e-commerce operator for sale of goods or rendering of services. So friends, you know e-commerce operator called as Echo. Now on Echo some sellers will be there. I am the buyer. Suppose if I want to buy LG washing machine, the seller will supply to me. Automatically I will make the payment to Echo. The Echo means Amazon or Flipkart, etc. The person will make the payment to this seller, right? After returning their commission 15%, balance amount 85% they will pay to seller. At the time of making the payment to the seller, Echo will deduct TDS under section 194O. So friends, your payer is nothing but Echo. That means Amazon or else Flipkart. Whereas pay is nothing but any seller. See the word resident person being e-commerce participant. Whereas TDS rate is 1%. And friends, here exceeding 5 lakh, in case of resident is a individual and HF, and the two he furnishes the PAN, in this case 5 lakh. Friends, in all other cases, that means other than individual and HF, there is no exemption limit. Straight away each and every payment is subject to TDS. So friends, last but one TDS section 194P, that is nothing but total income of a specified senior citizen. Friends, this is the latest amendment. In case of senior citizens, the TDS under section 194P is applicable. Very simple logic. Banks will deduct TDS in case of senior citizen. I repeat, banks only will deduct TDS in case of senior citizen on separate slab rates after giving permissible deductions and rebates. The two friends, basic exemption limit is only the exemption here. So senior citizen, no, I can say directly 3 lakh or else 5 lakh respectively. Friends, if the total income of these senior citizens exceeds 3 lakh or 5 lakh as the case may be, in that case certain banks will deduct TDS, and the TDS amount will be remitted to the government on behalf of that senior citizen. So therefore senior citizens no need to file the returns also. Okay, chalo. Last one friends, that is 194Q, that is nothing but purchases. Purchase of any goods on or after 1/7/2021. In this case, payer is nothing but buyer, pay is nothing but resident seller. Friends, here TDS rate is 0.1% in excess of 50 lakh when PAN is provided. If PAN is not provided, that is not 0.5%, that is 5%. Okay, chalo. And friends, here this is these TDS provisions is applicable provided only if it is not covered under any other sections. Okay, chalo. And one more thing friends, the exemption limit is 50 lakhs. So you know, in Jairabad one company is there, Alana. That company is buying the goods from so many members. When they are purchasing the goods, compulsory they will make the payment. If the payment is more than 50 lakh, compulsory TDS must be deducted at the rate of 0.1%. If the PAN number is submitted by the opposite person payee, then the TDS rate is only 5%. Okay. If PAN number is submitted, that is 0.1%. If PAN number is not submitted, that is 5%. This is nothing but TDS on purchases. Friends, with this, TDS concept is done. Now it is time for other points. Please follow. Friends, time of deduction. I would like to tell you one thing. In one case, payment basis. What is the case? 192, 192A, whereas 194B as well as BB, and 194DA as well as 194LA as well as 194NPE. I repeat, 194NPE. In all the cases, that is EE. In all the cases, TDS is deductible on payment basis, only on payment basis. 192 means, friends, salaries. 192A, that is premature withdrawal of RPF, whereas 194B and BB is nothing but casual income. DA, that is insurance compensation. LA, compulsory acquisition. NPEE, in the three cases all together payment basis. If you make the payment, then only TDS applicable. No payment, no TDS. Whereas in case of 194, that is nothing but dividend case, TDS is applicable, friends, before making the payment or else before making any distribution of that reserves and surplus to the shareholders. Whereas in 194 IB, that is earlier of the following, that is nothing but rent, payment of rent by individuals and HUF who are not covered under section 194I. Friends, here TDS must be deducted earlier of the following, that is at the time of payment of rent or else at the time of credit of rent for the last month of the previous year or else last month of the tenancy if you are vacated in this year. Okay, so out of these three, ultimately whichever is earlier only we need to check it. Okay, so this is the time of deduction of TDS. Friends, in all other cases, simple answer, payment or credit whichever is earlier. Even though you paid or not paid, tax must be deducted at source. Next one, friends, surcharge. Friends, only in case of residents, salary payment is only subject to surcharge. Whereas in case of resident, other than salary payment is not subject to surcharge. That means I told you in many cases tax rate is 10%, 5%, 1% like this. Take it for granted, whatever the rates I specified, these are only the particular rates. 10% means 10 only. There is no surcharge and all. But in case of payment of salary, whatever the rate I specified, the rate should be added by surcharge rate also. But whereas in case of resident, other than salary, there is no question of addition of surcharge. Whereas in case of payment to non-resident, each and every payment is subject to surcharge also. Next one, no TDS on GST portion. Suppose I am paying of rent 10 lakh, on that GST, let us say 1.8 lakh. Total I am paying 11.8. Friends, on the TDS must be deducted on 10 lakh only, not on the GST portion. Next one, friends, these are other special points, please follow. As far as 194C is concerned, that is works contract. In case of works contract, TDS 100% applicable. Works contract is nothing but advertisement. Whenever MSET results or NEET results announced, no, so many people will give advertisement through a TV9 or to some organizations. That is called as advertisement. Advertisement contracts are covered under works contract, so TDS under 194C applicable. Next one, broadcasting and telecasting. Now TV channels broadcast some programs, TDS applicable under 194C. And transportation of goods, I repeat, lorries, transportation of goods, that is also TDS under 194C. Catering, so for college functions or else for any function, we will appoint some persons for catering, TDS applicable. And manufacturing of the goods and as for the specification of the customer by using the material supplied from the same customer. Friends, same customer will give the goods, and with that goods we will do some service and we will give it to him. That is called as works contract. All these are subject to TDS under section 194C. But here I would like to tell you one word. If the goods are taken from someone else and we only manufactured and we only given to third party, then these are come under purchases. Take it for granted, purchases are not subject to TDS under section 194C. Purchases are not come under 194C. For example, Bharati Cements given plastic material to one person, Mr. X. After that, the Mr. X, he made the bags and given back to Bharati Cement. Sir, this is called as works contract. Why? Goods we have taken and we manufactured certain things, and that means we made some services and returned back. This is come under the category of works contract. Whereas Bharati Cement approached Mr. X, then Mr. X purchased plastic from Mr. Z. After that, he made the bags and hand over to Mr. Bharati Cements. That is come under not works contract, that is come under purchase. Take it for granted, in case of purchase, no TDS applicable under 194C. Whereas in case of works contract, TDS is applicable under section 194C. Okay, chalo. And tell me friends, what about reimbursement of expenditure? On reimbursement of expenditure, there is no question of TDS. Same way, material supplied by the contractee, whether TDS applicable or not. Answer no. TDS is not applicable on the material value supplied by the contractee. Okay, chalo. And payment made by TV channels or broadcaster to production houses for their production content. Friends, if the program as per the specification of the broadcaster and copyright of the content is also transferred to this fellow, then that is come under works contract, TDS under 194C applicable. Whereas right of content already produced by the production houses is acquired by telecaster or broadcaster, in this case there is no TDS under 194C. Suppose Jabardast program, so the content is owned by Mallimala Productions. After that, they only broadcast the same on ETV. So moral of the story, content not transferred, only program only broadcast. This is not covered under works contract. This is not covered under what you call purchase. This is covered under works contract, TDS applicable, because content not transferred. Suppose if the writer come producer, all the members, they exclusive rights they transfer to ETV, then it is not at all subject to TDS under section 194C. Next one friends, 194N. Already I told you friends, here exemption limit is 1 crore rupee. But in some cases exemption limit is 20 lakhs. General cases 20 lakh is the exemption limit. Whereas if you submitted your last 3 years income tax returns to the banker, in this case the banker will not deduct TDS up to 1 crore. Over and above 1 crore is only subject to TDS. And next one, 194P, exemption for filing of return of income. Already I told you friends, in case of senior citizens, if their total income is more than BEL, in this case some specified banks will deduct TDS, that is called as 194P. Next one, 194Q. Friends, that is nothing but purchases. Okay, see the word buyer. For this purpose, a person whose total sales or gross receipts or turnover exceeds 10 crore rupees during the last year. I repeat, your buyer turnover must exceeds about 10 crore. And seller or recipient provides valid PAN number for this. In that case, TDS under section 194Q is applicable. Okay, chalo. The similar point we are going to discuss in the topic TCS. Next one friends, other provisions, 196. TDS is not applicable if the payee is government or bank or statutory corporation or mutual funds or new pension trust. Friends, TDS not applicable if the payee is government or else insurer, etc. Next one friends, 197. Lower deduction of TDS. You know what? If the SSC is in the opinion that his total income is less than BEL or else his total income is not subject to tax at all, in this case he can approach assessing officer for permission for the lower deduction of TDS. In this case, if assessing officer satisfied, he will give certificate for that. That certificate we can submit to the payer so that payer will deduct lower amount of TDS. Suppose my income is very less, so I am not subject to that higher rate of TDS, then I can request assessing officer, then assessing officer may give permission. With that, I will transfer that certificate to the payer. Payer will not deduct at higher rate, he will deduct at normal rates. And next one friends, 197A, that is nothing but no TDS. I repeat, no TDS. Example friends, SSC will submit a 15G or 15H form to the payer. Then payer will not deduct TDS. The best example, bank interest. Suppose I am a senior citizen whereas my bank interest is 1,20,000 or else 1,80,000 or else 2,40,000. Friends, in this case I will request my banker like this. Babu, I am a senior citizen, my exemption limit 3 lakh, but I have only interest income. Here my interest income 2,80,000 less than bill. Unnecessarily please don't deduct TDS. Like this I will give declaration in form number 15H. Whereas other than senior citizens will give the declaration in form number 15G to the banks. This is one example, okay? Or else rent also, okay? In case of rental payment also, some persons will give the declaration. For example, I am the building owner. Masterminds is my tenant. So one day I given declaration to Mastermind, Babu, my income is only rental income. That too, my rental income is less than basic exemption limit. I don't have any other income, only rental income. That too, the rental income is less than basic exemption limit. Please don't deduct TDS. Like this, I will request the Masterminds. Then Masterminds will take the declaration from me in form number 15G if I am a other citizen. If I am a senior citizen, 15H. After that, they will never ever deduct TDS in this case. This is the point. Next one friends, 198. TDS shall be deemed to be the income of the payee except TDS paid by the employer on non-monetary perquisites or TDS deducted under section 194N. Friends, whatever the TDS I deducted, that is obviously pertaining to the payee only. In the payee account we will show it anyhow. Next one, 199. Friends, TDS credit is available to the person from whose deduction is made. Friends, if I deduct in your account, automatically that amount will be reflected in your 26As. In your income tax return, you can take it as a credit. That means total tax liability minus TDS we will write now. That is nothing but TDS credit. Okay, chalo. This is available to the person in whose account we deducted. But two exceptions. In case of clubbing credit available to a person in whose hands the income is ultimately taxable. Friends, in case of clubbing of income, so this will be allowed to other person in whose hands we did clubbing. And next one, in case of tax paid by the employer from his own pocket on non-monetary perquisites, in this case employee only can take the credit. Actually deducted by the employer, but paid by the employer to the government, but the credit will be available to employee itself. Okay, chalo. Next one, very important topic, interest on late deduction of TDS or late payment of TDS. Friends, in delay in deduction of TDS, 1% per month or part of the month. 1% means 12% per annum, 1% per month or part of the month. That too, from the day on which TDS was deductible till which the day TDS actually deducted. Actual due date to the day when actually deducted, up to that period we need to calculate interest 1% per month or part of the month. Whereas in case of delay in deposit 1.5%, indirectly 18%, 1.5% per month or part of the month will be calculated as a interest from the date on which TDS actually deducted till the day when actually paid to the government. So friends, first point is delay in deduction, then 1% per month or part of the month. Second one is deducted but not paid to the government, then 1.5% per month or part of the month. In first case, we have not deducted at all, or else we deducted lately, then 1%. Whereas second case, we deducted but not remitted to the government, then it is 1.5%. Friends, with this, we done with the topic called as TDS. Okay, very important chapter for exam point of view. Friends, now we are going to start the topic, that is TCS, tax collected at source. Friends, let's start with the first topic, that is section 206C subsection 1. That is nothing but TCS on sale of goods. Friends, here there are two parties. First one is the seller, second one is the buyer. Seller will sell the goods to the buyer, then buyer will pay the consideration. Let us say buyer will pay the amount of 10 lakh. Friends, on the 10 lakh, he has to pay some extra money, that is called as tax. The extra amount collected by the seller from the buyer, the extra money is called as TCS, that is called as tax collected at source. So here the person who is liable to make TCS is nothing but seller. The TCS will be collected from the buyer. That too, that is collected on sale of goods. That too, friends, the rates are as follows. I would like to tell you one technique here. Samantha, Telugu film industry. I repeat, Samantha, Telugu film industry. Number 1 actress. Okay na? Follow. Sam. S for, that is scrap. A for, that is alcoholic liquor for human consumption. M for, that is nothing but minerals. This Sam is nothing but 1% TCS rate. Whereas T for timber. Whereas F for forest produce, that is TF, that is 2.5%. Whereas another thing, last one is there, that is called as TL, that is tendu leaves, that is 5%. Okay, so all of you follow. Sam, that is nothing but Samantha, Telugu film leading actress. Okay, so follow. Sam, S for scrap. A for alcoholic liquor for human consumption. M for, that is nothing but minerals, being coal, etc., iron ore, etc., that is 1%. And the second one is TF, that is 2.5%. And TL, that is nothing but 5%. Okay, chalo. TL means tendu leaves. Here TF means timber as well as forest produce, that is 2.5, whereas tendu leaves, that is 5%. This is the concept called as TCS under section 206C subsection 1. Friends, next topic, 206C subsection 1C, that is nothing but TCS on lease or license of parking lot or toll plaza or mines or quarry, etc. Friends, this is nothing but parking lot allotted by one person to another person. So here the person who is liable to collect is called as lessor or else licensor or contractor. Whereas from whom it will be collected, no, lessee. The rate is no 2%. That too at the time of debit or receipt, whichever is earlier. Earlier case also same, at the time of debit, at the time of receipt, whichever is earlier. So this is TCS on lease or license of parking lot, etc. Whereas section 206C subsection 1F, that is nothing but sale of motor vehicle. I repeat, sale of motor vehicle. At the time, seller will collect TCS from the buyer at the rate of 1%, only at the time of receipt only. I repeat, at the time of receipt only. That too, if the car value exceeding 10 lakh, then only TCS applicable. If the car value is less than 10 lakh, then TCS is not at all applicable. That too, it is not applicable for wholesale sale, only applicable only for retail sale. If you and me purchase the cars, then only this TCS is applicable in case of purchase of motor vehicles. Friends, another topic is there, that is nothing but section 206C subsection 1G, that is TCS on overseas remittance or else an overseas tour program package. Friends, in this case, if any person avail these kind of services, that person is liable to pay some extra tax at the rate of 5%. I repeat, at the rate of 5%. If the remitted amount is for educational loan taken for financial institution, then the rate is not 5%, 0.5%. You know what? In case of remittances, I repeat, in case of remittances, the authorized dealer or else the seller of tour package operator, that person is the person who is liable to collect tax. From whom it will be collected? No, from the buyer of that authorized currency, that particular transaction, or else in case of sale of tour package, the person who is getting the benefit, the person who is getting the service, that fellow. And next one, at the time of debit or at the time of receipt, whichever is earlier. So friends, here the exemption limit is 7 lakh rupees. Up to 7 lakh there is no TCS. Above 7 lakh TCS is applicable. And last of its kind, that is section 260 subsection 1H, that is nothing but TCS on sale of any other goods. I repeat, any other goods. In this case, seller will collect the amount from the buyer, that too if the value exceeding 50 lakh rupees. In this case, 0.1% is the what you call TCS rate. Whereas if PAN number is not submitted, then that is nothing but 1% is the rate. Okay, chalo. So friends, if TCS PAN number, that person has submitted PAN number, then the TCS rate is 0.1%. If not submitted, that is 1%. Okay, and the exemption limit is 50 lakh rupees. That's all. This is the topic TCS is concerned. Here focus points, please follow friends. 260 subsection 1F. Friends, that is nothing but car. Okay, in case of purchase of cars in wholesale case, there is no question of TCS. Only TCS applicable in case of retail sale. Number 1. Number 2, TCS is applicable on sale of any motor vehicle provided the value exceeding 10 lakhs. Whether it is luxury item or not, immaterial. If the value exceeding 10 lakh, then only TCS applicable. That too, third point, TCS applicable on each and every sale, not aggregate sale. Suppose I bought the 4 cars. Out of that, 3 cars value is less than 10 lakh. 1 car value is more than 10 lakh. Then the value of car whose is more than 10 lakh is only subject to TCS. Other cars are not subject to TCS. Next one, any sale of motor vehicle exceeding 10 lakh, it would attract TCS at the rate of 1%, whether in cash or in check, bank payment or cash payment. And government institutions or notified persons are not subject to TCS in this case. Next one friends, 206C subsection 1H, that is nothing but purchase of goods. Friends, if buyer liable to deduct TDS under Income Tax Act, undeducted also, in this case TCS not applicable. First we need to check the TDS provision. If TDS is covered, for similar transaction TCS is not covered. For your information, if the TDS is covered under section 194Q, then no TCS under section 206C subsection 1H. Okay, next one, 206C subsection 1H not applicable in case of services sale. It is only applicable only for goods. That too, your seller means whose turnover is more than 10 crore in last year. And buyer means any person who is buying the goods other than government organization or notified persons. And friends, due date for payment of TDS and TCS, whereas in case of TDS is concerned 7th of the next month, generally in case of March month 30th April. Whereas in case of TCS, same answer 7th of the next month, whereas in case of March month, that is not 30th, that is 7th of April of the next year. Okay, chalo, this is the topic. Whereas due dates for filing of TDS and TCS returns as well as statement. Friends, with respect to returns are concerned, TDS TCS returns quarterly basis we need to file. So in case of TDS, that is nothing but 31st July, that means indirectly for first quarter after 1 month. So April, May, June gada, for that 1 month, that means 31st July. Whereas for 30th September ended, no, for second quarter 31st October, for third quarter 31st what you call January. Whereas for last quarter answer, that is 31st May, not April, 31st May. Whereas TCS returns are concerned, that is exactly 15 days before. Whereas TDS returns due date is 31st, but it is 15. See the word for first quarter 15th July, second quarter 15th October, third quarter 15th January, last quarter 15th May. Okay, chalo. Other points, fine 200 rupees per day of default under section 234E is applicable if TDS and TCS returns are filed after the due date. For each day, 200 rupees is the fine. Next one, if TDS TCS filed after 1 year of prescribed date, the penalty under section 271H ranging from minimum 10,000 maximum 1 lakh applicable. Minimum 10, maximum 1 lakh. Okay, chalo. And issuance of TDS certificates, in case of salary, form number 16, that annually we need to give, whereas in case of others, generally form number 16A, that we need to give on quarterly basis. Okay, chalo. Next one, friends, the here consequences for non-furnishing PAN or else non-filing of a return of income. So please follow, friends. This is the amended one, 206AA. That is nothing but no PAN details are submitted. Friends, if no PAN details are submitted, in this case, higher rate of TDS must be deducted. How much you know? That is nothing but rate specified in the Act, or else at the rate in force in the Finance Act, or else 20%. I repeat, 20% or rate specified in the Act. Whichever is higher, we need to deduct. That's all. But in case of 194Q, that is 5%. 194O also 5%. Okay, not 20%, 5%. And one more thing, wherever tax is deductible at a higher rate than 20%, then the provision would not have any impact on any impact. Generally, the 20 or 30%, whichever is higher, only applicable. Then indirectly 206A not applicable. Okay, chalo. And next one, 206AB, that is nothing but person not submitted is PAN in case of TCS. Then the answer is all of you twice of the rate. I repeat, 2 times into rate, or else twice of the rate specified in the Finance Act budget, or 5%, whichever is higher. Okay, so double the rate of income tax rate, double the rate of Finance Act rate, and 5% out of all the three, whichever is higher shall be considered. Same way, whenever 206AB is not applicable in case of tax deductible at source under 192, 192A, 194B, 194BB, and 194N, that is not applicable. Okay. Next one, specified person here. Specified person is nothing but all of you, generally those persons, a person who has not filed the return of income for 2 assessment years. If you have not filed the return for 2 assessment years, then only these provisions are applicable. Okay, in this case 206AA is applicable. As for 206AA is concerned, the higher rates of TDS is applicable. See the word, in case of person, 206AA are also applicable to the specified person. In addition to these provisions of this section, then is required to deduct TDS higher of 2 rates provided in section 206AA and 206AB. Okay, if you have not filed the last 2 years return, higher rate of TDS shall be applicable. Okay, chalo. Friends, with this we done with the topic called as TDS as well as TCS, consequences for non-filing and consequences for not paying, as well as consequences for non-filing of normal income tax return. These points we have covered. Very important topic for exam point of view. Take care. Friends, in today's lecture we are going to cover the topic provisions related to filing of return of income, as well as another topic called as self-assessment. Friends, this chapter is very important for exam point of view. Out of this chapter, we can expect minimum 3 to 4 marks. That too, we can expect one theory question. Friends, very important chapter. Follow. First, I would like to start with one topic, section 139 subsection 1. That is nothing but voluntarily filing of return of income. That means the following assessees are required to file return of income without fail. Compulsorily, these persons are required to file return of income. Very important topic, please follow. Point number 1, assessees who are required to file return of income. So friends, here there are 3 categories. First one, every company as well as every partnership firm. Friends, if you are a company or if you are a partnership firm, take it for granted, irrespective of your income, irrespective of your profit, irrespective of your loss, compulsorily we have to file return of income. So every company and every firm mandatorily required to file return of income. Second one, other than company as well as other than partnership firm. That means, friends, individual, HUF, AOP, BOI, like that. These persons are also required to file their return of income mandatorily if their total income before claiming deduction under chapter 6A is more than basic exemption limit. So their total income plus their deductions which are claimed under section 80C to 80U, if it is more than basic exemption limit like 2,50,000 or else 3 lakh or else 5 lakh, in that case that SSEs are required to file return of income. So see the second one, friends, total income plus deduction under section 80C to 80U. In some cases we can claim exemptions under section 54 also. Exemptions under section 54 are nothing but capital gain exemptions. Now this total income plus deduction under section 80C to 80U plus if any exemption claimed under section 54, we need to add it back. If it is more than threshold limit, more than basic exemption limit, in that case that person's compulsory required to file return of income. Friends, this concept not applicable for partnership firm, not applicable for company. If you are a company and if you are a partnership firm, compulsory we have to file return of income. If you are a other than company and other than partnership firm, then we need to check your total income plus your deductions plus any exemptions under section 54. If it is greater than basic exemption limit, yes, you have to file return of income. And last one, friends, another category that is applicable only for resident but ordinary resident. I repeat, resident but ordinary resident, called as RBOR. In case of RBOR, resident but ordinary resident who are not covered above, above means in other categories. In that case, if they have any asset or else any financial interest which is located outside India, that person also required to file return of income. See the word, friends, any person being resident but ordinary resident, in that case if he is not required to furnish return of income under section 139(1), but he has any asset located outside India, in that case he has to file return of income. So friends, see the word, resident but ordinary resident being beneficial owner of any asset. Beneficial owner means the person who invested, the person who purchased the asset. So that fellow is called as beneficial owner. So beneficial owner of any asset including financial interest located outside India. That means, friends, shares in a company which is located in abroad, or else share in a partnership firm, or else investment made in abroad. In this case, that persons also required to file return of income even though their income is not more than basic exemption limit. And another point, friends, if the resident but ordinary resident is having any signing authority in relation to any asset located outside India, that person also required to file return of income. Any bank account signing authority if he has, like Swiss bank account he has which is located outside India, yes, that fellow has to file return of income. Who? Any beneficial owner who has any financial interest or who purchased the asset, or else who has signing authority of any bank account located outside India, that fellow required to file the return. Friends, sometimes beneficiary is also required to do so. Beneficiary means for whose benefit we bought the asset. I will take one example only for academic interest. Number one, Jayalalitha, Kumari Jayalalitha, she purchased some properties in Malaysia, but she took salary as 1 rupee as a salary per month, 1 rupee as a CM. Kumari Jayalalitha ma'am, she has taken 1 rupee as a salary. Now my point is 1 into 12, 12 rupees per annum, or total income is less than basic exemption limit, but she has assets located in Malaysia, therefore she is a beneficial owner of any asset located outside India, therefore she has to file the return of income. For example, Kumari Jayalalitha purchased the property in the name of her friend Sesikala. In that case, Sesikala is known as beneficiary, not beneficial owner, beneficiary. So, when beneficial owner is no more, then beneficiary of that asset is required to file the return of income. Okay, chalo. Friends, with this, we done with the topic called as who are required to file return of income. Friends, three categories I told you. Number one, every company as well as every firm. Number two, other than company and other than firm whose total income before claiming a deduction under section 80C to 80U plus before claiming capital gain exemptions is more than BEL. And same way friends, RB or resident but ordinary resident who has assets located outside India, that fellow is also required to file the return. But here beneficial owner has to file the return. If beneficial owner is no more, or else beneficial owner is not available, in this case beneficiary has to do, so he has to file return of income. Okay, chalo. Next one friends, another topic, what are the due dates for filing of return of income. The topic we can check now. Friends, before going into this, I would like to cover another point, special point, FDERP. Remember friends, what is FDERP? I would like to tell you within couple of seconds. But remember, FDERP is a memory code. What is that? Please follow friends. Mandatory requirement to file return of income. So far I told you three persons names, no? So every company and firm, and the second one, other than company and firm whose total income before deductions and before exemptions is more than BEL, and the last one is RBOR whose assets located outside India. These persons are required to file the return. Apart from this, another 5 more categories are there. Number one, if any person spend expenditure for foreign travel purpose exceeding 2 lakh rupees, irrespective of other factors, he has to file the return. F for foreign travel. Suppose you are travel to abroad, for that purpose you spend 3 lakh rupees. Yes, you have to file return of income. And the second one friends, deposited any amount, aggregate of amount exceeding 1 crore in current account maintained with any banks or cooperative banks, he has to file return of income. Example, my income is 0 because expenses and income is 0. Both are equal, therefore my net income is 0. So what happened? No, my deposits are more than 1 crore rupees. I deposited 1 crore rupees above in current account. Obviously, I need to file the return of income. Even though my net income is 0, if my deposits more than 1 crore are equivalent to 1 crore, in this case, if it is more than 1 crore, I need to file return of income. Next one friends, E for if any person expenditure incurred for consumption of electricity purpose more than 1 lakh. Friends, nowadays because of current bills, many persons are paying 2 lakh, 3 lakh current bills. If you have one commercial property, current bill obviously more than 1 lakh. Therefore, you have to file return of income. Next one is R for friends, claiming of exemptions under section 54 revenue. E for R for revenue, section 54, 54B, 54D, 54EE, 54F, 54G, 54GA, 54GB. Sir, if any person claiming exemption under section 54 series, if their total income before claiming these exemptions exceeds BEL, obviously that person is required to file return of income. Last one, P, prescribed conditions. Government may specify some more conditions in future, that fellows are also required to file return of income. So friends, total 8 categories I told you. First 3 categories I told you. Number 1, every company and firm. Number 2, other than company and firm whose total income before deductions more than BEL. Number 3, in case of RBOR resident but ordinary resident who has assets located outside India, that fellows are also required to file the return. Apart from this, FDRP, F for foreign travel expenditure more than 2 lakh, D for deposits more than 1 crore in current account, E for expenditure for electricity purpose more than 1 lakh, and R for exemptions claimed under section 54 plus their total income is more than basic exemption limit, they have to file the return of income. P for any prescribed conditions in future if satisfied, that fellows are required to file return of income as per section 139 subsection 1. So friends, another topic ma, what are the due dates for filing of return of income? Sir, the due dates are as follows. Number 1, on or before 30th November. 30th November. So of assessment year. So friends, those assessees who are required to file transfer pricing report, I repeat, transfer pricing report is called as a TP report under section 92E, that fellows are required to file on or before 30th November of the assessment year. Next one friends, 31st October. Sir, income of this year is taxable in the assessment year, right? So income tax return we need to file in the assessment year. In assessment year, on or before 30th November, we need to file return of income if you are subject to transfer pricing provisions. Number 2, if you are not subject to transfer pricing provisions, in this case you are supposed to file the return of income on or before 31st October of the assessment year if you are a company. If you are a company, audit is compulsory, no? Company audit. Therefore, some time limit they wanted to provide. That is the reason 31st October. Second one, friends, tax audit persons. Those persons who are subject to tax audit, that persons are also required to file the return of income on or before 31st October. Okay. And next one, friends, any partner of a firm whose accounts are required to get audited under section 44AB. I repeat, partner of a firm, the firm books are subject to tax audit. In that case, the firm anyhow has to file the return of income on or before 31st October, and the partner also required to file the return on or before 31st October. Friends, in all other cases, they are supposed to file the return of income on or before 31st July of the assessment year. Okay, friends, these are the due dates for filing of return of income. Okay, chalo, very important concept. Next one, friends, if you have not filed the return of income, compulsory we need to pay interest as well as we need to pay late fees also. Okay, and friends, in case of those assessees who file the return lately, they will have some disadvantages. That points also we are going to cover. Okay, now see the material. 139 subsection 1, filing of return of income. Number 1, every company and every firm compulsory. Number 2, others whose total income before deduction under chapter 6A more than well compulsory. Number 3, RB or resident but ordinary resident, beneficial owner of foreign assets or else beneficiary of any foreign assets, he has to file return of income. And after that, special category FDRP also I told you, F for foreign travel more than 2 lakh in a year, he has to file. And D for deposits in current account more than 1 crore, he has to file. E for electricity bill more than 1 lakh, you have to file. And next one is called as another topic called as R for total income plus exemption under section 54 more than BEL, they have to file. And prescribed conditions they have to file. Due dates just now I covered, that is 30th September as well as 31st October as well as 30th November. Once upon a time that is September, they change it to October. Okay, chalo. And another topic, friends, section 139 subsection 1C, certain cases central government may give relaxation. Certain persons are not required to file return of income at all. And another topic, very important topic, 234F, that is fees for default in filing of return of income. Very important, friends. 234F, F for fees. Which fees? Late fees. Now please follow, friends. Now income of this previous year is taxable in the assessment year. So in this previous year we will earn the income. That income we need to pay tax in the assessment year, and we need to file the return also in the assessment year. For example, my due date is 30th November, my due date. So I need to file on or before 30th November. Suppose if you file after, I repeat, after 30th November, obviously I need to pay late fees. How much is the late fees? You know, the late fees is nothing but rupees 5,000. That's all. Suppose If the person's total income does not exceed 5 lakh rupees, in that case, instead of 5,000, you have to pay the late fees of rupees 1,000. Okay, chalo. So friends, late fees under section 234F, that is 5,000. If their total income does not exceed 5 lakh, no, instead of 5,000, they have to pay the amount of late fees 1,000 itself. That's all. Next one, friends. 139 subsection 3, loss return. Please follow. Friends, if any SSE gets a loss, in that case, that SSE no need to file return of income. Honestly speaking, if no income, no return. Okay, if you get losses, no need to file return of income. If you get losses, where is the question of payment of tax? Therefore, no need to file return of income. No need to pay tax also. But one point, if you get the loss you want to carry forward for next year, after next year, after next year, after next year, after next year, like that. If you want to carry forward for subsequent period, you have to communicate to the department, right? For that purpose, take it for granted, you have to file return of income. If you want to carry forward the losses, I repeat, if you want to carry forward the losses, compulsory we need to file return of income. That too, you have to file the return of income within the time specified under section 139(1). So friends, conclusion, very simple point. Filing of loss return is not mandatory, but filing of loss return is mandatory if you want to carry forward losses. I repeat, if you want to carry forward the losses, it is mandatory to file loss return, that too within the time specified under section 139 subsection 1. Okay, chalo. But one thing for sure, in two cases, it is not at all mandatory for carry forward of losses. It is not at all mandatory to file the return within that time. Is not mandatory in two cases. One is house property loss, one is unabsorbed depreciation. Sir, in these two cases, even though you file the loss return belatedly, you can carry forward the losses. Okay, chalo. So follow friends, as per section 80, SSE is required to file the return of income within due date specified under section 139 section 1 for carry forward of losses. Number 1, business loss. Compulsory you have to file in time, then only business loss can be carry forward. Speculative business loss, same way you have to file in time for carry forward the losses. Under specified business loss 35 AD, yes, you have to file return within the time, then only you can carry forward. Same way capital gain, yes, same way any loss from the activity of owning and maintaining of resources. Sir, in the following cases, it is mandatory to file the return of income within the due date specified under section 139 subsection 1 for carry forward that losses. But two optionals, no? Number 1, house property loss. If you check house property loss, you can carry forward even though you file the return lately. In case of carry forward of unabsorbed depreciation also, you can carry forward even though the last return you filed lately. Okay, chalo. Sir, another focus points. Loss can be set off even if last return is filed belatedly. If you file last return even after the due date also, you can carry forward a set off. You can set off the losses, but take it for granted, you cannot carry forward. Next, house property losses and unabsorbed depreciation can carry forward even if late return is filed. Next, any return filed under section 139 subsection 3 is deemed to be filed under section 139 subsection 1. Sir, last return due date is nothing but 139 subsection 1 due date. Therefore, the return which is filed under section 139(3) is deemed to be filed under section 139(1). Next one, friends. If SSE submitted last return in response to notice issued under section 142 subsection 1, take it for granted that losses cannot be carried forward. Okay, chalo. And next one, if any losses occurred, in that case If you want to set off, no need to do anything. If you want to carry forward, compulsory we have to file that last return within the due date specified under section 139(1). But there are two relaxations. One is house property loss and another one is unobserved depreciation. Sir, if you file last return belatedly, you cannot carry forward the losses. Okay, but in certain cases you can take the permission of the prescribed authority for carry forward of the losses even though you file the last return belatedly. Number one, if your losses are up to 10 lakh rupees, you can take permission of CIT or PCIT. If your loss is more than 10 lakh up to 50 lakh, then you can take the permission of CCIT and PCCIT. And if your loss is more than 50 lakh, in that case you can take permission of CBDT and you can carry forward the losses. I will take one example. My name is Mr. X. My total losses 70 lakh, but because of my personal issues I filed the return lately. So therefore when I filed the last return belatedly, take it for granted that loss I cannot carry forward. In that case, what I can do, I have only one remedy. The remedy is nothing but I can approach CBDT and I can request, sir, please condone the delay of filing of my return. Please accept it. Then they may accept and they can allow you to carry forward the losses even though you filed your last return belatedly. Okay, chalo. But I would like to highlight one point. If you have losses up to 10 lakh, take the permission of CIT. If your losses are more than 10 lakh up to 50 lakh, take the permission of CCIT. If your losses are more than 50 lakh, take the permission of CBDT. Enough. This is the concept called as last return. Only in one sentence I would like to tell you. If you want to carry forward, only carry forward, not set off. If you want to carry forward losses, compulsory that year return, only that year return, you have to file within the due date specified under section 139 subsection 1. But this condition not mandatory for carry forward of losses of house property as well as unobserved depreciation. Enough. Next one, friends, another topic 139 subsection 4, that is nothing but late return. You know what? If you file the return within the due date, well and good. If you file the return after the due date, then that is called as late return or else belated return. Okay, fine. Sir, for late also one time is there, right? Suppose our college timings are morning 9 to 5. You came at 8:30, super. You came at 9, superb. You came at 9:30 or else you came at 4:30, yeah, that is known as late. Okay, suppose you came at 5:30, then it is not late. You are not come to college, you came to college for someone else purpose. Okay, moral of the story, if timings are 9 to 5, at least you have to come on or before 9. If not possible, you can come after 9 but before 5 o'clock. Suppose if you come after 5 o'clock, what is the fun of coming to college? If you come after 5 o'clock to the college, that means you are not latecomer, you are absentee. Same way, here also for filing of return, there is one due date. The due dates are specified under section 139(1). That is nothing but maybe that is 30th November or 31st October or else 31st July as the case may be. Suppose if you have not filed within the due date, if you filed after the due date, then that is called as late return. For late return, there is one time period. The time period is covered under section 139 subsection 4. 139 subsection 4, that is nothing but late return. Follow. If SSC fails to file the return within the due date, then he can file the return belatedly but within the following set period. You know what? Before 3 months prior to end of relevant assessment year. Sir, my previous year, let us say 21-22. My assessment year, let us say 22-23. Okay, chalo. Now take it for granted, friends. This previous year return you have to file in the assessment year. So my due date is, let us say, that is 30th November. In this case, you have to file the return on or before 30th November. Suppose if you filed after 30th November, then that is called as late return. But for filing of late return also there is a time period. What is the time period? Time period is nothing but 3 months prior to the end of assessment year. Sir, my previous year ending, 31st March 2022 year, my assessment year ending is 31st March 2023. For this period, minimum 3 months prior. 3 months prior means that is nothing but 31st December 2023. Sorry, 31st December 2022 or before completion of assessment under section 144. Sir, there is one concept called as best judgment assessment. So anyhow, before completion of assessment under section 144, out of these two periods, whichever is earlier. So take it for granted. For filing of late return also, time period is nothing but 31st December of the assessment year. Okay, 31st December of the assessment year. If my assessment year 22-23, then that is 31st December 2022. Suppose my assessment year is 23-24, then my deadline for filing of belated return is 31st December 2023. Because just 3 months prior to end of relevant assessment year. My assessment year ending is 31st March 2024, exactly 3 months before. That means 31st December 2023. Okay, or before completion of assessment under section 144, whichever is earlier. Enough, Babu. In case of belated return, there are some consequences. Number one consequence, you cannot carry forward of losses. I repeat, cannot carry forward of losses. Friends, few seconds before we covered, if you want to carry forward of losses, you have to file loss return in time. If you file loss return lately, you cannot carry forward certain losses. But exceptions, house property loss and unabsorbed depreciation you can carry forward even though you filed that loss return belatedly. Number two, certain income based deductions not allowed, like 80 IA, IB, IC, ID, 80 IO, IIO, IBABOY, these kind of deductions not allowed. Next, interest under section 234A shall be levied. That is 1% per month or part of the month, that interest shall be levied. Next one, late fees for late filing of return under section 234F, that is nothing but 5,000 rupees late fees shall be collected. But if your total income does not exceed 5 lakhs, then take it for granted late fees under section 234F is not 5,000, that is only 1,000. Okay, chalo. These are the consequences for late filing of return. Once again, I am telling you one word here. For late filing of return, the deadline is 3 months prior to end of relevant assessment year. Suppose my assessment year is 2024-25. That means 31st March 2025. For that 3 months prior, that means 31st December 2024. On or before 31st December of the assessment year, you have to file late return. If you want to file late return after 31st December of the relevant assessment year, then that is treated as no return. That is treated as invalid return. Okay, chalo. With this, we done with the topic called as 139 subsection 4, that is called as late return. Friends, 139 subsection 5, that is revised return. Please follow. SSE filed the return of income. but there are some omissions or there are some mistakes in that return. In that case, SRC can revise the first return. This concept is called as a revised return. See the word. Any person filed the return already under section 139(1) or else 139(3) or else 139(4). The two, there is some omission or wrong statement in such return. In that case, SSC can revise the earlier return. Okay, chalo friends. First one, SSC must file the return earlier, maybe under section 139(1) or else maybe under section 139 subsection 4, maybe under section 139 subsection 3. Plus, in that return, there are some omissions or else there are some misstatements. In that case, in order to rectify that omissions or that misstatements, SRC can file another fresh return. Such a fresh return is called as a revised return under section 139 subsection 5. Next one, what is the time limit for filing of revised return? That is nothing but before 3 months prior to end of relevant assessment year. Sir, my assessment year, let us say 2023-24, my assessment year. In this case, we can revise the return and we can file the revised return on or before, that is 3 months prior to the assessment year. 3 months prior means 31st December of assessment year, that is nothing but 31st December 2023, or completion of that assessment, whichever is earlier. Sir, already you filed one return, no doubt in that return there are some mistakes. In that case, that return can be rectified by you by filing another fresh return. That is, time limit is there before 3 months prior to end of relevant assessment year, or else already if assessment completed that particular date, out of these two dates, whichever is earlier. So 3 months prior to assessment year or else completion of assessment, whichever is earlier. That's all. 3 months prior means that is nothing but for the assessment year exactly 31st December of that assessment year. Suppose my assessment year 2024-25, in that case that answer is 31st December 2024. Okay, chalo. But focus points, other points, belated return filed under section 139 subsection 4 can also be revised. Next, a revised return substitutes original return. That means a revised return replaces original return. And next one, SSC can file a revised return any number of times. There is no restriction, but within the said period. Okay. Next, the effective return is nothing but revised return only. Whatever the revised return you filed, that only will be considered by the assessing officer. Next, assessment refers under section 143(3) scrutiny assessment or else 144, that is best judgment assessment. Okay, the return can be revised before date of passing of order under section 143(3) or 144, but not till the date of serving the order. Sir, before completion of assessment you can do rectification, okay, and you can file the revised return. Next one, the second revised return can be filed by correcting any omission or wrong statement made in the first revised return, because a revised return replaces the original return itself. Okay, so any number of times you can revise, there is no problem. Next, last return which filed under section 139 subsection 3 can also be revised, because the return filed under section 139 subsection 3 is equivalent to the return filed under section 139(1). Next one, a return filed in response to notice under section 147 or else 153A cannot be revised. So remember, only 143, I repeat, 139 subsection 1, 139 subsection 4, 139 subsection 3, these three returns only can be revised. So 147 and 153A, if you file the return under these sections, it cannot be revised. Next one, whether SSC has to pay interest under section 234A or not? Answer, no, because a revised return will be considered having been filed when the original return was filed. Sir, simply sir, one word, revised return step into shoes of the original return. Therefore, SSC no need to pay any interest under section 234A. Next one, friends, another concept, that is nothing but defective return, or else it is known as incomplete return. Follow, friends. If any SSC filed the return, the two no attachments made properly, or else no documents submitted properly, in that case that is called as incomplete return, or else known as defective return. Okay, in the case of defective return, assessing officer shall intimate to the SSC. Then SSC has to rectify the same within 15 days. If it is not rectified within 15 days, in that case it will be treated as invalid return. Very simple, friends. The return shall be considered as defective if the return is not filed in the prescribed form, or else a report of 44AB or any report not submitted, or else proof of payment of tax has not submitted. Next one, friends, assessing officer shall treat the return as a defective and shall intimate to the SSC and will give the opportunity to rectify. Then SSC has to rectify within 15 days from the date of such notice. If not rectified, it will be treated as invalid return. But one thing for sure, friends, if you have not paid the tax, I repeat, if you have not paid the self-assessment tax fully, in this case such return will not be treated as defective return. See the word, if self-assessment tax has not paid fully, then also such return will not be treated as defective. You won't believe, this question placed 3 times in CA final, 3 times, thrice. Next one, if certificate of TDS and TCS not submitted, then also that return is not treated as defective. Okay, 2 cases, friends. Number 1, self-assessment tax not paid fully or else not at all paid. In this case, it will not be treated as defective return. And same way, if certificate of TDS and TCS not submitted, then also it is not treated as defective return. Okay, chalo. Next, another topic, friends, 139 subsection 1A. This is nothing but bulk return. I repeat, bulk return. You know what is bulk return? Very simple, friends. Employees can file the return through employer. Then employer will file the return with the department. I repeat, employee, instead of filing directly to the department, employee will file the return to the employer. Then employer also take the bulk returns collected from the employees and will submit to the department. This concept is called as bulk return. Not at all important. The bulk return concept is only optional. This option is given to the employee. If employee willing to do so, employee can file the return through employer to the department. So this is the reason it is known as filing of return through employer. Okay, chalo. Next one, friends, 139A, very important topic, PAN, that is a permanent account number. Sir, there is a 10-digit alphanumeric number. I repeat, 10-digit alphanumeric number, the two permanent number, unique number, lifetime validity number, that is called as PAN, permanent account number. So certain persons are required to apply for PAN. Okay, chalo. And what is the time limit for such application? These points I am going to explain right now. Follow. Every person whose total income is more than basic exemption limit, he has to apply for PAN. Suppose if your income is more than 2,50,000 or else in some cases 3 lakh, in some cases 5 lakh, they have to apply for PAN on or before 31st May of the assessment year. Okay, so assessment year, that 31st May before or on the day at least you have to apply for PAN. Okay, next one, every person carrying any business or profession and gross turnover is 5 lakh or more. 5 lakhs or more, in that case before end of the previous year he has to apply for PAN. Sir, your business turnover, let us say 6 lakh or 5.5 lakh, yes, you have to apply for PAN for the first time on or before end of the previous year. And next one friends, in case of any person other than individual who enters any financial transaction more than 2,50,000 or equivalent to 2,50,000, in this case on or before 31st May of that year you have to apply for PAN. For example, I only company, I only paid amount of let us say 3 lakh to one fellow, obviously I need to apply for PAN. Next one friends, in case of authorized person, okay, that is authorized signatory as per section 140, like in case of company managing director or else director or else managing partner or else partner, trustee, author, founder of the trust and karta of HUF, these persons also required to apply for PAN on or before 31st May. Next one friends, another topic, cases where PAN to be quoted. So friends, usages of PAN, very important topic. Number one, if you purchase any motor vehicle, you have to apply for PAN. You have to quote the PAN compulsorily if you want to purchase any vehicle, motor vehicle other than two-wheeler. And next one friends, in case of savings bank account opening time, you have to apply for PAN. Application for savings bank account, at the time compulsory you have to quote your PAN. Next one friends, in case of credit card and debit card, we need to apply for PAN and we need to quote the PAN also. And opening of demat account, PAN compulsory. And payment to hotels or restaurant where any bill, I repeat, any bill exceeding 50,000, suppose one person is giving the treat in a restaurant and the bill amount is more than 50,000, quote the PAN is mandatory. And next one, payment in connection with the foreign travel, in that case if the expenditure is more than 50,000, at the time also PAN is compulsory. Friends, now other transactions, in case of purchase of mutual fund units, if it is more than 50,000, quoting of PAN is mandatory. In case of payment to any company for the purpose of debentures purchase as well as bonds purchase, if it is value is more than 50,000, PAN quoting is mandatory. And in case of payment to RBI for the purpose of their bonds, if the payment is more than 50,000 per annum, in this case it is mandatory to quote the PAN. And same way, deposit with any banking company or else deposit with any post office or cooperative bank, if the amount is more than 50,000, in this case quoting of PAN is mandatory. So friends, another topic is as follows, in case of demand draft, DDs or else banker's check, if the value is 50,000 above, in this case PAN is compulsory. And the same way friends, in case of time deposit, term deposit with the banking companies as well as post office and as well as Nidhi company as well as NBFC, if the value is more than 50,000 or else aggregate value is more than 5 lakh, quoting of PAN is compulsory. And friends, another topic is payment for one or more prepaid payments instruments, in this case if the value aggregating more than 50,000, PAN is compulsory to quote. And next one, in case of any contract for sale or purchase of immovable property other than shares, I repeat, immovable property, in this case also PAN compulsory if the value is more than 10 lakh rupees. Okay, any immovable property value, that means stamp duty value more than 10, it is compulsory. And next one friends, in this case of securities more than 1 lakh, I repeat, in case of securities other than shares more than 1 lakh, PAN quoting is mandatory. And the sale or purchase by any person of shares of any company which are not listed at all, unlisted shares more than 1 lakh, in this case PAN quoting is mandatory. And next one friends, sale or purchase by any person of any goods or services other than those referred above, if the value is more than 2 lakh, in this case quoting of PAN is compulsory. These points are important for exam point of view. Okay, fine. Next one friends, PAN and Aadhaar interchangeably we can use it. nowadays we need to link Aadhaar as well as PAN. Compulsory we need to do this one. And see the point, friends, every person who is required to quote or intimate his PAN may quote his Aadhaar if he has not been allotted a PAN but he possesses Aadhaar. Sir, you have the PAN number but you don't apply for Aadhaar or vice versa. In this case you can use interchangeably. Okay, chalo. And the next one, friends, another point here, very important point, 234H, that is fees for default in linking of Aadhaar and PAN. If anybody not linked Aadhaar with the PAN with Aadhaar, in this case compulsory they have to pay the fine of rupees, late fees, or that fine of rupees 1000. Next one, friends, 139B, that is TRP, tax return preparers. Sir, we can file the return with the chartered accountant. We can take the assistance of CARs, some professionals. Same way, CBDT introduced one concept called as TRP, tax return preparers. So any person can file the return through TRPs. Okay, that means TRPs are nothing but those persons who empowered by the CBDT to do so. But friends, TRP means an individual who authorized to do so other than the following persons. These persons are not covered as a TRPs, not CAs and not legal practitioners. CAs are not okay, as a TRP, and legal practitioners are also not a TRPs, and any bank employees, scheduled bank employees, these are also not covered, and any employees of or any specified class of persons which are notified by the government, these are also not act as a TRPs. And the last point, friends, very important point, these persons cannot file the return through TRP. So no return through TRPs. That means first one is company. Company cannot file the return with the TRP, and those persons whose books are subject to tax audit under section 44AB, these persons also cannot file the return of income through TRPs. Okay, chalo. Next one, friends, 139C, that is nothing but annexure. Follow. Now, if you want to file the return of income, it is mandatory to specify certain things. Number one, you have to specify the assets list also, and you have to specify the bank accounts list also. You have to specify. See the word CBDT to make rules providing for class or classes of persons who shall not require to furnish any certificate or audit report or any particular report or document or receipt along with their return of income, empower CBDT to make the rules for the following persons. That is a class of persons or particular group of persons who are mandatorily required to file the return of income electronically, and certain persons must use the DSC, that is digital signature, and some persons no need to use the digital signature. See the word 139D, that is filing of return in electronic form. Sir, certain persons compulsory required to file the return in electronic form, like a company as well as those persons whose books are subject to tax audit, and those persons who have assets located outside India, these persons compulsory required to file the return of income electronically. Okay, and last concept, very important concept, that is 140, signing and verification authority. I repeat, signing and verification authority. In case of individual himself, he can sign the document and he can verify and sign the document. If the individual is not in India, or else the individual unable to sign, in that case authorized person or legal representative, as the case may be, can sign. If he is in abroad, authorized person can sign. If he is a mentally retarded or incapable, in that case take it for granted legal guardian can sign. In case of HUF, Karta can sign. If Karta cannot sign, in that case all of you, any member can sign. I never told you next adult member. Any adult member can sign, maybe male or maybe female, any member can sign, but only adult member. In case of partnership firm, managing partner can sign. If managing partner unable to sign, then any partner can sign, but not minor. In case of LLP, designated partner can sign. If designated partner is not in India, then obviously any other partner also can sign. Next one, company. In case of company, MD can sign. If MD cannot sign, any other director also can sign. those companies which are in liquidation, the liquidator can sign. And next one, in case of certain companies, insolvency resolution process has been submitted. In this case, that insolvency professionals can do. And in case of political party, CEO, that is Chief Executive Officer, can sign. In case of local authority, Principal Officer can sign. In case of any other person, any other competent person to do so, or Principal Officer, that person can sign. Okay, these are the points. Out of this, most important one is HEF. In case of HEF Karta can sign. If Karta unable to sign, in that case, any other adult member can sign. Important question. Okay, in case of LLP, designated partner can sign. Friends, another simple point, 140A, that is self-assessment tax. At the time of filing of return of income under section 139 series, or else under section 142, or else under 147, or else under section 153A, any other topics, take it for granted, at the time of filing of return of income, SSC has to calculate the tax and pay the tax. The tax is called as self-assessment tax. Okay, first calculate, that means first everybody has to do calculation, after that everybody has to pay the tax, after that only we have to file the return. Okay, chalo. But if you pay short payment, no, if you make short payment of tax, in that case first it will be adjusted against interest as well as late fees. Okay, after that if anything balance amount is available, then such amount can be adjusted against tax balance, tax liability. Okay, chalo. This is the concept of self-assessment tax. This is covered under section 140A. The name itself indicates self-assessment tax is a tax which calculated and paid by the SSC itself. This is section 140A. So friends, this chapter is theoretical chapter, very important for exam point of view. Out of this chapter we can expect one question, minimum 3 to 4 marks question we can expect. So this is the chapter. Thank you very much.